I had a huge pain point. And that was a big motivation for me to save my money. My paycheck would come in twice a month. I would pay my expenses, pay my credit card bills. Every month it would go up 6,000, then go down 2,000, then go up 8,000, then go down 3,000. Steadily, it would be going up. So I know the life energy that it takes to save $20,000, $100,000. A lot of it is just time. And that's how this game is. It's not the get rich quick scheme, but if you can save your money and then also compound it and pay a lot less in taxes, that's how you get there a lot quicker. All right, welcome. First module of the Masterclass. My name is Lane Kawaoka. I will be doing an introduction of kind of my origin story, and which I think resonates with a lot of our clients, people who are stuck at their high-paying job. Most times an annual income of $100,000 is where I started in my 20s. And we had some folks that are multiple six-figure incomes, and also some business owners out there that have pretty high incomes too. Obviously, the goal is to prudently build their wealth the same way that I've learned that the wealthy do. And of course, money's not everything, but it does give you a lot of freedom to do what you want, where you want, with whom you want, and at least get you off living paycheck to paycheck, even though some of your folks' paychecks are rather large. Legal notice and disclaimer here. Of course, this presentation does not constitute the rendering of legal advice or services. The information is intended for informational use only and is not a substitute for legal advice. If you guys are looking for referrals, as always, reach out to team@wealthelevator.com and we can connect you with the folks that we recommend and found out there. But of course, state, national, and international laws vary, as do individual circumstances. As always, consult a qualified attorney on all legal matters. So just a little snapshot on myself and our company. I'm the owner and lead syndicator of the Huido Pipeline Club, starting in 2016, investing alongside investors like yourself. We also have the paid family office Ohana Mastermind. Right now, over 100 members in that we started that around 2008. So that's our inner circle. So if you guys are looking for a mastermind of purely passive accredited investors to crowdsource deals, but mostly I built it as a place for myself and you to build lifelong friendships and relationships that ideally go generations deep. So we recommend that folks bring their adult children along. That way they can build relationships within the group. And oh, by the way, learn the same financial skills and build a peer network there. That said, you don't need to join that group to invest alongside of us in the deal club, which at this point, we've acquired $2.1 billion of real estate and well over 900 live investors who've invested at least $50,000 with us. So we are probably one of the biggest investor groups out there for retail type of investors like us. And that's what I always say. When you work with any sponsor, syndicator, all the words mean the same thing. Really trying to figure out what's their experience in terms of numbers of dollars. People like to throw around 100, 200, $300 million, which is not very much. Around 2020, we went over that $1 billion mark. And I felt like that was the point that we really started to hit our stride. Obviously, a lot of lessons learned throughout the years. We've worked with a lot of people. We've stopped working with some of those. And I think what really sets us apart is not only of our network of passive investors out there, but our network of partners on the GP level and the operator world. It really gives us insight in what's happening out there, who are the players, and what are ultimately allowing us to do that due diligence on people and deals. From these investors that have entrusted us with their money, count right now is around $200 million plus of equity within the group, 10,000 units plus, most of which apartment buildings. Obviously, we're going to be going into different types of projects in the future to not just be a real estate organization. So you're going to start to see, obviously, the projects start to go up. I do believe we're probably around 65, 70 projects at this point. We just pushed out a big distribution last week where a few $1 million went out to LPs. So that puts the total LP distributions amount at $48 million out to passive investors, which we hopefully you can be part of that in the future. And of course, spanning many states out there. My professional background before getting into this, I got a bachelor's of science from the University of Washington in industrial engineering. I later went back and got a master's in civil engineering with the emphasis in construction management, and also got my professional engineering license. That's the PE. In 2007, I graduated college, started to work for BNSF Railway. At the time, Warren Buffett hadn't bought us quite yet, but it was a Fortune 50 company at the time. I didn't really care for the job. One of the issues was I was supervisor of a union workforce crew, traveling 100% of the time. I guess it was a good job for a guy in his 20s with no family. I was able to save pretty much my entire paycheck for a few years there, because I'll get into my story here a little bit. But later on, 2013 to 2015 and beyond, got out of the field to some extent and into the office managing large construction projects as the owner's rep for the railroad. One of my big projects out there is in Kalama, Washington, which is that new third rail out there, which got completed around 2016. But that was me, my first probably 5 years working. These are just a few of the guys from the crew. I didn't really use my engineering knowledge, but I think this is really where I cut my teeth in terms of leadership. And I always remember these times, but at the time, I didn't really like freezing my butt out there in the cold and traveling all over, working on the road, all day, long hours, working on the railroad. My professional career continued. At this point, the first job I had was working for a private company. And as we all know, private companies have not the best quality of life, but you do get paid a lot. And looking back, I think I did it the right way. I needed money to start my investing. And because I didn't really start off with too much. Now, obviously, I'm not a rags to riches story. I went to college. I, started with just a little bit of student debt, but overall, I'm not complaining. I was given a lot and I am grateful for that. But make no mistake, I grew my net worth from nothing to where it's at today with these strategies that I'm going to be sharing. But as I started to grow my real estate portfolio, the private job was just a little bit too much. I think a lot of us are in this world where, yeah, we could probably get paid another 10, 20% by working a lot harder. But at some point, it doesn't make sense when you have other sources of income. So in 2015, that was certainly the case for me. I moved from my private sector job to public. So I started to work for the government. My first stop was City of Kirkland as a city engineer, working with a lot of public works projects, things I've never worked before, but it's actually a lot of things that really help us in our development projects today. Did a lot of sidewalk jobs, drainage jobs, those little buttons that you press to go across the street. And these things drive me crazy. In my opinion, they're rather unsafe because they give pedestrians the false sense of safety and they just walk out in traffic. I would put those things together. Later on, moved back home to Hawaii in 2017-19, worked for the Department of Transportation for the state, where I was the pavement engineer for the Honolulu airport. I know a lot of you folks go to Maui. There's an Alpha Charlie project. There was a huge depression in that one runway where you make the left turn to go back onto the runway there. That was one of my projects in the short time I was there. And I also had a short stay with the federal side of the government. So I did it all. I did like private, state government, city government, and federal government. Didn't spend very long at the end there. But at that point, I pulled the plug and went full time into real estate, mostly because we started to syndicate deals. I started to take in investor money at that time. And for a little while there, maybe a couple of years, I just was a little bit irresponsible, I think, for me at the time to be doing a full-time job, even though I wasn't doing very much at the job and what it's grown today. But that was the professional side. I think what we're all more interested in is what my side job and how that grew. Obviously, I grew up in Hawaii and I moved to Seattle in 2003 when I went to University of Washington, graduated in 2007. So 2007, I started to save my money to buy a house to live in because that's what we were all brainwashed to do, to get on that escalator wealth building, which is buying your own home. I very quickly, in a couple of years, saved up $80,000 to go buy my first home to live in. It was about $350,000 in North Seattle. I didn't know at the time, but it was an A-class rental, higher end, A-class location, primary market, all the things that you're not supposed to do that we'll get into. But again, this was just a home for me to live in. And if you recall from my professional career, I started to travel on the road all the time and never home. And I was like, this is a little silly because I was just home on like literally Saturday. And then I had to hit the road. Sometimes even if I had to go to Montana where I had to go through Denver, I would have to leave home on Sunday morning to get there. So I was like never home. And it was silly for me to have this big house to myself. So I called up an old landlord from college. I didn't know that she was a property manager. And I said, hey, can you help me rent my place out? And that was the start of all this madness. I didn't know anything at the time. They didn't know about the 50% rule. I didn't know how much property managers charge. I just did it. And essentially, I went homeless. So I can recall the day where I was working in Whitefish, Montana, and the property manager said, hey, we got somebody to lease up your property. Can you come and get all your stuff out? And I drove all the way back. I think it took 9 hours. And I just had a big garage sale, Craigslist, everything. It was a little crazy. And I put everything I couldn't sell in a storage unit for the next, I think, 5, 6+ years. But at that point, I didn't have any housing expenses. So I think people look at like my genesis over the years just as an investor. There were a handful of years there that I was putting like 100 grand into rental properties and just pure savings. At the end of the day, this is as much as like a personal finance exercise of how much money do you save? And this is where if you get into the coaching calls, we have a lot of free ones on the website at thewealthelevator.com/coaching. I always ask people, what is your net savings? I don't care what you make. So many people have phenomenal salaries, 400,000, $500,000, $1 million a year, but it all matters what your net is. For most of our clients out there, you guys are saving at the very least $50,000 to $100,000 a year. And you're on a great path to follow my path into this stuff. Some folks are already implementing, and now that's when things get exciting, right? When you're able to save $200,000, $300,000 a year to just grow your net worth over time. But getting back to my story, put that first rental into service. I think the monthly rents were about $2,200 a month, and the mortgage, the PITI, was $1,600 a month. So I had quite a bit of beer money there. The delta between the mortgage and what I was bringing in income. And for a while there, I was just like a dumb kid. I was like, wow, this is cool. And then I started to realize kind of financial dogma that we're all taught. Like when we first went into corporate management training, the Vanguard guy would come in, or the Prudential guy, or all these certified financial planners that are just certified and get licenses to sell us traditional investments, because this is the starter pack. And this is the way I grew up. Invest in your 401k. You get supposedly tax benefits there. Number 2, buy a house to live in. This is exactly what I did. And then number 3, pay down debt. Now, I talk a lot about differences between normal advice out there for normal people and the other side of the coin, and more for financial advice for folks that save a lot more and have the responsible financial skills to do a little bit different things that I discovered what the wealthy do and that I put into practice and it worked for me. This is where I came up with the whole wealth elevator concept, where there's different floors to the wealth elevator. There's a different paradigm shifts. It's not a one size fits all. There are folks like Dave Ramsey. I actually met the guy. I love his content, but it caters towards the masses. And that's not the folks that come through the wealth elevator doors. Most people coming in are not on the basement level where your net worth is under $250,000. You're just merely trying to get out of debt. And that's where the advice of pay down debt comes from. But most of you folks out there, you fall in this category of taking your funds and investing it and taking out good leverage, good debt to make more money, to buy more assets. And then, of course, there was never a curriculum out there for folks over $1 million, $5 million, and then the penthouse, $10 million plus. So that's what the Wealth Elevator book does. There's like a little pull-out chart in there to help you see which floor you personally are on. I would highly suggest checking out that book on Amazon and get a bird's eye view of all the different floors of the Wealth Elevator to see what's ahead. But again, this is the way I grew up, and this is all I knew. And I think that's where we all get trapped in the world of traditional investments, which ultimately just makes the certified financial planner and the Wall Street companies wealthy. And there's this narrative of go to school, study hard, get a good job. This is where I started to meet a lot of alternative thinkers out there who were very wealthy and implementing these same strategies that we're going to be talking about. There became a very stark contrast between the way that we were all taught to do it and the way the wealthy do it. And what I realized was a lot of the strategies that the wealthy do, it's very easy and implementable by everybody. But boy, is it very contrary to what we're all taught out there. So again, this is that first rental property or home I bought. They're on the bottom right. Again, this is Seattle, Washington. And I did buy at the right time. This is around 2009. So got a great wave, which we know this market cycle now went from 2009 to 2022 to 23. And as I'll talk about ahead, I actually sold this property, I believe in 2016 there. And some people say, you dummy, you could have sold it for like almost double than what you sold it for. You left 400 grand on the table. And I'm like, yeah, but I wouldn't have had the thousands of units that I own in the syndication deals. I wouldn't have met the cool people. And obviously, net worth don't lie. Net worth grew a lot more by going into more and more assets. So that's what this whole strategy of re-leveraging your equity again and again. The number one mistake that I see most amateur landlords and investors make is they buy a property or a few and they pay them down. That's great once you hit a certain net worth level. And I would argue and define that as $4 to $5 million in terms of what I call end game. Because at that point, that's enough money for you to survive off a steady rate of 5%. And obviously, we have end game strategies such as accredited investor banking, infinite banking, etc. For what we're talking about here is like, how do you grow your net worth in a prudent manner to get to that level in a reasonable amount of time? And the effective strategies that we're going to be getting into is investing in alternative investments, coupled with the tax strategies of the depreciation passive losses you get from those investments, and then accredited investor, infinite banking. So when you tie these three strategies together, what I found is you can get to where you want to be in about a third amount of time. And you got to realize that at this time, like I didn't really care for my job. My motivation of mindset was like, I just need to get out. A lot of us are going to be lucky enough to be that first generation multimillionaire. We always say our kids are going to be spoiled, but I always say that motivation and mindset that they're just not going to have, right? There's a pain point. We all have a pain point. I had a huge pain point, and that was a big motivation for me to save my money. I can remember like my online savings checking account. My paycheck would come in twice a month. I would pay my expenses, pay my credit card bills, and it would just inch up every single month. Every month it would go up 6,000, then go down 2,000, then go up 8,000, then go down 3,000. Steadily, it would be going up. So I know the life energy that it takes to save $20,000, $100,000. A lot of it is just time. And that's how this game is. It's not the get rich quick scheme, but if you can save your money and then also compound it and pay a lot less in taxes, so essentially your net worth is cutting through the resistance through the air, that's how you get there a lot quicker. That was 2009, 2010 when I put that first rental property into service. I bought another duplex a few years later in Seattle. But this is where I learned about rent to value ratios and buying properties in less sexy markets or primary markets where you don't get very much cash flow and it's just too competitive and expensive out there. And I started to discover something called a turnkey rental out in the flyover states. So in 2012, I tried it out, right? That's what I do. I try things out, I get proof of concept, and then if it works, I move in more swiftly and confidently. So in 2012, I bought my first rental out of state. I never saw it, never touched it, just purely remote, had property management remotely. It worked and it was pretty cool. And so what did I do? I sold my 3 units in Seattle, Washington, and I started to redeploy that money. And in 2015, I had 11 single family homes spread across Birmingham, Atlanta, Indianapolis, and Pennsylvania. And at that point, I think what differentiates me from most of our investors is I continued to plow money, but I put it into my education. So I would pay for all these. Now I look back and a lot of them were dumb, 10 grand here, 25 grand here to join different mastermind groups. A lot of these groups out there are fake groups out there led by a guru. The information is it's okay, but you meet some cool people, and a lot of that's where I would meet a lot of my general partners out there and my lifelong colleagues and friends and just people on the same path financially. And that was the idea behind creating the Family Office Ohana Mastermind, a mastermind of other family offices, which are what you guys are going to blossom into. It was so awesome to climb the ladder together. But I think 60,000, it's probably expanded a lot more since then, but that was key for me. And I also will say I wasn't married at this time. I didn't have kids. So it's not like I had to ask my spouse for permission. I see it all the time. Majority of investors out there, one spouse, likely you, is the person that is more the leader in terms of their family finances. And it always takes just one person to say no and not do something that's a little bit out of the ordinary, but that's required here. So one would say, get your skeptic spouse involved. Easier said than done. I would say 80 to 90% of folks out there, your spouse is just not interested in it. And that's where I get my whole theory about educating the next generation or kids. And if they don't have money, they don't have a job, I think it's a waste of time to teach this to them. And especially when you couple in, they need to have an interest. Like most of the people in our family office group and investor group, they love doing this stuff, right? You guys have these crazy spreadsheets that you guys have made, and you enjoy talking about investing and saving your money, building a nest egg over the years, like virtual gardening in a way. So, like I said, the whole spouse thing, it's going to be a little bit of a hit and miss there. One tip I do have is I think you guys are living in the numbers all the time, your spreadsheet, you have a good understanding, but a lot of this is just communicating to a partner who is maybe doesn't have the interests nor the knowledge base to be able to make a decision hand in hand with you. So if you want to Google this Sankey diagram, there's some cool online tools out there that can help you whip this up pretty quickly in a great visual format. Here on the left side, you have all their income coming in. And on the right side is how it's going out when I was working out in the field as a young construction manager. But I'm just showing you this because this can be a great way to start a conversation with your spouse and your family because it's very visual. Keep trying to keep it as simple as you can. I started to grow my rental property portfolio, adding a rental here. You can see the impact. The cause and effect was that the savings went up. And as the years went by, you slowly add rental properties, my savings started to expand. And at a certain point, it started to become like, wow, this is becoming sizable. And I think if you're somebody who's not super into budgeting and saving your money, it's going to be tougher. But there's becomes a certain point with every investor where you're like, wow, I'm really getting traction because it's very motivating to like, if I can save up $20,000 to go buy another rental property or another $50,000 to go into a syndication deal, that will equate to X amount in terms of maybe cash flow or certainly going to my bottom line, my net worth. And now you're seeing it move. And my story, as you can see, is not like a get rich quick scheme. It's very prudently like saving money every single month. And of course, I had the advantage of being able to save a phenomenal amount of money. $100,000 every single year for a handful of years there really vaulted me to where I need to be. Another thing that I'll have people pay attention to is like percent of alternative investments. To me, you can't get to where you want to be by having a majority of your funds in traditional investments, the stocks, bonds, mutual funds, the normal sad American diet of investing that we're all taught to do, especially when you are growing your net worth. So in the Wealth Elevator book, there's actually a pull-out chart where there's somewhat of a recommendation in terms of percent alternatives that you need to have. And when you're younger, under $1 million net worth, especially, you need to have a much higher percentage than what I think you need to have. That said, I understand that everybody's on-ramping into this world, and it's not going to be overnight that you're going to get to 50% alternative investments. The quicker you can do it, the quicker you're going to get moving down on this path and climbing this ladder. But when I started to get in this world very quickly, I would say even 5 years, 6 years in, I was extremely heavy, probably a little bit too much, but it worked out for me. I was maybe 80 to 100% of my net worth was in alternative investments, rental properties. But this is where I hit a bit of growing pains. At this time, 2015, like I said, I had 11 of these rental properties. And if you do the math here with $300 of cash flow per property, and of course, that's after all taxes, insurance, maintenance, that's the real way you calculate your profit. Just because your mortgage is $1,600 a month and your rents are $2,200 a month, that delta is not all gravy. You have to pay a lot of money to your property manager and expenses, and especially when crap like this happens, right? I probably had over a dozen evictions, and I would say 1/3 of the time it ends up in being a catastrophe, anywhere from a $5,000 to a $30,000 repair bill, because some nincompoop out there decides to trash your property on the way out because they feel like you've wronged them as a tenant. I'll leave it at that. Look, I grew up in a home where if I understand if you don't pay, you can't stay. If you can't afford something, you don't buy it. But hey, again, that's not how most of the world works. But if you did the math here with $300 of profit per property and 11 rental properties, that's just not enough. Most of you folks out there would say, or tell me at least, you need about $10,000 of passive income at least. Therefore, if you just do the math, you're going to need 20 to 40 of these properties to replace your income. And just to give you a little insight what it's like to own 11 rental properties, I used a professional property management that was remote. These guys did all my dirty work for me, and it was relatively hands-off by my part. But with 11 rental properties, I had maybe an eviction or two every year, some of which ended up in this, and at least some type of issue that popped up every quarter. And mind you, this is with 11 rental properties. Now, if you're thinking you're going to need 20 to 40 of these rental properties, now multiply the exception rate by 2 to 3 at least. So now you're talking about an eviction like every other month and some kind of catastrophe that happens every month. That, yeah, you don't have to do the work. The property manager is supposed to handle that for you. But again, the role of managing the manager, it just becomes now a second job. Now, that job obviously replaces your income and grows over time. But this is where I learned the lesson where at some point, owning little rental properties just are not scalable. And this is where I was so lucky to be in groups and have the relationships with higher net worth purely passive accredited investors that were going into syndication deals. And for me, it was a very natural transition because I had the peer group that did that. But nobody talks about this stuff, right? Everybody's buy a rental property, you'll be free. That's what the rich dad told you, right? But nobody ever told you about how do you actually implement this into your portfolio. This is what in the Wealth Elevator book that I call the transition between floor one, where you're buying rental properties, just trying to get to accredited investor status, just trying to get your first $500,000 to $1 million net worth, and then stepping up into some of these larger deals where you're just a passive investor. And the cool thing about being a passive investor is there's nothing for you to do. There's no management duties, so no headaches, which allows you to increase your throughput at your business or your day job to increase this. I think a big mistake that I see very hands-on landlords make is they don't realize what is their highest and best use. They think that they're an amateur landlord and they want to push this, but in reality, and I think a lot of folks out there listening that make over $200,000, $300,000 a year, you'll agree that your highest and best use is at your day job or your business. Now, you may or may not like it. What we're advocating here is you don't need to do this forever, right? There comes a finite point in time, whether that's 5 years down the road or 10 years down the road, that you titrate off of that lifestyle. And at that point, you become Mr. Passive Man here and you just relax and you turn off the active ordinary income job. We'll talk more about taxes in the future, but you turn your portfolio into passive income. Therefore, you can use the passive losses to totally negate your passive income with or without real estate professional status, rep status. And you turn off the ordinary income where you have to pay a lot of more taxes on the ordinary income than the passive income. The other cool thing about these LP positions is no legal liability. You're just a passive investor. And if you're worried about debt in your name, the debt gets put in the general partner's key principal's name, not the passive investor's name. So if you're a little cringy about buying little rental properties or the debt being in your name, you don't have to worry about that. But I think the biggest thing for high net worth investors over $1 million, at that point, you have something to lose and you just don't want a stupid little trip fall. Somebody drowns in the puddle outside on the sidewalk outside your rental property and suing you, right? When you're a passive LP partner, that's the beauty of the LP position, the limited partner, limited liability there. My journey took me a long time to just get my head above water, get to that second floor of the wealth elevator. Again, starting in 2007, graduating with zero net worth. The 11 rentals took me to 2015. So this was not a get rich quick scheme. And I talked to a lot of non-accredited investors, less and less these days, but I'm like, come back to me in 5 to 6 years when you have a $500,000, $1 million net worth. It's just going to take a while. As I've mentioned earlier, this is a bit of a red pill type of viewpoint. With real estate, you make money 4 ways: tenant paying down the mortgage, tax benefits, property appreciation, cash flow. And then this is where it trumps buying a home to live in by yourself. Because when you buy a home to live in, you're the sucker who's paying down the mortgage, where when it's a rental property or investment property, the tenant's paying down your mortgage for you. Plus, you're getting a lot more tax benefits because you're able to take the passive losses from the depreciation of the asset, which you can't do when you're the homeowner. People talk a lot about the homeowners. You can take the interest deduction, that's measly. That's nothing. And why would you want to take 20-cent deduction on a dollar expense? That's silly. But again, that's more of the BS type of financial advice that's put out there that real estate agents and lending brokers, they all just use to get you to transact more. And this is where, at least speaking for myself, and I think you'll start to see this develop in your peer groups as you start to move in the future, that there is a bit of a red pill type of mentality out there where, why is the government having us invest this way? And I'll say, if everybody did what I'm saying here and increase their alternative investments to get more passive losses, to follow what the tax code is incentivize you to do, you'll pay a lot less taxes and you'll be financially free in a third amount of time. How would you power our country like that, where everybody's just like getting financially free and just kicking back? Obviously, I don't think a lot of you guys will do that, right? You guys will find more fun endeavors that betters the world. But right now, how things are set up, everything's channeled to go to Wall Street investments through 401ks, mutual funds, and other retail type of investments so that the wealthy, the big institutions get rich. Look around like at your corner bank to Wall Street in New York. How else do they afford all these big salaries and buildings? They're not doing it for free. And this was like, to me, the aha moment. My parents were very hardworking. They had doctorates and master's degrees. They did everything that they were supposed to do, but it took them forever to get to financial freedom. I don't think they ever got there because they were led by all this dogma of doing all this traditional stuff. I found a system that a lot of people were doing very quietly. As they say, the wealth whispers. It's not very flashy. It's not flip this house, wholesale this house, invest, create an e-commerce business, right? No, that's a lot of it is just noise that's done by younger people that don't have very much money. But what do you do when you have some cash and you want to do this a little bit slower? That's the path that I've outlined in the book, The Wealth Elevator. And what I've realized is people who invest in Wall Street, again, those are the traditional investments. The people that I was surrounding myself with, people investing in real assets or property off of Wall Street. So this difference between investing in Main Street versus Wall Street was very evident. And before all, this was the linear path that I think I was on and we're all on to start out. Study hard, become a W-2 professional or start your business. Be frugal, don't go into debt. How else will you grow your asset category by doing that? Keep working hard. 20, 30, 40 years go by, you buy a house, you have a family, and then you retire. Who knows? People are living longer and they keep pushing that retirement age up. Most people have a horror story of a coworker or somebody in their family who retired and they just passed away. And that's a tragedy, but that is actuary tables. That's just how the numbers work. Here are some of the actual quotes that some of our investors have said in the past. I can't believe I can hit these types of return per year on their investments. I thought we were stuck in this 8 to 10% realm, which I would argue is, maybe a little bit over than what it actually is when you really take out the hidden fees in some of these accounts. I didn't realize that my money can be doing 2 to 3 times better than in just a simple rental property, and not even including a value add real estate syndication or private equity deal where you can do even better there. And that's where I was like, I asked the question very early in 2010. I was like, I'm making like 20, 30% returns on my money with this silly rental property that I wasn't the best investor at the time. I didn't really know what I was doing. Why is it that I'm only going to make like 6 to 8% in my 401k, right? There's a huge difference there. And then where's that money going to? Who stole it? That's the institutional investment world taking it. And that's where I discovered, and I got a little bit of sour taste in my mouth, that's ultimately the big institutions are taking majority of the returns while we take on all the risks. So now you all know this is that Wizard of Oz effect, that the man is behind the curtain pulling the strings. And as they say, pay no attention to that man behind the curtain. You can go back to the way you used to do things and continue doing it, or you can step into this world of alternative investments with a lot of other quiet multimillionaires doing it this way too. Here's a fun little chart that I made a long time ago. This blue one is, as you continue to work and improve your craft, your money making ability goes up over the years in the blue. We're on the hedonic treadmill. The amount of money you spend also goes up. I would also say it greatly goes up when your kids are around. When your kids get a little older, it dips down. I have another chart later on that we'll talk about, discussing more on that. This purple one is your investments. As you start to build your portfolio, returns go up exponentially because the world of compound interest. As you start to grow your portfolio, you start to redeploy it, get more assets, that starts to really grow on you. But I'll overlay a couple other fun ones here. The green one is constantly increasing expectations at work, right? If not merely just a 2 to 3% escalator just to account for inflation. They always want more for you at work. Yeah, you will always want to be constantly improving. but it gets tiring. And that's what creates this heavy decreasing motivation over time. And I'll tell you, at least speaking from my story, 5 to 7 years into my career, I became a pretty bad employee. Why? Because the income that I was bringing in from my rental properties probably put me at a higher point than my boss and my boss's boss. And it really ticked me off because we would do our budgeting for the projects, and they made a stupid comment to me one time that I remember. And I always take these things and I use it as motivation for myself. They said, "Hey, Lane, you're just a junior engineer. You don't know the finances like how we do." And I was like, "That's bold because, yeah, you might know this a little bit better than I do, but I certainly know personal finances a hell of a lot better than you are. And also, I make more money at the end of the day with all my rental properties and my investments." So that was where my motivation went down. And this is where you look for things that in your life that if you look back, things happen for a reason. Things pop up, especially when you go through times of tribulation and struggle, and there's pain and there's resistance there. In a way, maybe the universe, God, whatever you want to call it, was pushing me out of that W-2 working world. And maybe this was the grandmaster plan, was to get the heck out and then also help other people out of that type of existence, to reverse engineer and flip the script on that linear path where you put your money into good investments, you use good debt, you continue to work hard, you are on this fast path to becoming an accredited investor and beyond. And then if you want to have a family, you can have that too. You can have your cake and eat it too, which is the cool part. For most of our investors, I think that they find this stuff once they have about $1.5 million net worth. Therefore, that I think that's why majority of our clients are in their 40s or early 50s, because you realize, wow, I got $1.5 million net worth. My income is high. My kids are older. I think that's a big part of it. Once the kids get about 9, 10 years old, you tend to have a little bit more free time on your hand, where we don't have very many investors with young kids ages 0 to 10, because you're just trying to keep your head above water and you don't want to try to do different things. But ideally, you want to get into this stuff in your younger age. That's like personally myself. Now I've set myself up so if I wanted to, I could just enjoy the young kids when they're 5 years old. That seems to be the sweet spot, and have my money working for me passively. Obviously, I'm by no means passive, but that's my goal for you guys, is to have your money investing and the tax situation, and especially get the life insurance all set up with the accredited investor banking, and have that be on fast pass autopilot mode. That way you can have the confidence that you're on the rails, you're on the trajectory 3, 4 times faster than your average buddy doing it the traditional way. Now, for some of us in our 40s, it's too late to do that, right? It is what it is. And the cool part is that there's still time to catch up. But again, this is the whole premise behind the Family Office Ohana Mastermind and teaching this to our kids. Man, if they could be in their 20s and start to put money away, 30 grand a year, buying a rental property, then putting it into syndication deals, they can set themselves up so quickly and just kick back and relax. And especially when mom and dad give them several $1 million head start, man, now you're starting to build a legacy, right? Most people, I think, out there that are wealthy, they might have $3 to $7 million net worth. It's not enough for that to roll over the generations, because especially when you start to bring in the next generation, traditionally, they're not trained with these types of wealth values and network and knowledge. That's why they say 90% of wealth leaves a family in 2 to 3 generations, because they just mess it up. That's why it's so important to bring them involved on this journey after you learn it, of course. But I think that's where the peer group comes in. But the goal here for everybody, and if you're $2 million net worth in your 40s and 50s, you play your cards right, you're probably going to get to 8 figures. At that point, if you are somewhat adept at getting the next generation involved, they can take it the rest of the way and really build that dynasty trust and that dynasty generational wealth. It all starts with, what's the plan? We'll invest in alternative investments. We have the syndication masterclass for passive investors, really to dial in on that. There are a lot of tax strategies. I always say learn this stuff to some extent and then go find a CPA, not the opposite way around. Too many investors, I think, they just rely on a CPA. And most times the CPAs just do it the easy, non-aggressive, conservative way. The third part of this trifecta is the infinite banking, where you incorporate specially configured life insurance. And then this trifecta, what I again discovered is it gets you to where you want to be in about a third amount of the time. But what I also discovered is all these strategies, they're very implementable by anybody. You don't need to have any special skills. You don't need to know anything special, but you do have to know the right people. And a little bit of it is in the dosage and the timing. What I discovered by meeting a lot of other high net worth people is that they were all implementing this trifecta. And that's what we've come to help educate people into implementing for themselves. So we want to get people from the old school thinking, retire with $1 million of assets, which is definitely not enough. You need more like $2 to $3 million at the bare minimum these days to be able to coax in your old age. And then get people out of this being house rich, all your money in your house, pay down your mortgage, and cash poor, because that's not a good lifestyle. Typical client out there, most of our folks live in California. I think it's a big state, but it's also high incomes out there. A lot of you guys make multiple six figures, a couple of kids. That's why we're a big family organization. You might have some type of technical degree, certainly went to college, this decade plus working at your profession. You're certainly not the grunt level anymore. You're probably more on the director level, if not higher. Through that, you pay a lot of ordinary income. And that's really where the tax strategies come in. So especially if you make over $400,000, $300,000 a year, that going back to the trifecta, the taxes is going to be your big low-hanging fruit here. But unfortunately, unless you get involved in some deals, you're not going to get the passive losses to implement that. Infinite banking is, I think, something especially the engineers out there will geek out on. But we have the infinite banking e-course for everybody to consume in the members portal. But I would urge people focus on the big things first. I'm a big fan of the 80-20 rule, the Pareto's law, where you focus on the big movers first. And most times it's either investing in alternatives or tax strategies. And then the infinite banking is typically last. A lot of you folks were raised in a house where debt was bad and being cash is king, as they say. And this is the baby steps of Dave Ramsey that he talks about that I redlined a little bit. But again, Dave Ramsey, he caters towards the masses, right? The masses are in credit card debt. They don't make very much income, typically less than $50,000 to $100,000 a year. That's fine. I don't discriminate to anybody, right? But there's so much information out there. Just a lot of those folks just need to keep a budget, right? Don't spend more than they make. Whereas there wasn't very much curriculum for higher paid professionals, people above $1 million net worth. So that's what I sought to do when I wrote the book, The Wealth Elevator. But this is typically what I think a lot of us were the path that we followed, the traditional path. We do events. This is a kind of a quick screenshot of the last event that we did. Most of the people, I would say 100% these days, are accredited investors, most of which qualify through net worth. I would say like those would be like the dentists or the business owners or the doctors would probably fall in that category. And for those guys, man, the world's your oyster if you can implement this type of stuff. I've had onboarding calls with thousands of people these days, and we always make you guys fill out that form of what's your AGI, what's your income, what your net worth is. And nothing surprises me these days. And I can usually tell who's the trust fund kids out there. But as far as most people come through the door is first generation multimillionaires. But one thing I would say, and this is just the data just shows this, is take high income earners like doctors. They make phenomenal salaries, at least a few $100,000 a year, some as high as $1 million per year. Take those people coming in, the people implementing this trifecta of strategies, their net worths are all 4 mil, 5 mil, 6 mil and above. On the other hand, the people with phenomenal salaries, you would think are killing it. But again, net worth does not lie. Their net worths are all measly $1 to a few $1 million. So it's night and day difference. And we try not to have this type of attitude, right? But I think it starts to develop over the years. Like, we don't want to be elitists out here, but there are people out there that, to use the Harry Potter reference, the non-believers, the people who do it the conventional ways, are the mugglers. This is what's so cool when you start to meet other people also on the same path. And that was why I created the FOOM, and we have the Wealth Elevator investor community, because when you look at my path, I did this all by myself from 2009 to 2015. I thought I was smart. I consume all the books, the podcasts, and we didn't have YouTube back then as much as today. I was able to piece this puzzle together, and I just put my head down and saved money and bought rental properties, rinse, wash, repeat, bought 11 of them. And at that point, by chance, I started to spend money and get into higher level groups and just found myself in different circles. Part of my secret to this too is I had the podcast at that time, and people wanted to court me, and I became a bigger player in the space. So that really opened up a lot of doors for myself. The podcast was huge for me. That was really the one lucky thing I did that set the trajectory for myself and our community to be that beacon to attract other high quality people to our organization. But up until that point, 2015, I just did it all by myself. For people who know me personally, I'm an introvert. I'm pretty reserved, but you get me talking about money and investing. I really get jazzed on it a lot. To me, it's super fun. So I somewhat kind of turn into a different person, which I think a lot of you guys, when you guys talk about stuff you like, you guys do the same thing. But I went to this, I can remember the first event where I met several accredited investor, and I started to see a lot of this more modern day curriculum that you see from the Wealth Elevator today. And I was like, whoa, that was a lot of fun. I didn't realize there are other people out there doing this stuff too. Because prior to that, I would just go to lunch with my buddies and they would say, oh, that's crazy, man, buying rental properties in Birmingham. But yeah, maybe I'll do that one day. Excuse 1, 2, 3, 4, 5. And it was like, man, pulling teeth like this. But then I started to meet people that were on the same trajectory with me. And instead of trying to preach to them and wasting my time and energy, like, it was so synergetic. Like, we were trading referrals, we were sharing very personal things. Like, a lot of this money is very personal, and just like the learning and the experience just exponentially grew, and it was so much fun. And that's what I wanted to create for a lot of you folks out there, is that community, that safe space, and the opportunity to meet like-minded individuals that are on the same path as you are now. And that was why we created the Family Office Ohana Mastermind. But unless you have that experience, aha moment, that are other people out there like me, I don't think you think that any of these strategies are real, or that there's other people that are like-minded to yourself. That at the end of the day, especially for accredited investors, it's more about the experiences and the social relationships at the end of the day. And that's what's hard to communicate to folks, because right now I think a lot of people are just really in it to grow their net worth a little bit so they can get their skeptic spouse on their side. But trust me, social relationships are the currency of the wealthy, and time, if you can get to where you want to be in a quicker amount of time, is really the ultimate asset at the end of the day. And somewhat, you have to pay money to expedite and decrease learning cycles. But again, I want you guys to have that aha moment. Come out to an event, try us out with your test drive. Obviously, a lot of these events, we try to keep it real nice and high quality, and we vet everybody coming. So you got to pay. It's not free. Nothing's free. If you think it's free, we're not the group for you. But try it out once. See if you want to be a part of our community. Get the vibe. Test the culture out. Talk to other people and see if this world is for you. And it may not be a good fit that you join the mastermind. But if you're somebody who is going to be investing at least $250,000 in your first year or two, I think joining the Family Office Ohana Mastermind is absolutely required. Now, I'm not going to get into that. You guys can go to thewealthelevator.com/FOOM to learn more about that exclusive group. Putting that out there for those of people who don't want to mess around. Right? There's a lot of money here at stake, especially when you're thinking $50,000, $100,000 into just one deal, and you've got to deploy ideally into dozens of these things. I think joining that FOOM group is somewhat of an insurance. And I think that's just a prudent way to move forward than to just blindly invest in a few deals out here. And plus, even if you invest in a few deals, that's not going to get to you where you want to be. Like, we're not investing in venture capital businesses where you can 5, 20x your money. We're investing in a little bit more like blue collar, boring deals where, yeah, the returns are projected to be higher than traditional investments. But this is not the get rich quick scheme. A little bit of the mentality and the strategy before somebody joining FOOM, what they would be doing, and then a little bit insight into what they were working on after, right? Sort of night and day. And if these things don't make sense to you, that's exactly how this world works. A lot of it is you don't know what you don't know, right? You got to get past that first, second stage of learning. And then the people that are in FOOM, they're skiing downhill with each other, holding hands, going faster and faster. And I think that's what I see is like people, they take a little bit of this wealth elevator content, they read the book, they watch some of the YouTube videos, and they start implementing it. But they're just hitting that tip of the iceberg. And this is just to get an insight. And we do hot seats within that group from time to time. And investors, they put everything out there on display. And everything in that group is confidential. But this is to give you insight what like a portfolio would look like for one of those FOAM members. And at one time, and this is where, as you guys always hear from like the podcast and the disclaimers, a lot of what I'm talking about is infotainment. It's meant to be, it's a work in progress. This is as much as a changing world. I just did a good example. At one time, I thought I was going to buy 40 to 50 turnkey rentals, and that was going to be my retirement. Obviously, that's not the program that I'm thinking today. And at one time, this is back in 2018, I thought that this was the framework. This is it, right? Buy some rentals and you get the syndications on top of it, and you build from there. And you create this syndication ladder, like a CD ladder. And then it definitely changed from there as private funds came into place, a little bit less moving parts. And, you know, what we want to get people to, and this is an exercise that we do in our workshops and in person, is we start to build the deployment plan, what you want to do. And if, you know, you want to take a screenshot of this and build this on your own, you start to outline the years ahead, right? Because this is a multi-year plan. And where's the sources of funds to invest, to go from traditional to alternative investments? So it's typically going to come from your heart, sweat, and tears, which is your annual net savings, the difference between what you make and what you spend. Again, most of you guys are able to save $100,000 at least per year. And then some of you guys who are new to the organization may have a lot of cash liquid savings. So obviously we want to deploy that first because it's not doing anything. And if you get a sense of, as we go 1, 2, 3, 3A, 3B, essentially what's going on there is that we try and deploy the laziest money first, the money that's not getting any ROI or ROE, return on equity, and then start to go down, right? Whereas the money in our QRPs, ideally, you would think your money would be in the stock market. It's doing something. It may not be where you want it to be, but it's doing something. So let's get the lazy debt equity in our home equity first, deploy that out. But of course, you have to take into account taxes, and this where on your guys' onboarding call, we can talk about maybe some specifics. And then I think the taxes is like that second overlay on top of that, because some of you guys are already in the highest tax bracket. To take money out of your qualified retirement plan, you're going to be paying a lot of taxes in that. And it may be worth it. It may very well be worth it. And especially for some folks that did it the traditional way where you maxed out your 401k, majority of your net worth will be in these QRP accounts, which is exactly where you don't want it to be to implement these types of strategies. Also, how do you fatten up your infinite banking, accredited investor banking for the long term? And how do you flow your money through that to investments? Some people want to build their net worth through more of a cash flow focus here on the left side, some more of an equity growth focus here on the right side with more developments, more private equity. No one way of doing it, right? Taking the equity growth path versus the cash flow path. But ideally, again, let's not look at myopically with just one or a few investments. You have to deploy into ideally dozens and dozens of deals out there to get that diversification. You never want to invest more than 5 to 10% of your net worth into any one project. Now, for some of the folks that are above $5 to $10 million net worth, investing in the FOOM membership is, I think, a no-brainer at that point. If anything, your peer network just gets improved from there. But there you'll find people who have crested that growth years period in their life, and are moving more towards living with less risk and just pure cash flow at that point. So there's different theories that we have within that little boom higher echelon of folks. So what does the end game portfolio look like? But if your net worth is under $5 million, don't even look at the slide yet. Just focus on building your asset category. What we hope to provide folks, especially in the FOOM, is, and even if you're just an investor with us in our community, is ultimately we're trading some sets of problems for other first world problems. So these are some of the examples that come from it. But I think this all comes down to the numerical indicators. A lot of folks are anywhere from 40 to 60% alternative investments, rental property, syndications, private equity, not majority of that traditional investments. And then the majority of their income is the passive income color of money, as opposed to ordinary portfolio income where you get taxed at a higher rate there. This is, again, just taking a slide from one of those FOOM hot seats. I'm big on action. There's that Rich Dad, Poor Dad book out there that I think it's a great book, very much on mindset. But if you get a sense of my vibe, I'm very much more action plan as opposed to warm and fuzzy mindset. So I'm big on what is the 80-20 that we're doing here? What is the Pareto's law? What's the one thing that's going to move it forward, that's going to get us leverage in getting us further on the path? What strategies can we implement there? But that is end of the introduction section. As you can see, I'm extremely passionate about these sets of strategies, the trifecta, as I call it. It's changed my life tremendously. I know it's not an overnight thing. It takes a lot of patience, but I think if you change your mindset and understand the reasons why we do these types of things, it definitely can get a lot of the same benefits out of it. And you get your money out of the way and you get to financial freedom. You start to realize what is the real point of life, which to me is the social relationships with people that are like-minded on the same trajectory, and then trading your money in for experiences. A lot of people, that the whole mindset of paying down your house, being house rich, cash poor, not the life that I want to live. I want to trade my money in for experiences, because to me, at the end of the day, that's the point system. So to do that, you need money. And so what I'm trying to do here for folks is invest in alternative assets to get better returns, to get also the passive losses, to pay a lot less in taxes, flow all this through the infinite banking, accredited investor banking system. And then you can create this lifestyle, which you want. And at the end of the day, we are looking for this freedom, the freedom to do what we want with whom we want on our terms. And then what my hope too is, once you guys learn all this stuff, you pay it forward, send the proverbial wealth elevator back down for others. And that's why we have the community and we have the events. So you guys, you come in, you're a little bit of a sponge, and we have the culture where people help new people out. But the idea is, hopefully you like our organization, you like our community, and you pay it forward for other people also on the same path as you. And my hope is, obviously I found my passion project in running this organization, helping new people step into this world of alternative investments. Whether you're new to real estate deals or you've owned a lot of rental properties like me and you want to get out of being a landlord, it's moving into this world no different than a college professor or a preschool teacher. I see that as my purpose in the world these days. But you may want to use your freedom to do something else that is good for the world. And I think that's what this is all about. But with that, we'll see you guys in the next module.
Okay, so this is the last slide. This kind of ties into what we were talking about earlier. If you're relatively younger, in your 30s and 40s, and you're already at that $3 million threshold, the irrevocable trust, get that thing tomorrow. If you're older and you've crested past that $5 million net worth, then get that too. I'm just throwing that out there, not giving any legal advice. But part of that has to do with this concept of core capital here. So I'll explain this. Core capital is, this is age on this axis. As you start to get older, you need less money, right? A lot of us here have younger kids. You guys are in this stage where you probably need $4, $5, $6 million net worth to be able to put in a cruise control and not do anything. But as you get older, especially as kids leave, they're not a nuisance anymore. You can take them off the books. probably only need maybe $2 or $3 million or even less, right? So that's this concept right here. So the idea is that's all you need. This dark blue corresponds to this dark blue, which is lifestyle spending. So lifestyle spending is like your basic needs. It's said in different ways to mean the same thing, right? This is how much money we need to survive and some beer money on the side. But at some point, we don't need it, and it becomes more of this gray money right here, right? This is the legacy money. I think I might differ. I'm sure I'll change my mind, but I'm like, I only got one daughter, and I'm like, even if I had two kids, I'd be like, hey, give them 1.5, 2 mil each. Any more, you're just gonna mess them up, right? I went to private school, I know what's up. So I would probably call this light gray, but I think half of you guys might call this dark core capital, right? It's needed. But at least we're talking about these concepts, right, in this way. So the idea is lock down your lifestyle spending first, your core capital first. And that's probably, again, let's just call it what it is, maybe 3 to 5 mil net worth. Once you have that, lock it up, and everything else, all the gray stuff that should go to this, gets put in your irrevocable and put up in the cloud and gone away out of your estate. But you're not going to do that investing in like traditional investments or not being your own business owner, right? Some of you guys own businesses. You have the ability to get there. But if you're just working for the man making $300,000 a year or less, ain't going to happen. You need to take more risk. But for most of people in our community, that's not the need. We don't need private jets. That's one blueprint I'm showing here. But what's nice, once you have your core capital set, everything else is off the table of litigators too when you're doing this. That's what's so nice. It's like so freeing in a way that you're set. You're in cruise control, that whole concept. I changed the terms a little bit to align, but it solves the question of like, all right, yeah, how much do you need and what's the concept? And then it's also the concept of what's the real goal. If people who have read the book, the Bill Perkins book, Die with Zero? Yeah, that's a recommended book. It starts to talk about this idea of maximizing your experiences. So, okay, so this is esoteric. So you have like money, right? We're all trying to get money, right? Money is very important when you don't have it. I think a lot of us, time is more valuable than money. In a strange way, you can change like money for time. Like I pay for the Whole Foods delivery thing. Whenever I got $40 worth of groceries, I have them deliver. I don't waste my time going to the grocery store, especially when you have young kids. I just pay. I don't care, just pay. I'm paying for time. But there becomes a point where when you're older, you're sicker, and then you bring in health, right? You can't use money to pay for time at that point. But what is in the book, Die with Zero, the whole point is it's not necessarily time, because you can have a lot of time and you can live an uneventful life, or experiences that is the thing. And this is where I argue you need freaking money to exchange for experiences. And at the end of the day, experiences to me is the point system. Now you might disagree with me, but experiences is what I think is the score at the end of the day. Throughout this, yeah, we're all here playing this game, trying to get passive cash flow, but the real game is exchanging your money for experiences while you're optimizing your finances. That's the optimization question. Maximize experiences to optimize financing. We all know that you're getting older and you could die at any moment, which is why you need a trust, and your core capital goes less and less. So it makes sense to like, all right, when I get older, I just need to trade these suckers in, this money in, for experiences. This is in super fine print here. Most of you are trying to go, and this is myself too, are trying to go for 99% confidence that you will have enough to last and understand the trade-off for limited time to achieve that. What that means is we're scarcity minded. We're like squirrels putting nuts away in the tree, and we're just running around. We have a shit ton of nuts in the tree, more than enough for a winter in Hawaii. And this is like the case for the people in FUM, right? I think more times than not, they're still like working their asses off, even though their net worth is 3 to 7 million net worth. And it just makes absolutely no sense. But that's the case. You know, it makes sense, right? Because if you spent your whole life trying to save money, make money, you start to associate your sense of value on that. So that makes sense to me. But if you look at it like this diagram, it's stupid. But with that, thank you all for coming.
Going through this whole transition myself, it was really hard to do it without meeting other purely passive accredited investors out there. So that's why we've created the network, which you guys can join. Second module, why cash flowing real estate? So 4 ways we look at this, making money in real estate. First, you get the equity buildup with the mortgage pay down by your tenants paying rent. And this is the real big one, big difference between you paying down your rent with your heart, sweat, and tears versus your tenants doing it for you. It's almost like an extra income source. Number two, the tax benefits via depreciation from PALs, which is passive activity losses. Third is the appreciation from the property. And since you're able to leverage, you can buy many of them. And lastly, the fourth way, cash flow with rent to value ratios. These days, it's hard to hit anything under 1% in single family homes, but with commercial properties, there's a lot of better numbers. And especially when you add in other incomes, such as a lot of the apartments are able to charge for things like trash valet, late fees, vending machines. When you add all these up, it comes out to quite a bit. And we're going to be digging into each of those. There's an acronym out there, IDEAL. Each of those stand for one of these 4 things. But the way I look at it, I'm a numbers driven guy. The numbers just, when you add up all these 4 different ways you make money with real estate, that's what you compare traditional investment. So we'll break down each of those. First one is that equity buildup. PITI is the principal, interest, taxes, and insurance. As you go through the maturity of the loan in residential real estate, that's 30 years, usually amortized. In the very beginning, a very small portion of your monthly payments, your PITI, goes to your mortgage pay down. That said, as you go through the amortization period, more and more of your monthly mortgage checks goes to building up equity, essentially going right to you. Now, still locked up in the property until you sell it, but at that point, it goes on your balance sheet and it's equity going to you in the long term. And again, this is paid by the tenants, not you. Tax benefits here. So this is a tax form that you're seeing on this slide from 2019 and 2018. So in 2019, I paid 0% tax. 2018, I paid 4.2% tax. $3,700 over my AGI was $136,000 that year. And this is all with real estate. So with real estate, you're able to write off an asset, drive tax to the negative, and lower your adjusted gross income. We're going to be getting more into this in a future module. Some of you guys might be looking at taking money out of your 401ks or IRAs, but this is just a real high level. If you notice, I structured the first 2 right there. A lot of people say, well, yeah, owning real estate is a great way to write off the mortgage. Your interest payments is what they're specifically talking about. And they're correct, but we want more, right? We want a lot more write-offs and tax benefits. And that was something I never really understood. Like, why would you want to pay $10 in interest to get $2, $3 in tax deductions by paying interest? But hey, again, this is what's all stuck in the mainstream mindset, right? Regular financial ideas that we just all got it stuck in our head. People putting money into 4Ks and Roths. For most people who make less than $400,000, $500,000, it doesn't make sense to put money into these types of retirement plans, because when you put your money into one of these retirement plans and invest from it, you don't get these tax benefits that we're talking about here, namely the passive activity loss. So again, I think I'll highlight this throughout the presentation, but there are a lot of bad financial advice out there that has become dogma over the decades. That's just why we always tell people, we'll get around our community, get around our group, come to one event and test drive it, or just join our family office Ohana Mastermind with well over 100 investors in there now, and get around a group of people thinking for themselves. Another one, buying a house to live in. Most times in normal financial speak, they say that's a good idea. And yeah, I would agree. Most people are really horrible with their money and they need a forced piggy bank. They need to be paying down a mortgage, because if not, they'll take that $1,000, $2,000 a month and go blow it on something they shouldn't. But a lot of you guys who are financially minded and have better incomes should probably pay offense more. And at least speaking to the younger folks out there in their 20s and 30s, it may make sense to forego buying that primary residence to live and invest first. Speaking from experience, that's what I did in my 20s. That's what really set me up. I didn't buy a house to live in. I just rent and actually still do this to this day. Hawaii is very expensive. It's $1 million to buy any type of house out here. So that's going to require me to take a $250,000 as a down payment. I'd rather have that be working in 4 or 5 deals in syndications and be leveraged there too. But like I mentioned there, I made a lot of these mistakes myself. After graduating college in 2007, I saved about 80 grand to buy this property right here in North Seattle, a neighborhood called Maple Leaf. And I bought it around 2009. Up on the upper right-hand corner is how it appreciated over the years. And this is what's nice about real estate. It goes up most of the time. And we say, do not focus on this appreciation portion. I always say it's icing on the cake, but it does, you're getting this appreciation leverage. So if real estate goes up by 2% and your leverage 20% or 1 to 5, you essentially get 5 times as much return. So instead of 2%, 10% there. Some people play this game where they just buy houses to live in, or they buy little rental properties and they appreciate it. I think it's a great strategy, but there's something later that we'll get into, forced appreciation, which is a much more reliable way of benefiting from residential real estate. The next one I'll highlight is cash flow. This is how you replace today's ordinary income. This was my goal when I first started to invest from 2009 to 2015 to 16, about there. After that, I had a little bit of shift of mindset, which I'll go over in a little bit. But throughout that time, I wanted to just get in all these rental properties and all these syndicated deals like how I have here. This was like a little mind map I put together of all my investments at the time on different ranges from Class A to Class C, more yield plays, more heavy reposition. This is not scientific. This is not anything I think anybody should try to emulate, but it's something that I was very focused on in replacing my income. Later, what I discovered as I started to meet more higher end investors, this is for me around 2016, 17, 18, was that the more and more people have money, when you start to get to 3, 4, 5 million plus net worth, a lot of these people, they don't really care about their cash flow or income. Again, this is going to be important for a lot of you folks listening, as it was for me. It's going to be on the forefront. The reason being, you probably want to leave your day job at some point or not want to be forced to be there forever. So you're going to be trying to build your portfolio with an emphasis on cash flow. In reality, you should be really focusing more on equity growth, which tends to forego cash flow in the interim. Again, what I try to do is emulate what higher net worth, more experienced investors do. And what I've discovered is they tend to not really care what cash flow comes in on a month-to-month basis or quarter-to-quarter, and they focus more on the big picture, their net worth growing. And you might say, how do they pay the bills? They either have a job that they enjoy at that point because they're probably working for the fun of it, or they have other investments in their portfolio that are already kicking off cash flow at that point, or they have the financial means to have hundreds of thousands of dollars in their infinite banking, and they can pull from that if they need, or they just have money in the bank, literally. I think at the end of the day, real estate is what got me to the dance. When I graduated college in 2007 and in 2009, got my first rental, my portfolio looked very much like the traditional investment portfolio, where we'll define it right here. Real estate is considered an alternative investment, whereas stocks, bonds, mutual fund, money market, and cash are considered traditional investments. We like alternative investments, at least to get started, until you've hit $3-4 million net worth, because slightly higher returns and the tax benefits that we mentioned earlier. But here's a little chart just to compare different asset classes the real estate tends to have a little bit better returns, especially when you're using leverage. You're having equity build up there. It's a hard asset as comparison to these others, better tax benefits. The only downside about real estate when you compare it with these other asset classes, liquidity. Once you're in, you're stuck in it. But I would argue, like, where else are you going to have your money working harder for you or getting a higher yield that you got to wait for? Especially when you get into projects that are value add, they're going to have higher returns, but this component of illiquidity is much more present there because you can't just take the bread out of the oven halfway and pop it out. I had an investor, he was not one of my investors, it was one of these investors from one of these silly forums out there. They said, I don't like these private equity or real estate deals because it's like a boomerang. Like a boomerang, you throw it and you gotta wait till it comes back. And you don't really have control when it comes back. And a lot of the unsophisticated investors were like, yeah, that sucked. I don't want to wait. But a lot of more experienced investors who've gone through this say, yeah, man, that's how investing works. But especially when you're doing some type of value add business plan, this thing isn't going to be overnight. Wealth did not come to those who are impatient. So with that in mind, that's the downside of real estate. But if you're in it for the long haul and look, a lot of this is not the get rich quick scheme. The other one that we don't have on here is private equity and investing in businesses, which we're starting to do as a group. Now you're getting into much higher returns and more asymmetric type of plays. But the reason why I try and keep it simple here is a lot of the people that are going through this masterclass might be under a couple $1 million net worth. And if you're going by the rubric that I have in my book, The Wealth Elevator, there's a little pullout chart. And if you are keen enough to look at the asset allocation mix in that chart for folks in the first floor and the basement level of the Wealth Elevator, you're seeing a higher concentration of alternative investments versus traditional investments, stocks, bonds, mutual funds, a lot of the typical financial planner brokered stuff. Now, I try to speak from experience. When I first got started, I had a traditional investment portfolio, wasn't really getting anywhere, was on the 30, 40-year plan. But then I bought a rental property and I was like, wow, this is great. This is a lot of beer money. I need to keep doing this over and over again. Eventually, I had 11 rentals in 2015. And by then, I had just pulled my 401ks and IRAs. I got rid of all that stuff in the Roth. I realized it just wasn't for me. And I needed to use that precious down payment cash to buy more and more rental properties. At that time, I probably had 90 something percent of my net worth in alternative assets, and it worked for me. So I know not everybody's going to be as crazy as I was in my 20s, applying all my money into alternative investments. That said, the Wealth Elevator pullout chart has a little bit more of a mild application of what I personally did. Now, if you're somebody under $1.5 million net worth, you may feel really uncomfortable going over 60% alternatives, even though that may be what you should do. But certainly, I think you need to get above 10, 20%. So everybody's going to have their level of buy-in on this type of stuff. And I'm not such a person to say you must do 46.7% alternative investments. I don't know how you would get that or measure that really. But I think what I'm looking for everybody is like, hey, just incorporate a little bit of real estate, value add, private equity into your portfolio, try it out, and then increase over the years. Sure, that's going to take a lot longer than if you prudently stepped up to 20, 30% and then increase from there as deals started to cash out. But I think we're going after baby steps here because I get it. For a lot of folks out there, this is totally brand new, investing off the beaten path, off of what all your friends, family, coworkers are doing out there in the traditional investments. But when you add up all these ways you make money with real estate, you're making, when I calculated on a whiteboard exercise, about 30%. But that didn't include the bonus here at the end, which is the value add force appreciation portion. The third module, real estate investing fundamentals. This is going to be going over a lot of the basics that folks will need to do to buy a rental property. But I think it really sets up those investors investing in the syndicated deals to have a baseline knowledge of what is exactly going on the business level of these types of deals, especially for those people who have never owned rental properties. When we first started this community back in 2016, I myself was still on the tail end of my career buying little rental properties. And on the podcast, we talked a lot about buying remote rental properties at the time. And we had this incubator course for remote rentals, which is mainly for non-accredited investors. Obviously, as you guys know, our investor base and myself matured and we've moved off of this type of investments. A lot of the content that you're going to see in this next module is going to be derived from this content. And a lot of the real estate fundamentals are kind of encapsulated in this particular chart right here. And if you look on the x-axis, which is on the bottom, you have a spectrum of low-end properties and high-end properties. We'll get into the grading system of Class C on the low end, Class A on the high end. As you're following the different dotted lines, you can see how cash flow, headaches, and etc. moves throughout. And it starts to develop some sweet spots, which we'll highlight in this next section. Some other important things to define before we get diving through this is first, CapEx, which is short for capital expenditures. Today, when we value add assets, we'll fix things up and we'll add in a lot of these types of components. This could be like the roof, new sinks, new cabinets, could even be like dishwashers or a driveway asphalt or just slurry sealing the asphalt. So all this is considered capital improvements or CapEx. And each of these improvements have a different serviceable life. Within the incubator program, where there's actually a spreadsheet that we have with a laundry list of all these different improvements that you could do and the serviceable life. And then the costs, obviously the costs you got to account for inflation because this is a rather older spreadsheet, but it just demonstrates the idea that there's a bit of a life cycle cost analysis in each of these, where at the end of the day, when you add up all these things that can break on a house, it comes out to be quite a bit. And which is why when people buy the house to live in, what they don't realize, and I think most people turn a blind eye to, is things are constantly breaking. And they don't realize that money is just going to consumable maintenance on it. And which is just another hidden cost of owning a house, which is why for people starting out, I wouldn't necessarily think that buying a house to live in might be a good idea for most people within our community. But something to think about when you're having rental real estate and you have to account for this in your numbers. The other thing here on the right side is the vacancy turnover. So when you have a tenant move in, you're not going to have your rental property filled up at all times. There's going to be a certain percentage of vacancy, and it's not like you get them out and then you get the next tenant in right away. Especially if you're doing value add, there's going to be a period where the unit is down. That's the turnover period. In large apartments, a good vacancy number might be about 5% to 8%, which if you take the opposite of vacancy, it's occupancy. So that's about 92% occupied. You probably are wondering, why not 95, 100% occupancy? That sounds like a better number. Yeah, traditionally, if your asset is running at 95, 90, or 92% and above, it's a sure sign that your rents are just too low and you need to be pushing it, especially if you're in a value add type of strategy. But how this distills down for a little single family homeowner is you may have a full month there where you're not bringing any rent, and you need to account for this in your numbers. This is, again, part of rental property ownership 101. If you own a rental property, a lot of this you understand intuitively, but this is just a review for those people jumping right into syndications and private placements without any rental property experience. So going into the property classes, Class A, B, C, and D. Class A is the nicest stuff. It's the newest stuff. It's probably the stuff that's built within the last decade or two. Class B is getting to be a little bit older. I would say when you start to get into the 1980s, that might be on the lower end of Class B. Certainly when you're looking at 1970s, 1960s property, it's probably a Class C asset at that point. And then obviously there are things that are much, much older out there that you would probably call Class D or F. In commercial real estate, these assets just degrade over time. The idea is you don't want to be holding on to an asset too long because they just become functionally obsolete. Now, I think this is maybe a little bit different than single family home residential world, where you can upgrade those properties and sometimes the old feel of an old house gives it character. But with commercial assets, it is just strictly an age thing. Newer is seen as better. But as we've seen on the previous slide, here, there is a sweet spot in not having the latest and greatest property on the Class A side. So very similar grading system, but for neighborhood classes. And I would probably say that this is a little bit more important because the neighborhood you can't really change. Sure, if you have a 300 unit apartment complex and you have a wall around you can somewhat affect change pretty effectively within your apartment complex as you start to kick out the riffraff and bump rents up and get a better clientele in there. But especially with single family homes, the neighborhood block is going to be what it is. And it's going to be one of these four categories here. First, the Class A's, your most affluent neighborhoods. These are your cool places to live. I think a lot of us live in Class A neighborhoods. They're going to have the best school districts. Unfortunately, this is not where you're going to get the best rent to value ratios. Class B is more your middle class part of town. It's still relatively safe. Class C, now you're starting to get into places that I think not a lot of you would even want to be spending too much time in, even in the daytime. Low to moderate income levels, I would say definitely 20-30% lower than the median income for the MSA is in here. And then Class D, nobody really talks about Class D too much. If it's Class D, you might as well call it Class F or war zone prop areas. So there are certain resources out there. I usually tell people there's Neighborhood Scout if you have a subscription to that. But the free method is just going to the local municipality website, the GIS that they may have either through the police department or the county, and looking up the crime incident map. In your Class C and war zone areas, you're going to have a lot of more violent crime there. In all areas, especially more urban areas, you're going to have all types of crime, but it's going to be more slighted on the petty crime, the vandalism. I'm not saying that assault is good, but it's going to be more on the better areas, whereas you're going to have the much more heinous crimes happening in the lower areas. So if you're just sitting at your computer trying to figure out if it's a B, or C area, this is where I think as an investor, you need to take a little bit of everything with a grain of salt. The syndicator, the broker, the real estate agent, they're all going to be lying to you at the end of the day. What I would say, most of our investors, they enjoy coming to a lot of our events to meet other purely passive accredited investors and get acclimated in the community. We always tend to have this in cool, fun areas like California, Hawaii, Vegas, places where we don't invest. So I always urge people, when they get involved in these types of deals, we tend to do maybe a investor field trip once per year where we go in the field to a Houston or Huntsville. And this way you're able to jump on a tour of one of our existing properties and you can be there. You can smell the air. You can look around the block. And I'll say, let me stick my finger in the air. This is a Class B minus neighborhood. And then once you do that a couple of times, you start to develop your own scoring rubric in your head. And it's a real touch and feel thing, but it's pretty easy once you've done it. And I think that experience is invaluable. And once you do that, you don't have to do it again. Most times when people come on these tours, it gets a little boring after the second property. And people are like, let's just go to the bar and have some dinner. Let's just get out of here. It's hot. Because I think that's the nice thing about investing in apartment. At the end of the day, it's all the same damn thing over and over again. It's just renting out cubes, where that's what's hard about single family homes. That they're all very unique and they're all in vastly different neighborhoods. To wrap this up, again, there's no numerical means of determining this as opposed to the property classes, which you would look at the age of the property or the vintage. With neighborhood classes, if you want a quick and dirty rule, I would say I've got a daughter in a Class A neighborhood. She might be having her latte and her cappuccino and jogging there, maybe even the evening time too. Class B area, she probably wouldn't be, there. Or maybe I'm just thinking that my daughter's gonna be super bougie, probably, I'm guessing. But she might go out for an afternoon jog out there, but certainly wouldn't want to be there at nighttime. Class C, my daughter would not probably want to step foot in that area. I personally am used to this stuff, so I go to these places all the time, but I sure as hell don't want to be caught there at nighttime. I've done it before just for kicks. It was like, let's try and freak ourselves out. Me and my partner went, but it was scary there. So we said we would never do that again, other than just driving by and quickly going to the parking lot. Obviously, Class D and F war zone areas is much, much worse. Like Baltimore is a good example of war zone, like where they have those one-way streets. And then if you're an outsider, you drive into town or drive down the wrong cul-de-sac and they blockade behind you and they bug you and they steal your car. Like that would be a war zone. Class C isn't as bad. Like I said, it's that said, you can make a lot of money in these transitioning areas. In the early days, we would buy a lot of properties in the Class C area. We turn it around, we make a lot of money. But these Class C areas and these Class C tenants are difficult to deal with on that. Actually, that one property that I mentioned that me and my partner wanted to just scare ourselves and we went there at nighttime, that property consistently ran at 80% collections. So the property was essentially 95% occupied, but 15% of everybody just didn't pay, maybe even 20%. So again, 80% collections or economic occupancy takes into account who's actually there, plus who's actually paying their damn rent. So I think most of us are good citizens. We pay our mortgage, we pay our rent on time. But in these types of neighborhoods, that's just not the case. And I can remember like 2013, when I had my first properties in Birmingham, and I would get all these Walmart money orders. I wasn't wealthy when I was growing up, but we didn't pay things with money orders, but a lot of these folks will. What got me is sometimes it costs money for these mail orders and it takes time. And they would get hit up with all these late fees that sometimes the late fees and the money order fees for these guys was like 10, 20% of their monthly rent. And it just killed me inside. But that's just how some people live. Some people out there, they don't trust banks. So they have those prepaid debit cards that they just use. I think a lot of us, we just see the people around us. And a lot of us are just very fortunate to live in economic circumstances where we are definitely the top 10% or maybe even the 1% in the country. And we fail to see how the majority of America lives. This is a depiction of the locations and the tenant class put on a scale here. The business plan today is we try to find assets in B locations or better, depicted here in the red. Another analogy I use is in football, you have quarterbacks. They always say, get the quarterback with the best arm, because that's just God-gifted talent right there. You can maybe train accuracy in a way. When you're looking at an investment, you don't have as much influence on the neighborhood as you do the asset. Obviously, we'll get into this here in a little bit. You're value adding the asset, changing out a lot of appliances, paint job, playground equipment, landscaping, power washing. You're changing the facade of that asset and you're improving that. Essentially, you're trying to bump that class of the building a little bit. Sometimes you're putting lipstick on a pig, $5,000 of renovations per unit, which is enough to change out the flooring, not new cabinets, but repainted cabinets, new appliances. You might need to do $10,000 to $20,000 rehab to bump it from a C grade to a B minus grade. But a lot of the value add projects out there, that scope isn't quite there. And I think the reason being is like sometimes to spend $10,000, $20,000 of renovations per unit isn't going to get you the ROI, which is the bump in rents. Ideally, you buy properties that's already undervalued, where even if you did nothing to it, you bump the rents up $150. But if you're going to do renovations to it, do $5,000, $10,000 of renovations, I certainly want to be able to bump that thing up $200, $250 per month.
So as I was saying earlier, I think a lot of us are very fortunate to be living in A-class homes. What you have to understand is majority of the people live in this bell curve. And I would probably say today in this dotted line right here, that is centered around Class C homes or apartments. Now, what this green line is showing is what would happen in a theoretical recession, right? Everybody collectively moves downward. And that's why we try to invest in workforce housing. Not only are the rent to value ratios better in that, but if we're just thinking to ourselves, in case of a recession, the A's move down to the B's, move down to the C's, etc. And we're able to catch the majority of the population out there. This is why, if you've noticed the trend, when we first got started, we would buy a lot of crappy Class C assets in Class C areas. We'd fix it up, we'd make a lot of money. But for us as operators, it was a lot of headache dealing with 15 to 20% of tenants who just didn't pay every month. And that's the thankless job, I think, sometimes is like tracking those people down and getting them to pay or partially pay, because you can't really send that stuff in for collections. A lot of these tenants are just not collectible if they start to rack up thousands of dollars of late payments. You got to rely on the court system to get them out, which is again why we focus on more red states than blue states to invest in, because we know that we're going to run into a lot of evictions and we're going to need the court system on our side. But as we've moved along, I think in 2019, we really started to focus more on Class B assets, which is a little bit better clientele. That said, you still have the same problems to some extent, non-collections issues. And when you're working with 1970s properties, things always just tend to break. You can do a lot of due diligence, and that due diligence will identify a lot of things that are just always on the verge of breaking, or maybe fine, but they're just going to break later. There's a lot more variables, which is why I think today, and this may change in the future, we try to focus on a little bit better properties, obviously in the good areas, but this concept of Class A, because it's new builds, it's newer properties within the last few decades. I guess you'd call it 1990s to present vintage, but still workforce housing. So this is different from like your traditional idea of Class A, which I think of like luxury properties, the stuff a lot of you folks would put your kids in their first apartment. If you lived in California, these properties may rent for $2,500 a month. In a place like Alabama, it might rent for $1,500 a month, just to give you a range there. A good example of these Class A luxury properties as rentals, if you've heard of a publicly traded company, Amelie, I think it's spelled AMLI. If you Google them, you'll see the amenities level. They have like bars for the tenants, really cool amenities. It looks like a hotel, but that's not what we're going for as investors. We want to go for more workforce housing. Again, we want to be in somewhat of the heavy part of this bell curve where the majority of people are out there, so we can be hedged in case that there is a recession. That could happen at any point, right? And that's why I say always try to dollar cost average and spread your investments through a period of time, because you never know when a correction will be. I talked a lot about these renovations previously. Pictures speak louder than words. So this was actually from a little 50 unit I had that was a Class C in the upper right hand corner. Yes, it is yellow, and that's pretty common for Class C assets. And then on the bottom right is the renovation. This one, I think we just repainted the cabinets, or maybe we just changed out the doors, but you certainly see the upgrades in the appliances and then the sink hardware and the countertops. Nothing fancy here, right? This is a classic Class C to Class B amenity renovation. I'll take a moment and I'll dispel some other investment strategies that are out there that some people like to do that I think are a little bit more nearsighted. Some people like to buy properties from auctions. However, when you do this, you don't get access to do inspections on the assets. So it's a total crapshoot. You can make a lot, but it's a total crapshoot as an investment. When we go into assets, we have the financials, the P&L, we get a full due diligence team in there, third party contractors to get in and itemize all the work that needs to be done. And we want to eliminate a lot of the unknowns. Short-term rentals is what a lot of people like to do, because long-term rentals just don't hit the rent to value ratios it once did 5-10 years ago. That said, I would highlight that short-term rentals is a discretionary part of people's spending. When tough times come, people stop going on vacations, and this falls off the map. We saw this very greatly in the COVID pandemic. People weren't able to travel, and your property went dark. There's a lot of amateur landlords out there heating up this space, and I certainly do expect some type of bubble bursting in the short-term rental world. From a political standpoint, especially here in Hawaii, I don't like the fact that you have a lot of absentee owners buying properties here because it just makes it more difficult for people who it's already expensive here in the first place. But from an investment point of view, short-term rentals is, I think, a lot more riskier way of investing. Number three here, as I mentioned earlier, we focus on red states that are much more landlord friendly. We always want to invest in places where the court system is slighted in our favor. I think a lot of us would agree, especially as the landlords. We believe of anti-squatter laws, and if people can't pay, they can't stay. At least that was the value system that I grew up in. You could probably do a huge fishbone diagram and figure all the inputs of what makes a good market, a good place to invest. What we look at a lot is supply and demand dynamics, and population and job growth are the two big ones. But there's not a good way of measuring those two concepts. But what they do feed into is rent growth, which is extremely measurable when there's a lot of data out there. So that's what we key in a lot of our top level due diligence on markets, because also like rent growth is where the rubber meets the road at the end of the day for us as we get into an investment. The last thing we like to do is we like to control our own fate with doing these renovations. This is totally different than the buy, hope, and pray model. The buy, hope, and pray model is what I did when I first started to invest in 2009 to 2015, when I was just buying rental properties. I put good leverage on it and I was cash flowing, and that's great. But there was nothing I was doing to increase the value of that asset. In commercial real estate, the value of the asset is dictated by the net operating income divided by the prevailing cap rate, or what the assets are trading for. You don't have control over the prevailing cap rate. That's just the market. But you do have control over the net operating income, which is the income minus expenses. And by doing things like as you're seeing in this picture, changing out those appliances, new countertops, we probably increase this unit rent by $150 a month, or almost $2,000 a year. So if you do the math at home with a calculator, $2,000, which was the increase to the bottom line or net operating income, and you divide that by a 5 cap or 0.05. It's a business plan. You take over an asset, and then your occupancy starts to drop as you start to get the riffraff out. 88% might seem low, but that's just relative. Like sometimes we have properties that have dropped in like the 50% range. And yeah, that hurts cash flow in the interim. And yeah, we like cash flow because that's the lifeblood of the asset, but we try to keep as much reserves where we could, if we needed to, just rip the Band-Aid off, drop occupancy, and get moving through the business plan quicker. Like we got a lot of people out this month, and maybe this coincided with a period of slower lease up season, which is there's some seasonality to people tend to move in more in the summertime, but you can see the average rents just pop up from there. And that's where you're making money. So if you're bumping it from 560 to 620 just in the first year of ownership, and so that's a delta of a small $60 per unit on average. This one had 168 units. So you multiply it by that. Obviously, you haven't gone through even, you've only gone through a fraction of the units renovating. This needs to continue on for another few years. But you take that $60 times 168 times 12, and then you divide it by, even to be a conservative, use a cap rate of 6. And that's amount of value you've created in just this first year ownership here. This one actually went really well. We actually were able to get out of this asset in 2.5, 3 years, more than beating the business plan of doubling our money. So some of the basics here, just so you understand some of the vernacular, multifamily apartments can be defined as a few different ways. The first upper left is the garden style. This is the stuff that we try to focus in on because it's typically more of in a suburban area where we try to stay out of the core business district because the rent to value ratios, property values there just don't justify the holds in most cases. And we tend to like these more suburban types of settings where there's a little bit more space for the tenants, a little bit more homely. This really helped out in COVID where people like their space as opposed to being right on top of each other in a high rise or a mid rise type of asset. You're seeing a lot of no more mixed use and they're great, but they're newer assets and they just don't have the rent to value ratios. Right now, the prices are just too high to justify the acquisition. This is how some institutional investment firms will define some of this types of investing. Maybe just review this and just have it in the back of your head as different ways to describe it. And the reason why, like a lot of this information, I think arms you with the baseline level to understand and talk to other purely passive accredited investors and to really set you up to, if you were to join our family office Ohana Mastermind, you'd be able to talk intelligently about these types of investments. Hey, I'm looking at the Class B asset in the Core Plus type of category. I'm not super sold on the value add plan. So if you want to smoke a cigar and look cool when you talk, you got to talk the lingo, right? And that's what we're here to educate. And more specifically on syndicated deals, there is a syndication e-course that we have, which takes most people about 10 to 12 hours to go through. But to just go through some quick reasons why I initially invested in US multifamily, and I think it's still a strong investment class, attractive risk-adjusted returns. And if you're just going by the numbers, relatively low volatility in terms of the vacancy. Vacancy rates, going back to what we consider is 92% is considered full occupancy, because you're always going to have some vacancy there. And if you're reading between the numbers, you're like, okay, if I go by this, it should be 95%. And you're exactly right. What's accounting for that 2 to 3% delta between 92% and 95%? And that, my friend, is the deadbeat rate. That's typically the assumed amount that even in good assets, you're going to have non-collections on. Out of 100 units, you're going to have a couple of units or people partially pay on those. And just that's the name of the game, right? And that's when we say for the little landlord out there, just to know that you're not going to be 100% on your collections. You're always going to have vacancy and non-collections there to some extent. But that's where the nice thing about apartments is that we're working with minute fractions here, as opposed to a lot of the new landlords. They may be wrestling with an eviction and having 2 or 3 months of vacancy that year. And that's more on the scale of 20 to 30% vacancy that they're having. And that's probably more than enough to have them go negative cash flow on that individual single family home. I think what keeps bringing me back to residential real estate is that there's a healthy demand and demographics. The United States population is growing in comparison to some countries like China and Japan. Those populations are very top heavy and dwindling, whereas America continues to grow. But I think if you dig in a little bit deeper, it's the lower middle class that's growing due to immigration. And unfortunately, things are getting harder for majority of Americans. The rich are getting richer. And I think that's what all of us are trying to do here, right? Invest our money in good assets so that we become that 1%. But again, for majority of Americans out there, it's tough. They're not able to invest in assets like this, nor do they have any leftover after paycheck to paycheck. One of the great things about America is we do immigration, they typically start living in these types of apartments. I think one of our goals is to provide good quality value living conditions for people out there and treat them fairly and fix things when they break and provide it at a fair price. Getting back to the demographics, looks very strong. Data supports this, that the majority of people in the future aren't going to be living in single family homes. That American dream has gone by the wayside. And where are they going to live? In smaller quarters. And that essentially, imagine that bell curve coming back to the little apartment. You're seeing this trend in majority portions of the world, Asia and Europe. People are moving into smaller square footage living conditions. Now, I'm not saying we're going to get to micro units, people living in 300, 400 square feet apartments in my lifetime on average, but it's moving in that direction. And Maybe I saw this when I put on that Apple Vision Pro for the first time. I'm like, first of all, that's an amazing product. Super, super cool. I would highly recommend just demoing it at a Apple store. It's free, but I think it'll change your life. I'm not going to ruin it for you. You're going to see it for yourself. After that, I was walking home and I told my wife, oh my goodness, people are just going to be single and live by themselves and put this Vision Pro on their face and live in their 300 square foot apartments. That's how we're getting to. I'm not going to get people started on like how the next generation are just totally inept at having social conversations. I think that's the way we're trending, and they're going to live in little apartments. Another reason, favorable regulatory environment. The United States has a good court system for the most part, as long as you stay out of California. This kind of helps us. Yeah, there are some municipalities out there that put rent control in, but again, we try to avoid those types of markets. Some people say, why don't you guys do Section 8? I've done it before. I've done it on the single family home side. And then we've done some properties where we've had the property has transitioned from low income to unrestricted rents. And some other properties have 20% of the rents restricted to like about 80% of what the going rates are. I would say if you look at our business plan, we're usually trying to bump the rents and get out before the asset gets really old. So that's typically under 5-10 years. So when you're doing that, you want the ability to bump the rents up unrestricted. And part of that is if you have a low income property, your property is always going to be considered that rough property in the neighborhood. Maybe not necessarily where the shoes are hanging from the power lines to denote that this is where you get your drugs from, but there's always a stigma with these lower income properties. In my opinion, when you get above 20% of your tenants are Section H voucher people, that strategy may work more in single family homes because you can be the crappiest house or tenant profile in that block. And that's actually good for you. But when you're in apartments where you can create your own micro community, having more than that threshold, even 10% of the people being Section 8 voucher, you bring down the tenant profile of the entire community. And a lot of tenants just don't want to be in that. Another reason why I like this asset class is there's a lot of data on this. It's not like laundromats or car washes, which, goodness, I've been hearing about this stuff for years. I'm tired of hearing about those stupid things. I think it's a bit of a bubble, personally. Everybody's getting into it. That's a part-time entrepreneur or beginning entrepreneur getting into that stuff. Whereas again, that's why I like real estate, because real estate, you need money to get involved in this type of stuff. And maybe one of the bad things about real estate is there's nothing really game changing coming on the horizon. But as far as like data and statistics, which we use to derive a lot of our underwriting off of, it's pretty solid. We'll use Yardi or CoStar, which investors don't have access to. It costs like $20,000 plus for these subscriptions, but this will have very key information on the rent growth, the rents at the current time, and competition and comps. And you pair this with this high degree of transparency of census data, demographics, median income, you realize why a lot of these institutional investment firms from Wall Street like to invest in this stuff. And also the life insurance companies that back a lot of our infinite banking, accredited investor banking policies invest in this very same asset class in the same, very similar way. There are other asset classes within the real estate sector: office, retail, industrial, hotel. There's even mobile home parks and self-storage, which I'm not a huge fan on. Like, one of the nice things about multifamily, it's one of the bigger asset classes, and thus it's a very liquid type of sector where we always test the market. Even though we're not ready to sell the asset, the business plan isn't complete, maybe we'll just submit it to some brokers and it'll become an off-market property because we're not super serious about selling it. And we'll get a bunch of offers. And if we really wanted to do the full-blown marketing package and putting it out on the street, we might get like 40 to 60 offers on an asset when you call for offers. So incredibly liquid sector, and everybody is, I think, sold on the whole, what I was discussing about multifamily and the long-term prospects of it. And then I think that's where I'm guilty of this. I put out a lot of content and information on the weekly newsletter, and a lot of it is I'm trying to be like a media company and trying to scare people so that they pay attention. But if you're like myself, who doesn't really get excited about too many things these days, and like what is the one that just happened recently? It's election season. So there's a bunch of crap going back and forth in terms of rumors. The latest thing is some type of bill in place to restrict rent bumps more than 5%. And it's put everybody more on the Republican side in arms, and the media is just trying to draw day trade attention like how they always do. But this happened a few years prior when Congress had this bill where they were going to get rid of the self-directed IRA and blow all that up, and it never happened. I've been in the game for 15 years with this stuff, been watching it. You start to get really tired, and although I'm not from an age-wise old, I've got a lot of mileage. And I've just seen a lot of this news and things that are supposed to get people excited or triggered. And I just try to look past that, all that noise out there in the media and in terms of business plans or investments out there. Another good example that kind of went by the wayside several years ago was like cannabis investing. Everybody was looking at that as a new emerging asset class. And that's why I'm like, I don't even want to look at car washes and laundromats. Goodness gracious. I think that's just a thing that sells YouTube video attention for people who don't really have too much money, who can't really afford apartments or these type of asset classes. But I guess getting back on topic, focus on trends that are going to be around for a decade plus. Don't look at the small crap that's going to be 1 5 year trends. What is the stuff that's going to be around time tested? And I had Peter Linneman, the podcast, a few times, and this is exactly where he comes from. Avoid the noise, the stuff that moves quickly. Real estate is one of those things, especially apartments, that you're looking at the long-term demographics and the demand is going to be there. And there is a fundamental shortage on this stuff. That's something that is really predictable yet boring, and a good place where people can feel safe to put a good portion of their net worth in. Sure, maybe you want to go into more asymmetric plays, but at least have that as a baseline on your investment. Invest in things where the trend long term is in your favor. Another reason you have a good amount of leverage options. This kind of pivoted a little bit or got paused in 2022 when interest rates got jacked up. And it hit all industries, but the loan to values came down from 75% on average down to maybe in the 50% range. The leverage was one good thing about multifamily. It got put on pause in recent history, but long term, I think you'll start to see this come back because a lot of the institutions they invest more for the long term and they see the value of it. And also what got me into this asset class initially, or at least into apartments going from single family homes, is I realized that the government knows that they have a workforce housing shortage for the lower middle class and the lower class, but they're not in the business of building government housing. We have that, but it's not on the scale like how other Asian countries do it. And for good reason, because that's how you create projects in the bad sense, like in New York, right? The really rough areas. And it becomes a cesspool for crime. Ideally, what they've discovered with more modern urban planning practices is that you want to spread out your lower middle class, your working class out in the suburban, or just basically spread them out, right? So they're not all pooled in one area. But that's where it becomes very difficult for the government to implement that. And one of the only ways that they've been able to do this is offer good financing through the government-backed agencies of Fannie Mae and Freddie Mac to give to people like us to use these semi-government-backed loans at great rates. So the way I looked at it, see where the money is flowing and put yourself in position to catch it. Another reason as far as diversified credit risk, but like when you have an apartment with 200 individual tenants, you have 200 people that are all going through different things in life, but for the most part, you're not concentrated with just one anchor tenant. In contrast, you have a strip mall. You might have a dozen tenants in there. Safeway might be your anchor tenant. You don't have that many tenants in there. So if one leaves, you might now be down 10% in terms of occupancy, where multifamily assets have a large volume of leases, which is a nice thing. Transparently, I also say, though, the downside of this is, yeah, you might have a lot of individual tenants and that provides diversification, but individually, they are all regular people. This is where industrial properties and commercial properties like strip malls might have a leg up because you're renting out to not regular people who has a flat tire with their car and now they're late on their rent. In the other example I was giving, it's more commercial tenants. So they have thriving businesses and you underwrite the business as the ability to pay the rent. Whereas in residential real estate, you're underwriting individual people using credit scores. You verify their pay stubs so that they're hitting that 1/3. You don't want more than 1/3 of their paycheck going to their rent. And you're doing your criminal and background checks. And that's pretty much the standard vetting process to getting good tenants. As I've seen many times, especially firsthand as a single family home investor, people are people and they run on tough times, and especially people who have less money. And I've maybe when I own single family homes, I maybe had a dozen of these evictions, and a few of those times these guys will just trash the property. We certainly have that share of it in the apartment world. The nice thing about the apartments is they can only mess up the inside of the property, whereas the house, they got a lot of more surface area, literally, for them to jack up, and they got a lot more square footage on that too. So your exposure on that is a lot more. The range of damage that they can cause on an apartment is a lot less than a single family home. These guys, they all run on tough times, and that's just part of the business. That's why you shouldn't be running a property at 100% occupancy and economic occupancy. This is why you want to have a large unit count to help. Every month you're going to have a handful of tenants run on tough times. Another good thing about the apartment world is you have shorter term leases. So like the most leases last about a year, whereas office, industrial, and other real commercial retail investments, they typically last on a 5-year or more cycle. So with us being on a year cycle, we're able to adjust for inflation a lot more quickly and pass costs down to tenants. And this gets into maybe a little bit political, but like the whole idea of inflation typically gets passed down to the consumers who have the least ability to account for it. And this is a good example of it. Like we mentioned earlier, we like to try and eliminate risks. We pull the financials, we underwrite it. We send in the full due diligence team to itemize major components, like, for example, the individual HVAC, the roof, and create a list of CapEx. And we're able to forecast and build a prescriptive plan of what deferred maintenance items need to get done, as in addition revenue generating CapEx items that we can be doing. And this can be accurately forecasted pretty well. And then of course you apply a layer of buffer contingency. And then reason 10, in apartment investing world, you have a lot of good third-party leasing and property management options. They're extremely plentiful out there. If somebody is not performing, we'll get something better out there. There's not a loss for options out there, put it that way, in terms of property management companies. The opposite of that is mobile home parks. There's very few, if any, major property management companies that specialize in that sector. So oftentimes the mobile home park operator, they really need to get their hands dirty and do it themselves, or find somebody who actually lives in that park to be a pseudo property management person. And they need to get lucky doing that. So that provides a level of competition for us to be able to change out property management if things don't go the way we want. But with that, that's the end of the real estate fundamentals section. I think that was a good high level of understanding the business of real estate. Nothing replaces experience and actually investing in deals and seeing what happens. But I think the good step on this is to go check out that syndication e-course and to dig more into that content there. There's maybe about 10 to 12 hours of content in there that kind of builds upon this fundamentals and talks more about doing due diligence on syndicated deals.
This is the module 4, syndications. What is an accredited investor? So accredited investors are investors that are typically investing in these types of syndicated deals. These syndicated deals are also known as country club deals, because back in the day, people would go to the country club You had to be wealthy to go to the country club, and that was where these deals were shared amongst people. But nowadays, with the advent of technology, and who really goes to the country club anymore these days to play a 5-hour round of golf, it just takes too dang long. At least from our community, a lot of us are first generation multimillionaires. A lot of people who go to the country club are second, third, fourth, fifth generation wealthy people. And then a lot of the people are just not really interested in investing or growing their net worth. And that's probably why they always say 90% of wealth leaves families in 2 to 3 generations. That's why to get around the community that we've put together, we've got the family office Ohana Mastermind is super important. But first off, what is an accredited investor? Net worth $1 million or greater is supposed to be excluding your primary residence. I always thought that was a little bit silly. On the one hand, SEC is saying, hey, your house is not your asset, and you shouldn't be paying down your mortgage and hiding your money in there, because that's exactly where creditors and litigators know where to get it from. But also, they see it as to not have your money in your primary residence doesn't count as your net worth. But I also say you could just take a HELOC from it or get a loan from it, turn it liquid, and then turn it right back. The other way you could to qualify is income over $200,000 individually or $300,000 for a married couple. That said, a lot of this is not super critical, right? The accredited investor status, and we're going to be getting into 2 different deals out there, 506B and 506C. There's a couple ways that you go about doing this. You can self-certify or in a third-party certify situation. So a lot of times what people will do is they'll just get a letter from their CPA lawyer. We've got some really simple and easy form letters to give to your CPA lawyer so they can just sign on your behalf. And ultimately, it's up to them to certify you. I would say just try and get this letter, because this is the qualification here. What it mainly is to not disqualify people at 999,99999 net worth, or if your income is 199 a year, but it's mainly to keep in people who are just not qualified to invest in these types of deals, right? People who have $250,000 of net worth, and if they lost $50,000 in a project, that they would just be financially devastated. That's really what these laws are put into place as their goal. And for that, I agree with that sentiment. Another way that people can get into accredited only deals is through a Series 7, Series 65, and various other securities tests. These tests aren't the hardest to get, but it's supposed to help out people who aren't quite accredited, but you can test your way to get in. But these are actually pretty rare to do. Most people are able to get their accredited investor letters. As soon as you start to come into a deal from a passive investor's perspective, meaning you don't have managing member authority, right? Sure, there's things that may come up where you may have a vote, but if you're in the sense of a passive investor, it's triggered securities laws, right? Securities laws are out there because if you think of like cryptocurrency, right now, cryptocurrency has been the Wild West. All kinds of crazy things happen there, and they just don't have a lot of these laws put in place. Whereas forming companies, raising capital, like the SEC, there's a lot of things that have happened in the past, and they've created a lot of laws to protect consumers and to minimize like the fraud out there. So what they've put forth is a couple of deal methods here. And so the first one is the 506B offering. Now this accepts up to 35 non-accredited investors and deals, but the deal cannot be mass marketed or what they call generally solicited. Now again, you probably don't care about this. I'm teaching this more from the perspective of the general partner. So if the general partner wants to be able to bring in non-accredited investors, they have to go down this 506B route, but they cannot mass market the deal. So they can't put it on social media. They can't do any LinkedIn ads. They can't talk about it on their podcasts. They can't put it on their website. It cannot be generally solicited. As soon as they do that, the government says once you've generally solicited a deal, now you can only do it as a 506c offering, which a deal can be mass marketed, like I said. But the problem there for the syndicator is that they can only accept accredited investors. As soon as people bring in passive investors, they've triggered securities law and they have to do one of these two. So some people are like, I brought in my four buddies and we took down this fourplex. In that arrangement, probably would make sense to make everybody managing members. But if one of those guys technically wasn't doing anything and they were completely silent, then that little group there has triggered securities law and they have to do a full blown PPM. We usually pay like our attorney $15,000 to $30,000 to put this together. And then there's also blue sky filings that costs maybe another $5,000 on top of that. So this is expensive stuff. So a lot of operators, they just don't do these things, which makes things illegal. The SEC can rain down fire on the project and the general partnership there. Passive investors may say, well, that's not me. I didn't break the law. That was the general partner. But it can also bring the deal into scrutiny, right? If the general partnership becomes under fire, it can endanger the deal too. So I think even passive investors need to keep this in mind. Are they working with a syndicator who's blasting things on the internet? They better be doing a 506c offering that allows for generally soliciting. So to overlay my experience on this, when we first started, we would do 506b offerings, mainly because I had a soft heart for non-accredited investors, because it wasn't too long ago that I was a non-accredited investor. And non-accredited investors, you're limited to buying little single-family homes. But I would say after 2018, 2019, prices on properties and rental value ratios in single-family home buy and hold rental properties, or what I call turnkey buy, hope, and pray properties, where there's no value add. And there's value add in these syndicated deals. If there's no value add, there's not enough meat on the bone. And therefore, if you're a non-accredited investor, you're just left with not the best investment options. And how the heck do you get to accredited investor status? So that was what was in my mind back in the day. And it still is, right? I still want to try and help out people, especially those guys who make a good salary, but you're just still under that $500,000 stage. That's the hardest part of wealth building. And it just takes a while. I graduated in 2007 and it took me like almost 10 years to get to accredited investor status myself. So it's a grind. So in the beginning, I thought, why don't we give non-accredited investors access to our projects where there's value add, where they are in a group that they trust. Two things happened. The podcast got even more popular and we started to do things more on the internet, and just got to a point where our attorney was like, look, you guys are just way too out there. The investor group started to expand so big. And we started to do many deals. In 2020, we started to go over that $1 billion of assets owned threshold. We're probably going to keep growing from there. But it got to a point where we were not small fries anymore. And that we had a lot of syndicators, they cut corners a lot on their documents and just a lot of things in general when they're getting started, right? Because they have to be cost effective. And I think I always poke fun at like oil and gas operators, the cowboys out there. Literally, these are cowboys, right? I'm in Texas or Oklahoma. But a lot of these guys don't do any PPM securities documents. It's just bring in 100 people and on a JV document. And woof, that stresses me out for those operators. But that's just what those people will do. Not saying that they're not good deals, not good operators, but just from a security standpoint, not really following the law there. I don't want the SEC knocking on my door and then now I got to pay $250,000, $500,000 to fight them. I'd rather just do everything on the up and up. That said, we've moved more towards 506c offerings and we've lost our ability to accept accredited investors for the most part. If you're not a non-accredited investor watching this, stick with us, learn, and hopefully it'll make the transition from the first floor of the wealth elevator to the second floor of the wealth elevator a lot quicker. Don't do what I did and buy 11 rental properties. If I would have done it all over again, I probably would have bought maybe 3 or 4 and then moved up to syndications and private placements. The last thing I want to overlay on top of these two, now that we've set this up, 506B offerings. when you come into a deal, you obviously don't need to be accredited. But when you do your subscription documents, you're asked if you are accredited or not. And just a little bit of a trick, folks, if you've never done PPM documents, when you check the box that you're not accredited, the application asks you, hey, qualify yourself, because we don't want unsophisticated investors in these types of deals, right? So you have to justify yourself. And to avoid it, you just mark down that you're accredited. Of course, you're certifying yourself in that circumstance. So if people get my drift here, self-certify means you police yourself and you're certified that you are accredited based on your understanding of the definition. Of course, these definitions could always change very slightly. And sometimes they talk about increasing it, decreasing it, different things happen. I would say just check out the SEC website for the latest criteria at that current time. But I think everybody here, 95% of people on this call, are probably going to be looking to go to 506C offerings where you need a third party letter to invest in the deal. 506C offerings, if you think of it from my perspective, the syndicator, the SEC says, yeah, you guys can go out there and generally solicit, right? And part of that, when you generally solicit, it goes everywhere. And what the SEC is trying to avoid, and I totally agree with their angle here, is that they don't want like truck driver Tommy, who is broke and has $100,000 to his name because half of it was his new inheritance from his long lost uncle, and he invests half of his total net worth. Number one, he doesn't have the financial stability, and number two, he probably doesn't have the financial aptitude to be able to make good investment decisions. But that's what the SEC is trying to avoid, is these deals are genuinely solicited out there. That's why they put this restriction in place, so that those unqualified, or what the only way they're able to govern things is they say, oh, no non-accredited investors investing in that deal. They say, hey, syndicators, hey, Lane, you can mass market this deal, and you're probably going to have some people come up to your door that are unqualified, because that's just how general solicitation works. But they need to be accredited, and those people need to bring their third party letters. Like, we cannot have them self-certify like the 506B offerings. So from our point of view, is you need to bring us your third party accreditation letter. Now, there's a couple of online methods out there, companies that have made it a nice little niche to certify you, where you submit some bank statements, some income statements, they review it, and they give you your letter. I think it usually costs like $50, or with inflation, it'll probably over $100 at some point. It can take a little bit of time to do, especially if you're right on that line there. I would say that the easiest way, and probably the cheapest way, is just slip in this form letter that, again, you guys can email us at team@thewealthelevator.com. We can give you some easy form letters, some different formats to just get your CPA or lawyers, John Hancock, and then you're in. Now, there's some things that change from time to time, like how long does this letter last? Am I certified? In most cases, once you submit it, unless something changes, we as general partners don't really need to know. It lasts for quite a while. But that's where we really suggest people going to their CPA or lawyer, because then you can get it renewed if you need to. Whereas like these other cool third-party sites, you got to keep paying them every single time. It's actually a good business for them. I wanted to identify a big thing when you guys look at deals. There's a bit of a slider here where on one end, you have institutional operators. So institutional operators, they've done billions of dollars of deals. These guys are experienced, they're reliable, they're large companies. However, you're not going to get the returns that you are from other deals. Maybe you're going to double your money in 10 years in these. The reason being is there's higher fees, more carry interest on the general partnership side. There's just more overhead, right? For some investors that are net worth $4 or $5 million greater in our family office group, we may put them into those types of projects. But on the opposite end of the spectrum, and I guess we're saying don't invest in these types, right? You have your fake it team, make it operators under $1 billion of assets under ownership. And these are the guys to stay away from. And these are the deals I would go into in 2015. And I jumped on landmines, blown off my arm, lost some money.
But hey, it got me to where I'm at today. And I think that's the hard part about getting into this world, and what I try to help people get over these initial stages when they're investing with just garbage operators who are newbies, who just took a weekend course and now they think that they're a multifamily millionaire operator. Everybody's going to get started somehow. Some people focus on splits and fees. Some of these newer operators, yeah, they'll do 90-10 splits, 80-20 splits. They're just bad operators. They're just getting started. So not a good place to invest. But I think they can lure unsophisticated investors who key in on the wrong things. So there's a lot of like silly internet forums out there that talk about splits and fees all the time. The splits and fees are like how the deal payouts are structured. They focus in on that because I guess it's something tangible that people can understand. But what they fail to really focus in on is this thing a good freaking deal, right? Whether you get 90% of the profits on a crappy deal with a new inexperienced operator, I don't want to do that. But unfortunately, when you get into some of these like free internet forums out there, you start to get into this world because a lot of these people on the internet, they're not operators like myself. So they can't really speak to digging into the rent rolls, the profit and loss statements, what's the reversion cap rate, and the underwriting, right? So they focus in on what's visible. Think of it, they focus in on the tip of the iceberg that's sticking up. Where I'll just say it, like I'm sophisticated enough to underwrite the deal, get a third party underwriter and underwrite it and dive beneath the surface and do true investigation on a particular deal. I look at the splits and fees very last. In fact, I don't really look at it because I look at the projected returns that my spreadsheet is giving me, and that takes into account that fee structure. What I'm looking at it is what is this deal performing on that deal level? Again, if a deal sucks and an operator sucks, I don't care if I'm going to get 90% of it, right? 90% of zero is still zero. What I'm more concerned about is how fat is this deal? How good of a deal is this? And of course, who's the operator running it? And then with all things being equal, the splits and fees are secondary. But if I still hit my numbers that I'm looking for, whatever that's 70% return in 5 years or 100% return in 5 years, I don't care what the splits are. If the operator found a really good deal and takes half of all the returns, I don't care. That's good for the operator as far as I'm concerned. So getting back to the spectrum of more experienced institutional operators and fake it to make it newbies under $1 billion of assets, there's this world that we try to live in the middle, right? Experienced operators who've done dozens of deals and don't have egregious acquisition fees and splits. There are some operators out there, like some of the institution operators out there, their promote may be 15% right off the top before the deal even gets started. Now, if the deal pencils and it works, then yeah, so be it. My only problem is if you're working with an operator under $1 billion of assets and they're newbie and taking those fees, that's where I have a problem with that. But a lot of this, like normal fee structures, normal acquisition fees, asset management fees are in the syndication class, which you guys should have in your members portal. That's a little bit more diving into the details. I think it's better to check that out in that format. But I just wanted to make this aware and how it overlays with the 506B and the 506C. Your institutional groups out there only want to work with accredited investors, right? Think about it this way, and this may be offensive to some. Nobody who is a good operator wants to deal with that accredited investor who's going to put $100,000 in and ask 1,000,001 questions. That's called a high friction investor. Nobody wants to work with that investor. Pretty much all non-accredited investors are high friction investors. If they lost $50,000 in a deal, they would probably be pretty decimated at that point. And this is also another reason why we've moved away from 506B deals and taking in non-accredited investors too. As much as I'm conflicted there, like I said, to me, like as far as like a company, I don't really want to take on that headache and that liability myself. So that's why we've been sticking more towards accredited investors these days. And you got to think about it. Like you're probably thinking, oh yeah, it's unfair, right? I'm a high friction investor. But in reality, it takes so much money to onboard people. As you guys see, like when we bring on you guys as investors, we do invest a lot of time, right? The staff talks to you guys, we get you set up. There is costs associated to that. So if you brought in a non-accredited investor and they only have enough money to invest in one or two deals,
That's just not a good investment for us in reality. Like accredited investors should invest multiple times, right? We want long-term customers. And the only way that's going to happen is at least you're an accredited investor net worth $1 million or greater, right? Or make a good salary, $200,000 per person or above. Some people, they like to look for deals to diversify and they want to try and get in with a lower minimum. I would highly warn people, if any operator is willing to take less than $50,000, I would really scratch your head and ask, are they just desperate for money? We used to do it. When we first got it started, we were desperate for money. We were trying to bring in any investor and we'd just buy the worst 50 unit Class C properties when we're getting started. We were there at one time. And I can remember letting a handful of guys in at $25,000, $35,000. And half of the time, it was a huge mistake. They were the most needy investor, high friction investors. And that's just a lesson learned on my part. So sorry if that's you. People in the past have ruined it for you. And that's why we've moved to accredited only. But it can be a sort of a telltale on what kind of operator you're working with. I've gone as far as to say is if you're vetting invest sponsor groups, just throw out there, hey, do you guys take $25,000 minimum investments? If they do, be careful. And then I guess the same can be said for like crowdfunding websites. Like some of those crowdfunding websites, you can put in like $1,000. I would just be careful because sometimes the crowdfunding websites, they're a broker dealer. They're not the sponsor, not the operator. They may be selling a different part of the capital stack. Sure, in the same deal, in the same asset, but different part of the capital stack. So the way I explain this is like people go to the outlet mall, right? Coach Outlet is one of the more popular ones out there. But in reality, there's different products that are made specifically for the cheapo Coach Outlet clientele. It's not the same exact purses that is sold in the real Coach place. So in a way, it's the same thing. The crowdfunding websites will be selling kind of Coach brand or in the same asset, but it may be a different part of the capital stack that goes to a more retail investor, unsophisticated investor, which is more high fees typically, because it takes higher overhead to handle a higher number of investors, especially non-accredited high friction investors. So hopefully that gives you a little bit more insight into the industry. And then, yeah, we'll move on from this topic. So switching gears a little bit, syndications is part of the evolution of the wealth elevator. If you guys have checked out those pull-up pages with the chart, I have it on the second floor of the wealth elevator. In that chart, there's guidelines on like how much cash flow you have, how much net worth you have. Guys, they're just guidelines. It's not gospel. And there's big ranges. Like, for example, on the second floor, it says maybe $1,000 a month cash flow. But a lot of you guys come into this world cold. You don't have any single family homes or any investments, and you may not have any cash flow. But from a net worth perspective, you line up more to be a syndication investor. And that, I would say that's probably most of the people coming in these days. And this is why we do the onboarding calls, because there's really no way that you can just give out advice, or none of this is supposed to be financial planning anyway, right? This is just general infotainment here. That's why it's good to get into a conversation. I can give you your pros and cons, or just quite frankly tell you, hey man, your wealth elevator floor 2, just do syndications. Don't even do rentals or anything like that. Perfect example of that is if you're already making a couple $100,000 a year, even if you don't really have too much net worth built up, that would probably be the threshold to just jump into syndications and private placements and don't even do single family homes. A good use case for that is some of the dentists out there starting their practices or starting their career. They make a lot in terms of income, but they might have student loans too. So their net worth might be super low, but still it just makes more sense for them to go more passive into syndications. Additionally, your time is better spent progressing your career in that infancy stage than to mess around with single family homes. And also liability, right? Liability of owning those single family homes is way bigger than being a passive investor. But this is the evolution that we try to move people towards. I went through all these stages myself. It took me a while. And then people in our family office group, once you reach about 2.5 million, I think you start to see the light at the end of the tunnel. And I always define end game at around $4 to $5 million with a family and living in a higher price area like California.
If you're relatively younger in your 30s and 40s and you're already at that $3 million threshold, the irrevocable trust, get that thing tomorrow. If you're older and you've crested past that $5 million net worth, then get that too. I'm just throwing that out there, not giving any legal advice. But part of that has to do with this concept of core capital here. So I'll explain this. Core capital this is age on this axis. As you start to get older, you need less money. Right? A lot of us here have younger kids. You guys are in this stage where you probably need $4, $5, $6 million net worth to be able to put it in cruise control and not do anything. But as you get older, especially as kids leave, they're not a nuisance anymore. You can take them off the books. Probably only need maybe $2 or $3 million or even less, right? So that's this concept right here. So the idea is that's all you need. This dark blue corresponds to this dark blue, which is lifestyle spending. So lifestyle spending is like your basic needs. It's said in different ways to mean the same thing, right? This is how much money we need to survive and some beer money on the side. But at some point, we don't need it and it becomes more of this gray money right here, right? This is the legacy money. I think I might differ. I'm sure I'll change my mind, but I'm like, I only got one daughter and I'm like, even if I had 2 kids, I'd be like, hey, give them 1.5, 2 mil each. Any more, you're just gonna mess them up, right? I went to private school. I know what's up. So I would probably call this light gray, but I think half of you guys might call this dark core capital, right? It's needed. But at least we're talking about these concepts, right, in this way. So the idea is lock down your lifestyle spending first, your core capital first. And that's probably, again, let's just call it what it is, maybe 3 to 5 mil net worth. Once you have that, lock it up, and everything else, all the gray stuff that should go to this, gets put in your irrevocable and put up in the cloud and gone away out of your estate. But you're not going to do that investing in like traditional investments or not being your own business owner, right? Some of you guys own businesses. You have the ability to get there. But if you're just working for the man making $300,000 a year or less, ain't going to happen. You need to take more risk. But for most of people in our community, that's not the need. We don't need private jets. That's one blueprint I'm showing here. But what's nice, once you have your core capital set, everything else is off the table litigators too when you're doing this. That's what's so nice. It's like so freeing in a way that you're set. You're in cruise control, that whole concept. I changed the terms a little bit to align, but it solves the question of like, all right, yeah, how much do you need and what's the concept? And then it's also the concept of what's the real goal. People who have read the book, the Bill Perkins book, Die with Zero. Yeah, that's a recommended book. It starts to talk about this idea of maximizing your experiences. So this is esoteric. So you have like money, right? We're all trying to get money, right? Money is very important when you don't have it. I think a lot of us, time is more valuable than money. In a strange way, you can change like money for time. Like I pay for the Whole Foods delivery thing. Whenever I got $40 worth of groceries, I have them deliver. I don't waste my time going to the grocery store, especially when you have young kids. I just pay. I don't care. Just pay. I'm paying for time. But there becomes a point where when you're older, you're sicker, and then you bring in health, right? You can't use money to pay for time at that point. But what is in the book, Die with Zero, the whole point is it's not necessarily time. Because you can have a lot of time and you can live an uneventful life, or experiences that is the thing. And this is where I argue you need freaking money to exchange for experiences. And at the end of the day, experiences to me is the point system. Now you might disagree with me, but experiences is what I think is a score at the end of the day. Throughout this, yeah, we're all here playing this game, trying to get passive cash flow. But the real game is exchanging your money for experiences while you're optimizing your finances. That's the optimization question. Maximize experiences, optimize financing. Well, we all know that you're getting older and you could die at any moment, which is why you need a trust, and your core capital goes less and less. So it makes sense to like, all right, when I get older, I just need to trade these suckers in, this money in for experiences. This is in super fine print here. Most of you are trying to go, and this is myself too, are trying to go for 99% confidence that you will have enough to last and understand the trade-off for limited time to achieve that. What that means is we're scarcity minded. We're like squirrels putting nuts away in the tree, and we're just running around. We have a shit ton of nuts in the tree, more than enough for a winter in Hawaii. And this is like the case for the people in FUM, right? I think more times than not, they're still like working their asses off, even though their net worth is 3 to 7 million net worth. And just makes absolutely no sense. But that's the case. It makes sense, right? Because if you spent your whole life trying to save money, make money, you start to associate your sense of value on that. So that makes sense to me. But if you look at it like this diagram, it's stupid.
But it can also mean maybe your kids are growing up, or maybe you don't have kids. You live in Texas, a little bit cheaper area, and it's just you and your spouse. You very well could need only about $2 to $3 million net worth at that point. So it's a sliding scale. Like I said, everything I talk about is a range for the most part. But I think it's important to understand the why. The older you get, the less money net worth you need. So to use a morbid extreme example, say you're only going to live for a few hours or a day. All you really need is $5-10 for a beer or two, right? Or essentially you don't really need money. But the longer you live, and that's the hard thing, we don't know how long we are all going to live, the more and more money you need. Our goal here, or my goal for everybody, especially those in our family office group, is to optimize the amount of experiences we get by aggressively, as safely as possible, of course, save money with taxes, go into good deals, and implement infinite banking, this whole trifecta I keep talking about, to grow our net worth to a point where we can just go into cruise control. We can keep still doing the strategies, we can keep investing, but maybe we don't need to do it as aggressively. And then just go into cruise control and maybe even go into T-bills and chill, because you don't need the high returns at that point. And to spend time on things that you enjoy, family, friends, hobbies. The Wealth Elevator 3 is finding a passion. A lot of people like myself are very outcome oriented. Go to a job, you create a career. You start doing that for a decade or a few decades, or in your 40s or 50s. Somewhere down the line, you may start to associate your value as a person to your occupation, where my goal is to head you off before you get to that point so that you can have the necessary means to not go into that job. Now, a lot of you guys will continue working because you're incredibly talented. And that's all about life too, is contribution to the world in your highest and best form, which for a lot of folks is your day job or your business. If we can get people at least to that state of mind where they don't have to do it, they go in on their choice. That's my goal for everybody, and kind of what keeps driving me forward, helping people get to their point. It doesn't mean that you get to this point and you start to be a philanthropic person, right? And donating heavy amounts of money. I think that comes later, but unless money's not everything, but it gives you options. Now, this slide isn't meant to make fun of people. I used to be a newbie at one time. I never could grow a beard like some of these young guys do. I definitely didn't wear those skinny jeans that he's doing there either. I definitely had a lot of these new investor type of ideas in my head. And again, this is why it's critical to get around a community of other purely passive accredited investors. And quite frankly, guys in their 40s, 50s, and 60s. I would say that most of our investors are in their late 40s to early 50s. That's where most of our folks are at. And then, of course, we have guys in their 30s, people in their 60s, but I think that's the core age group within our community. They may be young, some gray hairs there, but a lot of people that I see have a lot of these ideas that on the right side here. What I'm trying to get you is to the left side, but that's just going to take time. Hopefully that I'm just bringing awareness to this. As they say, awareness is the first step. When people come in, they're like, they may be in a place of pain. They don't like their job. That said, maybe it's a different employer, a different boss, right? need to work that hard. You can take a little pay cut and then they would be totally happy. The other thing that they look at when they look at their investments is they want cash flow, right? They want this short-term feedback loop of success where they want to see money coming back into the bank account from the investment every month or every quarter. This is a little bit nearsighted. And again, I did the same thing myself. When I first started racing up to 11 rentals in 2015, I wanted the cash flow so I could quit my day job because I didn't like my job. That said, it was a little bit nearsighted because between cash flow and equity growth, you can't have both. It's very rare that you have deals that give you both, or you got to pick one or the other. A lot of developments, there's no cash flow, but there's high returns there. And on the other side of the spectrum, you could probably get 4% in life insurance. That's pretty much the most guaranteed thing in the world of real estate and increasing the risk level. Maybe you can get 8 to 10% cash flow yields on a quarterly basis or even monthly basis, but you're not going to get that high ROI bumper at the end. So it's one or the other. It's like a Chinese saying, you can't ride two horses. You have to have one or the other. We'll talk about later about where you pick deals. Is it more cash flow focus or is it equity growth focus? It's rare that you can have it with both. There might be a mix of the two where it's going to be a little bit less risk, a little bit less cash flow. There are some of those hybrid type of deals, but generally what I'm trying to say here is most people, when they get started, they're too much heavily focused on cash flow. And the only people that should be focusing on cash flow, if you're in retirement years, you're 60, 70 years plus, or you have a net worth of $3, $4 million at least. If not, to me, you got to get going. You got to get your net worth to $3, $4 million. You're not there yet. Might be more than your buddies, but it ain't not much in our world. And the people who have this are typically on their first couple dozen deals. This is when people come into the family office group, they get around other accredited investors and they get checked with this really quickly in the first 6 months. And I'm just trying to make people aware of it sooner. And especially because a lot of people, they don't have a network. They like to lone wolf it, which I think is very dangerous in terms of picking deals, but also you are misled with these strategies that can linger long term. Imagine 10 years from now, just saying, shoot, I don't know why I was looking for cash flow. I had a day job at that same time, but I missed out on a lot of returns because I went for the cash flow every quarter route versus the have the project bake in the oven and pull it out and grow my net worth a lot quicker in that timeline. But as you can see, that comes with experience. Experienced investors, number one, they don't have a job and they have other investments. And that's where this cash flow is coming from. They don't need that next deal to pay for expenses. They don't think in terms of months and quarters where the cash flow is coming from. They think of in terms of years, 5-year increments mainly, and decades, right? How is that those deals when they go full cycle, they're cashing out, and typically they're reinvesting the money anyway. They're never really using it to eat. This is also, you got your non-accredited investor on the right side and your more higher net worth accredited investor on the left side, or another term out there is qualified individual. I think the net worth threshold for that is $2.5 million at least. To me, the ideal thought is go into 4 deals a year for 5 years. That's 20 deals. That way you space it out. And I think at that point, that's not an incredibly huge amount of deals. I think a lot of people on my level, we've got 100 K1s coming back every single year. So you can imagine how many deals we're in. But it just takes time. And I think that's what I'm here to help people get over this hump, because there's nobody really teaching this stuff. I think the reason why I've been so successful is like these kind of nuances come up and I make a slide and I talk about it and I memorialize it, because the way I figure is if I had this aha moment, and I would have a aha moment like this by talking to 3, 4 people all within a synergy of 2 to 4 weeks, I would jot it down. But I think most people it would just fly over the top of their head. They're definitely not memorializing it like how I do. And I think that's really been my secret sauce, is like everything I learned from synergizing it through my community. And also by having this community allows me to get access to more people. Really, I think I would be hard pressed to find a bigger group of purely passive investors out there. larger than myself. That's such a tight-knit community. But some other ideas that kind of come from this is, and this I would say add this, consider this for your action plan moving forward. Passively investing is not a get rich quick scheme, but I think it's a get rich surely. Sure that there is market corrections that happen supposedly every 7 to 20 years. We just saw a big one in 2022 to 2023 that was a larger correction than in 2008. In fact, not a lot of people talk about it, but that happens. And that's why you have to diversify over a 4 to 7 year bridge. Because if you just happen to invest in the wrong year, which it will happen if you're doing it the right way, you have a few years or maybe in 5 years of good deals that will survive, or you've already taken your profits already. At that point, you can breathe a sigh of relief. I think that your portfolio is stable. But I guess what I would acknowledge is getting up to that point, right? Your first 4 or 5 years of investing, they're going to be somewhat exposed, but it is what it is, right? That's investing. There's always risk in investments. But I think the nice thing is like investing in real assets that provide utility in this world, as opposed to stocks. The stock world is like the traditional investment market. What dictates the price of stocks? And this is what really turned me off. When I just got out of college, I had 50 grand to play around with. I would do a lot of swing trades, buy something and then sell it maybe in the next few days or several weeks. But I really could never figure out what the heck correlated with the price going up and down. And this is just my opinion on stocks. I don't have any stocks personally. It doesn't make sense to me. But my big beef with stocks is that the price is not correlated with the performance of the asset or the company in terms of profits, etc. Some people argue it is, but in reality, it's tied with the expectations of the numbers of that company. And that's what I don't like. I don't know what the expectations are. And then I don't know what the reaction when those numbers come up to the Wall Street. And that's what it's very disempowering in my opinion. You can do a good job, company can do well, but if they don't hit expectations, you can get hammered. Where with real estate, a lot of this is in your control, right? You control what the net operating income is. Before you get into an asset, we run the due diligence and the numbers and see what this asset was working with. We get the full rent rolls. We see who people are moving in. We see who are the new people. We see who is leaving. Are they sticking around? And then we can physically verify, yeah, these renovations do yield higher rents through comparable sale analysis and just literally seeing it on the rent roll, on them being absorbed at higher rents. Or with a development, I think it's actually even simpler to verify things. Build a property for $150,000 a unit and you sell it for $250,000 a unit based on comparable sales that have happened around the area. Very clear path to profitability. You buy for this, you sell it for this is your profit. That's what you take home. And to me, that excites me because I like it's big numbers, but also it's very clear. No different than maybe this is why I didn't like my job. I had bad management, right? I didn't know what the KPIs I needed to hit to get a good performance review, right? I think we've all gone through that experience, but that's my frustration with traditional investments versus alternative investments. And another point on the first point here are real assets that provide utility in the world. If you're somebody who likes to invest in things like housing, self-storage, mobile home parks, and then as we get into private equity, manufacturing, like a lot of these products that it creates provides real direct utility to humans, Americans. And you're like, I see the profit and loss statement. I see how you're making money with this. You take the raw materials, cost of goods and services, and this is the profit. Not everybody has the ability to sit on a webinar like this, network with some people, and then I think the biggest thing is get off the beaten path. I think once you acclimate yourself and you build your network and you get more comfortable and you get accustomed to a trusted community like ours, you're going to realize that this ecosystem is rather small. It gets a lot fun. I enjoy about this. A lot of cool people, a lot of eclectic people.
join our group and you can get very comfortable. That said, a lot of education, getting through the threshold. That's where I try and help people get through that threshold and get started in this world. But it is daunting for sure, because it is very different than the traditional investment path. But this is the idea. And this is any investment, whether it's a single family home or syndication. The biggest mistake I see investors make, especially single family home investors that only own a property or two, and you may have a wealthier auntie or uncle or friend that has a paid off rental that they own. They have violated this cardinal sin where, sure, when you get into an investment, you look at things from a return on initial investment level. And typically it's 10 to 20, 30% ROI. I have a video on this kind of going through the numbers at thewealthelevator.com/returns. But for just discussion, when you first go into deal, your return on investment or return on equity is very high. And once you get into a deal, you need to switch from evaluating things from initial investment to more return on equity. So what is that? Return on equity is a little bit similar calculation to return on investment. Return on investment is how much profit you made from your investment divided by your initial investment. So if you spent $50,000 to invest and you got $5,000 that first year, 5,000 divided by 50,000, that's 10%. But as time goes along, the property goes up in value typically, either from forced appreciation or market appreciation. But certainly by you paying down the mortgage, you're getting more equity build up there too. So you also have to count that. So over the years, that denominator of that calculation, which is the return on equity calculation, goes down. So that's where this phenomenon where you're seeing this line go down. So it's a tricky thing. I would say, to give you more of an extreme example, a lot of people in Hawaii, they have paid off $1 million houses, which I don't think is the thing to do. But again, most people out there should pay off their houses, right? Most people. You, if you're listening to this webinar, are a little bit more financially adept than the average bear out there. And you guys are playing a little bit more offense, like how we're talking about here. But that person who has the paid off house, $1 million, if they put a renter in there, maybe they rent it out for $5,000 per month, a $1 million house, they've got to pay expenses on it. So really maybe they profit $30,000 per year divided by $1 million of how much equity they have is 3%. And most people would say, why the hell would you want to do that? Just put your money in like something like life insurance where it's zero risk, zero liability, and just a cleaner asset. But this is obviously what a lot of people do because they just aren't aware of this whole concept. Now, sure, when they didn't have as much equity in it, the return on equity was much higher. And at the end, the extreme point I gave, your return is almost nothing. So to sell or re-leverage and get it to the next deal, that's up to you. In my opinion, I think beating 10, 12%, you can probably do that pretty easily in the alternative investment world. The idea is ride that deal down to this point and then re-leverage it. If you have a single family home that's good amount paid off, sell that sucker and get 2 or 3, and then ride those deals and do the same thing, get 9 deals. But this is where the syndicated deals do this for you. And the nice thing is none of the debt gets put in your name as a passive investor. And if things were to go south, you're not the person holding that lien. You're not a loan guarantor on that. The general partners are typically the loan guarantors. The syndicated arrangement, some people complain about these deals are so short and then I get my money back with the great returns, but then I got to go find another deal. Hey, that's just how it is. That's what the goal for most syndication is, to get the highest amount of ROI in the shortest amount of time, kick you out. And then unfortunately, you got to go find another deal. But once you're in this world, you're going to find deal flow pretty easily. That's what the family office Ohana Mastermind is all about. You're going to get thrown right into the deal flow with a bunch of other people there too. But I'll just point that out because I think I heard it on some investors say, I like working with these guys. They exited out us in 3 years instead of 5. I wish they would have just kept us in there. That's a little silly because we've done this. We've done a development and you make the most money when you're building the asset and then leasing it up the first few years. After that, sure, everybody likes cash flow, but in reality, your return on equity isn't very much at that point, and which is why we turn them and burn them and sell them. Now, of course, that creates a capital gains situation, and we've got a full e-course on I think 8 ways you can mitigate that capital gain solution there that most of us will do is the lazy 1031 exchange, where you're investing in many deals outside of this one in particular, and you're using those passive losses to offset that deal, and then you get more passive losses to create the good vicious cycle in a way, or that what we call the golden hamster wheel, and you keep delaying the capital gains forever or to your death. But again, check out that tax section. If you guys are logged into your members portal, you should have access to that I think it's a 1 to 2 hour series of 8 ways you can mitigate those capital gains. But other than that, that's really the only downside. Really, what we're trying to do here is maximize the amount of returns and not get you in the situation where you're in the buy hold stage, not really making too much money. But some people call this phenomenon like C curves. I invested in coffee farms. I remember sitting there, it was really hot. I don't like to get hot very much, but it was like in a tropical rainforest. But what they'll do is they'll grow the coffee plant. I think it takes 4 to 5 years for it really to start to have coffee beans, but they'll harvest it. And then a year or two will go by, and then the stump will continue to grow. And what they'll do is they'll cut off the coffee arms to re-stimulate the coffee growth. The coffee beans are obviously the ROI, the returns. And they'll do this for several seasons. The stump of the coffee plant, it'll be under an inch thick, but it gets pretty beefy. It can be like 5 inches. And the problem there is like the more and more fertilizer you have to invest in that plant to grow an equal amount of coffee, maybe a little bit more. But what they do is they continually prune the plant. But at some point, that stump is so big and it's just you need to feed it too much nutrients to get the same amount or just slightly more coffee beans. That's better just to dig that thing up and burn the plant and start new. That idea of pruning the plant, trimming off the branches that gave you the coffee, and then having the plant regenerate in a way, it's very similar to this phenomenon. And if you're somebody with a handful of rental properties who have under 50% loan to value and paying off your debt, you're probably like, oh, shoot, I've been doing it the wrong way for so long. That's just one of many ways. Like our idea is to source the best practices. Of course, with debt, you play around with a little bit more risk, but this is where everybody's on different parts of the journey. If your net worth is already $4 million, then yeah, sure, pay down your properties or pay off your mortgages. But at that point, I guess what we're saying is get out of rental property ownership altogether. Go to syndications where you're not the debt holder. You're not on the front line of the liability at that point. And I think that makes sense for anybody over $1 million net worth. You don't want to own dirty rental properties, high liability rental properties. You want to get into syndications. And that's the nice thing about syndications. It does this pruning for you automatically. The people ask like, all right, it all sounds cool, but maybe give me some like working models. And this is where I'm always a little hesitant because I'm like, I'm not a certified financial planner, certified to sell you marketable securities and get paid off of that, whether it's a good investment or not. Obviously, we put together these deals because I'm the sponsor on it. I got carried interest that the asset succeeds. And also we got our own skin and reputation on the line. I think that's what sets us apart from most people out there, certainly the certified financial planner who's just selling you stuff and he just splits and leaves after he makes the sale. So again, I'm just prefacing this is just infotainment. This is not financial advice. If you were looking to maybe just get started with $500,000, which I think most people do in their first years of doing this, especially if you've been traditional investments your whole life up to this point, I'm big on just, hey, baby steps moving forward. Of course, if you're going to be investing more than $250,000, I would highly suggest joining the family office on a mastermind because there you're going to get the network, right? If you don't join that group, you're on your own. You're a lone wolf. And it is difficult being a lone wolf because that's how I did it in 2015 when I went from 11 rentals and transitioned to a syndication portfolio. I went to a lot of so-called conferences, met a lot of people and experienced in single family homes and real estate. But I would say that the first 15 deals I went into, a few of them were with either shysters or just fake it to make it operators. And I didn't do well in those deals. So my failure rate was 1 out of 5. So if you're thinking about investing $250,000, 50 grand of that probably is going to be a little bit up in the air. I think that's more than pays for the full membership. And then you get the relationships tacked on top of that. Like it's there for you, but if you want to lone wolf on it and just, I think the other mistake is like people get into these deals so slowly and they're not diversified one bit. They're in like less than 5, 6 deals. That's not diversification. So you got to get into it. And that kind of puts people in a difficult position, right? They've been doing things so long for one way. And what I'm on the other side is this totally changing your portfolio. But whether that means 50% of your net worth into alternate investments or 80% of your portfolio in alternate investments, your level of jumping into this stuff is up to you. But you're not going to get there with 10, 20% of your net worth. That's just going to get proof of concept, but that's not going to change anything financially for you. Just speaking from my own experience, in my 20s, what got me to where I'm at today is I went very heavy, 80% plus into alternative investments for 5 to 10 years at least is going to make a noticeable difference. But if you're starting out, what I would say, just dabble, right? Try and get diversification as much as you can. Try and spread out your money. That said, you got to think about $50,000 got to be your minimal investment that you're going to have to put in your head. The reason being, most syndicators who are decent that have $1 billion of assets, again, key mark that threshold. A lot of these guys, they have these silly websites where they're saying, oh, we've done $300 million of deals. Like $300 million isn't anything. That's nothing. That's unless you're over $1 billion, you're still in newbie status. And those are a lot of people that I invested in my first 15 deals. Like I said, you're just working with these fake it till you make it operators who anybody can put together a website. And then, especially if you don't have a network, I know what you guys do. You guys just go on podcast land and see who's talking about syndications and you invest with them. That's the absolute worst way you can be an investor, guys. That's the worst way. Don't do that. You're going to find some of the worst operators getting started. Today, what we do to find operators to work with, whether we operate it ourselves, is off our network of general partners, right? Unfortunately, you're not going to have access to that unless you kind of work with us. But this is a stair-stepping game, right? Like I said, your network is always going to be constantly improving over time, and it's just going to take time. You just have to have patience. My hope is to help shield you from just garbage deals with garbage operators. And these are the guys typically who troll the real estate investing club. If you want to know what I'm talking about, just go to the local real estate club and you'll see some of the slime balls that are out there and some of the garbage deals that are being syndicated. And I think you can also just type in real estate syndicator school and you can find some of the newbie operators and what they look at. And what you'll find is it's very hard to determine who are the fake it to make it and who are the legit operators out there. What we try to do is we try to find people or operators that are more on the introverted side and don't do any marketing. In fact, they're horrible at marketing, which typically means that they're good operators. A lot of people are really good at prancing around on the internet. I myself have gotten better at this. I know the tricks of the trade nowadays, and I know where to spot it. And I see it as a big turnoff. Again, I like to find introverted operators that don't do marketing very well, that are really good at operating, because the good operators are the good people that you want to be in their deals. There's funds out there that are diversified, especially getting started. I think it's a great way to diversify. The biggest food group that people will start off with is apartments, because you've lived in apartments or you've rented a house, maybe in college, and you know what that dynamic is. There's other food groups out there in the real estate world, such as like mobile home park, self-storage. I'm not a huge fan of self-storage because it's just, the nice thing about Class B, Class C multifamily is it doesn't directly compete with new inventory being built, where everything in self-storage needs to be Class A. So if you're unfortunate enough to be in a project where somebody just builds a Class A self-storage facility next to you, you're screwed there because they're competing directly with you and it just throws off your comps. But diversify, learn. No way of learning other than investing and putting your own skin in the game. And also, sure, we have the syndication e-course for you guys to take part in that should be accessible in your guys' members portal. 10 hours of content for passive investors. And I would say once you go through that, have the confidence that you know more than most accredited investors out there. But really, all that is to set you up so you're aware of these concepts. And at that point, if you did come to one of our events, I'd be able to sit you down at a group of 5 other accredited investors, and you would be able to hang in the conversation. And you're not talking about silly things like what's a preferred rate of return, and you're understanding what split structures are. You're understanding a lot of these concepts. And you guys are smart people. It's just like a lot of the concepts just aren't talked about in normal American vernacular. So that's what the e-course is for. But the real magic happens is when you start to join a community and start to build one-on-one interactions with people out there also doing this stuff. And that was where I was back in 2015. Prior to that, I don't want to pay for anything. I don't like people. I'm just gonna do it all by myself, right? That is e-course. I'm gonna just do that. Look, I had the same attitude from 2009 to 2000 or 2015. I played that game. I just thought I was all cool, too cool for school. I'm just going to be a lone wolf. But in 2015, a magical thing happened. I started to, by chance, interact with accredited investors. And this is where you're seeing a lot of this curriculum from deal vetting to infinite banking, accredited investor banking, to tax strategies. These best practices is what I crowdsourced from a lot of these people in 2015 when I finally got out of my shell. People who know me as a pretty big introvert. Obviously, it doesn't seem like that because I'm super passionate about this stuff and it's fun. But I really like to interact with talking finances and money like this. Most people think that we're weird because we talk so openly about our money to seemingly strangers. But you come to the retreat after a few days, you're lifelong friends for life. It's a huge bonding experience. And that's what I wanted to create at our annual retreats. But you guys are allowed to come once and test drive. You got to pay, of course. Things free. But to come again and be a part of the community long term, you have to join the family office of HANA Mastermind. What I realize is I'm really bad at selling that group. And there's no better way to seeing if it's a good cultural fit for you to meet the other participants and get a vibe of our community. So that's why we do events from time to time a year, open houses. But for the most part, we are a closed group organization. One of the big reasons is in the past, we are well known out there in the general partner newbie syndicator world, and they would love to get in the walls of the wealth elevator because we are probably one of the biggest purely passive investor groups out there, which is unfortunately like why I have to put the guards up in some respect, which is why everybody who comes to our events are vetted. And that's part of the reason why I have the onboarding calls to just get the vibe of people. Are they right fit? Ultimately, if I bring somebody in, even as a guest to a one-time event, it reflects badly as me, the host. I want everybody to have a great time. I want the right people who are open-minded, who aren't weirdos, to be honest. I want everybody to have a good experience and to create that culture and that safe environment where people can talk about their finances in a confidential place with growth-minded people too. Amazing things happen, right? And I think it creates an environment where, you don't meet very many new lifelong friends after you leave college or once you're in your 30s and 40s. But that was the goal of this group, was to create a cornucopia of people who are first generation multimillionaires, good value system, works hard for their money, but wants to invest, have the patience, and then reap the rewards all together. And you climb the ladder or you send the wealth elevator floors together. Different samples of different ways. These are just ways to think about how you would do this. Of course, I'm trying not to get into like nitty gritty because then I get myself into trouble, right? Because people are like, you gave financial advice. None of this is financial advice, folks. Just 2 data points here. On the left side, you have maybe somebody who's a little bit more cash flow focused. Again, I would say this is really for those people who have a net worth of $3 to $4 million or greater already, or you're already in your 60s and 70s where you need cash flow. If you're relatively younger, in your 50s or younger, or you're just growing your net worth, still in the $1-2 million range, you got to get after it. You got to go for equity growth and don't get suckered in with this idea of monthly cash flow, quarterly cash flow. But I will validate, I guess this is very common. People are like, I won't say this, but this better work. If not, my wife will kill me because I'm doing something out of the ordinary. A lot of you guys don't even tell your spouses what the heck you're doing. You come out to the live events, you'll see where everybody's head is at with this stuff. I know what you guys are thinking. And with that, you'll be guided more towards cash flow. So at least when your wife asks you, hey, what'd you do at that $100,000? It's been a year or two. You can say, yeah, I've been getting started. Yeah, the cash flow started 6 months after we got into the deal. Here's the bank statements. Get off my back. At least you can celebrate in the success, right? I know what you guys are thinking. I think I have an idea what I think is best for people, but I think the biggest thing is, like I said, baby steps. Whether you go into cash flow deals first or later, as long as you get into alternative investments and then get you a rolling start, and then you meet other people in the community, you start to expand your ecosystem. 10 years, 20 years, I think it won't make a difference where you are. The 5-10% rule that I have, I'm careful when I say rules, right? Because people think of them as absolutes. Nothing is absolute in this world. The 5 to 10% rule is you never want to have more than 5 to 10% of your net worth into any one project. So if your net worth is 2 million, probably don't want to be putting $200,000 into one particular asset. Now, diversified funds are different, right? They're diversified. So feel free to put a little bit more and bend that rule. Number two, your startup phase with 10 to 20% net worth in the first 2 to 5 years. This is what most people will do. They'll take 10 to 20% of net worth and then spread it around. So if your net worth was $2 million, $200,000, $400,000 of that, you'll put that into 4 or 5 deals or so. I would say try and get to this 20 deal portfolio as soon as you can, because then I think you can breathe a sigh of relief at that point. That if you did that, you're in 20 deals, and more importantly, you're spread over 5 years. Even if there was a correction in year 4, you're fine. If you think about it metaphorically, it's a bridge. A bridge can bridge you over, even if you got some down years in the middle there. But this on the right side, like with the development deals, you have a little bit quicker full cycle because it takes a year to develop, another year to lease up, and maybe you could even sold before that. But that's where the magic of this syndication works. Like it's going to be slow for the first few years. The value add is going on behind the scenes. Your general partners are hard at work, and then the deal goes full cycle, and then you reinvest that money. And then now you can see you're off and rolling. Depicted a little bit different way. You can go one way in terms of equity focus versus cash flow focus. And your path is somewhere in the middle. I think you got to get off thinking your first deal. Think of it more, okay, what about my first 12 deals? How's it going to look? Right? Because it's all going to be all in the middle here. And I think this makes a lot of people uncomfortable because you guys are used to these target index funds or these asset allocation mixes where you go 10% international, 30% large cap, 20% medium cap. Throw all that out the window. We are in the alternative investing world. There is no normal here. Some people have just 10% of their net worth in alternatives, and that may be all cash flow stuff. Some people have 70 to 100% of their net worth in these deals, and it's all equity growth, right? It's all over the place. So I think that's why you have to dig down into people's individual stories and investment values, and you'll start to build your investment criteria and values over the long term. But unless you get started with your first half a dozen deals, you got to learn by doing, and then you got to mix it up with the right people. This is the 5th module where we're diving into why choosing syndications over the buy, rent, rehab, repeat model, or just buying little turnkey rentals like how I started from 2009 to 2015. Let's set a couple terms here. Market appreciation versus forced appreciation. Market appreciation is the price of the market goes up and we make a good amount of money. Some people call this kind of the trade winds behind your back. Of course, you always want to be investing in a good market and in good times, but you can't always predict this. From 2010 to 2021,
21, 22, that was a great bull market. We've had economists on the podcast many times. And if you read a lot of academic books, a lot of times they'll say normal market cycles typically last anywhere from 7 to 10 years. They go up gradually and then come down a lot quicker. And this is no different than the last one we saw. So probably we'd like to say that the 2020 beyond cycle is definitely looking like a nice, good bull run. And as we all know, the earlier years are the years that early adopters who come in, who have the confidence to go in when nobody else goes in, are going to get most of the returns. So that's why it's important to empower yourself, get educated so you can think for yourself. And when I mean everybody else, obviously that was a lot of people getting involved in the game in 2021, 22, 23 at the peak of the market. But it's all been hindsight. And that's why we say you always wanted to diversify over 4 to 6 years. So that's why if you're looking at deals now, you got to just get in. The vision is to build a portfolio of dozens and dozens of deals and spread it over that long time horizon. So just in case you do invest in a year where there is a correction, you have your portfolio spanning that long time horizon. So getting back to it, market appreciation, just dumb luck, right? This is like what amateurs do. They buy things and they hope that the market goes up. And yeah, it typically does over the long haul. Now, forced appreciation. Now, this takes a lot more sophistication to do. You're actually doing things at the property. So you can see a picture of one of our, Class C assets that we picked up. I think this was back in 2018. We only held it for a couple, 2.5 years, I believe, and doubled investors' money on this one. You can see the renovations. Take a look at the kitchen. The kitchens are always the telltale. You can see the new flooring, new appliances, new paint jobs. Sometimes the cabinets are just resurfaced, repainted, and new hardware. Very rarely, now you're getting into the heavier value add, but this is considered cosmetic renovation, anywhere from $5,000 to $15,000 of renovation per unit. Of course, there's other things that get done. You can see the paint job on the outside of the clubhouse. Obviously, the clubhouse got revamped and jazzed up a lot, but that is example of getting your hands dirty, doing construction, and force appreciating the asset. And this is what I like. That you're taking faith in your own hands. You're not just relying on luck to make money. Now, obviously, when you get both of these right, this is where you greatly overachieve performance. And we like to set before where we look into the future and predict where the market's going to be at and predict a softer market. In reality, we want to be pessimistic. We don't want to count for market appreciation. But when I was picking up low rental properties from 2009 to 2015, I was just putting 30-year loans on it. And the great strategy, I think, for getting started. That said, that was a long time ago. And this strategy is called, crudely, the buy, hope, and pray model. When you are doing this type of strategy, you're putting a loan on it, you're ideally cash flowing, but there's nothing you're doing to force appreciate that asset. There's no value add. Now we're getting more involved in private equity deals, buying a business and doing various things to value add that business, changing out employees, adding systems and processes, adding new product lines to increase revenue, and doing various other things to lower expenses. No different in force appreciating a business to then sell it for more. At the end of the day, there's a saying out there that I've heard: wealth comes to those who create value. And in this case, the value is better living conditions for the tenants, who in turn pay more rent. I never really liked the idea of businesses where they buy and sell things on Amazon and just play this arbitrage game. Yeah, I get it. They're helping out with the supply chain and adding value there, but really they're not doing anything to the physical product. Not only can their business plan get caught there if there is a correction, but in holistically creating wealth, when you jump into these types of projects, you can feel good that product is getting improved. And it also, especially when you're talking real estate, it improves regular people's lives. So let's dig a little bit more into the numbers. This is the magic part of investing. There's a laundry list of different things you could do to force appreciate the asset. A lot of times, the property management will be a little bit dysfunctional. This is why when new investors look up the property on apartments.com or Yelp and see it's 1 or 2 stars, that's exactly why we want to buy it because we want to improve the service and the tenant base. So when you see that type of stuff, and this is why when we do physical due diligence, we want to see broken handrails here or there. We want to see paint chipping and dysfunctional things because these are things that we can improve. But just go with me on the numbers here, right? The first one, the property management. A lot of times when you go into these assets, the units are under market rents. Why? The property management, they're on the tail end. They hear that the property is being sold. They're not the most aggressive in getting the market rents or top line rents at that point. $50 is a pretty negligible amount of the $1,000 rent these days. So it's usually easy low-hanging fruit to go ahead and bump that up. There's a variety of things that we can charge under the line item of other income to the tenants. A lot of us haven't lived in apartments these days, especially on higher end B class and A class properties. It's not just the rent you pay. There's always these add-ons. So it's just one of these things that the industry has moved towards squeezing the customer for more and more revenue at the end of the day. Obviously, it's things that they opt in for and choose, but this just one thing could lead to $54,000 a year of extra revenue. These properties are evaluated on a prevailing cap rate, a sort of equity multiplier, if you will. If you divide that by 5%, you just increase the value of the property by over $1 million. You're probably thinking, whoa, you see where this is going. So next thing, utility bill back to tenants. Say we bill some of the utilities back to the tenants, so they're burdening it. And when they start to pay it, magically the utility bills start to go down for the entire building, saving $40 per unit there, over 100 units. Huge bump in value. You've got the parking lot here, and in Texas, for example, you have a lot of hailstorms. So people will pay a premium for covered parking as opposed to standard parking, or they may pay more for better position parking. But let's say we started to charge $45 a month for just 100 spaces and created $4,500 a month. Now, we're not going to do this at every property. I think the bread and butter, especially for Class C and Class B properties, is just the real basic renovating the units. Of course, we don't try to kick tenants out. It's more naturally as it happens. Of course, I'm big on kicking out those really difficult tenants that nobody else in the community likes anyway. We improve the tenant profile over the years, and those people, we play a little hardball and we get them out by bumping the rents up a little bit more aggressively. That makes everybody feel good. Tenants, they don't want these shady characters in their community anyway. Just say you bumped up 5 units per month, right? You're going through the tenants normally anywhere from 5% to sometimes 10%, 15% is going in and out every month, especially in the summertime months. Again, we just let this naturally progress. Part of these multifamily value add strategies, you don't want your occupancy to plummet too much because you want to keep your cash flow. But that said, we've had it where occupancy has dropped 70%, even into the low 40s. Sometimes we've come back. It hurts cash flow in the short term, but in the long term, it actually helps the project. It's like ripping the Band-Aid off, as opposed to waiting half a year to get a good chunk of that tenant base out and in and renovate the units and new fresh tenants in there that are paying more. We're able to do that in a couple of months, right? Going through the math here, $4,500 a month times 12, you're creating about $9,000 at a 5 cap again. $900 at a 5 cap means $180,000 bump in value every single month. Multiply that by 12, you're seeing almost a couple $1 million right there. And you do that over a couple of years. This one is more showing you the bump of value every month because we're renovating a handful of units. This is where the big value is coming. And now you're seeing, especially if you're coming from the house flipper world, this is really cool because this is long-term sustainable. I don't have to flip a house every single month. The cool thing is you've got all the other units online and hopefully you're in a long-term note and you have revenue coming in. Whereas a house flip, you could probably bump the value of that property by 6 figures, but you have absolutely no revenue until you sell that asset. You don't make any money and you can get caught in that type of situation. Whereas here, the asset is cash flowing and going, and you're just continually to work at it, as these chaps here in this image are doing, slowly and surely. So here's some of these pictures. This was one of our early projects in Iowa, 52 unit. You can see the yellow appliances, and yeah, we still run into these from time to time. This is more of going from a C class to a B class upgrade. It looks nice, right? But you look closely, the sinks aren't nothing special. The cabinets are actually the same cabinets, just repainted with more modern hardware. And the appliances aren't stainless steel. They're just the standard black or white appliances. Here are the bathrooms. You can see the flooring. That's the big game changer these last couple of decades. This LVT flooring looks nice. Everybody likes it. It's cheap and it's pretty indestructible. Here's the bathroom. One thing that goes back and forth, and even in the same property, our contractor team and handyman team, what we do with the showers, sometimes it's just a basic resurface where you come up over the old tiles and you put that flat sheet over the top. Sometimes they just repaint the tub. Again, trying to do things the cheapest way to get the biggest bump in rents. Aesthetically, it looks pleasing. It's pretty durable, but it's not a kitchen or bathroom remodel that you're doing at your home that's going to cost 50, 100 grand. Again, we're normally in like the $5,000, $10,000 range in kind of the lower price markets. In Phoenix, you've got a little bit more California type of pricing that might get over $10,000, $15,000 per unit. Just things are a little bit more expensive out there. Manpower's a little more expensive. But going back to myself, from 2009 to 2015, I was buying the little rental properties. And I think it's a great strategy at the time. Now, that said, modern day now, you can't pick up properties for $90,000 that'll rent for $1,000 a month as I did. On the side note, it makes me a little sad. Like our kids can't just blindly buy a little rental property and do the buy, hope, and pray model. They could not get as much leverage, but I was buying with full leverage. Anybody can just pay down their mortgage and cash flow. One of the biggest mistakes that landlords make, as we talked about in the other module, is that whole discussion about return on equity, ROE. If you have a paid off property, yeah, dude, you better be cash flowing on that. But your return on equity is probably going to be in the single digits at that point. You need to get that thing moving and leveraging into other assets so you can grow your net worth over time. But if your net worth is over $5 million, you don't got to listen to a thing I say here, right? So it's all subjective at which floor of the wealth elevator that you are in. But if you're in the basement, first floor, second floor, you got to keep taking the equity in your house or other assets and get it working. Either sell it, go and buy more rental properties. Some of you might be looking to sell some of your rental properties and getting out of rental property ownership for the liability reasons. Another masterclass I've got is the 8 ways to offset capital gains when you do sell one of these properties, which is a good problem to have, right? Because you made a good amount of money on it. Take a look at that in the e-course masterclass section. Just reach out to our team at thewealthelevator.com. This is the slow grind. It's not the get rich quick scheme. As you start to build assets, your monthly savings keep going up and you can use that to buy more properties. But this is where I reached a problem with my 11 rental properties back in 2015. I had professional property management to deal with my problems and be the direct line of communication and enforcement with my tenants. But with a few $100s per property times 11, that was a few grand per month. Now, I was in my late 20s at this time. Most of our clients today need passive cash flow every single month. It's just that you need more properties than 11. But just to give you an idea what owning 11 properties feels like, I had an eviction or two every single year. And I had some type of big catastrophe, like tree falling on the house, some type of big storm that created a flood in the basement. There was a fire. What got me a lot of times is like that there was some kind of domestic violence thing and somebody broke the window and they say that somebody came through and broke the window from the outside, which we all know it really happened. Things happen and I got to pay for stuff and more probably deal with it, right? The property manager, managing the manager, keeping them accountable because residential property managers really aren't the greatest out there. And especially when they know that you live in California or not in their backyard, they just associate you with some rich, absent landlord. And now you start to see these ridiculous repair bills for the simplest of things. I think I almost fell off my chair when I saw a plumbing repair for $900 where we knew it was just simply clogged. I don't know why you got to send two guys for that too. But with 11 rental properties, these evictions piled up. They're going to happen. And I had decent rental properties in okay areas. So it was not like I was in the slums or anything like that. Over several years, I had probably about 12 evictions. With those 12 evictions, one out of every three turned out to be a big catastrophe, like this video here. You can see by the thumbnail how bad it was. And at the end of the day, I think it costed like $20,000 to repair this thing and get the property back online. And then you're thinking, wait a minute, like, are we doing this in the first place? I thought we are trying to make money because that big of a repair bill is like years of the supposed cash flow you're supposed to get from the property. Obviously, when you buy rental properties, you have your CapEx line to account for this stuff somewhat, but that just blew that budget out of the water. Now, for you non-accredited investors, I'm thinking you have to go down this route, unfortunately. And I think this is also a cool route for a lot of our kids to go through. We talk at our retreats about buying little rental properties for our kids so they understand this business and they understand about the ups and downs of life. Even if you didn't deserve it, you're just the innocent landlord and you have to deal with this nonsense. Sure, you lose a little bit of faith in humanity by interacting with these types of things. But I think it's a valuable skill for our kids because unfortunately, they're never going to have to feel what it feels like to be going through these initial adolescent stages of being investor. But most of you guys out there are accredited investors and are skipping over rental property ownership. But that's where from one point, if you have 11 rental properties, that's some type of eviction every quarter, some kind of big catastrophe every month, but that's with 11 properties. Now, if you have 30 properties, you really need to hit those cash flow numbers to retire. Now you're talking about an eviction every other month. A big issue comes up almost every other week. And that's where this is not scalable. This also puts you on the front line of liability. When something stupid happens, like they fall and twist their knee, they sue you directly. Whereas in a syndication as an LP investor, you are an LP. That's the beauty of a limited partnership. There's limited liability for you. It's no different than you owning a stock in a company. A lot of these kids out there like to do what's called the BRRRR strategy. They buy something, rent, rehab it. You can make a lot of money doing this, but boy, is it a lot of work and more importantly, a lot of risk, right? And I think that's where you have to ask yourself if you have construction background, project management skills, and the connections to do this remotely. It's extremely hard to make the numbers work in a high price area where a lot of you live. So you've got to likely do this remotely. Some people do this in Kansas City or Alabama, where they know nobody. And contractors know that you're just some out-of-state sucker. And they call them contractors, highlighting the word con for a reason. And if you've also heard the term change orders, it's hard to keep these guys accountable because things just pop up and your budget increases. And after a certain point, you're not making any money. You're losing money. I think that's the difference in terms of liability and exposure by going down that BRRRR route. And everything all looks cool when people talk about the success stories, but you never hear about the failures. At the end of the day, it's just trading time for money too. I've always been like, you don't want to put more than 5 to 10% of your net worth into any project. Doing this buy, rent, rehab, rent, repeat strategy, you're putting a lot of concentrated part of your net worth into this. And it's speaking to the accredited investors out there. That's why the syndications and private placements line up to be a lot better for you on the second floor of the wealth elevator. But if you're a non-accredited investor in the basement floor or the first floor, you may have to do things like this. There's a lot of internet gurus. Be careful who you listen to. A lot of these guys are just making money teaching people how to do this because it's too damn risky to do it themselves. And it's funny, a lot of these guys, I think they're smart. Like they make like they're flipping houses and they're on Instagram. Of course, they're on Instagram, right? And TikTok. These are for the younger guys. But they make like they're flipping these houses themselves. But in reality, they're just marketing for suckers who think that they want to flip houses that are newbies that get involved with this and need money to the hard money loan to go buy the asset and do the construction on it, take on all the risk. And they're just playing a middleman to a hard money lender out there, a bank or a debt fund who lends 50 grand, $500,000 to this investor. And these influencers out there are just making a point or two on the transaction. But they tell everybody, oh yeah, I was involved in another flip where they just was the lender on it. That's out there. Be careful of that. It's not always what it seems. We actually are the ones doing the deals in the trenches, operating, but certainly putting our name on the documents as the sponsor. Many times I'm actually the one personally signing on the debt. So yeah, that's a lot of skin in the game. The nice thing about these syndications and private placements, you got to read your PPM docs, right? But you're more on the equity side where you're involved in a house flip as a private money lender, you're just the debt investor. If the property knocks it out of the park and makes a whole bunch of money, you don't really get any of that. This is why I like the spirit of these syndications and private placements, because there's a split structure. Everybody's incentivized, especially general partners, to do what's right for the assets so that we all make money. The GP can make money and you as the LP get alongside of that. At the end of the day, now some people maybe not agree with me, but I think it's structured in a way where it's a great harmonious joint venture. But if you own rental properties now, just do the math, folks, right? Like with $300 per property, you're going to need 20 to 40 of these things to replace your income. You run the risk of a $10,000, $20,000 setback every third eviction, at least in taking my track record into effect. The big thing here is the liability, and then the debt is in your own name. Whereas in syndications, the debt goes in the key principals' names within the general partnership. The passive investors are not recourse on the debt. It doesn't even show up on your credit record. You guys are not on there. You're just passive investors. And the last thing I'll point out here before I close this out, I think some people, what they like to do is they like to pay off these properties. They call this the domino effect, which is great. But the problem with that is with single family homes, there's this tidal wave of CapEx. At some point, huge things start to go. It's like health and bodies, right? When you get to be 40, 50, 60, things just go. Organs start to fail. Things pop up, just like houses. So the idea is you never really want to be in an asset for very long. What's long? I would say 5 years to 15 years or less. You're going to get hit with what I call the CapEx tidal wave, where it's going to catch up with you. And then it's just going to be eating into your profits. This is why on our side, what we try to do is we get into an asset, we rip and roar, we do the force appreciation, and we get out. These assets only have a certain serviceable amount of life, anywhere from 50 years to 100 years. Certainly at a certain point, 50 years down the road, it becomes more of a Class C asset. And now you start to attract more seedier tenants. This is why you look at Las Vegas, right? The Strip, you start to see assets like the Circus, which should have got removed a long time ago, in my opinion. They get bulldozed and you put up a new asset. This is just what happens in real estate. Things get refreshed. But here's the vision, right? And this is, I think it also illustrates on the left side, the bifurcation between you and your peers out there. Now, I'm not saying you need new friends, but I think what's difficult, what a lot of our folks, at least echoing what they say and why they like our family office Ohana Mastermind so much, they can talk openly about their finances. For a lot of people, especially myself, money's the big thing. I love money, the journey, the growing it. In our community, we can talk about money without comparing sizes with each other. Most people will talk about sex with their guy friend, girlfriend before they talk about their family's finances. It's just a taboo subject out there. Here, obviously, it's a different culture and we try to keep it responsible. We're not trying to showboat. You're seeing where, again, I like money because I think it guides family values and where you're heading to. You may never want to build your own philanthropic organization, but money magnifies people, who they are. You're seeing this stark contrast between how normal people live out there, just struggling to get by with no assets, and then just starting to build your portfolio of all these private placements and holdings. And obviously, how it results in just increased cash flow at the end of the day. So, how do we get involved in these types of things? How do you transition from the first floor to the second floor of the wealth elevator, as I personally did when I started to sell off my little rental properties? I don't have any little rental properties because they're just a pain in 2015 and beyond. So, if you're new to this, what is investing in syndication? And since syndication is essentially just a method of pulling together passive investors so that operators, general partners, sponsors can go after a stronger deal with a very little low competition. And to speak to that competition, when you're buying properties under $1 million, even under $5, $10 million, it's extremely competitive because of access. You're fighting with the average person, but within our world, right? People buying rental properties. And at this point, you're able to fly higher than these mom and pop investors and get in more institutional investments. Now, obviously, we try to stay right below the altitude of the institutional players who are investing lazy stock market money in the form of REITs. The REITs will buy these types of institutional assets, but the reason why we don't like them is because there's layers and layers of middlemen and extra fees, right? And that's the thing about these syndication deals. You're investing directly with the operator. Now, there's these crowdfunding websites out there, but the crowdfunding websites is just a middleman. They're just a broker dealer. And also, they don't really have any skin in the game if the deal goes good or bad. And I think that's what's different with us. We're the ones actually flying the plane and like the sponsor in the deal. And also the whole idea is like the plane goes down, all the LPs go down, but hey, we're in the cockpit too. We're going down also with everybody. None of this grab a parachute, get out. If we don't do that, I think that kind of speaks to the honor code in all of this, at least that we try to uphold. A lot of pros of being in syndication deals, the passive income, not ordinary income, the difference between ordinary income and passive income, and how you can use passive losses to offset passive income. Also, full strategy real estate professional status to offset all ordinary income. We'll get more into that into the next masterclass. Number two, you get to piggyback on the experience and more importantly, the deal flow of the general partnership. When we first got it started, we had to introduce ourselves to brokers. Nobody knew who we were. But by 2020, when we went over $1 billion of assets under ownership, the brokers knew us by first name and brought us the best deals. They knew we were proven players in the industry. This also expands as we look outside of real estate asset class and multifamily. It's all about who you know. And I've met people all kinds of ways. I'm a part of a bunch of masterminds with other business owners. I've got partners, and it's all about the personal relationships. This is where I think I've been blessed to have all this. If I didn't start this podcast back in 2016, I wouldn't have met all you guys. I wouldn't have created this platform. And it's that platform that now gives me notoriety. It makes me like a cool kid in high school in a way. I was reluctant to be in that position when I first started to do this back in 2016 to 2018. But I certainly understand the power of this magnet. Not only does it attract passive investors, it allows me to create a community in the family office Ohana Mastermind and hui these deals together with passive investors. What a lot of times you don't see is how it attracts strong operators. A lot of the operators we get connected with these days are connections that we've partnered with on a general partnership level, and they have connections and they refer us to their buddy. even though they have no skin in the game, they don't get any kickback from them. It's just what we do on the general partnership level. We try to cordially help each other out, and we're able to figure out just through the grapevine who's good. And reputation is a big thing. We just had a meeting with one of these guys the other day, and the meeting started out with, we've heard of the wealth elevator guys before, right? Our reputation precedes us. We do what we say we're going to do, and we're cool to work with. They like to work with myself and my team. Also, number 3 here, professional commercial property management. Residential property managers are just glorified real estate agents. A lot of times, unfortunately, the real estate agents who can't sell houses, property managers is a bit of an entry level job. When you start to get into commercial assets, one leg up they have is all their units are in the same area. When you get 50 units or greater, you can have somebody physically there all the time at the property, which further creates the community at the property. New tenants are coming in. It's all a part of the sales process to getting new tenants at higher rates. That commercial property management company have a lot better systems to manage the asset that's in front of them. Number 4, better professional and better bonded vendors. You just step up hugely. When I was buying single family homes, and when we used to teach people how to buy little rental properties, was one little tip would be try and find the local HVAC vendor who on the weekends, not under their company, fixes your HVAC, right? You get the personal cell phone of the guy, and he goes in there and fix it for a lot cheaper. These are the scrappy things you do when you're a small time landlord. And then if you're on the basement level, first level of the wealth elevator floor, check out that remote rental e-course for all you accredited investors. I wouldn't even bother with that. You guys are moving more into the syndication world. The starting point would be that syndication LP due diligence course. When you're in commercial assets, you're working with better contractors. They might be a tad bit expensive, but we have the money to pay for top level talent. Number 5, better debt options. These are amortized over 30 to 35 years. In commercial real estate, the terms are a little bit shorter. You try to go for the longer terms. 5 years to 15 years is the range that you can get for agency, non-recourse debt, Freddie loans. Sometimes certain deals line up. If it's a quick flip deal that you do in less than a few years, you get a 2-3 year bridge note, and then either sell at that point or go into a more perm financing, 8 to 15 years at that point. But a lot of these terms are better in terms of interest only is pretty typical for several years. Non-recourse debt is key. Non-recourse debt means that if anything happens, the bank doesn't come after if there's any extra balance. This is the opposite of like your guys' home loans when you buy rental properties on your own. That is recourse debt. If you buy a property for $1 million and it sells for $500,000 and there's a $700,000 note, you owe the bank $200,000 in a recourse loan. But in a non-recourse loan, in theory, you could just walk away from the asset. Maybe that doesn't pertain to past investors because you're another step removed from this anyway. You're not even a loan guarantor. But I think it just speaks towards the reason why they give this non-recourse debt to these assets, because these assets pencil. And it's something that the bank feels comfortable enough to give these nice loans to. And this is where I was like, this is one thing, like back in 2016, I was like, why the heck are all these government subsidized loans that are non-recourse going to these wealthy people buying all these big apartments and commercial assets? Number 1, that's the way that the government stimulates money to their need of lower middle class workforce housing. The government has tried to do projects where there's low income housing authority projects. I think we all know that's a failure and not a desirable way to go about things, because you just create ghettos or cesspools of drugs, etc. when you start to do that. The government has realized that it's best practice to scatter the lower middle class out in the communities. You may obviously not like this because it's not in my backyard stuff, because a lot of us live in some of these areas and we don't like that little bit lower class property next to them. I'm just talking in terms of what the government, what the modern practices are.
So it's not like they can go and buy these properties out there infill style. They subsidize a lot of these loans for these syndicators and people like us to take advantage of to go out in the community and buy these assets. When you're investing, you always look for what are the free money out there from the government. Not necessarily you take it, but you try and align yourself in that position. This is one way that we've been able to take advantage of what is out there. And I don't really see this going away. Another one in terms of the loan debt is not in your name. The GPs are the loan guarantors, and it creates a situation where there's additional skin in the game for them. And number 6, stronger legal protection as a passive investor. We've had murders on properties, fires, domestic violence. We've unfortunately had people slip, trip, fall. Had a guy that was sleeping and the ceiling crashed and he wanted to sue us because he got hurt on the floor. I don't know why he was doing, but you have the craziest things happen. This is crazy. But LPs never hear any of this because you're LP, of course. Number 7, you get better tax benefits due to cost segregations. When you're buying a rental property on your own, you're probably depreciating it over 27 years. With current cost segregation laws, you're able to aggressively itemize the components of the building and take some of those off in the first year. So in some cases, we're able to get 1/3 of the depreciation all in the first year, which is almost 10 times as much that first year. We're going to talk about how to use this personally on your taxes in a future Masterclass section. These are all the things I went through back in 2015 and 16, saying, not only am I going to listen to the advice of people who are higher net worth at myself at the time, but these are the things that I was tabulating in my head and pros and cons. I got to sell these single family homes and smarten up to what the accredited investors are doing. And then lastly here, larger institutional assets providing more stability and more economies of scale. When you buy these types of properties, the banks are giving you a commercial loan. The commercial loan is underwriting the asset to perform at a certain rate. Whereas when you're buying a little rental property on your own, they're underwriting it more as a residential property that you're living in. So they don't necessarily think that you can run it as a profitable rental. Sure, you can pay down the loan and anybody can cash flow and profit at that point. But again, what we're trying to do is walk that fine line between a good amount of leverage so we can produce the returns that investors want to see. Nobody wants to just make 10% in an investment. The expectations are higher than that. And therefore, you have to ratchet up the leverage. And luckily in real estate, you have good leverage options as we discuss. I would say the one big con is the counterparty risk. This is the idea that people are nefarious out there. When I first started to get into this industry, I was pretty well networked. Back then, I was able to travel and I wasn't married. I didn't have kids. So I had a lot of time to travel different Texas, California, all over the place to all these conferences. Unfortunately, all these conferences that you see online are just put on by gurus, real estate club type of events with a lot of young people trying to get rich quick, trying to be general partners starting out. You meet a lot of bad operators under $1 billion assets under ownership. In some cases, they're incompetent and dishonest. What I try to find these days are operators that are competent and honorable. Unfortunately, you don't really find that out until you get into bed with people. What I try to do is test it out myself, work with people I have long relationships with. My first 15 deals I invested with right out the gate, come to find out several years later, even 5 years later, 3 of those 15 turned out to be not the best people. And that's why we say, if you're going to invest more than $250,000 into this game, could mean 3, 4, 5 deals. If you're finding lower minimum deals, 50 grand out of that 250 could be up for risks if you go off of my beginning track record on stepping on landmines out there. The idea of some people have it in their mind that they want to control everything, sure. And then obviously that violates the having huge chunks of their net worth into any one asset, which is a big risk exposure. If you can put your ego aside from being the guy, I don't know why you want to be the guy. To me, you just want money so you and your family can live a good life.
you grasp onto this concept of having a little of many watermelons as opposed to all of the grape is a lot more fruit at the end of the day. And also it's fun, right? We've got the community where you come in initially looking for deals. You want to find a CPA. If you guys need those vendors, just reach out to us. We can help you get started with that. But I think if you join our family office, Ohana Mastermind, it's more about the social relationships at the end of the day, right? Finding people aligned on that path long term. Once you hit $2 million net worth, you start to realize life's not about saving your money and gamifying your financing. It's more about social relationships are the currency of the wealthy. Now, if you don't believe that, we're probably not the group for you, or you probably need to make some more money and get your net worth over $2 million, and then we'll talk. If I'm just foreshadowing and sharing my own experiences, I was extremely cheap. I don't know if selfish is the word, but some people are just really tight and they're not fun to hang out with. They got money, but from a social currency type perspective, they're very poor. And it's very hard to meet friends after 30s, 40s. We're all going to get financially free. You invest in the stock market. A lot of you guys are good savers. You're going to get to $1.5 million, $2 million pretty easily, a little bit before normal retirement age. We're all going to get there, right? I'm here to help expedite things because time is the most important thing. But you're going to realize your goals are going to switch from money, saving to experiences and relationships. This is what we try to do with these projects, whether it's a multifamily value add where you're just trying to bump the NOI by 10 to 20%, enough to double your money, or a development where you build something from scratch. That's an obvious form of a higher level value add, forced appreciation, or you're buying up 3 CPA firms, improving the management, synergizing the expenses, sharing the client lists, and then bundling up with 4 other CPA firms that you bought and selling it for a higher multiple. These are all forms of value adding, force appreciating businesses, whether real estate asset class or non-real estate asset class. From a return on equity standpoint, you're going in, force appreciating the asset, and in the beginning, you're making a good amount of money. Over the years, this dwindles down. This is the biggest mistake landlords make, where they continually pay down their mortgage. The property appreciates over time. And when you look at the deployable equity in relationship to how much money they're making, their return on equity is just going down into the single digits. Now, people ask, when do I re-leverage into the next deal? Sell this one and buy 3 others or go into the next deal? That's usually around a little bit more than 10%, double digits. And it's all up to deal flow. And deal flow is dictated by your community and your people around you. Family offices get very good deals because they're plugged in. I think that's where we are, right? We're well connected. We can find good deals. And for those people, they may sell assets once their ROE goes down under 20%. If you're like a very unconnected person, very lazy, now you see why some people, it's smart for them to pay down their mortgage in the single digits here. But this is where, if you understand this area under the curve concept, which is the way you improve your net worth, you need to cycle in and out of deals. And this is where the syndication model, the private equity model, where you're going in, you're doing what you can. And yeah, it might take a year, might take 5 years or more, but you're going into a variety of projects. And this is naturally happening over time. Now, another cool thing about these syndications of private placements, it can be either in a fund model or a single asset deal model or SPV, special purpose vehicle. A pool fund is a bunch of assets as opposed to an individual deal. Like, for example, we're going to invest in this 200 unit apartment complex. We're going to value add the units $10,000 per unit and rip and roar for 200 units. A blind pool is where future assets investments are unknown. There can be a prospectus on the fund saying that we're only going to buy 3 assets or under $20 million of assets, or it can be completely obscure. There's pros and cons for both. We've talked about this in the syndication e-course more in length, but just know that this is out there. Most investors who are new, I think funds are better because you get instant diversification. When you're in less than a dozen deals, you don't really have diversification. So that's why I'm like, guys, get started now investing.
The only way you're going to learn is by doing. And the only way you're going to grow community is by having street credibility and deals already. So you have something tangible to talk with. Nobody wants to interact or build a relationship with somebody who's just doing the syndication course. That person is obviously a waste of time to interact with. I'm here to help, but I'm just saying from a perspective of another accredited investor who may want to build a lifelong connection with you, an organic relationship. Most investors, what I see, the 5S, a lot of you guys like to feel, touch, know what you're investing in. And whether it's like you want to invest in a certain market, 5 deals in Texas, 3 in Arizona, 7 in Florida, or you want to have 5 multifamilies, 1 self-storage, 6 private equity deals. Like that allows you to customize your portfolio. People ask me all the time, what's a good portfolio allocation mix? And I'm like, dude, we have gone so far off of the standard Vanguard Fidelity. Here's what you probably should have when you're age 56, right? We have gone so far off that path. And this is why it's critical for you to get around other purely passive accredited investors so that you can grow that organic relationship, so they can open up that kimono and show you really what's on the inside. I mean, it's rare when people actually sit down with their computers and show people their pie charts, because that is getting a little bit intrusive. You grow the relationship over time. That stuff does happen, I think, with individuals in the community. But here's a little bit of deal structure. A lot of these syndicated deals get wrapped up in a legal structure where you trigger securities laws. The general partner operator needs to have a lot of, we pay the lawyer like $15,000, $20,000 every time we do one of these deals to do all the documents the right way. There's a private placement, or PPM for short. It does a couple of things. It protects passive investors, that the general partners have fiduciary responsibility, not lie, cheat, steal, etc. And it also protects the general partner to prevent disgruntled investors from suing should the investment performance not meet what was said. There's always risk in investments. Performas are just performas. They don't really mean anything at the end of the day. The general partner wants to make passive investors happy so that they come back as reoccurring customers. But we live in a litigious society. What's to stop an investor from, say, a deal was trying to double your money in 5 years, and in year 4, you got 80% of returns. So great return. But what's to stop a passive investor from suing, saying, you said I was going to get 100%. Obviously, that's ridiculous. But hey, that's the world we live in. But this is the evolution of, at least speaking for myself, a lot of us are first generation multimillionaires. So we started off with almost nothing. A lot of us had good paying jobs or businesses, and we worked hard in our 20s and 30s. People out there who already have substantial net worth probably bought a rental property or 2 or bought assets in their 20s. It was funny. The other day, my spouse, she understands this stuff to some extent, and at least deal with my rants from time to time. But we're talking about some investors out there who had $4 or $5 million net worth already in their 40s. And I always tell her, I've talked to thousands of investors, and you guys always do those onboarding calls. So thousands of data points. I already know what your net worth is for the most part. Once I get to know you a little bit with limited data, what your AGI is, what do you do for work? Have you owned a rental property? Nothing really surprises me anymore. The only times it surprises me is if you're a trust fund kid and your parents started you off with a few rental properties, then your net worth is probably 5, 7 million in age 40 or 50. But for the most part, vast majority of our investors are first generation multimillionaires, the generation that started the legacy financially. But I was telling her, it's like that Monopoly game. What do you do in the first times around the Monopoly board? You just buy stuff. And she's, you just buy anything? I'm like, yeah, seriously, you just buy anything. Doesn't matter if it's Park Place or that crappy Baltic Avenue, you just buy stuff. Because more times than not, it's good. And that's like me. Like my first few properties were in Seattle, not a good market to invest in for cash flow, maybe for appreciation. I wasn't sophisticated in terms of knowing what rent to value ratios were, or running a P&L and knowing if I'm going to cash flow anything, but just got started at that point, just buying stuff. And I think this applies for even people in their 40s and 50s who get started with us, who may already have $1 million, $2 million. The syndicated deals that we sponsor, we go through a lot of deals and we pass on most of the stuff. And unless things align with good vibe and understanding with the deal and the people involved, we don't move forward. We're in this deal along with you guys. Sure, you guys have to do your own due diligence, but we've been in the game for a while. I would say we're not a huge institution, but we're not one of the smaller guys just getting started under $1 billion of assets at this point. I like to think of us as more middle market operators. Speaking for myself as an ideal client, what do I want? I want to invest with people I know and trust who have been doing this for some times. They've seen some ups, they've have some black eyes, some lessons learned, especially going through the 2021, 2022 market cycle. People I could trust at the end of the day. That's all I really want. And get along too, right? We see eye to eye. Yeah. So that's at least what the community, the business I wanted to create with as a boutique syndication company. Now, well over $2 billion in assets, we are popping up to be a bigger institution, which is why I had to expand my team. It's allowed me to expand our reach in terms of general partnership, operator relationships to find better deals for you. This is all that transition for you guys, probably in this TWE 2.0, going from might have had rental properties, but certainly getting more into syndications and private placements. And where I want to take everybody is into the 8-figure range. Get over that $5-10 billion mark. Most end game I define as $4 to $5 million net worth, because at that point you can just put it in T-bills or life insurance and live the rest of your life. But after you're doing that for a little bit, you start to realize that, yeah, I can get to $10 million net worth. And at that point, once you get to that 8-figure mark, it's a substantial number where you're implementing master dynasty trusts, irrevocable trusts, and giving something big to your children for them to take it to the next level. And family offices, which are somewhat defined as $100 million net worth families and above, they're not created overnight, especially if you don't have some type of concentrated business. It's going to take several generations to get to that level. But it all starts here, and it all starts with this network. You're not going to just play golf. You're going to need to try and find some type of passion, or at least just keep building, keep growing. I think that's what's cool about gardening. It's a constant growing and seeing where you can get, but also having fun along the way and not stressing out about it, which I think a lot of us were in the TWE 0 and 1.0 stages, and probably even now at the second, third floor of the wealth elevator. So counterparty risks, where does this all break down? Investing with the wrong people. Golden rule here that I tell a lot of people in our family office, Ohana, over 100 people in there, they show me deals like, what do you think of this deal? And I always start off with saying, like, who do you know personally, or have you invested with this individual in the past to verify track record and experience? If you've heard my story, it's at thewealthelevator.com/fail. I had a blog article where I talked about the first time I invested in syndication back in 2012, and I lost all my money. More times than not, especially in my first 15 deals, it went well, but I got caught 3 out of those 15 times. That's why you need a community around you. When I first got it started off, and most of you guys starting off your first several years, you're not going to have a robust community of passive investors out there to have a Rolodex of who to invest with. So you're like this guy running across the landmine field, just hoping you don't get your head blown off or a limb blown off, to use a better term, because you never want to be investing with your entire net worth, something you can't lose. So I invested with this individual, and how would I find them? I was just talking to one of these self-directed IRA companies, and they recommended them. What probably happened is there was some type of kickback system, which is how all these forums out there, these so-called investment groups out there work. It's just a cesspool of like people paying them behind the scenes to promote their brand. And if there's internet forums out there, it's just like a bunch of fake reviews out there for them. And then they like to put fake reviews, bad fake reviews on the other people. The same game that you have like with the Amazon reviews, if you're an e-commerce business owner. But yeah, I invested with these guys and the deal went belly up. I think they actually stole the money. But the guy who referred me over, he probably got a kickback, or maybe just had beers with them the night before at the conference, and he just was the top of mind. The guy was just the sales guy who referred me over.
of a separate company. Again, no experience. The guy probably was in his 30s or 40s, pretty young. He was not an investor himself. So the golden rule here is only take referrals from people you have a real organic relationship. None of this, I had a beer with somebody and thought we were cool, so I listened to who he was investing with. No, you need to go deeper. And that dude needs to actually have invested with these people in the past. That's the gold standard. It's not going to be possible for you. Wasn't possible for me when I first started, right? I had to just go on a whim, but it's going to take you a few years to get plugged in to start to establish that. So you minimize this chance. But some quick tips if a syndication is legit, learn how to do the numbers yourself. That's what's in the syndication e-course. You don't need to go to the entire thing. Focus on, if you're short on time, just go to that numbers section to understand about reversion cap rate, what is good assumptions to be looking for in the deal, so you can underwrite the deal. Because as a passive investor, you're never going to be given the rent rolls, the P&Ls to be able to do that due diligence. That's what we do on our side. Speaking operator to operator, as sophisticated investors, we are able to run it through our own model with raw data, where that's not really in the scope of a passive investor. You'll want to work with a good operator, but it's hard to verify that because you don't know if anybody's telling the truth these days. We've been audited by regulators. We were able to show the documents that, yeah, this is what we've done in the past. Most times people under a couple $1 billion of assets never really get roughed up by the regulators, and they can just put whatever on a track record sheet, an email, or their own website. One thing that I did when I first getting started was work with my legal team to verify people. This jump-started my relationships in the ecosystem. Your network is your net worth. It's not what you know, it's who you know. If you are looking to be more serious about investing six-figure numbers into this world, I suggest joining our family office Ohana Mastermind. You guys can apply at thewealthelevator.com/club. We do have sparing events from time to time, which we do allow you guys to test drive the group, but you can't come to those again and again. That is for you to come once, meet myself, meet the culture, meet the community, see if the Ohana Mastermind is for you. The events are mainly for family office members. I try to have people see the community at least once. In 2015, up until that point, I had done everything by myself. I thought I knew everything. Obviously, I didn't. I was just that dude buying rental properties as we started at the top. Obviously, not a good long-term strategy. If I didn't interact with a handful of cool accredited investor dudes that informally mentored me, I would have never learned the strategies that we talk about today: alternative investments, tax strategies, accredited investor banking, that whole trifecta I keep talking about. I would have never pieced this together, which I put in this nice curriculum for you guys. And I've had a lot of fun since stepping out of my introverted self back in 2015 and meeting all these people. And it is a little bit out of your comfort zone. I get it. Most of the people in our community are hardworking introverts that put their head down. But you have to realize, or at least understand, that a lot of the high net worth second, third generation, they understand this game, that it's a people game. And they're good bullshitters. They interact with people good. That's at least my takeaway from interacting with those types of people. And those are the social skills, which I think are going to be harder and harder to come by with those Gen Zers out there. That is going to be even more important. But again, like, this is the whole Dunning-Kruger effect, right? At least speaking for myself, when I first started, I thought I knew everything, right? I was the best. I didn't know anybody, so I was technically the best. But then you go to this transformation where you start to meet other people. It's like, wow, there's more to this than I thought. And then you start to get to the stage of, I know that I don't know a lot about this. And that's when I think the learning starts. And that's what at least happened for me. And then you start to get ingrained and you start to know what questions to ask. And then you start to get more comfortable. In about a year or two, you start to really get traction. This happens mainly when you join a group like our family office Ohana and start to get ingrained and meeting other people and building those one-on-one relationships. We will talk about this more in the syndication LPE course, but we talked a lot about multifamily real estate. It's a good starting place to have your first half a dozen investments come out of there.
what people discover is that there's a whole bunch of these other investments out there that make a lot of sense, right? Why would you ever want to invest in traditional investments where there's a lot of these middlemen and you don't know what you're really investing in? You're just investing in the top six companies in the S&P 500 effectively. The weighted average is heavily those top six companies, which is mostly in tech these days. You start to see all these types of investments that are aligned with lower middle class America. The need is not going to be going away and maybe in fact increasing over the long term. We're going to be talking more about this in the syndication LPE course, but I just wanted to touch upon it that traditional investments is the stock market, bonds, a lot of the more marketable securities, stuff that financial planners sell and make a commission off of, where alternatives is multifamily apartments and then all this stuff here. And then now you're getting into private equity, buying businesses, which is the huge opportunity going in the future as all these baby boomer business operators don't have succession plans and need to sell. But this is all part of the wealth elevator framework. Most of you are in the second floor of the wealth elevator, needing to diversify into a lot of projects in the syndication and private placement world. If that's you, the next step is to get into that syndication LP e-course, go through that, and then start investing. I follow the 70-20-10 rule. 70% of it is actually doing it. And in this case, investing, getting skin in the game. I'm not a huge fan of crypto. I don't really invest in it myself, but I invested like 10 grand a few years back because I know how I work. I put skin in the game and now I watch it. Maybe that was a similar effect with fantasy football, right? You put some skin in the game and you start to learn all the players' name for some strange reason. Going back to the 70-20-10 rule, 20% of this is community, learning from others. And only 10% of it is the academic stuff, which is what I put out in the e-course, my Wealth Elevator book. All too often, people spend way too much time with the 10%. Follow the 70-20-10 framework and get more involved into actually doing it, investing it, rubbing physical shoulders with people in our community. That's the only way you're going to make progress. Sure, there's some pitfalls out there as I encountered when I first started to invest. That over time, you got to push through that infancy, adolescent stage, or align yourself with us and follow us into the projects that we sponsor. This has absolutely changed my life for the better. And it's what I want to have people go down the same path. But obviously, this is not for everybody. Who would get our coffee? Who would build our bridges? Who would be our dentist? Who would be our doctor? Who would do the great things for our society? And who would pay the most taxes too, right? We'll see in the next module. Module 6, one or two parts of the tax section. Taxes is such a big, important part of our world. It is one of the sides of the triangle, which is investing on alternative investments. Secondly is taxes, where you get a lot of passive losses to unlock a lot of these different strategies. And then, of course, infinite banking. This is why we'll dedicate a couple sections of this masterclass to taxes in particular. Differentiate between tax tips and overall tax strategy. So what I have displayed on the screen I call a lot of these types of tactics small ball tax moves. Yeah, it's cool. And I think a lot of people, especially when they come to the retreat and late into the evenings, they like to talk about these types of strategies that are employed, but it doesn't move the needle as much as what we're going to be talking about, driving down your adjusted gross income with passive losses or maybe doing real estate professional status. But just to whet your appetite here, some of these things that people will do, use qualified retirement plans, self-directed IRAs, solo 401ks, gain harvesting, wash sale rules, paying off your cell phone or your power bills a year earlier to capture those losses, paying your kids, which is essentially just a cool way of income shifting from your high income to their lower income. You're going to need a LLC for that. And then general business deductions. Now that you have an investment business or you have a small business, pushing as much expenses over to that side of the business as opposed to your personal so you can get a tax deduction on it. Essentially recovering maybe anywhere from like 15 to 45 cents on every dollar that you spend.
And number 6 here for other business owners, if you utilize the S Corp, you can optimize a salary dividend split to minimize the self-employment taxes and miscellaneous taxes that you can get around with that S Corp strategy. But again, these are all really miscellaneous types of tax strategies out there. But we're going to be focusing here on is the big overarching one. And the way I always explain it is like if you're trying to fill an aquarium, you fill it with the rocks and the sand. Think of these things as the small sand particles. And what we're going to be getting into is more of the rocks. So just going into my story, before I got into real estate and I was just a working Joe, I had no passive income. And 100% of my income was coming from traditional investments and ordinary income. And I was getting killed with tax doing this. Fast forward a few years when I was starting to buy rental properties in 2009 and to 2015. I did turnkey rentals as I was a non-accredited investor back then. It was becoming where maybe half of my income or a fraction of it was becoming more passive income. And my traditional investments, my portfolio was becoming less and less. And my alternative investment portfolio was getting higher. Fast forward to several years later when I got 100% into syndications and private placements. Most of my income was passive, and especially as I left my day job as an engineer. And then 0% was traditional investments. Now, these are just 3 data points as a threshold to think about the phases. And as I have it in my book, The Wealth Elevator, which all of you guys can get a copy. And if you haven't got the audiobook or the PDF version to share with some of your friends, let me know and we'll get you that private link. I mentioned traditional versus alternative investments. What is that? Real roughly, in case you forgot. Traditional investments are here on the left side. These are the darker items where these are your traditional stuff, your public equity, stocks, bonds, mutual funds, or another way you can think of it as paper assets. On the other side is alternative investments, such as private equity and real estate. Now, this is a chart from a group called Tiger 21. To get into this group, you need to have a portfolio size of $20 million of investable assets. I wouldn't say these are quite family office type of size people. Usually family office is 100 plus million, but definitely I think the next level up from where our group is at with people in the 20 to 100 plus $1 million net worth size. But when they polled their audience, and this doesn't really change too much from year to year, this is what their portfolio allocation looks like. Now, it may not apply to us directly, but what I wanted to show was a data point and a glimpse into what the ultra high net worth are doing out there. But for purposes of our tax talk today, traditional investments are going to be typically giving you no passive activity losses and little, if not any, tax benefits. Whereas alternative investments, especially real estate, you've got a lot of losses and depreciation there. And in private equity is essentially you're investing in operating businesses and you've got equity in it. So a lot of times you can get some of the operational losses from those types of investments. But again, you can't be investing through any type of like REIT or fund. You've got to be more directly aligned with the operating group. And I mentioned it in previous modules, but that's one of the big themes here is to get past traditional investments where you're getting past the Wall Street fee structures and bloat, and you're getting closer to where the action is. This allows you to capture more of the returns by shedding most of the middlemen, which is what makes up today's investment and financial world. Shown in a different way, this is a depiction of folks that are on the left side. I would say these are like regular Joes. You see the principal residents making up the majority of their net worth. And then they got pensions. Because these are higher net worth people, you probably wouldn't agree with it being under $500,000 net worth. But most people with any sort of net worth these days are going to be our older generation, people above their 40s and 50s. And a lot of those guys still have pensions. So you're probably wondering, where does my pension? Yeah, you don't got them. If you're under the age of 50 to 60, you probably don't have these types of things. But what I wanted to
show is this middle category here where we're net worth between 500,000 to 100 million. And that is pretty much our community here, right? We're that layer underneath where the Tiger 21 folks are at on the right side, where if you take the pie chart from the last slide, it aligns directly over and validates this bar graph here, where they're buying half of their net worth is in businesses and other real estate equity right here, private equity and real estate. Now, stocks, bonds, mutual funds, the traditional investments still there at a third, but they also have some miscellaneous assets. And that's a lot of times we just don't know what that is. So what I would probably say, it's probably just more business and equity and stocks, bonds, mutual funds spread apart. But you can see how it is vastly different than the average Joe. $1 to $10 million net worth is this right here in the middle, where if you're looking at this for a lot of folks getting started, this might be something to emulate or move towards. But a good portion, about a quarter of their net worth is in businesses and other real estate. They've got another quarter or so in stocks, bonds, and mutual funds. They've got a chunk of it in their principal residence, where you can see the majority of the lower net worth guys are in their principal residence. Now, as I always say, like the people that you don't want to emulate, like our parents' generation, who, yeah, they might have a net worth of $1 million or greater. Obviously, they have their paid off houses, which they aspire to, which we talked about is maybe not the best thing, especially when you're under a few $1 million net worth. But most of their net worth is under that primary residence. The one thing I'll mention here, if you're saying that for these high net worth people around, let's call it a $20 million net worth, just to put a number out there, very well maybe a $100 million net worth. This chart is saying that a little under 10% of their net worth is their primary residence. So if you got a $20 million net worth, $2 million residence. So that kind of makes sense, right? These are percentages off their worth. But from a dollar wise, at only like 10%, this person obviously has more because their net worth is greater. I think you guys are smart enough to understand the point I'm trying to make here. It's all percentages based off of the whole. Again, a lot of the stuff that I've talked about in these master classes are my own experiences. I'm not a tax attorney. I'm not giving any financial advice. I'm not a lawyer. But a lot of these things are steps that I went through personally. I started to buy rental properties 2009. So I had a lot of these tax benefits, but it really wasn't juiced until I started to get into syndications and private placements because of the bonus depreciation. And even if you don't have bonus depreciation, a lot more aggressive depreciation schedules when you get into bigger commercial properties. But this is my actual, for my taxes in 2018. And this is, I think maybe about a couple years after I've been in this syndication game, that I paid about a 4.2% my first year in terms of taxes, paid about 5-6 grand out of my adjusted gross income of 136,000. And then look what happened next year, 2019. This is when I think a lot of the passive losses got put in my schedule, paid no taxes. And I was able to drive down my adjusted gross income to $25,000. And this is, again, going back to the previous slide where this was the transition where I sucked my ordinary income down and it was just all passive at that time. So that's what was going there. This is where I think everybody wants to get to, this clean energy burning mode where you don't make too much and you pay little to no taxes legally. And it's just very efficient from a tax perspective. So how do you do this? So I'm going to start off, might be a little slow for some of you who've heard this before, but I just don't want to leave anybody behind. Calling this Tax 201. Because if this is new to you, it's probably going to take you a few times to truly understand this. It took me a couple of years to really get it. But it's something that most people aren't even aware of nor talk about. So here on the left side, we have ordinary income. This is coming from jobs, W-2s, or if you own your own business, 1099s. This is all the active income. But let's call these things what they are from a tax perspective or in the tax code. And we'll call it ordinary income.
So the bad thing about ordinary income is that you get hit with these high taxes and extra taxes like Social Security, etc. What we want more of is on the right side, which is the passive income. So passive income, other than the fact that it sounds cool and everybody wants passive income, but from a tax perspective, again, we're going to focus on this. Passive income comes from sources such as rents or syndications as a passive investor. And what's cool about this is you can zero out your passive income by passive losses slash depreciation from real estate. Again, if you have ordinary income, there's nothing really to shelter that or lower it down, right? What we're trying to do is lower your adjusted gross income, which is your ordinary income plus your passive income minus passive losses. Then the passive income is a better color of money. Think of these as different colors of money. Passive income is no different dollar wise than ordinary income, but you can offset it with passive losses. So the next obvious question, where do passive activity losses come from? And we'll call these things pals because they're our friend. If you look at the image here, the house is circled in red. This is the improvement value of this piece of property. The green part, the land, is not depreciable. For a general rule of thumb, just for conversation's sake as we move forward, in secondary and tertiary markets, a lot of the places that we'll invest in, not places like California, Seattle, Hawaii, which are primary markets, in these secondary tertiary markets that we like to invest in, about 30% of the market value of the property is going to be the green part, where in private markets flip-flop because the land is more expensive. The basic rules for residential real estate, if I use my first property I bought in Seattle in 2009, is that property was about $360,000. So if we break it down, and that was a primary market, about a couple $100,000 was the improvement portion in the red. So with depreciation in the tax code, it allows business owners or real estate owners to take a paper loss on their assets because the assumption is that these assets, or what's circled in red, the improvement portion, slowly decays in serviceable life. The house may last 100 years, but what's important here is what does the IRS tax code allow and what they say you can take as a paper loss. What they are saying for residential real estate is over 27 years, you can deduct the improvement portion over 27 years. Basic math here obviously gets a little bit more complicated on the taxes, which the computers do and the CPAs do. But just for our understanding here, 200,000 divided by 27 comes out to be about $7,400 per year that I could use as a paper loss on my first rental property. Which on that rental property, if I think back then, I think I was making, my rents were about $2,200 and there's obviously expenses. Let's just say I was making $1,000 a month of income after expenses, and multiply that by $12,000 per year. That would be what would come down on my taxes as passive income. But what I'm allowed to do is take the passive losses and also deduct that. So I essentially shielded $7,400 of income per year. And that certainly offsets a lot of that passive income. Now, 27 years is a long time. And it's helpful, right? As you can see in the last example. Funny thing happened to me when I started to go into syndication deals. I started to realize that in these commercial properties, the depreciation schedules are a lot more faster than 27 years in residential single family homes. And also you can get what's called bonus depreciation, which basically what you do or what your general partners do, you don't have to do anything as a passive investor. Is they'll get a cost segregation. This is what we do on select assets. And what this cost segregation does, it usually costs about $5,000 to do. And it's this big report that is passed on to the CPAs. This report basically breaks down all the components of the property into these different categories, such as the 27.5 year, the 15 year, the 5 to 7 year. And depending what the bonus depreciation laws are at the time, like in 2016 to 2026, I think it phases out. I think it'll probably get extended again. They're saying that you can take pretty much all of the 5 to 7 year and a good portion of the 15 year all in the first year. which really front loads a lot of this depreciation. And this is why bigger deals are better because you can get a lot of these losses quicker. Now, we'll get into some of the specifics, but it's better to get a deduction sooner rather than later because of time value of money. Because if you're able to maximize the usage of those losses now, you can save money on taxes and then you can have more money to invest, right? That's the kind of general idea, time value of money. I just put a screenshot here of one of my K1s, which you get as a passive investor. This investment, I put in $50,000 and I got a negative $36,000, almost $37,000 first year loss on what I put in there. So almost, I would say 70 to 80% of what I put in, I got a loss to be able to offset obviously the income in this project, but also could be used to offset other parts of my passive income portfolio. So here are some other examples. And of course, these things range and it depends a lot on how much improvement plan, how much leverage you're using. These are obviously from past years. Bonus depreciation comes and goes, but it's just a portion of it. Even without bonus depreciation, when you invest in these larger deals, these commercial assets, the depreciation schedules are a lot more aggressive than the 27-year standard straight line depreciation with your single family home. One of these, like $180,000 investment I made, I got $176,000 first year passive loss. So I don't know if I made any money that first year because usually the first years are usually pretty slow, especially in value add plans. But I was able to take that and pool it in my other passive losses to use elsewhere. I'm not going to get into the nitty gritty here, but this is a visual of what's going on in these cost segregation studies. Again, the general rule of thumb is you can take about a third of the entire asset's depreciation schedule in the first year. And then the rest trickles out in the next 5 to 10 years is the way of thinking about it. If you guys are ever looking at a deal that we're doing and you wanted to really understand this, I can take some time and go through the estimated cost segregation. Because what we'll do is when we go into a deal, we'll typically get the cost segregation consultants on board, and they can usually give us a pretty good, you can run it through their software. Of course, it's always estimate. We don't know how it's actually going to become out, but for the most part, pretty close in terms of estimates. And the idea is you should be investing into multiple deals and then pooling your passive losses from multiple areas. And you always want to underestimate these things just to be conservative in your entire investment portfolio. And then this is just an example. Of course, all investments are different, but this was, and it all depends on the business plan too. And sometimes the age of the property. So this was a little bit of an older 1970s asset in Texas. Made a $200,000 investment here in 2018. The 2018 K1 came out to be about 75 cents on the dollar or $153,000 of losses that first year. Again, that's where you get the majority of it, about a third of all the juice to squeeze. And then the rest trickles out in the coming years. So in 2019, got about 27,000, and then in 2020 got $11,000 of losses. But in this year, we actually exited early this deal, more than doubled our money in, I think, 2.5 to 3 years. Obviously, surpassed the business plan here. But at that point, when we exited, we had to recapture these losses. That's the other flip side of this. And we'll get into more of this in the next module. We'll review it again. But when you get these losses, you have to recapture the depreciation at the exit. But again, a lot of this is playing this game of time value of money, right? If I can get a $153,000 loss today, obviously offset all the passive income I made from this particular investment, maybe I can offset another capital gain from another deal that I'm in globally in my portfolio. That this $153,000 loss at the 45 to 50 cents on the dollar, especially if you live in California, because it's actually another layer of taxes there, you might be able to translate this into a $75,000 cash in your pocket at the end of the tax year. Again, you're going to have to recapture this when the deal goes full cycle. But if you're able to take that 75 grand, put it into the next deal, then you get even more passive losses to offset that and replenish your passive loss reservoir.
but were able to have that money grow. And then when the deal finally exited, this one exited early, of course, right? A few years later, you have to recapture those losses. Again, this is new to a lot of folks. So don't feel bad if it just goes over your head. We're going to go over it a couple more times in a little bit different ways. I think once you get this and you talk to other people in our community, that's why we say come to the events, the retreats. And especially if you're going to invest more than $250,000, joining our family office Ohana Mastermind is, I think, a no-brainer. More so for the social relationships and connections there, and also avoiding stepping on a landmine, working with the wrong person out there in the world. But you'll get into conversations about people having fun with this stuff, strategizing, getting passive losses. When do they use it? When do they not use it? It becomes a little bit of a game. And this is where you need to self-direct your own tax strategy. This is not your CPA's job. Your CPA's job is to just do your taxes on your sheets. You can't really put strategy on them because, as you're seeing, what you're doing is becoming multifaceted. There's multiple moving pieces here. They have no idea when your deals are cashing out. They don't know when you're going into deals, right? And you're probably going to many and many deals. So to put that on them is just not fair. And it needs to be your 100% responsibility. And again, if the problem here is with CPAs, most of them don't do this themselves. They're just investing in stocks, bonds, mutual funds, traditional investments where they don't even get any passive losses. So, what we find is most people that come into our world, most of them need to change their CPAs because their CPAs just, quite frankly, don't understand this stuff. Sometimes it's funny. People, they want to hold on to their old CPAs, but then their CPAs say, no, you can't do this stuff. But then we tell them, just have them put it into the same tax software, which is more of the commercial version of TurboTax ran by Intuit. Everybody uses the same software. And then say, Mr. CPA, type it into the software and you tell me what's happening. And then they're like, oh, shoot, I didn't realize it works like that. Oh, you're right. Okay. But I think what you want is a CPA that is open-minded, that is already experienced in doing this time and time again, and has the confidence, if ever audited, that this is totally in the green area. If you need a referral, thewealthelevator.com/vendor, or if you're in our community, just shoot us an email. We can connect you with the folks that we use. Part of this, I think, is go through this section in the next masterclass and really understand it for yourself so you're empowered to have a conversation with your CPA. Kind of switching gears here, other tax efficiencies. Again, we talked about this earlier. Ordinary tax income is very high and you get hit up with these other taxes. Capital gains tax. So a lot of you folks are smart enough to be aware of when you've held on to things longer, there's usually two different sets of taxes on the capital gains portion. You've got long-term capital gains and shorter-term capital gains, which are a little bit higher. These things kind of change over time based on who's in Congress, but generally these concepts, the percentages change, like I said, but these concepts are pretty ever present. Normally what our CPAs or my CPA tells me is anything held less than 1 year will be categorized as a short-term gain, taxed a little bit more. So ideally, if you want to try and strategize the whole thing's a little bit longer than a year, that's usually how you can get things under the lower. Of course, that's where you need to work hand in hand with your CPA. I've seen it where the intentionality of what you're doing really matter in these cases. See, a deal lasts 11 months. Based on the circumstances of that deal, perhaps you could have that qualify as long-term. And this is that gray area where you need to have a conversation with your CPA and they need to feel comfortable on what's going on here. But it doesn't even start until you out there are empowered to drive your own ship. Unfortunately, any good CPA, they're churning out dozens and dozens, maybe even hundreds of these tax returns. They just want to do it the easy way. They don't really want to interact with you or do things that are going to put them in a little bit more of a hot spot, or they'll need to turn on their brain to do it. They just want to put in the computer and be done to the next one. So you have to hold them accountable. And again, part of this is you understanding this stuff. Oh, I'm just going to get a good CPA and put my trust in them. Do not do that. Even if you have a good CPA, especially the older ones that are more established, they have established clienteles that are more mature and they can get away with being a lot more lazier, quite frankly. I've always liked to work with established operators or vendors, but ones that aren't set in their ways doing it the old school. way. And then another thing to be aware of, we talked about depreciation recapture tax. Generally, it's a little bit lower when you recapture it. So there's a little bit of a tax advantage there. This is more minor things that we'll get into the next tax masterclass here. But I wanted to just focus on the big picture here. Again, how does this fit in my overall high level strategy? And then again, one of the slides that I first started out with, my story. And I think this is the story and transition for most people out there going from very little alternative investments and no passive income, most importantly, right? The key tax terms here are highlighted in green. You're moving from that, you're getting killed by taxes. And most of you who are already accredited investors will probably skip over single family homes because of the high liability and just not scalable. But I just wanted to highlight this intermediate category that I went through myself, where I was building up my alternative investment portfolio. Thus, my alternative investment percentage was starting to go down. My passive income started to go up. And then moving on to the more mature, clean passive income. And if you're getting my drift, the idea is getting into more alternatives such as real estate and getting out of traditional investments slowly over time. And this is where I introduce this analogy of when you first get started, you're this gas guzzling truck. You're making a lot, paying a lot of taxes. But you know what? Investing is a capital intensive business. You need money to invest. So you're going to have to do this. But then over the years, you move more into the hybrid model. And then we want to move to the 100% electric model where you have very efficient taxes. Most of it is passive income. And also a lot of it is coming from very little traditional investments that create that ordinary income. And I'm not saying that everybody needs to go all in, but again, this is just my story, right? Like very early on in my late 20s, early 30s, I was 100% alternatives. I'm still on that side today, right? Because I'm a general partner and operator, but that's effectively how I got to this point where I'm at today. But you're going to have your own level of buy-in. Now, this slide is extremely important to understand. This is what I call bracketology. This changes every year, usually with the pace of inflation, but I would say right now, go and Google this current year's tax brackets. What I have is the 2024 tax brackets pulled up here, but the general concepts remain the same. As most of you guys know, we have a graduated tax scheme here where the more money you make, the more money you pay in taxes. And it is based off of stepwise functions where it's not like when you go into you're making $331,000 or more, it's taxed all at 37%. But this layer is taxed at 35, this layer is taxed at 32, this layer taxed at 24. So now that we got that basic stuff all the way that most of you guys already understand, where are like the synergies to overlaying these tax strategies at? To me, if you notice the tax rates, they go up gradually. But when you go from the 24 to the 32% tax range, there's a bigger break there than a lot of these others. And again, I'm just teaching you these concepts because in future years, the tax brackets will jump around, but this concept will remain the same. Find that big break. There is usually that big break here. And that's where I draw this red line. And that's why this guy's freaked out because it was such a big jump here. Whereas these are smaller gaps. Of course, you may fall in the single filers category, or I'm going to be talking mostly from the perspective of a married couple, dual income, or two people. In these cases, once you hit 383,000, the next dollar is going to be taxed at a little bit higher tax bracket. For most of our clients, what we say is try to stay under, or I guess above this red line. And you're probably saying easier said than done, right? I make what I make. But now that we're investing in real estate and able to offset our passive income, we're able to have much more control of what our adjusted gross income is. And this is for keying in on a lot of these clickbaity articles of XYZ president is going to tax the rich. They don't really do that. Unless they completely overhaul the tax code, which I don't think is going to happen in my lifetime. But unless they overhaul the system entirely, you're not paying taxes based on how much money you have, your net worth. It's based off your income, your adjusted gross income. And that's what we're looking at here. So if you're able to drive your income down, that dictates how much taxes you pay. We have this concept out there, the wealth whispers. Wealthy people quietly do a lot of these strategies that what I'm teaching today. They try to drive their income down legally through real estate using passive losses, or we'll get into later is real estate professional status as additional way to drive down your income to sharpshoot a lower tax rate, or at least modulate their income every year. And what that means is they're trying to cut down on these big spikes of income. So maybe normally you're hovering around 350, which isn't too bad, but you sell a $500,000 asset and you have a $400,000 capital gain. And that would pop you up way up here and you get killed with taxes. If that's you and you have a big capital gain coming out from a sale of an asset, or maybe you got a big bonus that year, or maybe you had a windfall, check out the other more specialized masterclass we have in the members portal. I think it's 8 ways to mitigate capital gains. If you can't find it, just shoot our team an email, but that would be more specific for your situation, which we're not going to get into today. But just an example of when big whacks of income come, which is a good thing, you modulate your income down. Another term I've come up with in past seminars is I've called this like income modulating, keeping it around the same level. Like couple of years, this happened to me, especially when I was investing in syndication deals where I had a lot of passive losses. And the idea is to build up passive losses so that when things do sell, you can offset those gains. You have it waiting. But one year, my CPA elected to drive my income down to nothing a couple of years in a row. And I was like, I'm a hoarder. That's how I got here, super frugal. And I was like, Mr. CPA, shouldn't we save these passive losses for the future? And his comment was, I see what you guys are doing and investing. I think for you, even though you're not going to get a good bang for your buck, we just use it up because I see you have so much passive losses and it's not doing anything. It's better just to capitalize it as money in your pocket, even if you are only getting 10% or half of that of the savings at these higher elevated taxes. Maybe then I catch myself, a lot of that is some of the nuances. The big thing here is that, hey, there's these tax brackets here. And when we use real estate, we use that to drive down our passive income. And this is our adjusted gross income, which is again, our ordinary income plus our passive income, net of the passive losses that we elect to use to lower our passive income. So there's a combination of the two, puts you into this chart to pay your taxes accordingly. Okay, so expanding on a couple of new concepts here, passive income on the right-hand side. Again, you can knock out your passive income with passive losses or depreciation from real estate. The long-term capital gains, we talked about that. The lower you drive your income downward, the less you pay, obviously, but also you can lower down your long-term capital gains down to even lower levels, as you can see here. And if you're making over $488,000, I don't know what year this is, but again, like these numbers change with inflation typically, and sometimes these rates change, but the concepts stay the same. You can take an additional 5% off by getting yourself under this threshold here. And I put 2002 and 2003 to show you that the rates stayed the same, but the thresholds changed, right, with the pace of inflation or maybe more. Okay, so now I'm going to introduce real estate professional status here. So again, the cool thing about passive income, other than the fact that it's cool and passive, from a tax perspective, when you make passive income through rents or syndications, you can take the depreciation or losses from that deal and other deals. The key designation to talk to your CPA about is grouping your entire investment portfolio. That's the key. I think that's what trips up a lot of folks up out there. But you cannot use the passive losses or depreciation to offset your ordinary income, right? The stuff from your job or your 1099s, unless you are able to get this real estate professional status checkbox on your taxes or sort of unlock this cheat code. The analogy I like to use is like a bow and arrow set. So in a way, like the arrows are like the passive losses, right? You need to invest to get passive losses. This is why like people who don't invest in alternative investments have no arrows to play these games. But the real estate professional status is like the bow. Now with the arrows, now you're able to shoot bow and arrows. But how do you get this bow? The bow is the real estate professional status. So again, like I'm not a CPA or tax attorney, but generally speaking, and this is where you have to go in and have a conversation with your own CPA, who's the one who ultimately at the end of the day, who's going to be that person who checks the box on your taxes to unlock this for you, is you need to have 750 hours of active participation in your portfolio. And you need to keep a little logbook on your hours. 750 hours isn't incredibly hard to hit. And you need to have more than 50% of your time or your spouse's time. So this works well. You may work a full-time job and that's going to disqualify you off the map already. But maybe your spouse doesn't have a full-time job. Maybe they work part-time and they're able to allocate those hours. The idea is that they cannot have more than 50% of the time. Of course, there's so many permutations and commutations of it. Some CPAs are extremely liberal with this thing, but I think it's important to talk to a very flexible CPA out there. I'm not a CPA or tax attorney. I don't give any tax advice here. I'm not giving any investment advice here. But if you want to jump on that intro call that we give complimentary to new members, I can size you up with what other people are doing and maybe give you a couple ideas to talk to your tax professional at the end of the day. But yeah, there's the 50%, I think, is the automatic disqualifier for some people, right? And I would cite the Fortis case law where this guy, he was trying to get qualified for real estate professional status, had a full-time job. He should have done it some other ways, maybe a short-term rental property, or maybe have some rental properties that run and allocate hours to. But because he had a full-time job, disqualified him. But once you're able to do that, now you unlock this cheat code of now being able to drive your income down to whatever you want, assuming you have enough arrows to drive it down. And now you're seeing what I was like, wow, this is cool. This is for me, that was back in like 2017 after talking to so many people who were quietly doing this very legally. And now you realize why the rich get richer and the poor who don't even have any passive losses or real estate stay where they're at and they just pay a lot of taxes. I'm a big Marvel fan. Using the analogy of the bow and arrow set, you get a bunch of tiles and this is stored on your 8582 form. So go on your taxes when you get a time, or maybe pull it up right now and search for 8582. And that is where all your suspended passive losses or your arrows will be. If you don't have it, maybe you need a new CPA. If you don't have any real estate in your portfolio, you probably don't even have that form. But if you do have real estate, you certainly should have an 8582 form. I just say that because sometimes these CPAs like to withhold that from you. They certainly withhold all the back end calculations, which is all in the computer, to accurately get you how much passive losses you have, because this is where it gets very technical. And the CPAs are smart people, but they just put in the computer. This is all stored in the computer, all the cost bases of all the assets to come up with how much you have in terms of passive activity losses stored on your 852 form. This is extremely powerful. In the Marvel Avenger universe, everybody makes fun of Hawkeye with his bow and arrow set, but the bow and arrow is extremely powerful in our world in terms of taxes. And that's why it's one of the big parts of our trifecta, which is investing in alternatives. Alternatives gives you passive losses, especially through real estate, through the depreciation. And then it unlocks all these other tax strategies, like just driving down your adjusted gross income or simply just offsetting your passive losses if you're not a real estate professional. For high income earners making over $300,000, this stuff I think is going to be your low hanging fruit right off the bat. And this is where in these intro calls is where I'm like, yeah, for you guys, taxes is going to be your biggest thing. You may not necessarily need to go big into investing in these types of investments per se. Sometimes you don't even need to do investing to get some of the tax benefits. Again, more comics and comedic relief on poor Hawkeye. They give him a lot of crap, but in our world, this bow and arrow strategy is extremely valuable. And don't discount yourself. If you're like, yeah, my spouse doesn't want to do it, remember, one of you guys has to qualify. So maybe you could be doing most of the real estate hours, even if you work your day job. And that's a conversation you need to be having with your CPA. I see way too many times people will come to the events and they just write themselves off. I'm like, nah, yeah, we saw that real estate professional status thing. And yeah, we talked to our CPA, we can't do it. I'm like, are you serious? You need a new CPA. And this is where I don't really push things on people. I think it's better when they get it from like the ecosystem that, you have a bunch of people doing it and you learn the best practices or what people are doing. But guys, like, wake up. Like, this is something you guys need to be doing. And you guys already have some rental properties here. It's not out of this world for you guys to put this together, and it could save you several $100,000 a year in taxes. It's a no brainer, guys. Like, actually see if you can implement this. And just a little bit more information. Sometimes the question comes up, can passive losses offset dividend income? When you buy like a publicly traded stock or traditional investments, you usually don't have too much to work with. So people think that dividends are passive income because they're both passive in a way. But again, just getting into some of the nuances. This is why in the beginning I was like, don't think of it as dividend income. Think of it as passive income, because from the tax code, there are different categories of income. There's dividend income, there is royalties. A lot of these things people don't typically have, right? A lot of this is just focusing on the big things that we do, which is real estate, and you get passive income from that. But under Section 469, gross income from interest, dividends, annuities, or royalties is income not treated as income from passive activity. So something, a little nuance to in there. This means that passive losses from rental activities will generally not offset the income generated from your dividends. Long story short. But unless, of course, you qualify for real estate professional status. The way to think about it, and this took me a while to wrap my head around it, is when you have real estate professional status, in a way, now everything becomes ordinary. So ordinary losses offsets ordinary income, obviously, right? So think about it like that. Like your whole world kind of changes once you are able to check that box. But it may not make sense for a lot of you guys out there. And I think that's where having a talk with me, interact with people in our community, that's where this comes from. And then you start to learn it, and then you can go in there and have an educated conversation with a good CPA. But more than likely, I think 80% of our people change their CPAs, but so more than likely, you probably don't have a good CPA. But definitely not a good tax strategist. Some people say paying no taxes, is this ethical? You can create the narration on your own. The way I look at it is we're the ones pulling money out of our pocket to put money directly into these Main Street types of investments where our dollar is going directly there. Where when you're investing in traditional investments, the Wall Street plan, a lot less of that gets to actual Main Street. So much of it goes to hidden fees, expenses, and all these middlemen that I think that's partially why I don't really like the traditional investment world. But we're the ones putting investments into the community, into Main Street. And that's where the way the tax code is written. It's written to reward those who contribute funds that will benefit the economy. They're tax incentives in a way. Mom and dad, the IRS, they want us to put money in certain places. The reason why it's so big is that there's so many of these tax incentives. We're just being selective here, which ones we typically go into. But a lot of these things are time tested and exactly what the government wants at the end of the day. Take financial advice from people who are financially free and see what they're doing in terms of strategy. And of course, always run it through your professional team. So again, high level here, I talked a little bit about the three vehicles here, but the analogy I like to use just to sum this all up is your ordinary income to passive income mix. Gas guzzling cars, bad, because it typically is synonymous with ordinary income, where the electric is passive or clean income that we can easily cancel out with depreciation, or to introduce another place we get passive losses from Section 179 losses, which are equipment losses. Again, these are the three stages of investors, three stages of the journey from a tax standpoint. You're going from the gas guzzling truck to the hybrid mode and then into the full electric mode. But what's happening over time is you've got these measures where you're slowly going from a mix of less traditional investments to more alternatives, because that is where you're getting more of the passive income from, as opposed to the ordinary income where you're going to get from your day job, but also stocks, bonds, mutual funds. That's what that stuff is going to get you. So some common use cases out there, most of you guys who are starting out are going to be in the gas guzzling truck mode, a lot of ordinary income. You need it when you first start out, right? When your net worth is under $1 million or $2 million. I think once you hit about $2.5 million, that's the point where you really start to feel like you're hitting critical mass. Certainly at that point, you're going to feel like you're moving forward. But if you're not implementing these strategies, it's going to take forever to get even to that point. So for single people in this category, get married because you're getting killed by all these a lower tax bracket scheme. You're not going to be able to utilize the real estate professional status because more than likely you as the single person are working. Therefore, you don't have somebody else to qualify for real estate professional status. For married couples with unbalanced income, a lot of times, especially when you have kids, it makes sense for one person to spend those very precious years at home and not working. And in a lot of cases, you can implement real estate professional status and actually make more money at the end of the year net of taxes doing this than two spouses working, and also get all the additional time with your kids to see them grow up. That said, couples with similar income. So the example for B here is you got a doctor making $500,000 or greater and a stay-at-home spouse. That's actually in a very ideal situation to go down the real estate professional status. It may require you to get a short-term rental or a rental property or two, but if I can help, maybe we do the cost benefit analysis, right? Like the headaches of having a rental property and then the costs, especially if you don't live in a high price area, you could pretty much recoup that extra cost and incremental headache by tax savings in the first couple years. And then the rest is just all gravy after that. And that's where you have to do that cost benefit analysis on your own. But a lot of people, they're in marriages where both spouses make the same thing. I call this the high friction, high tax model. In some of these cases, it just makes sense for both people. You just both have to work. You both have to pay a lot of tax. This is where it's good to get around other people doing this because maybe you understand and accept the role to some extent. The analogy I use for this is like an airplane, which has two engines where you're burning a lot and you're paying a lot of taxes, but that's just how it is, right? Until you get to the destination, both engines have to burn hot. Some people say, and this is where we bring in a little bit of the community aspect. Some of the best practices here that come up is when the kids are already 10, 12, you only have 6, 7 more summers with them. And they're in school, they got their own friends. So even if you got the stay-at-home spouse and they're not really interacting with them too much, if anything, you only have those 6 or 7 summers or those handful of spring, fall breaks. It probably is better just to both spouses just make a lot more money and then also burn it on really nice vacations to capture the memories and to convert money into experiences, which is, I think, a lot of the content that we talk about once you hit that end game level, $3 to $4 million plus. That's some of the common cases here that kind of overlays into this is, again, my story, right? And you may not follow this completely. I think a lot of you will just skip over the turnkey rental step, but that's the hierarchy strategy and kind of the transition into this world, into paying less taxes. Now, a lot of this is drinking from a fire hose. When people come into the flume, the first 3 to 6 months is just, quite frankly, overwhelming. But trust me, guys, you'll get to a point where you finally wake up one day and totally get this stuff. It'll be second nature to you. And sure, the taxes code will change, but the concepts will stay similar. And some of these things here have come and gone, like land conservation easements in this example. But this is what the cool kids will do. You have a high income earner making $1.2 million AGI, which is not uncommon in our group. They do a little land conservation easements, which is a way of using donations in a leveraged way to drop their income down 30%. Now you can't really do this anymore. It's a little bit riskier, but they would do this to drop their income from 1.2 to 800,000. And then they also are implementing real estate professionals status, and they can use $600,000 of PALs that they've gotten from previous years that are banked up in their 8582 form and drop their AGI further to about $200,000. Again, what they're trying to do is modulate their AGI to around that, under that $400,000 range. Maybe even under. A lot of people will focus more and being a little more aggressive to getting it to the $200,000 range. That's why I mention it here in this fun story. They go on a summer-long vacation because they're more into the stage of life in terms of wealth building, where they realize time is more valuable than money, and part of time is experiences and the richness of life. So, but they come back and their passive income portfolio did well, and a couple of their deals cash out early in November. That happens, right? Good problems to have, and now they have $300,000 of more income, and they got to recapture the depreciation. So now they thought they were good in the middle of the year at $200,000 income, but it went up to $500,000. And they're always upset at the government for paying too much taxes for way too many years until they found these types of strategies. And they're like, you know what? Screw it. We're going to pay no taxes. So they deplete their suspended passive activity loss bucket, 8582 form, and they drive it down to zero. And this is what they've done in the past. But you got to be careful. There's a strategy here, right? You can't just burn up all your passive losses, because in this case, they had some exits end of the year and they reached down into your 8582 form bucket and they don't have passive losses, right? Because they burned it up. And that's not uncommon, especially when you have more aggressive people who aggressively lower their AGI and use their 8582 form. I think I personally am a little bit more conservative, and I probably err on the side of not using enough of my passive losses. Like my daughter, we like to go to Fun Factory. You play the games, you get the tickets. I think I got like 1,000 tickets on my card. I probably should let her buy some cool toys with it and just burn it up. But again, I'm a hoarder in that way. And same thing with my passive losses. I have a lot of passive losses I just haven't really used, and they carry forward. And when they carry forward, the tax term, talk to your CPA, is they're suspended passive activity losses. But in this example we're talking about, these guys, what they did is they just kept using it and they exhausted it. They took it from suspended and they just used it. And once you use it, you've used it. You can't use it anymore. So right now they're looking for other ways to get passive losses. One of those ways is they may go into more real estate deals end of the year, or they may look for deals that have Section 179 equipment losses. They may just buy a $6,000 pound truck or SUV to get some quick passive losses that way. Of course, you never want to have the tax tail wag the dog, buy a stupid vehicle just for some tax benefits. It always needs to make sense. That's how these guys think. And they find, in this case, they go into a tax centric fund and they get these passive losses and they sharpshoot exactly how much they need. And they bring their AGI down to $100,000. And then they go start more vacations again, right? This is how the kind of the cool kids are doing it. I mentioned that the 8582 form several times, but this is what it looks like. Mine's is pretty long. I still don't know how the heck to read this thing. I suppose you could upload yours to ChatGPT and ask it, how much passive losses do I have? And then, of course, you email it to your CPA and ask them themselves, because that's their job, is to report back and translate things like that. But again, this 8582 form, think of it as like the cloud, right? It is the running track on how much suspended passive losses you have. And that's why the suspended is up in the cloud. And we all talk about it in terms of clouds these days. That's why I thought it was a good way of kind of thinking about this concept. But to just round out this, and again, this may be really confusing to you. It actually is simple. It's just you have to hear this several times. But just to confirm everything, properties go up in value, but on paper, their value is going down due to depreciation from the improvement portion, not the land portion. The land portion doesn't depreciate, but the improvement portion does. So what this does is it flows to your personal W-2 income if you're under $100,000 AGI, which not a lot of folks out there are. But maybe for your guys' kids who have an AGI of under $100,000, right now you can take $25,000 of your passive losses and chop your $100,000 AGI down to 75. So that's low hanging fruit for those of you guys who have lower incomes. But if you're above that, you age out or it doesn't qualify. You guys don't qualify for that. Like how you age out or you don't qualify to, once you make a certain amount of money, you can't do a Roth IRA in a way. So, or you need real estate professional status to use your passive activity losses to offset. What is it, folks? Yes, your ordinary income. And that's what the rep status thing is. Remember the bow and arrow. But aside from that, passive activity losses cancels out what income? Passive income, right? The key there, I think where some CPAs get tripped up is they don't group your entire portfolio. Sometimes these guys think that the passive losses from that deal only offset that deal's passive income. Not the case, folks. Get a new CPA. I think of it as your AirPod Pros work, counteracting wavelength to counteract the noise source and creates a resulting noise, where you would think that this is like the passive income and then the passive losses cancels it out. And the last review is if I have real estate professional status, I can use what income to offset passive income and ordinary income? Well, you can use these passive activity losses and I will be cool and rich and wealthy. Because if you think about it, it's not what you make at the end of the day, it's what you keep. Most people who haven't gone through this last hour think that what they make is what they pay in taxes. But now you guys know the truth. It's not what you make necessarily, it's what you can drive your AGI down legally with. And these are some of the tools to do that legally. The one gotcha, again, I mentioned this before, is the recapture of the depreciation at the deal's exit. When I was transitioning from my single family homes, I believe this is like 2016 or 17, I was selling off all my properties and I had a capital gain, but the big one was depreciation recapture because I made the silly mistake of doing a 1031 exchange. I would not suggest doing 1031 exchanges to most people. I know why people do it, because you got these 1031 exchange salesmen running around telling everybody it's the best thing since sliced bread. But what we do in our world is this lazy 1031 exchange is the unofficial term. More of the strategy is going to be in the members portal, which you guys should have access to if you've joined our group, joined the club. It's the 8 ways to mitigate capital gains. It's, I think, one of the first few sections in there. Goes more into details into this concept. But going back to my situation, a lot of you guys who own rental properties, you guys are going to be selling off your single family homes to cash out that equity there. But remember, you have to recapture the depreciation. But the whole idea is to first check how much you have on your 8582 form, because you might have a lot of passive losses suspended, ready to use in this manner. So again, like when I sold off those first chunk of rentals, I had a $200,000 capital gain and depreciation recapture. But what I did here was I just brought over $200,000 of suspended passive losses to offset that. And I paid no taxes, offset that transition right away. And this is what's called the lazy 1031 exchange. The last major concepts I want to cover here is this bucket theory. Now, I talked a little bit about this in the retirement section. I'm not a huge fan of retirement plans or qualified retirement plans. Again, what are qualified retirement plans, QRPs for short, which we'll refer to? We're talking about self-directed IRAs, Roth IRAs, solo 401ks, DB plans, SEPs, TSPs, all those. We're just going to refer them all to quickly as qualified retirement plans, QRPs. But my whole idea is, and this is what clashes with normal thinking, has us filling up the legacy bucket, which is the yellow one first, right? And I think you hear echoes of it, even if you haven't been completely brainwashed, but they teach us to put money in your retirement plans first. And it makes sense. Most people are horrible spenders, and most people will raid their savings account really easy. So that's why they say put it into your retirement plans first, because it's harder to get out. But we are all here different. We are a different breed of people. And I think for folks like us, the idea is a little bit different, where try to fill up your cash flow today bucket first with at least $15,000 to $50,000 of passive income every single month. That's a lot, but that's the goal. Create your pension fund today, because you may never be able to fill that up. And I think that's what frustrates me. If you're filling up your yellow bucket first, you'll never fill up today, and you'll have to work forever. You'll have to have a day job or a source of ordinary income. But this is where a lot of you guys can get to a point, and yeah, it's going to take a while, right? This is not a get rich quick scheme. But if you can fill this up and concentrate on this, at some point you're going to hit a threshold, normally around $4 to $5 million net worth. Then you can start to fill up the yellow bucket. By the time, if you've been doing this for a decade or two, a lot of you folks will get to 8 figures. And that's where you fill up the third bucket here, which is more legacy wealth, nonprofits, organizations, philanthropy, things like that. You can give money away whenever, but from bucket 3 is putting it in a legally formatted nonprofit and doing it that way. But hey, let's focus on what the task at hand, which is filling up today's bucket first. And a lot of that is by investing cash. And the reason why you invest cash is you can get these passive losses that we talked about over the last hour. Whereas you can invest in these syndicated deals through a self-directed IRA, solo 401k, and you get the passive losses, but it stays insulated in those qualified retirement plans. It doesn't come to you personally for you to play these games with your taxes today. And that's the key highlight there. And that's why, especially when you're investing in real estate, to give you a lot of these passive losses, is to prioritize your cash with those investments so that those passive losses don't stay insulated in any qualified retirement plan, but come to you personally so you can use those tax benefits to help you out to pay less taxes today. We talked about this concept in the past. I'll refer to a different video and a different section here, but yeah, it's all kind of part of this wealth elevator trifecta, right? Very simple. Investing in alternatives, that's where I would send people to the Syndication LPE course. Pretty heavy content section there. The tax strategies, we've got another masterclass, which should also help summarize and confirm a lot of this, what we talked about in this first half today. And then the infinite banking, make sure you take a look at thewealthelevator.com/bank for that webinar. And you're ready to get that started, just reach out to us. We can get you connected with our vendors who worked it in the past there. But we will wrap up this section.
Even right now to the rest of this year, if someone put in $100,000 and they were getting an $80,000 intangible drilling cost deduction, you're going to take that $100,000 and reduce it by $80,000. Now you have an adjusted basis of 20. But again, you're reducing income by that $80,000 deduction.
Just to diagram this out to separate the two buckets, you've got ordinary income on the left side. A lot of you guys have that coming from your W-2 or 1099 income, either from your job or your business. And then that's separate from passive income on the right side here. And of course, there's some oversimplifying this, but I think this will be useful in today's in-depth discussion on possibly using oil and gas investments to offset your ordinary income here on the left side. I see a lot of people make the mistake. They think that they can invest in real estate, get depreciation, which we're going to call passive losses, to offset other passive income. That's somewhat true. Of course, not giving any tax or legal advice today. We've got referrals if you guys need those. But generally speaking, you can use losses from the depreciation of real estate to offset your other passive income. Now, where the limitation of those passive losses comes when people try to offset their ordinary income. So a use case would be high paid couple, they make $500,000. What ideally they're trying to do here is $500,000 AGI is in this 32% tax bracket. Ideally drop it by $100,000 or $200,000 can greatly decrease your taxes, especially because you're in these higher tax brackets here, as I'm highlighting. Now, where the limitation of the passive losses come in is if all of this AGI right here, the $500,000 in this example, was ordinary, you can't really use the passive losses to offset the ordinary income. So that's where there is a limitation, and I just wanted to point that out. Now, this is going to parlay into the discussion that we're going to be having today. There is a way to offset the ordinary income with or without real estate professional status. Now, some of you guys are using real estate professional status. There's some caveats you need to do to apply and qualify for that, but very few of you guys actually do that. I would probably say under a fourth of you folks in our group are doing real estate professional status. But a lot of folks are saying, hey, I just can't qualify for real estate professional status because me and my spouse both work a full-time job. And we don't want to really mess around with like little dinky short-term rentals. You might be doing the short-term rental loophole, but in my humble opinion, I feel like that's just a lot of effort and legal liability you're just piling on yourself. And you got to do the dang thing over and over again. It becomes a treadmill. Whereas today's strategy that we're talking about today, using oil and gas investments to offset ordinary income, is what we're going to be getting into. Some syndicators and sponsors out there say 100% bonus depreciation in year one. So don't get misled by that marketing tagline there. It sounds like it's wipes out the taxes, but it's only half true. Bonus depreciation happens at the property or the project level, not your individual investor level. It might be 100% bonus depreciation, but there may be only enough bonus depreciation in there for you as an investor to get $35,000 out of a $100,000 investment back, right? Even though they're doing 100% bonus depreciation. So there's a disconnect there. It's always probably best practice for investors to ask individually on a investor call, how does this look? What's the guess? It's all estimates, but every deal is a little bit different. You get passive losses, have usage limits, and cannot offset W-2 or business income, which is why we're going to be talking about oil and gas investments today. Other things that passive losses can do is offset passive income, like we said. You're staying on that one side of the bucket. And again, passive losses cannot offset your wages, W-2, 1099, or business income. And then you could possibly use real estate professional status. As I mentioned, of course, you really need to rope in your CPA for this. But one of the biggest things is people need to materially participate in their investments. And then there's a real estate professional status that requires 750 hours and more than half of the service time in real estate. You still need to materially participate, which a lot of LPs don't. And by the way, being an LP in a syndication absolutely does not count. The real takeaway here, syndications produce valuable passive losses, which some of you guys who are doing rep status or having other rental property portfolio or syndication passive income on your K1 can use those passive losses, but there's a limitation to that on your ordinary income side, which you're going to be addressing today. I would probably urge everybody to get a hold of their 8582 form to see exactly how much suspended passive losses they have. It's not like you invest in a real estate deal, you get suspended passive losses. It's not like it just goes away. It stays suspended on your 8582 form. I'm going to be doing a future webinar on using AI to ask certain things like, hey, how much suspended passive losses do I have? And you upload your 8582 form or your entire tax return to AI. Real estate and grouping together, we jump on an onboarding call to look at your own individual situation. But today, if you have high ordinary income, today's discussion is absolutely going to be for you. Jack, why don't you quickly introduce yourself for the folks?
My name is Jack Hollander, speaking to you from Long Island, New York. I'm a tax lawyer by background. I have been in the capital markets for the majority of my career, working with different companies that provide alternative tax mitigation strategies, be it oil and gas. I like participating in presentations like this from an educational standpoint, because I think it's really important for people to really have a good understanding of what they're getting into, how things investment-wise can benefit themselves.
Yeah, before we go any further, none of this is to sell any securities. And of course, consult your own CPA, tax attorney, etc. We're not giving any personal financial investment advice.
I appreciate what you were getting to, Lane, in the discussion just now, because people need to, on a year-round basis, really talk to their professional advisors, CPA, financial people about their tax situation and to really understand the terminology that you were alluding to. So even though we're year-end and people might be scrambling for tax savings, given that we have a few weeks left in the year, come January 1st, people should not hesitate to talk to their professional advisors about tax planning for the coming year. I want to compliment what you were saying about terminology, because I think it's really important for people to understand, because when people ask me about, hey, I need to shelter some income for this year, there's a number of questions that need to be asked so that we can properly mirror and match a investment vehicle with income that somebody has. And from an investment vehicle standpoint, are we talking about an individual making the investment themselves? Is it into a partnership, limited liability company, trust, qualified account? So all these different vehicles, if you will, can make investments. But again, we have to see what the right opportunities are. And as you were alluding to, Lane, understanding income and deductions. And I always point out here with this slide that really the way that tax law works, everything goes into buckets. So when you have ordinary income, it's offset by ordinary deductions. When people have capital gains, and typically a long-term capital gain is when certain assets are held for more than 1 year, Capital gains are offset by capital losses. Passive income, as you were alluding to, is offset by passive losses. Portfolio income is not passive. Portfolio income is really defined as dividends, interest, pension distributions, required minimum distributions. To me, that is really portfolio income, to be distinguished from passive income. Above the line versus below the line. Typically, income deductions gets us to adjusted gross income, and that's where we're dealing above the line. Below the line occurs after one is able to ascertain adjusted gross income, itemized deductions, standard deduction, if you will. Those take place below the line. And again, an itemized deduction versus standard. Standard is a fixed number. Itemized deductions, if you have significant deductions, you itemize them because typically that would be significantly more than a standard deduction, and that's why you would take the itemized deductions on the return. Deductions offset income items, and tax credits reduce taxes that are owed. And I always get a little bit frustrated with people when we have a conversation, especially around oil and gas, when they're like, hey, tell me about that tax credit. We're not talking about a credit, which is a dollar for dollar reduction of the actual tax liability. A deduction reduces income to get to eventually taxable income.
People loosely say, I bought that piece of software for my company and I just deducted it. If that software cost $100, it's not like they got $100 credit in their taxes. Really, they got to deduct their income for their company by $100, which for most people, that could mean 10 cents in the dollar to maybe 40 cents on the dollar.
In tax savings, correct. Basis is a tax measuring point. When you buy something, the cost of it is your initial basis. When you have investments, especially partnerships, you start with, let's say, $100. If you get a loss, you reduce the basis by $100. When you have income, you increase the basis again by that amount of income. And if you have cash distributions, you reduce the basis by that distribution. And that's what we call adjusted basis. So at the end of the day, when something might be sold, when you've owned it for a period of time, and you're getting what they call an amount realized, meaning this is the sale price that you're selling something for, you subtract that adjusted basis to determine the gain. And once that gain is determined, then we have to characterize it. Is it ordinary? Is it passive? Is it capital? Things of that nature come into play. Not all income is taxed at the same rate. We go through marginal rates. So when you look at the brackets, income for certain levels to a certain point is taxed at a certain tax rate, lower rate. Then the next level, grouping, is taxed at a higher rate, and it gets to the top rate of 37%. So again, a lot of times when people do some sort of projection, they just may take the top bracket amount. It's scaled somewhat, so it's not going to be an exact science. But just keep in mind that not all income is taxed at the same rate, especially the difference between ordinary income and capital gain.
Before we move on, if anybody has any questions, feel free to put it into the Q&A. We want to try and keep this interactive, and we don't want to lose anybody behind as we start to build on top of this. In the future, if this is something you're interested, we can definitely jump on a call and we can walk you through this.
That goes to the whole concept. You should do it year round and not expect to just the last part of the year absorb all these concepts, because you want time to digest it, ask questions, and learn about these things. So now we get into what I consider financial planning investment considerations. And in general, when you think of a portfolio, you're looking for assets that could appreciate, okay? Appreciate potential. Think of stocks and bonds and mutual funds and things of that nature. You want to have a portfolio that's diversified. We always hear about that. Market goes up, it may go down. You want to minimize the losses by having a diversified portfolio. Are the distributions going to be fixed, or will they be variable? Will they be paid weekly, monthly, semi-annually, whatever it may be? Again, when you make an investment, you want to have an understanding of how distributions are going to come out. Secondary market considerations is important. Liquidity options. Can you just call up your advisor and sell something right away? or is there a limitation, or you don't have the ability to liquidate the investment? And then, of course, risk versus reward and current and future tax benefits. So the point of this side is to say, hey, you want to have all different kinds of investments, but at the end of the day, you also want to have investments as part of a portfolio that provides you with current and future tax benefits. So now, how does oil and gas investment fit into this? When it comes to appreciation, an oil and gas investment is typically a depleting asset. A well has so much oil and or natural gas in it when it starts. I always tell people to think of it as inventory in a warehouse, and every day we're selling off that inventory until theoretically there's nothing left. So it's a depleting asset. It does provide portfolio diversification. And typically when you go into an oil and gas program, depending on the program, but you're never really investing in one, you're going to invest in multiple wells that would be within the partnership program that you invest in. Typically with oil and gas, you have variable distributions that could be paid monthly or quarterly. The reason that they're variable is that you're going to have different production amounts each month, each pay period, and also pricing changes. We know that commodity prices changes very often. In terms of secondary market considerations, when you're dealing with limited partnerships, it is deemed to be an illiquid investment, meaning there is no readily available secondary market. So you got to expect to hold on to this on a long-term basis. Risk versus reward, oil and gas. To me, in today's world, finding oil and natural gas is not such a big risk. The programs that you would look to do is what we call developmental drilling. You're drilling in areas that have already found oil and natural gas. You're not wildcatting. You're not doing exploratory. It's really a manufacturing business. So the biggest risk is commodity pricing. And right now, oil is trading at about $59 a barrel, and natural gas is getting up to about $4.50 per MCF, which is 1,000 cubic feet. The current and future tax benefits in oil and gas, and that's what we're going to get into now, is what's called intangible drilling costs, which creates a large deduction the year of the investment, followed by depreciation and a depletion allowance. So there are different ways that one can invest in oil and gas, and stocks, mutual funds, ETFs, master limited partnerships, MLPs, which is really nothing more than a publicly traded partnership. Then you have royalties, working interest, and direct investments. So typically when someone is looking to have year-end tax planning with an oil and gas investment to shelter income, they're looking at a direct investment through a limited partnership. In today's world, and again, I've been doing this for a long time, so I've seen a progression here of some changes over time. And again, we're talking about the commodity of oil and or natural gas, because when you're in Texas, the production is going to be predominantly oil, though there can be a fair amount, large amount of natural gas as well. And if you're in Appalachia, Pennsylvania, let's say, the Marcellus Shale, you're talking predominantly natural gas. So if I'm talking to somebody and they want to have a oil and gas investment to shelter income, are you more interested in oil? Are you more interested in natural gas? Do you want a combination of both? Because right now what's going on with data centers and AI, okay, everybody knows that you need a lot of electricity for that, and natural gas is the component that manufactures, if you will, electricity. And that's why a lot of people are very bullish on natural gas, though we'll always be bullish to a large extent on oil as well. And then you have this concept of an operator versus a non-operator from an investment standpoint. A company that does their own drilling, vertically integrated, they prep the well, they drill the hole in the ground, though they will still hire subcontractors, and then they'll operate the well once the well is drilled. Those are the operators. But there are programs today where you get similar tax benefits where you're investing with majors, Exxon, Shell, EQT, Marathon. They look for third-party capital to drill their wells because you're dealing with very large horizontal wells that can go 10,000, 12,000 feet vertically, and 10,000 feet horizontally. And those wells cost multiples of millions of dollars. And therefore, they don't want to keep spending their own money. So they take in investor money to participate in the drilling of those wells. Once those wells are drilled, those major companies are the operator. So in oil and gas, direct investment reduces. This is what is pretty exciting about oil and gas investing. It makes it very unique. As Lane was saying, you could have ordinary or active income, so it can reduce active income, W-2s, bonuses, things of that nature. It can reduce portfolio income. It can reduce capital gains, though the way the tax return works, you're first going to shelter or offset ordinary income items before you're going to offset capital gains. Passive income, meaning income from other partnership activities like real estate. Maybe someone's got stock options. Alternative minimum tax, though far fewer people are in the AMT these days, but there is a potential benefit from an oil and gas investment in helping reduce to some extent the alternative minimum tax. Self-employment tax, another area that can be benefited from an oil and gas investment. Closely held C corporations, the business income within that entity can be sheltered by oil and gas. 1031 exchange boot income, pension income, required minimum it's the gamut. We say that an oil and gas investment can offset any source of income, and this just proves that.
Yeah, so some of you guys are selling off your rental properties, trying to trade up, and don't want to go to the cumbersome 1031 exchange. Those people doing the lazy 1031, we have a e-course for maybe 8 or 9 different methods. Oil and gas is one of them, and it's a catch-all, as Jack says. I think also the use case where guys selling your crypto, right? Got some nice gains in that, but that falls under the ordinary income portion. So that's where oil and gas is a bit of an enigma in a way. People ask, how can I offset it? Maybe Jack can talk about how the government, I mean, it's incentives, right? It's written into the tax code specifically for this, but maybe talk a little bit like, why do they do that?
It's been in the tax code forever. And it's interesting how every time there's a new administration, they always talk about maybe eliminating the tax benefit. But really, the oil and gas industry in this country was really built by mom and pops. And you really can't get rid of the industry. When you think about it, if the population in this country is like 430 million people, and it's going to grow to, let's say, 500 million people over the next 30, 40 years, what are the things that you always need? You're going to need real estate. You're going to need clothing. You're going to need housing. You need water, and you're going to need energy. And solar and wind and some of these other things you hear about cannot accommodate the population when it comes to the need for energy. And that's why oil and gas will always be around. But the way it always started out, because it's risky, you're drilling a hole in the ground to find something, given the opportunity to have some tax benefits that you can write off. It's like R&D, research and development costs that you can offset right up front.
And certainly the United States wants to get off foreign reliance of oil in the Middle East, Russia, China. So
Absolutely.
They're throwing these incentives in there too.
Going back to the point that if I look at either individuals or financial professionals with clients, I always say it's not for everybody in a book of business, but every professional has a client or two that has a need for tax reduction strategy like oil and gas. And the reason we say that is someone's going to have a lot of wages, W-2 income. Maybe they have a lot of self-employment income. Maybe they're getting a really big bonus this year. Maybe they exercise stock options, sold a business, creating a lot of capital gain and recapture. Traditional IRA conversion to a Roth IRA, where you're generating income from that. That income from the conversion can be sheltered by an oil and gas investment. As we said, required minimum distributions and other pension distributions, recapture due to liquidity events or roll-ups. Closely held C Corps is where 5 or fewer own more than 50% of the stock of the company. It's not a pass-through entity. It's an actual tax-paying entity, can come into an oil and gas program, actually as a limited partner, not a general, and offset the active income of that business. One question that is frequently asked is, What about limited liability company and S corps? They should not make the investment themselves, because where they have limited liability, corporate veil protection, okay, you can't be a pure general partner. We're going to address that right now, so that it doesn't make sense. They can come in and be a limited partner and have a passive loss, but they can't have an active deduction from the LLC or the S corp. So again, because people ask all the time, can I come in to these programs, use my LLC? And the answer is you cannot.
Yeah, I'm looking down the list of attendees here. A lot of pilots, some single folks. So, if you can't do rep status and you make over $200,000 a year, I think this is definitely something that maybe we should jump on a quick call and discuss.
Okay, so now here's where we start getting a little bit more granular about how well this actually works. So I said earlier, there are 3 different tax benefits associated with oil and gas. The first one, the major one, is called intangible drilling costs. Clearing an area to drill a well, take the trees down, build a road. They make a pad, consider a pad like a table, okay? That's where they're going to poke the hole in the ground. The cost to poke that hole in the ground, the expense to do that, to drill that hole, those are intangible costs. They're real expenses, and there's no equipment or anything like that could be depreciated. That's why they're called intangible drilling costs. They make up the majority, could be 70, 80, 90% of a well cost is going to be allocated, if you will, to these intangible drilling costs. When you go into a different program, it's usually about 70 to 90% of the investment amount is going to be allocated towards these intangible drilling costs. So if somebody put in, even right now to the rest of this year, if someone put in $100,000 and they were getting an $80,000 intangible drilling cost deduction, okay, you're going to take that $100,000 and reduce it by $80,000. Now you have an adjusted basis of 20. But again, you're reducing income by that $80,000 deduction, okay? Now, there is a choice, and most people don't take advantage of this choice because they'll take a deduction for what they need for the year. But the choice is to expense, take whatever you can use this year, or amortize it over a 5-year period of time, okay? Now, how do these companies do this? How are they able to create such a large deduction year end? The tax code has 2 requirements. One, all of these intangible costs have to be paid by year end, paid to the operator by year end, okay? Prepaid by year end. And then you have to start drilling the wells. We call it spud the wells by the end of March of next year. 90 days following the close of the year, you have to start poking the hole in the ground. Spin the drill bit around a few times, you're spudding the well. So as long as those requirements are met and you invest in something between now and the end of the year, you can get that 75, 80, 90% tax deduction for 2025.
And I'll walk a little bit further with this. And of course, you need to consult with your own CPA with that. But you invest 100, you get 70 of deductions. Now you go to your AGI, and that's what you use to lower your AGI on your personal side.
Correct.
I got a question. I don't know if this is super important, but these are intangible drilling costs we'll refer to as IDCs. But the tangible drilling costs, that's all like the piping, that's all these physical things that I'm guessing because you can deduct those materials, etc. The government doesn't want you to double dip. Is that kind of why? So we're getting those deductions elsewhere.
It's a different asset. Like I said, the intangible are actual drilling costs. And then for depreciation, it's equipment. There is equipment that is associated with the well, compressors, pipes, things of that nature that are owned by the partnership. And therefore, that's what's subject to 7-year depreciation. Under the tax law today, you could take 100% bonus depreciation. As long as that asset, that equipment is placed in service, you can take 100% bonus depreciation for it. And by the way, it's not really bonus. It's not additional depreciation. It's an acceleration of depreciation you are otherwise allowed to take. Okay, so having a greater deduction up front is great because it's all about time value of money. You want to save tax dollars And therefore, if you can create more deductions early on, that's an advantage. By lowering income, puts more money in somebody's pocket. And that depreciation is used to offset future income. Because remember, what we're doing is we're creating a new business, drilling wells, finding inventory in that warehouse, and then we're going to sell that inventory, sell that oil and gas. Okay. That's going to create revenue or income, but we can partially shelter that with the depreciation deduction that may take place next year. And then to the last column, there's a 15% depletion allowance. It's 15% against the gross income derived from the wells as long as they continue to produce. You got $100 of income, $15 is not subject to tax. You pay tax on $85. So again, you have depreciation, partially shelter income, but then you have that 15% depletion allowance through the life of the program as long as the wells continue to produce.
A lot of our folks are very familiar with the depreciation in real estate syndications. So I think that center category is very familiar to them. In real estate deals, when you sell the asset or you exit the deal, you have to recapture all that. Is that still the same case here?
Yeah, it is. Intangible drilling cost is subject to recapture. Depletion is actually to be subject to recapture as well. But let's go back to the initial adjusted basis. You start out with $100. If now between the deduction of $80, you're down to $20, you have income, you got cash distributions, maybe that adjusted basis is $10, 5, 6, 7 years out. Okay. You're selling that inventory, so the value of what gets sold cannot be the same as day one, because every day we're selling off that inventory. Nobody can say, hey, Lane, give me all my money back, because you get your money back piecemeal. So now maybe if there was a sale and that adjusted basis is 10, maybe you're only getting $30. So the gain is only $20. And that's what would be subject to the recapture.
I think maybe I made the mistake on this like maybe 5, 10 years ago. Unlike a real estate deal where the basis actually increases greatly. In this case, I think somebody taking a quick look at this, the value of it depreciates, goes to nothing. But in this case, for tax reasons, that's exactly what you want it to do.
Right. You'll have much less gain. Not great, but you're getting your money back from the tax benefit and from the distributions, the sale of the oil and the gas. And by the way, you mentioned earlier with real estate, in some cases, if you're not the professional, you need the material participation. In oil and gas, you do not need to have material participation to get the write-off. So here again is what makes oil and gas really unique. We talk about ordinary deductions and passive losses. When somebody goes into an oil and gas program as a general partner, and how do you go in as a GP? There's a subscription agreement. You check the box that say you want to be a general partner. When you're a general partner, and everything we talk about with the code, what is the definition of an intangible cost? You got to prepay IDCs by year end. You got to spud within 90 days. If you're a general partner, all these things are part of the Internal Revenue Code. It's not gray. It's very black and white. Okay. When you come in as a general partner and you get that 80, 90% deduction derived from the pass-through of these intangible costs, it is an active deduction. It is not passive. The concept is when you're a general partner, you are deemed at risk. That's what a general partner is. If there are expenses that can't be paid otherwise, a general partner could be called upon to pay it. Okay. So if you come into a program as a general partner, you will get a large upfront deduction to offset any source of income that you have. Now, I will tell you, having done this for 35 years and raised billions of dollars in oil and gas, I've never, ever seen, heard, experienced anybody investing as a general partner have any sort of liability because they were a general partner to start. So we'll never say never, but in my opinion, and you can take it for what it is, nobody should lose sleep at night. This is the way this whole industry performs. There's a lot of insurance. The partnerships have to have substantial insurance. Subcontractors are insured. you have partnership assets. There's a lot of protection before anything would remotely get close to an investor general partner. Again, it shouldn't stop someone from coming into a program if they're motivated to have some sort of tax planning. And
Yeah,
what
and
typically
additionally, a lot
happens,
of these projects, at least the ones I look at, you look to get out of that spotlight after the first year. Because after the first year, you've got the vast majority of the ordinary losses or active losses, as you said, and that's where you flip-flop to
that
passive LP.
that's what I was just going to say, that the following year, once you got the write-off, everybody gets automatically converted to a limited partner status. It's a non-taxable event. Now you're getting income. You're going to report the income no matter what. You don't have to be a general partner. Okay, so that's just the benefit of it. And by the way, as this slide indicates, the third bullet on the left, income in subsequent years is active, not passive, even though someone's converted to a limited partner status. Again, there's a code section for that. A lot of people don't realize that. They get a K1, they see their passive, it's income. It's going to be treated as passive income by the tax preparer, but technically it's supposed to be active income. Just point of information. And I want to skip to the third column there with self-employment, because when somebody is a general partner, they are deemed engaged in the trade or business of the partnership. They're not a limited partner, they're a general, they're deemed active. That's where the deduction, this IDC deduction, will offset self-employment income. When they're converted to a limited partner status, income will not hurt them for self-employment purposes. Again, this is what makes oil and gas so unique, that there are so many great positive tax implications. Reduce self-employment income by being a general partner, and you're not hurt later on when you get the income as a limited partner. Now, let me go to the middle column, passive loss deduction. If you don't want to be a general partner, you don't have to be. If you have, as Lane was saying, if you have a lot of real estate passive income, then you can go into the program as a limited partner. All you do is check the subscription agreement that you want to be a limited partner. You get the same percentage write-off from the intangible drilling cost, and now it's characterized as a passive loss. So again, lots of ways to figure out how to use this type of write-off. Again, you want active, you want passive, closely held C Corp, you want to shelter self-employment income. All these kind of considerations can come into play. And it's just, for me, because I'm a tax guy and I've been doing this a long time, I just want to ask certain questions to make sure it's positioned the right way if someone's interested in doing it. Maybe only one spouse is self-employed, okay? How do you split that up then between two people, right? So therefore, if one spouse is self-employed, that one spouse should be the one making the investment. So they're not getting this return. They'll file a joint tax return, but they're not joint ownership of the partnership investment itself. Only one spouse should invest in the oil and gas. They'll benefit from the self-employment that way. And again, you get the same benefits, depletion, even when you're as a passive loss or passive investor, you'll get depreciation and you'll get the 15% depletion allowance as well going forward.
It all sounds confusing, but from a tax perspective or a form perspective, you're just getting a K1, right? I think that's what I remember, like when I did my first one in 2018 or 19, it was a K1 for both the first year and then subsequent years, I recall.
Correct. But I always say, if you're going to have people invest, it's always good to give them a little heads up as to what to look for when they invest and they're talking to their tax preparer to make sure the return is done correctly. You want to make sure they're a general partner and it's treated as an active deduction. If they're self-employed, you want to make sure it's treated the right way on the return. Those kind of considerations.
We had a question come up. When you say self-employment, are you talking about 1099 income?
No, we're talking about Schedule C on the return. Self-employed, you have your own self-employed business.
Yeah.
Okay, thanks. And again, at the end of the day, we want to make sure you manage expectations just like with any other investment. So one of the things that people very often will ask me, what can I expect each year in terms of a distribution? And I tell everybody, listen, it's variable. So I can't tell you what it's going to be every year. So the better question to ask is how quickly can I get my money back? It's illiquid, right? There's no readily available secondary market. So how am I getting my money back? Cash on cash, cash and tax. And the other thing, when you talk to companies, they may say, hey, we drill a well and that it pays back in, let's say, 2.5, 3 years. And that very well may be. It's very common. That's factually accurate. However, when you're in a partnership like this and you have multiple wells, there could be 15, 20, 30 wells in a program. They are not all turned on at the exact same time. And therefore, a more realistic expectation of getting money back cash on cash is probably about 5 to 6 years. Cash and tax, Lane said earlier, you put in 100,000, you're in whatever the tax bracket, your actual tax savings is, let's say, 35, 40%. And by the way, most states do allow for the intangible drilling cost deduction. Okay, so you get the state benefit as well. And so take that 40% tax savings, cash. How long is it going to take to get all my money back? And by the way a well performs, again, think of it as a bottle of water filled to the top day one. Okay, about 50, 55, 60% of that water in that bottle is going to come out of the ground in the first 3, 4 years. We call that flush production. The remaining 50, 40%, whatever that number is, can literally take decades. And that's why we say distributions will slow down. There'll be less. So your distributions will go down. But it's not uncommon to get 15, 20, 25, 30% cash on cash in the early years when you got great production together with really positive pricing. Okay, and it's also on the buy side. The well is drilled, costs aren't out of control. Companies pretty much know what the cost of a well should be. Okay, so when you factor all that in, you may be getting most of your money back in the early years. You come into this again, portfolio diversification. You come in, you want that great tax benefit. You're going to get really good early on distributions and reinvest those distributions for other suitable assets for your portfolio. Make it part of a portfolio strategy. That's the ideal way to utilize something like this. Yes, it's driven at this time of year by the tax savings, but it's about time value of money. Okay. Big tax savings, big return from the savings, really good upfront distributions because they will diminish over time. And that's when people say, I don't understand my investment. What happened? I was getting all these great distributions and now they're not as good as they used to be. One, you forgot you got the tax benefit. Two, you're beyond flush production. And so again, this comes down to manage expectations. Because if you did put in 100 and you got that 40% tax savings, you got another 70% cash on cash, let's say, in the first couple of years back, and you reinvested that money, you're going to have more than $100,000 of benefit back into your portfolio. And that's the ideal way to utilize this.
The big picture here, guys. So you're getting the tax savings right up front in the first year. And for most of you higher income earners, you're trying to at least duck out of that first tax, the highest tax bracket you're in. Whether you want to drive your income down to way less, that's up to you. There's a little bit of diminishing returns, I think, as you start to get really low adjusted gross income. That's the biggest thing there. And then hopefully you can recoup your original investment in from that flush production, and then the rest is all gravy. But the big picture here is you got your money back, and it's a concept of velocity of money. We're getting the money back out, and then maybe you invest in something like this again. Maybe we'll see you again in 2028, I guess. Or maybe you put it in a real estate deal, or maybe you use the money for something else. It's the concept of internal return on investment, IR, which normally I'm not a huge fan of. But in this case, it's all about IR, turning your money, velocity of money. Make sure you understand that. Like, it's a pet peeve of me because we've been looking at a lot of these different operator and non-operator funds out there. And some of these guys will do really wonky things with their projections and include the tax savings in the projections, which I don't think is right because everybody has a different tax picture.
You're correct. Typically, from a track record standpoint, somebody would show cash on cash, and then they would show cash and tax savings. So the tax savings, they would usually presume someone's in the highest bracket.
I got a question. Our group some folks would do land conservation easements back in the day. Today, that's a big no-no, which is why we've moved to more of this direction. With that, I believe at one time they had some type of rules in place where you could only use the land conservation easement deduction to drop you to 70%, or you could only use up to 30% as a deduction of your total income.
Adjusted gross income.
Is there any type of restriction like this with this stuff?
To me, it's a function of comfort level, right? If I'm a financial guy, how much are you going to have a client put into something like this versus other investment opportunities? You're not really sheltering 100% of income because, again, you still have maybe an alternative minimum tax consideration, but you don't want to knock yourself all the way down. And so you want to be prudent in making an investment. It's still an investment no matter what. You want to be able to have something that's reliable. You're going to make your money and all that kind of stuff. I know with the easements, you had a 3, 4, 5-to-1 write-off subject to a percent of adjusted gross income. This is just, again, it's diversification. It's investing in energy. It's giving you a very good upfront tax benefit. You get, as we're saying, time value of money, very good distributions early on, but you got to keep in mind, until you have all your money back, it's really a return of the investment versus a return on the investment. So let's say 5 years, you have 100% cash on cash back, okay? And again, that's what makes this also unique in a way because it is a return of your capital. You're getting your investment back. And once you have it all back, you stay in these deals. It's like mailbox money is what everybody calls it. And you're right. People come in year after year. It's like dollar cost averaging. Come in next year. The pricing might be a little different. Production could be whatever it'll be. It works. It's been known to work from the tax benefit, cash flow. But you want to make sure you're working with a good operator that has a track record, good management. And again, you're going to find production. At the end of the day, you will have production. You will have cash flow. Nobody invests in one. You're going to be sharing, have a participation in many wells within a partnership.
And something that I key in on too is there's different basins. We're not going to get into this today, but different basins around the country that are a little bit more prime than others. And in a way, just like how we rank class A, B, C markets and properties, there's A, B, C wells that are a little bit more prime. Obviously, they're a little bit more expensive to get into because they have better deposits. Can you go over the best case scenarios with say somebody did $100,000 and their AGI was about 500? What would be like the worst case scenario, and then what would be the best case?
Again, if someone's making $500,000, how much are you going to put into a program like this? Would it be cash available? Let's assume it's $100,000. Okay. You're getting an $80,000 write-off, 90,000. Let's say it's 80,000. Okay. So now you're paying tax 500 less the 8. You're paying tax on 420. Okay. So you do have that tax savings opportunity, $35,000, $40,000, something along those lines, based on the investment that you're making. Best case scenario, again, is how quickly am I going to get my money back? The worst case scenario is, yes, you'll get your tax benefit. Yes, you'll get distributions. The question is, will I actually get 100% cash on cash return over time? And that's why, again, I'm an advocate. Reinvest those early dollars in other suitable investment opportunities. Like anything else, there's a risk component to any investment. You're not going to take all your money and put it into a program. There are programs you can diversify and go into different programs. Some programs don't really have a liquidity feature. Other programs do, by the way. Some programs are out there that can provide some liquidity. They'll look to sell assets within 7 years. Some programs provide a mix of natural gas and oil. So you get a little bit of diversification there. So you're not 100% dependent just on oil or dependent on natural gas. But companies, you're dealing with reputable companies. They're vetted. The management's vetted. We're not talking about any new kids on the block. There are different basins in Wyoming and the Dakotas, and we all know Texas has different basins. Then you got Oklahoma, and then you have Appalachia. And over time, all the wells drilled were vertical wells, just straight down. Now, a lot of the wells, yes, There's still a lot of vertical drilling, but a lot of horizontal drilling, which provides for a lot of cost efficiencies.
Did that make
Yeah.
sense?
Yeah,
Go ahead.
I had a question, Jack. So one of the things that I understand is that the quality of oil is different in different places. Maybe your Saudi Arabia has really pure, really good oil, but then some of the oil they frack out in like Wyoming, that's a little messier. And so it costs more to get the oil per barrel. And so as the cost of oil goes up, there's a lot more interest to go dig wells out there and like your Wyoming. And I'm curious, I guess I'm just trying to understand how much risk you're taking if the price of oil really changes on you and really goes down. I guess that's my question.
Once a well is drilled, because the real primary cost of an investment is drilling the well, right? I'm saying a well could be 6 million, it could be $10 million per well. But once that well is operating, the cost to operate it is not that much. And you could hear all different stories about what's the break even. Like Saudi Arabia, you may hear it's $70, $80 a barrel for break even. A lot of times in Texas, you're going to hear it's probably in the $40, $45 range. But once a well is actually operating at the wellhead, it may only be like $20 as a break even price. Companies do have the ability on an as needed basis to shut in production if it's appropriate to do. But again, because the operating cost, once the well is producing, is significantly low, even with a lower price point, they're still making money. There's still the opportunity to make money. While I agree with you, Wyoming and all that, it's a heavier oil. The real issue from Wyoming and the Dakotas is really transportation because you're so far away from the markets. Where Texas, to get to the Gulf and all that, it's much easier. But all those transportation costs are factored into the models. So we would know how well we're doing. We have a good idea what should come out of the ground because, as I said, it's all developmental drilling. We're not wildcatters. We're not doing exploratory. We know just by how many wells have been drilled in the area in the past, what the average production should be. And I say average because some wells will do much better than others and some will not do as well. And therefore, when you have multiple wells, here's the average that we can expect. And also keep in mind that many of these companies, they will hedge their pricing. They're never going to hedge 100%. You want to have some upside potential, but you also want to protect the downside. So hedging is very often part of the modeling, part of the operations plan, so that you are protecting the downside. And companies can look every day what the futures market's going to look like. And that's how they model these things out. But just like gas for the car, right? It could change every day to some extent. And while oil is more dependent, you deal with Saudis and more international issues. Natural gas is all domestic. It's weather, it's commercial use, things of that nature. It's electricity. So it's all about supply and demand. If the demand is there, we have the ability to accommodate the supply. And when you have that imbalance, if you have more supply than demand, your price is going down. If you have more demand than supply, your price is going up. But companies are pretty good at navigating the market and controlling what they can control from a cost standpoint. A couple of years ago, wasn't that long ago, oil went down to $20 a barrel, and a lot of wells got shut in at that point in time.
You were talking about there was two categories of places to invest, with a direct operator or with an Exxon big company. Do you have thoughts on that, whether maybe the direct operator might potentially make more money, but I also could see where there might be more risk?
But again, you want to have the opportunity to invest with management that have been around for a while and they have a positive track record. So I could tell you a company, MDS Energy, okay, they're in Appalachia. It's an old family-run oil and gas company, very big in the Marcellus Shale. They've been there forever, probably 50 years in the Marcellus. They are an operator. Okay, they control a lot of what goes on in drilling the wells. But I know companies that moved to Texas, and again, they established relationships with some of the majors because early on, to participate with the majors, it was a bit of a bidding war. So you may be overpaying to participate with them, but the benefit of dealing with the majors, you're relying on their due diligence, their expertise, the companies they use that they want to control costs. because they do have plenty of their own CapEx that are involved in drilling the wells. Because if your capital is the last piece of the capital stack, those wells are ready to come on and produce much sooner than if you're raising the money, it takes time to do it. You may be 6, 7, 9 months out before you start seeing distributions.
We had a question earlier. Investor was interested in using their Roth conversion aspect. I don't know if that kind of clashed with, like you said, can investors take ownership in this within an LLC or any type of not entity
So,
that's not them, right? Like a Roth or a self-directed IRA, for example.
so let's just LLCs, S corps should not come in if you're looking for an active deduction, because if state law limits liability, corporate veil protection, they're not a pure general partner. If the law had allowed that, I'd be setting up single member LLCs all day long to have people invest. And that's why it's not advisable to have an LLC invest if you're looking for an active deduction. When we talk about the Roth conversion, if you take an IRA, convert it to a Roth, the fair market value of that asset that's being converted, you have to pay income tax for that conversion. By investing in oil and gas, again, it's income that winds up on the face of the return. The IDC deduction winds up on the face of the return. So there's an offset there. So that's how you can shelter income from taking a traditional IRA, converting it to a Roth. Now, can you take IRA money itself and invest it in the oil and gas program and then take that partnership interest and convert it to a Roth? Yes, you can. However, what is the discount that would be utilized? Because that's what you would look to have happen. So put in $100,000. Next year, you do the Roth conversion. You're not individually getting the IDC deduction because it's sitting within the IRA, if you will. So you don't have personally the benefit. When you do the conversion, okay, and you need to have some evaluation what the value is, but there are discounts, lack of management, limited partner, things of that nature. So maybe there's a 60%, 50%, 60% discount. So when the conversion of that 100,000 is done, you're only paying tax on 40,000 as an example. But they need to have set up what's called a tax blocker because you have to deal with UBTI, unrelated business taxable income. To me, it makes it a little bit more complicated. Unless you have a lot of money that you're looking to convert to do 100,000 or some amount, I'm saying you could do the Roth conversion and shelter the income. I'm saying to have the investment made with inside the IRA. To me, 100,000, it's not worth it. I know many people over a number of years have used oil and gas to shelter Roth conversion income.
Yeah, you guys can do this however you guys want, but to me, which you guys are mentioning earlier, doesn't make any sense. But if you were looking for a way to get your money out of those 401ks, self-directed IRAs, Roths, etc., you realize income, but this would be a hell of a way to offset that ordinary income in itself.
Yeah, I know it's a lot of information to digest. It's just it's a planning opportunity. And again, it gives portfolio diversification, good tax benefit year end. There's nothing really like that because I'm asked a lot now, what do I do? How do I shelter my year-end income? People have capital gain income. And again, you can shelter that. But again, you're first going to offset ordinary income items before you get to the capital gain items.
The first thing you look at is, are you going after owner, operator versus the bigger guys? You obviously want to stay away from like these small cowboy outfits. You want to look for guys with a track record that you can verify. But the bigger guys, obviously, there's more overhead there. You didn't really mention that, but that's obvious, right? The other thing is, do you go after wells that are already producing? There's a trade-off with that. You get more cash flow there. You miss out on that initial flush. But I think the right answer where we're heading to is a bit of a blend. But the reason why you do this is mainly for the tax benefits on the front end. If you're aged, around 750 and you're in this highest tax bracket, I think it would be smart to drop it down to 500 down to 400. Maybe you invest 150,000 in one of these things to capture those deductions to drop you there. And then you're asking earlier, what's the pessimistic estimate on this? If you don't hit any oil on your multiple wells, then that's your base case scenario, right? But then you look to, okay, what are the track record of these operators in the past? And generally speaking, it's they usually recoup their money within the first several years. And then this is when you also dig into, all right, where are you guys drilling? Is it grade A, grade B, grade C? And is it horizontal wells, vertical? What's the strategy? I think the biggest part of the due diligence that we look at is like the geologists, getting a third party geologist on board. Because that's really the big factor is like how much oil is in that basin? Like how good are where they're drilling, where they're poking holes?
Yeah, one thing that I'd asked ChatGPT, which it said that there is no way to unlock your passive losses. I have a lot of real estate passive losses, but this would not be a way to unlock them and use them. This is an active loss that's special, like the land conservation easement was. I'm just still trying to find ways to unlock. I have a lot of suspended passive losses. So that's one of the things that I'm still looking to tackle too.
That's the trouble with passive loss. It's great to offset other passive income, but it's useless to offset the ordinary income if you're not doing rep status, which is most of the people out there.
Rep status it's got to fit. It's
Yeah.
a ton of time and energy. And for some people, it just is a great fit, depending if they have a spouse that sort of fits the right spot and you all want to do it. But no, it's also time, energy, and money that you only have so much time. I'm a little fuzzy a little bit on some of the depreciation recapture piece, but he did a good job. I'll probably have to watch it again to understand. Again, there's just different categories.
Yeah, go back and re-listen to it, but essentially the basis goes down to nothing, and that's that you recapture. So it's somewhat negated. Whereas real estate, the basis actually goes up, which is why you need to hold on to your passive losses. I know you got a lot of it and you can't use it today, but you're going to use it in the future.
But then also there's that piece with the machinery, right? And there's going to be some write-off of equipment. That's always nice because you don't have to recapture the equipment.
Yeah, because that stuff degrades over time.
No, a lot of good things, especially let's say you were going to do a big Roth conversion or something in a year, boom, and you could just time it and do the same year that you take this. It seems like a really good first year. After that, it's less good, but not bad.
Yeah, the guys who do this, they start looking about this time of year where their AGI is going to fall, where in the tax brackets are they falling, and then whatever magic number they're shooting for, whether it's 394 or 200, that's basically how much they see how they can buy into this stuff for, if they got the liquidity lying around for it. Of course, you don't want to have an overexposure on oil and gas, but I think for a lot of people, they don't have any. So they don't have to worry about that too much. But that's kind of getting a little bit more advanced at that point, more into asset allocation mix, which I'm not allowed to talk about.
Yeah, the general partner risk stuff was a little interesting. I think he's probably right. You really don't have to worry, although you're not shielded by an LLC on this. So there's potential there.
And I would just say the alternative that people are doing is a lot more risky, right? They're getting a little short-term rental. They're the direct exposure to that as they're making decisions on it day to day, and there's just a lot more litigious world in that world. Whereas this, you're put on there for the first year to get the active losses, and then you get out of that exposure. But in reality, it's if something were to happen, you're the small fish amongst maybe 100+ people, and more than likely the smallest pockets. A lot of these lawsuits, the way they work is like really what's the collectability of that individual. So I would, of course, talk to your own lawyer, but I would definitely say that doing the short-term rental loophole and that nonsense is way more exposure than this type of stuff. That's all subjective. I've heard of people also getting umbrella insurance. Don't know if that's going to kick in or not. I'm just being conservative, but that is an additional tactic that people will do. But some of these guys will say it's not really needed.
I don't know. I guess one takeaway might be for some people is, hey, if they're interested, if you or somewhere else they have a fund and they can do 50,000 or something and watch it happen for a little while and see how it goes.
You got to see it for yourself, right? I did this in 2018, 19. I flew into Dallas and I drove up a couple hours. I think I was in Oklahoma, but yeah, I went and kicked the dirt, looked at the wells. Don't know what really got for me. Or I met the geologist when I did that, but Really, it was just investing a little bit of money and then seeing that first year or two tax returns. And it's fun to see like the oil barrel reports, right? Because that gets transported and that turns right into dollars. But for me, it was like, how does the IDCs really work? And it just comes on a simple like K1 form. Just pass it over to your CPA. But I'm one of those guys that needs to see it for myself. If not, we'll see you guys on the next webinar. I usually do these the third Wednesday of every month around noontime Pacific. I'm going to be unveiling the new Circle group. So if you want to be part of that soft launch, shoot me an email, lane@thewealthelevator.com. Ideally, need you guys to complete that onboarding call with myself so we know who you are. And then also a reminder that the annual retreat is going to be in January 16th to the 18th in Honolulu, Hawaii. I hope you guys all can come, and we'll see you guys next time. Bye.
All right, welcome, folks. This is the next module. We're protecting your assets. Legal. Before we get going through this, I am not a tax attorney. I'm not a lawyer. Everything here is things that I put into practice myself, but with the aid of my professional team. If you guys need a referral, let us know. So here we go. Asset protection. You've got like a web of all these things that you've heard out there: umbrella insurance, you've got liability insurance, you've got different entities, and how does it fit with estate planning and taxation? You've got a lot of these layers to this, and we're going to start to break these things down into steps. And we have to think the reason why we're doing this. And sometimes it may totally conflict with paying less taxes that we've talked in the previous section, but it puts you in a better position for risks of lawsuits. This becomes more of a bigger issue for those of us who are higher net worth. When I was in my 20s and early 30s, and I just was playing around with little rental properties under $1 million net worth, I wasn't a big target to be sued because I didn't really have anything to lose. It wasn't really worth the calorie expenditure from somebody to come after me to get under $1 million. But as investors get a higher net worth, certainly into the 2 to 3 million plus range, a lot of these things are a must. And especially if the things that you do at your profession, of course, you should have your own professional insurance, but you're still a big target there, if not only because you have a high income. So some of the doctors, dentists out there may choose to go up a step or two. If you're just some guy who works a sales job or in corporate America, you may not have too much extra liability, but we all run around, drive cars, interact in public very safely. But the problem is the other people out there. And we live in a litigious society here in America. And the other thing is we also live in a somewhat unfair legal system. The reason why I invest in America a lot is we have a good legal system. And that kind of sounds a little contradictory. But the point I'm trying to make here is that it's not always 99, 100% of the time things work its way out where the people who were in clear conscience did what they're supposed to do win these types of battles. And if anything, we do know that most of these lawsuits end up in settlements. It's very rare to take everything to trial to get to that point. It's usually settled. And if you're going in with that mindset, all right, we're not going to battle this out in the courtroom floor. The legal team are just going to go back and forth and argue the merits of the case, then these types of entity structures and things we're going to be talking about is going to be ultimately what decides how good or how bad that settlement is. And we're going to be getting a little bit into irrevocable trust, taking your money offshore. But I would say unless your net worth is over 5 to 10 million, that a lot of that stuff doesn't really make too much sense. It's expensive. It's cumbersome. I think the things that I wanted to point out today, especially, again, this is not legal advice, is to make sure that you're at least on the same planet with it. If your net worth is $4 million and don't even have a simple Holdco LLC structure, then hopefully today this was that wake up call for you. So I'll refer to this image here on the right side. And the way that this is built up is you start to build your protections in rings. And think of this like a castle as a metaphor.
You've got a moat, you've got archers, you've got walls. But what if you have a little castle to protect? And that's what's in these smaller rings here. The way to read this chart is if you go up this side, this is basically how much net worth things you have to lose, and it goes sequentially. And on this side is what it costs you to perform some of these things or put some of these protections into place. And then the middle ring is, and we'll go through these steps. I think everybody here listening to this, you guys are probably in these first few rings at the very least. So we'll start there. Step 0 is insurance, right? You've got your car insurance. You've got your malpractice insurance if you're a medical professional. If you're not, you've got umbrella insurance. And if you're a doctor, you should have both. You should have all 3 of those things: auto, malpractice, and umbrella insurance to cover most lawsuits. And this is typically what most frivolous lawsuits are trying to go after, the insurance claims. We've had probably dozens of these types of insurance come back on our thousands and thousands of rental properties. This is, after a while, we got all frustrated of it, but then we just learned the game that this is what frivolous lawyers will do. And a lot of times what they're trying to do is just get the low-hanging fruit, trying to figure out what is your deductible and what is your coverage, and just going in right under that because they know that they can get that number with the least amount of legal resistance on our side. And what I would probably say, and I've detached myself over the years from these types of things, like perhaps desensitized myself. I don't take things personally anymore these days. If people want to spend $25, $50, $100,000 to collect $25, $50, $100,000, then so be it, right? That's just how some people are. And unfortunately, there's a lot of lawyers out there that kind of trick their clients into thinking they may have a case when they really don't, so they can just churn those hours on them. As the saying goes, in any type of dispute like this or divorces, it's the lawyers that get rich at the end of the day. For our purposes of this talk today, you put your umbrella insurance amount to a point where it will defend off for, essentially, here's the umbrella, dude, just take that, leave me alone, man. So for most of us here, you probably make a lot of sense to mimic where your net worth is, at least get $1 million. In our FOOM group, this is the first thing that we have people to get some good momentum moving forward, is to go get an umbrella policy out there where there's multiple carriers. A lot of times you can tack it on to your auto insurance. It's rather cheap, especially if you get it tacked onto your auto insurance. It falls behind the auto insurance, so that's why it's so cheap. But just to give you a round ballpark, maybe $400 or $500 for $1 million, plus or minus 20-30%, adjusted for inflation, depending on when you're watching this video. You should be able to get it for under $1,000. This peace of mind per year, I think it's just a no-brainer. If you wanted to double it, triple it, get $2 or $3 million. If your net worth is $1 million or $2 million, go ahead, knock yourself out. But if you don't have umbrella insurance, dude, what are you doing? Get that yesterday. All right, so now going into step 1 here. You've got some rental properties or passive in investments. Maybe you own your own practice, you have a business. The idea is to start setting up your entity structures. We live here in America. The LLC is a great legal entity that separates personal assets from business assets, and also business assets from business assets. You've got little rental properties. Those are typically higher liability than your holdings in passive syndications, where you're a passive investor in LP, limited partner, limited liability. And that's the beauty of investing in syndications and private placements. I would say maybe separate those 2 holdings in separate entities. Certainly separate your LP holdings from if you have a real operational business. So we had an investor, they ran a custodial company, operational business, high liability. They got employees. There's a lot of risks there, relatively speaking. And whatever you do, don't put your passive investment holdings in the same LLC. Just create a new LLC. It should be pretty cheap to do, $500, $1,000 to create one of these entities. That said, I would stay away from filing this on your own or doing the LegalZoom ran a LLC document from the internet method. Personally, what I do is I always have my lawyer make this for me, and it shouldn't be that expensive. Shouldn't cost more than a couple grand on the high end to do one of these activities. Essentially, what we're trying to do here is we're saying in step 2 is separate your real estate from yourself once it gets to a certain stage. Whereas step 1 is separating yourself from your business activities. Just to highlight that nuance, both are using LLCs or different entities that are separate from you. A lot of us might come already on the second or third floor of the wealth elevator. So both of these might apply to you, and what's on the next slide might apply to you. But if you're thinking sequentially as you're trying to build up your net worth, this is how, personally speaking, I started from no net worth. For a while there, I didn't have any LLCs. So I violated a lot of what I'm talking about here. But then again, I didn't have anything to lose, right? As a kid with under $500,000 net worth in my 20s, I wasn't a big target. And spending a few $1,000s to create these entities was maybe the cash flow for one of my properties, one of those turnkey rentals back then. Again, no excuse for doing that, but that's just what I did. So I guess a little bit of do what I say, not what I do in a way. But of course, take this information and have a good educated conversation with your own CPA and attorney. This would be a good time to show you some real application of this. This is actually what my entity structure when I had 11 rental properties and was starting to get into syndications and private placements. Obviously, a lot of these structures have changed as my net worth have grown and become more elaborate entity structure. But what you're seeing here on the right side is upper right-hand corner is where all my little rental properties were. Again, these are relatively high liability. And what I had was a little tree of LLCs. So I had my Georgia rentals in one LLC and my Alabama and Indiana rental in another LLC. And those got pulled into another LLC. And you're going to hear a term thrown around a lot called the hold co. In a way that Kanaka LLC there, which was filed in Delaware, was my hold code there, where the other two entities were filed in that wherever the rental properties were, in this case, Georgia, and then Alabama. And then we just did Indiana, one in there, Indiana property there we could have made a third LLC, but this is where you need to sometimes balance, what makes sense from a money standpoint to put this stuff together, or headache. There are probably about 4 or 5 different arrangements of just protecting these 11 properties. You could just throw them into one holding company. You could also throw it into the state that you're living in. But this to go to show that there's so many ways you can do it. This is just one working model for this. None of this is tax or legal advice. On that right side, you can think of that more as passive income from a tax standpoint. And then on the left side is more of my ordinary income, right? Like at this point, I started to become a business owner. We started to syndicate deals 2016. So you start to see how I would take over the LP side and the GP side. So I think that's a little bit different, right? This would be no different than if you own your own practice, own your own business. A little bit different application, but I'm just putting this out there as like an personal example and ways for you to start to think about things. And one way to think about it, and it doesn't always align well with taxes, but you have to blend the two. And it's nice when your tax attorney and your lawyer are both on the same page. Sometimes it's really worth to spend $500 an hour for one guy and $500 for the other guy to sit on a call for 30 minutes. Be careful with that. They love to do that and BS with each other on those calls and burn up your money, but sometimes it can make a lot of sense. So let's go back to the theory of this. So we talked about creating entities. Step 3 here is establish a holding company. And that was what I was mentioning over here that I was doing myself, which is this entity, and operational company was on this side. So that there was some kind of consolidation happening. And also these entities were filed in a little bit more business friendly states such as Delaware, Nevada, and Wyoming. You need to categorize your holdings into risky and safe.
So risky ones are more like rental properties, your operational business. Your safe holdings are your stocks, bonds, mutual funds, and probably your passive LP syndication holdings too. Try not to commingle them into one, because if the dirty, risky liability assets have an issue, it's going to bring the safe ones into it too. The idea is you try and silo all your entities. We hope nothing happens, but if one thing were to get blown up or called under question in a litigation, then the other ones are free from that and separated. If not anything, starting out at the top, the settlement amount goes way, way down. All right, you've spent several $1,000s to create these entities, and you've got your little PowerPoint slide deck to be able to discuss things with your CPA and your lawyer, and you're feeling really good. But step 4 here is respecting your entity structure, basically treating it like a business and doing all the filings, the taxes, and separate bank accounts, separate credit cards for those bank accounts, and always acting as a manager on behalf of the company, not personally, to maintain the separation. Basically, don't screw up the cool thing that you made. If you ever went as far as a litigation and full discovery, they may go back and look at your ledger and look for instances when you're commingling funds and not really using this entity as it's a true separate person of you or separate part of this business, and may use that to call into question your entire entity structure and go after other things that are outside. Have that in the back of your mind. Of course, great time to also explain that if you're doing anything fraudulent, criminal, all this blows up all this stuff. Doesn't really protect you. And I think we would all hope that's the case with all of us being law-abiding citizens, trying to do things the right way. But we live in an unfortunately litigious world that we have to do these types of things to protect ourselves and our family. At this point, we've stepped up to this bluer level in terms of how much we have to lose or asset level. And we're getting into these outer rings and a little bit more of these exotic strategies. Up until this point, from a asset protection strategy, you're implementing basic entities. And especially if you have kids, this is not quite of a asset protection thing, but it's just you need to have a living trust, revocable trust. That gets put in as soon as you have a kid, at the very least, or especially when your net worth goes over $500,000, $1 million, I would think. And what this does, it avoids probate, which probate is this kind of nasty process that goes through where all your stuff is aired out and it takes a while for your heirs to get your money. Now, it's something that everybody delays doing because they don't want to think about their demise, but it's not really like some people are attacking your money. And this is more like in case you died to protect against that side. So think of this as more of a side, right? If you have a kid, your net worth is over $500,000, you should have had your revocable trust, living trust done yesterday. Revocable trusts only offer a layer of anonymity, meaning when you go to probate, all your stuff doesn't get aired out publicly. It has no liability protection. I will say that again. No liability protection, meaning that it does diddly squat when you get sued. All it is the directions of where your money goes to. Now, if you want asset protection, you need to have what's called an irrevocable trust, which, as the name suggests, it is irrevocable. You can't really change it. And think of it as outside of your estate. You may be the beneficiary of this trust, but if somebody were to come and attack you from a legal standpoint, it's going to be a lot harder, if not impossible, to get at the assets within that irrevocable trust. If you're keying in on this, as I did when I was stepping up the floors of the wealth elevator myself, the irrevocable trust is like this cheat code in a way. The problem with it is pretty expensive. You're going to be expecting to pay $10, $20, maybe even $50,000 to set one of these things up. If that sounds like a lot of money to you, you probably don't have enough assets to protect, or you're super cheap and you need to change that mindset. And I think that's where you need to get around other accredited investors within our community. That's why we have the family office Ohana Mastermind group. We allow people to come to the retreat to test us out. But I would say you really need to have at least a handful of accredited investors around you to start thinking this way, and to, especially for like asset protection, right? How do you structure your entities? It's hard to have these types of conversations with your buddies and your coworkers because it's about money. And most times they are in a much lower financial level than you are listening to this type of content. There's a lot of names for these irrevocable trusts. It can often be very confusing. And to add a layer of confusion to that, there are a lot of these legal promoters out there that like to use a lot of cool names out there for these irrevocable trusts or revocable trusts to make it sound like the Cadillac of entities for your asset protection. Don't be fooled by all the bells and whistles and the names, especially. A lot of these are just marketable terms, much like you'll hear for simple solo 401k will be called all kinds of different marketable trademark terms, but they're all the same damn thing. Now, if your net worth is a few million, 5 million, $10 million plus, or even you run your own dental practice where you have a lot of high liability coming from your business, it might make sense to put together what is irrevocable trust or even go offshore. And another side strategy would be to implement equity stripping, where you're commingling your assets with loans that are senior to any litigation. Now, this is something that I put into practice, but later on learned that it may not be the most effective thing when a lawsuit does come up. Again, it's just another strategy out there to have a conversation with your CPA. If not, the offshore aspect of some of these trusts also create another deterrent and barrier. And that's what all these things are. None of these things are foolproof. Some of these things they may or may not work. Like Series LLC, there's really not a lot of good case law behind that. It's a little bit untested. But if you can stack these multiple strategies on top of each other, that's really what's going to protect you at the end of the day. Again, the analogy is you're trying to build a castle. You may geek out on having a big moat, but what if your people coming through are really good swimmers? You're screwed, right? You would have wished you would have spent the money on the archers. But I think what we're trying to say here is try and build your asset protection strategy with a good amount of these lower level strategies and maybe some of the more exotic stuff at the top. The last thing here is to review and adjust your asset protection strategy. That's why I have mines on a PowerPoint slide so it can change and I can plan for the future, because this is a moving type of diagram that's going to change. And also laws change. For example, right now, Congress is fighting the grantor trust aspect with an irrevocable trust, which right now is a great way of paying less taxes in these trusts, but also really strong asset protection. So to have your cake and eat it too. It's one of those known things out there in the more advanced asset protection tax strategies that are coming under fire. Hopefully it just, the ball gets kicked on it for forever. It's just an example of things change. Just in the tax world, a lot of us did those land conservation easements, and then the omnibus bill came and we moved away from that strategy as it became a little bit more risky. But I think this is where, again, you got to get around other accredited investors who are implementing these types of strategies, having good conversations with them. But as you can see, a lot of this is very private, especially asset protection, especially how your entity diagram is put together. Obviously, it's not something you want to put on the internet or in a masterclass, right? Like this. But that's why I always say get around at least 5 people that you can build a relationship over time. That's why ultimately why people join our family office, Ohana Mastermind, or inner circle, so they can be in a safe environment to build relationships with other people. We're talking with the next generation when your kids are old enough. Some would say even 12, they would sit down with their kids and they would put this entity diagram on the board and then say, hey, Simba, this is what you own. This is your horizon right here. This is how all these entities make money. This is how we're protected. Maybe this line we want to get rid of, and then we'll augment it this way. This is a great way of mind mapping out and sharing this information with the next generation for them to take the baton. I never had this conversation with my parents, probably because there wasn't jack really to give, and it was just simple. All they had was stuff here in the middle, all your traditional stuff. If my parents would have had something like this, I would have really loved it. And this would have been obviously turned into huge interest and passion that I would have had in the future. If not offer a sense of security, but also provides a little bit of anti-entitlement too, right? This can be taken away. This can be sued, and this may not be here forever. They understand the risks of owning these types of assets and how it can be taken away and how they need to just keep putting their foot to the pedal and keep moving forward and growing the family's legacy and net worth. And obviously this gets into more softer subjects. And this is why you need to get around other people. These aren't the conversations you have with your lawyer or your tax attorney. They're just there to set up your entities and to help you when there's a problem. Just healthcare. Nobody really talks about optimizing health. They just talk to you when you get a sickness. In this case, you need your peer group around you to help grow the legacy and expand it in the same sense. The last thing here that I'll mention is a fraudulent conveyance. You guys can Google that word later. But if you are putting these entities into place after litigation, a lot of that is seen as you doing things after the fact. And at that point, it's too late. And in reality, a judge or lawyers will unravel that. So the idea is putting the stuff into place before the issue comes up. And when we're on a topic of legal protection, a couple side notes, your retirement funds, your life insurance. That's why we all do the infinite banking, accredited investor banking. Money in there is typically safer, depending on what your states are. Check your specific state, send an email to bank@thewealthelevator.com. That can be part of your legal strategy. As I use the analogy, when your assets is put into an irrevocable trust, that is pretty dang secure at that point. Even a regular entity, right? You're putting it into its own silo. In a way, think of it like you're putting it into the house or putting it into the safe in the basement. When assets are in cash or you're paying off your house, depending on which state you're in, paying off your house and having all the equity could be one of the dumbest things that you could be doing. You're sitting duck. Everybody knows how much you have and it's right there and they can go after it. Certain states are a little bit more asset protected for your house, such as Florida, but other states, I mean, I think in Hawaii, your only first 50 grand is protected in your primary residence. So it's smarter to have a mortgage, encumber yourself with debt in that way. If you don't own any rental properties, you're probably like, yes, stepping over that adolescent step of that first floor of the wealth elevator and going straight to the second and third or higher. This would be a good way of thinking about it. So first is on the left side here is more of within your estate. The right side is more of the advanced stuff, more of the irrevocable side. For now, just ignore this portion right here, right? This would be a great starting point to, of course, have a conversation with your own attorney. But first thing, this is yourself, right? You might have an LLC where you have your holding company, and then you would put your investments into here. So that's on this more passive side, lower liability side. Now, a lot of you guys have businesses, whether it's a high liability medical practice or a low liability side gig, sell stuff on eBay. Maybe your spouse sells things on Etsy, makes little crafts on the weekend. This would be that entity, that LLC that would hold this side gig business. Notice we're not really talking about one way or the other, whether you're doing it as an LLC, S Corp, C Corp. That's more of a tax distinction. I'm just talking about just entities for now. This would be an example of separating the lower liability stuff from the high liability stuff here. If you don't have any operational business, cool. You just got your passive stuff here. This would be a good starting point for somebody who's a few $1 million or higher. A lot of investors, I would say most of them just invest in the passive syndications as an LP and sign on behalf of their own personal name too. I'm just using this as an example. And then of course you've got your life insurance from that goes directly to your own name because again, life insurance generally is asset protected to begin with, along with your other retirement accounts. At some point when your net worth gets higher and you have more to lose, you might want to put in this irrevocable trust structure, if not anything to get out of the estate tax thresholds. And estate tax thresholds will change over the years. And I think this starts to kick in right now around $20, $25 million which seems like a lot, but for most of us who are in our 40s and 50s with a few $1 million net worth, by the time you're in your 70s and 80s, you got to believe just with pure inflation, and even if you put it into some lower return type of vehicle like life insurance, and you continue to make and save money, your net worth is going to go over 8 figures. And who knows what Congress is going to do with the estate tax threshold? It may come way down and may put these types of situations where, yeah, you want to get your money outside of your estate to hide under those estate tax thresholds, if not only for asset protection at that point when your net worth goes over 5 to 10 million. As I said before, there's all these marketable, cool terms that all mean the same thing. It's some kind of spin on an irrevocable trust. Irrevocable trusts, you can build them as a grantor, non-grantor, who's the trustee, who's the beneficiary. Yeah, I think this is where it gets really confusing and might go beyond the scope of most investors out there. And this is where you have to really work with a good tax attorney who's not going to fleece you on the pricing. And that's why if you're looking in the market for one of these things, your net worth is over a few million. I think that's why you got to join the family office on a mastermind, guys, right? Like you have to interact with other people putting these entity structures into place. But this is how you might put one of these things together. The trust has its own investment LLC. Again, that's a similar structure of a holding company. And that's where you may put other investments in, and then it has its own bank account. And you may even take it a step further if you have your own primary residence in your trust, especially if you live in a place like Hawaii where the protection limits are pretty low, opposite being Florida, where you want to put that primary residence in the trust. And then you do some type of structure where you rent yourself and you pay your trust from your personal side. And this is where, as we mentioned earlier, you got to get the paperwork right. You have to uphold these things. If you're renting your primary residence from your trust, you better show the paper trail of the money going to your trust as rent payments. And of course, pay the taxes on behalf of the trust if it's grantor or non-grantor. So it gets a little confusing, right? And obviously confusion creates more costs too. So you have to weigh the differences between, do you want to do one of these things or just want to keep it simple, but be somewhat exposed? This is a lot more nicer looking. And just an example of what I showed in the other slides. You can do things of a myriad of different ways, right? None of this is legal advice. This is just different ways that you can build the skeleton. The way I would read this is you've got yourself. Self was here in this diagram, but the self is here in this individual. And you've got, this guy might have a rental property here and it goes to him individually, which may not be the best practice method, but it is what it is. But this real estate is put into here and this LLC is here. And then they've got their infinite banking and 401k. This one has the hold code. The way that I think that's a general best practice is have it go into a holding LLC. And then this one's got a separate holding LLC for their more safe investments. The reason that they would do this is now you have separate bank accounts. It's just cleaner. And I think sometimes we think of managing this on our own, but for all we know, we could just die tomorrow and our spouse and our kids have to pick up pieces. And if you already have this stuff set up and already in a trust, then it's easy for them to get moving and not skip a beat. So these are, I would say, common structures for people that are under 3 million. These are over 3 million to 5 million, or people with higher liability professions like doctors. This might be similar to what we showed earlier, where the passive syndications are in a holding LLC, which is owned by a trust. And then also the infinite banking, your life insurance is put into the trust, or infinite banking could be just put into individual, like we said, because generally speaking, the life insurance is asset protected depending on which state you're in. If you really wanted to geek out on this stuff, you can put life insurance in trust. It's called an ILET. Not a lot of people do it right now because the state tax thresholds are relatively high, as I mentioned earlier, but maybe it comes back down and this becomes more of a common arrangement where they put the life insurance in the trust for tax reasons. But hopefully that demystifies a little bit of the layering strategy Again, have a conversation with your attorney, but also have a conversation with other purely passive accredited investors. But the only way you're going to get is to build real organic relationships from them. Nobody just shows their Google Sheet, Google PowerPoint diagram of other entity. It's rather sensitive information. You build a relationship with people over time, and that's how we format the events, right? People come down, they spend some time with each other, and they grow the relationship over years. And I think that's what makes this journey a lot more funner when you do it with other people. One quick discussion on entity structures when you're investing as a syndication. This is within a syndication, how some of that's structured. A lot of this is encompassed in the black box within the syndication holding. But there's a few different ways syndicators, operators will set these things up, but they'll typically have the asset in a holding company and might be a series of these LLCs. But essentially what happens is there's a private placement memorandum, operating agreement, and there is a split structure put into place. Of course, a myriad of other things in there too. But this is where knowing investors will go in on, you hear class A, B, and C, and those are just arbitrary letters. You can make it XYZ, MYC, whatever. It doesn't even matter what the letter is. I think in one of my deals, I actually made it as the Mercedes. You got your C class, you got your S class, you got your E class. But I think that just confused people. But that is the shareholders in here. And then you have your general partnership, which could be class A, could be class F. It doesn't really matter, but those are your manager level people. Sometimes that will be a separate LLC where the different general partners are put into there with their rights and their control rights. This is typically where I will be in there with other partners that can control the asset on behalf of everybody. If you're thinking just for yourself, how does it tie into my personal strategy? You're in typically these holdings right here, the common equity holdings. And that what goes into your own structure. But being a passive investor has a lot of good perks. The biggest one of being if you're not signing a recourse on the debt, any liability gets firewalled from you. If anything, there's any lawsuits, it comes to the manager's side, whereas that's the beauty of being an LP. But with that is the end of this module. I think it is rather confusing. The first time you hear this stuff, it might go over your head. We've got some other videos just to push the point home, spoken in a few different ways and methods. But if you guys need a referral to a tax lawyer person, because we're always very clear, we're not giving any tax or legal advice here. I'm just here sharing my own experience of my journey. We can help you guys out with that. As CPAs and lawyers, there were people we refer out to have changed over the years. But we live in a dynamic world. And I think that's, again, why you guys need to learn this stuff to a certain extent, but also have a community around you of people also dynamically improving themselves.
Is your net worth $1 million or greater and you're just freaked out about getting sued, but overwhelmed by all these lawyers? You should make this LLC, that LLC, this domestic asset protection trust. Let me just break it down and bring you from steps 1 through 7, what I think that you should be doing to adequately protect your net worth. Let's get into the video here and let's learn how do you protect yourself from potential litigators out there, especially those stupid frivolous lawsuits. If you're in the medical field, you know it's a matter of life and death, and being the direct practitioner puts you and your family's wealth on the line for lawsuits, even the frivolous ones. And let's face it, we live in a very litigious country here in the United States. Now, whether it's malpractice suits or random litigation tied to other ventures, your wealth is constantly on the line. Lawyers know that doctors are high earners, and they often make easy targets in court. Now, I get it. Asset protection is one of those unsexy yet absolutely essential pillars in your financial strategy. Like taxes, it's not just what you make, but what you keep at the end of the day. If you're under $1 million, $2 million net worth, you may not have enough money to even worry about. But certainly when you become an accredited investor, like many of folks in our community, you get above that $1 million threshold, you start to ask yourself, I have something to lose here. Certainly that's where I was. When I was in my 20s and I owned rental properties, I didn't put them in LLCs and do all of that asset protection stuff we're going to talk about here. But back back then I didn't really have much to lose and therefore wasn't a big target to get sued at that point. Now, what we do know is the US legal system is not fair nor really consistent, and it's rarely about having your day in court to go in there and argue your case. In reality, majority of the time, 90% or more of cases are just reaching a calculated settlement amount. So if you can do some of these strategies, you can simply mathematically dwindle down these settlement amounts. One of the big things here is just lowering yourself to a point where you're just not a big target, less of a legal sitting duck. And we're going to be taking this sequentially. Now, asset protection doesn't mean that you're going to hide your money in offshore accounts like foreign criminals or like in the movies. It's all about making sure your wealth is well organized and, more importantly, unattractive to anybody looking to get at your money or suing you. So step one here. First thing first, form an LLC for your practice. This is your first layer of protection and is a limited liability company or an LLC. Setting one up for your practice or any type of business that you have that has operational or lawsuit liability is critical, particularly if you're just starting out. An LLC provides a legal separation between your personal assets and your business. So let's say a patient sues your practice. If your business is under an LLC, only the assets owned by the LLC are at risk, not your house, savings, or other personal investments. Essentially, this helps create a protective boundary that ensures your personal wealth stays shielded, even if your business faces legal issues. Now, it's not total protection, which is why it's a first step, but it's a good building block to build on. And as you're going to start to see, you start to build together this asset protection. An analogy that some people like to use is protecting your castle. When you have a castle, you've got your moat, you've got your archers, you've got your tall walls, you've got your inner walls, and then all kind of booby traps in there. That's what you want to think of like your LLC. Maybe call that your moat in a way. We're getting into step 2 here, which is separating your real estate from your practice or other business ventures. Or if you're not a doctor and you just own rental properties or some other operational businesses, it's interchangeable. Now, this is where you want to separate your assets. So if you own the building where your practice operates, you should separate the property ownership of your business by creating a separate LLC, as we mentioned in step 1, but also create a separate LLC for the real estate. Then lease the property to your medical practice through a formal agreement. And it's important to keep this paperwork very formal so that if it does come under question, it does look very legitimate. You are running these things as 2 separate businesses and entities. Now, I've seen medical professionals fall into the trap of mixing these two, and it's like putting your eggs in one basket. A lawsuit against your practice could threaten your real estate too. So this is the whole idea of separating them. By doing this, you protect the property if something goes wrong with your practice and vice versa. So side note, from a tax perspective, I've seen some medical professionals, folks in our investment group, use this as a tax strategy to help qualify themselves as a real estate professional status. Now, we have some other videos on this topic, which you can also access at our website at thewealthelevator.com/tax, where people are using this real estate professional status, or REPS for short, to offset ordinary income. Part of this, and we're not going to get into the details, they're now using this property management that they created through this entity that owns the real estate for their practice and allocating hours on their behalf. So maybe they might have their spouse operate this property management, take the rent checks from the medical business, and use that to qualify them to get great tax savings on the personal side. But moving on, so step 3, establish a holding company. Now, this is a little bit different than your individual LLC on your business. When you start to accumulate wealth outside your practice, say in stocks, bonds, or real estate syndications, it's all about setting up primary holding company. So this holding company can be your safer investments, such as stocks, LP holdings, and syndications. Even raw land is pretty safe. Riskier assets like operational businesses, your medical practice, and even rental properties, especially those with tenants, remain well within other individual LLCs. If you think about it in a diagram form, at the top you have the parent holding company, and like I said, it may directly own these safer assets that you don't really have much legal liability or risk, but it has a dotted line owning other businesses that are a little bit more risky, such as your medical practice, as I mentioned earlier. Now, it's important to categorize these assets into risky and safe buckets. Again, risky assets are those such as real estate with tenants, businesses
businesses or vehicles. This is exactly why we like the LP holding in syndications. This is part of my journey. I had 11 rental properties, and then I started to meet a lot of these accredited investors, started to learn a lot of these tactics that I talk about on this channel. I realized that when you get above $1 million, $2 million, you start to really worry about getting sued. Frivolous lawsuits. It's crazy what people do these days. Like I said, I just did things haphazardly prior to this because I didn't know any better and my net worth was rather low back then. But as it started to grow and I met other high net worth accredited investors, I quickly caught on to the fact that I needed to get rid of my little rental properties, for example, or maybe you might want to get your business, your operational medical business, into a holding system where you're able to separate it from your more safe assets. And also, by the way, some people own vehicles within LLCs, and this would probably be more of a riskier asset as it does run around out there and potentially hit somebody and cause you a lot of liability that way. So to recap, you've got safe assets such as syndication, LP holdings. You've got more dangerous, risky assets such as operational businesses, rental properties where you're direct in line to get sued for a slip, trip, and fall, which happens a lot out there. You want to house these in LLCs separately. On top of that, have that holding company on top to play the management as just another layer there. Now, step 4, respecting your entity organization structure. As we mentioned and set up this idea of you have this hold co up top, and then you have an LLC down here that might own your risky assets and another LLC that might own some of your safe assets, thus separating the two from each other or separating the safe assets from the risky assets. You've got this nice little org structure, and it can get rather complicated as you build upon step 4 and beyond. Part of this, where most people go wrong, is that they don't really uphold their organization structure, meaning that they might slip in terms of corporate filings, taxes, bank account commingling, and other items where you are treating each entity or business separately. Somebody is able to pierce the corporate veil. So this all this hard work and cost that you did to set up this cool entity structure goes up in smoke, and then obviously increases your settlement amount if you were ever to get sued. Also, as a side note, one best practice is whenever you sign on behalf of your entities, your businesses, or your properties, make sure you always sign as a manager of that particular entity as opposed to your personal name. Again, upholding your separation of personal versus company is kind of the whole idea. This may seem like a lot of headache. You want to try your best to do this. Another good benefit of this is we talk a lot about passing on the legacy. You're setting up the org chart for passing on these assets to the next generation. These things are somewhat scalable, and you could put many assets into that one leg of the org chart that we're talking about and give this to your kids, right? I think this is a great discussion, talking to the next generation, showing them the org chart, saying, hey, Simba, this is what you own out there, right? These are the conversations that we have within our family office, Ohana Mastermind, of accredited investors, and why our events are so rich on people that have good values and big on passing down the generation wealth to the kids the right way. But on to step 5, asset protection trust. Now, once you've hit that net worth threshold of at least $1 million, couple $1 million, you might want to set up a domestic asset protection trust, or DAP for short. Think of this as more of that next level of LLC that you're going to set up that can offer even more protection. You can also take it a step further and turn these trusts structured in jurisdictions that specialize in asset protection. Some places like Wyoming, Nevada, for example, might have better asset protection laws. And this is when I think you really need to bring on that individual estate planning attorney. You can also now get a little bit more exotic and maybe go international. A very common place that people will set up these trusts is the Cook Islands. Obviously, they're a bit costly, and when your net worth gets to be a sizable amount, probably should be thinking about setting one of these things up. I've seen people get charged $20,000, $50,000 for something like this. If you're under $1 million, you're probably thinking that's crazy. If you think that's crazy, you probably don't have enough money to protect at that point, which is why, again, once your net worth goes over several $1 million, these are the types of things to really start to think about. This is something within our community, a lot of our investors start to get more involved in. It's obviously a lot of costs and a lot of headache too. And it's confusing, but this is the protection that really gets you that next level and makes a potential litigator or creditor be like, wow, maybe I don't want to mess with this guy, right? And let me just settle for pennies on the dollar. So let's just say your entities are all set up and you've got everything in line, and maybe you still lose a lawsuit. An international DAP puts your assets out of reach for a long, expensive legal fight. They may get it at the very end, but like I said, it's going to be a real pain in the butt for them to get the money, thus lowering the settlement amount. And also, they may have to get a lawyer who is licensed in a foreign country to go out there and fight you, which obviously increases the headache. So this is the umbrella shield. And going back to the analogy about protecting the castle, you've got the moat, you've got the walls, you've got some archers there. You probably think that this is already a lot of overkill. But if you have enough wealth to protect, heck, build another set of walls, another drawbridge for all we care. And this is essentially what's going on here as we start to add on these layers. We've got a couple more steps here, but this is the idea. Obviously, they cost more as we go along. What we're trying to do is make ourselves, again, a bad target, and at least at this point, really scaring away a lot of those frivolous lawsuits. Now, getting into step 6 is don't skip on insurance. I probably should have mentioned this as step 0 or step 1, but you probably would have skipped this video because that's boring. I'm just inserting it here because now I think you're drawn in, and this doesn't replace good old-fashioned insurance on your rental properties, your car insurance. What I'm talking about is umbrella insurance. Most people over $1 million definitely need at least $1 million of umbrella insurance. Tack on there your malpractice insurance if you're a medical practitioner. Also, any other specific insurance that you need for your line of business. You want to use the insurance to cover the bulk of any lawsuit, while the LLCs, trusts, and all these other things protect the rest of your wealth. Again, I moved the steps around for a reason, but make sure you do this step first. A few $100s a year, $400 to $500 per year should buy you a pretty good 7-figure amount of umbrella insurance. It's not that expensive. Just go and buy it. Just a peace of mind. And that can also be good momentum for you to make these steps. One mistake I see a lot of investors working with us, they get a little bit of sticker shock with some of these costs and they don't know what to do. And unfortunately, they don't do anything and then they get hit by a lawsuit tomorrow. And that's what we don't want to happen. Start making these conscious efforts, get the umbrella insurance and start moving up. Here we get to step 7. Regularly review and adjust. Asset protection is not a one and done thing. Wealth will grow over time and asset protection strategies evolve too, right? There's always new case law coming out. There's always cool marketed terms out there. So be wary of that. A lot of legal promoters who aren't really attorneys selling these types of products. Other words that we hear is like dynasty trusts, have your cake and eat it too trusts. A lot of these things are the same for irrevocable trusts out there, but have become sort of intellectual property or IP.
They're the same picture.
No different than a software package. A lot of these things are sold in this nature from legal promoters. That makes things confusing for people, and people often end up paying up a lot of money for these kind of marketed type of financial products. So just be aware of that. That's why we say get more involved in a community like ours so you can get around the people who set these things up for themselves so you can get the lay of the land from your peers. Obviously, you want to combo this with a good estate trust attorney, which I always say best one to get is through referral. Now, if you guys are ever looking for referral, please let us know, as we are not giving any tax legal advice. I'm not an estate attorney. I'm not a CPA. We have folks that people in our community have worked with in the past and had good success. If you guys need that, please reach out. But just to close out, asset protection is building a fortress around your wealth. Some people call this protecting your castle. As we said, keep building layer after layer. And if your net worth is still building, it may not be for you. In my book, I talk about the different floors of the wealth elevator. And in there is some guidance in terms of what you should be doing in particular for each floor of the wealth elevator and how do you apply these 7 steps. One last word of caution. These strategies can be construed as cheating the system, right? The purpose what I do is to help people who worked hard for their money. It makes me sick when people get sued frivolously for something that they didn't deserve. I definitely don't condone people doing things just to hide money, especially if there's criminal activity involved. And remember, anything that is a non-justified business move for the purpose of asset protection, especially done after the fact, after a lawsuit has been created, will be seen as a fraudulent conveyance. So that's a big F word right there. That will pretty much make everything you do null and void, as well as disadvantage you greatly in the eyes of the court system, as everybody knows what kind of games you're playing. The important thing is to set it up now before anything happens. Join our community at thewealthelevator.com, and if you need a referral to a good CPA or lawyer to help you out with these types of things, please reach out, team at thewealthelevator.com, and we'll see you guys next time. Module 8, mistakes I see people make. A lot of these are just mistakes I made myself. I try to speak from experience. You don't want to come across as giving people advice. None of this is financial, legal, tax advice. They're just merely things that I've learned through my own personal experiences interacting with high net worth individuals out there. First, this in the early days and then more recently, first property was the wrong property in a primary market. As you guys know, primary, secondary, and tertiary markets. Primary markets are like your Seattle, your New York, your Boston. Great places to live, great for appreciation, but too expensive. Today, we focus more on secondary and tertiary markets like Huntsville or Savannah, Georgia. Secondary markets are more like your Dallas, your Phoenix, places like that. Today, we focus on more workforce housing. My first property in Seattle was an A-class rental. Classes of properties are mostly dictated by the vintage or when the property was built. 2000 or later is considered A-class. 1970s to 1990s is what B-class, and anything less is considered C-class. When I first started, again, bought that A-class, again, very similar to buying in primary markets. You're just not going to get the price dynamics where you are, the price per unit to be able to cash flow. And you're just competing with residential home buyers, people on that luxury side. And this is why we focus on workforce housing, Class B and C properties. There's a temporary dynamic where a lot of new supply is hitting the market, which should subside in the next 2 to 3 years. Not a lot of people started to build once interest rates started to go up in 2022 going into 2023. So you extrapolate off 2 years from there. So that is when a lot of people stop building. Even ourselves, we develop multifamily apartments and we put a lot of projects on hold. We didn't stick a shovel in the ground because the cost to get construction loans in this high interest rate environment are getting into the double digits, 10, 12%. Long term, workforce housing, BNC properties, I think we can all agree that this is where it's at with the dynamic of the workforce housing population, the lower middle class growing with immigration. Population in America is generally growing. The bifurcation of the rich and poor, the rich are getting richer, but the middle class is shrinking to the lower middle class, thus needing to get into an apartment as opposed to buying that single family home that once in the golden era people aspire to. A general movement towards newer assets. People are willing to take a little bit smaller footprints for newer fixtures, kitchens, things like that. All of things of which can be easily renovated in an apartment. You put a little lipstick on the pig in some of our value add projects, and that's a product that people want more and more these days, especially within their more value and price points. So today we're focusing on more B plus, A minus assets, but long term, the workforce dynamic, the B and C property should come back. We like to invest off the macro trends that don't change every 5 to 10 years, such as workforce housing. People always need a place to live. Every 2 to 3 years, supply demand dynamics may change slightly. For example, people talk a lot about investing in this state or that state. The Sunbelt states from a high level are great, but I'm not co-signing that statement quite yet. What I want to be doing is going into specifically like what submarket in a market like Phoenix, for example. Phoenix might have 15 to 20 different submarkets or neighborhoods in that geographic area. Not all of those submarkets are emerging and growing. Some are decaying. But overall, sure, a Phoenix, Arizona, or Arizona is a great place to invest. You got to dig deeper into the submarket. Some of these statements here are a little bit contradictory. We still do the multifamily value add where we have to deal with tenants, even though I'm saying when the one common trend is we're trying to get away from lower end tenants. When we first started, we would do a lot of Class C, low end Class B assets, and it's just difficult working with that clientele because they just don't pay.
It's not common to have your delinquency in the 20% range, meaning only 4 out of 5 people pay on time, if at any. Part of the trend recently to get to a little bit nicer assets, a little bit better clientele. And that's in our multifamily value add space. We also do development. And with development, there are no tenants. Most of the project is just building it. When you finally build it, you're leasing it up with more Class A tenants who tend to not have trash the property on their way out and huge delinquency, such as the low end properties. We're trying to get more on the private equity side buying businesses. Obviously, no tenants on that side there. Perhaps you change that out for clients and people using professional services or brick and mortar private businesses that will go in and do an M&A on private equity. But that's expected for any business. The biggest thing from a high level, what I never liked when I was a single family home owner was just being exposed to a tenant living in your property and then something goes wrong in their life. They go a little crazy and they just totally trash your property. I've had to evict about a dozen people when I owned single family homes pre 2015, 2016. 1/3 of those times, the tenant just trashed the property and I was left with a $10,000 to $20,000 repair bill. This is why a lot of these things I talk about have been my experiences, but also the experiences of other people I've met. Single family homes, as we discussed in a previous module, just are as not the way to build sustainable wealth in the future unless you're looking for a day job to manage 30, 40 of these little rental properties. And that's why the movement more private placements and syndication is more of the way of the future for most people out there, growing at least to $1 million or greater. I'm bringing this chart out. People are always asking, all right, this information is great. We're already to the 8th hour of this masterclass. What do I do? I've always been hesitant to give specific advice. I'm not here to give tax or legal services. I'm not a certified financial planner. I'm not telling people how to differentiate their asset allocation mix. I'm merely here to explain how I did it and maybe give some ideas from the other side of the railroad tracks, if you will, the alternative investor side. I came from the traditional investment world, investing in the 401k, where you have X amount of large cap stocks, your S&P 500, if you're a little risky, you got some international mutual funds or funds. If you even are like that, maybe you're just somebody who just has the target date funds of retirement. When you get off into this alternative investment world, you've thrown asset allocation out a window and you're picking individual deals to invest in. At one time, I attempted to allocate $500,000 out of your portfolio, which could mean coming from a guy who has $1 million net worth, which would be half of their portfolio, or could be a guy who has $5 million net worth and is just merely trying to invest 10% of their portfolio. This would be the way that I did it initially. On the bottom, you see turnkey rentals at $25,000 a piece as down payments on $100,000 properties. The syndications get you the leverage on your own, obviously, because the general partners keep principal, son, and debt on your behalf, which is nice, right? You're not the loan guarantor on those projects. I started with a bunch of things that made much more sense to me, that I seemed to be a little bit more sensible. Multifamily, Class B and C, workforce housing. What more simple can you get? And I would urge people to start there because you've likely lived in an apartment or rented houses out in the past. So it's a business that is tangible. I actually do think it's a lot easier than, say, a assisted living syndication or a hotel syndication. Unless you've worked in the hotel industry, you likely don't have the personal experience than you would of living in an apartment. There are other investments on here. That's just how I learned. I invest in things. I didn't know anything about mobile home parks at one time, and then I started to invest in it and pay attention to it. This is maybe similar to crypto. I don't invest in crypto. I think the blockchain phenomenon is a great idea of decentralizing everything, but I focus more on real estate and this types of alternative investing. I did throw maybe 5, 10 grand into that world because if I don't have money in the game, I don't start to learn.
This is what we also explain to other investors. I think one of the big things is to get around other purely passive credit investors. There's no other group as community based than ours. We have an annual retreat every year. Typically in Hawaii, where I live, people come down, break bread with each other. We have table topics. We have lightning rounds of structured networking. We do some sightseeing together. It's all structured in a way where people build relationships with each other, which for me, getting started in this world, the absolute critical part. You want to know more people who are passively investing along on with you than you want to know operators. Some people have lists of operators that may invest with. It's the opposite way around. You want to start with the passive investors. I think this is a little bit more of an alternative mindset, more of a long journey to get to where you want to be. Trust me, in the future, a lot of you are already a million, few $1 million net worth. It's not going to take you very much to get to the other side of what I call end game, $4 to $5 million net worth, where financially you're set. And by joining a group like ours, you set yourself up to interacting with people who are like this. We try and filter in the right people and keep the right people around that have the mindset of people first. Relationships are the currency of the wealthy. Part of this is to grow the knowledge bank. Unless you start to build your portfolio on your own, like we've shown here, I still think our folks are really cool, and I coach and I set the tone where everybody's giving back to each other in a mastermind format. I think if people are just starting to interact and meet people face to face in this world, if you haven't invested in a handful of deals quite yet, is somebody really going to interact and really want to invest a long term relationship with you? I don't know. I hopefully I'm wrong here, but nothing is better when a guy is in a couple of deals talking to somebody who's in like maybe 6 deals. They're both on that same stage of growing their portfolios to dozens and dozens of these assets. And nobody's going to come out and say, hey, what's your net worth out? Right. And even if you were to say, this guy's $2 million, this guy's $6 million, it doesn't really matter at that scale. It just matters like what's your experience investing in these types of projects, how many deals you're in. That's why we say maybe get into some deals first, get some street credibility, and then you really start to interact with other purely passive investors from there. Start meeting folks, come out to our events first, and maybe that's a way you can get going and get more confidence investing in this world more and more. The next mistake I've seen, and I did this when I first started, say 2009. I was on this linear path to go and buy a home. And why? I don't know. I just follow what my parents told me and what society told me. Go to school, study hard, become an engineer, invest in the 401k, and buy a house to live in. What we'll say about buying the house to live in is it's the right path for most people. But if you're listening to this masterclass, you are not normal. Your net worth is likely a lot more than the average person. You make a lot more in salary, well over 56 figures a year. So you're not normal. A lot of you folks are really good with money. Like myself, you're good budgeters, you're good savers, you're good investors. You may not put in alternative investments yet, but for those, let's call it the non Susie Orman, Dave Ramsey followers, right? A lot of those folks are what we call in the basement level of the wealth elevator. If you guys have read my book, we briefly talk about the basement level of people under $50,000, $100,000 income a year, and not yet to $250,000 net worth. Those people need to buy a house to live in for it to become a forced piggy bank. Because if they're not paying their mortgage every month, they will take that money and spend it on frivolous things. If that doesn't apply to you, you see where I'm going with this, right? For people putting money into a house as a down payment, it's some of the laziest equity in terms of where you can be putting your money. If your net worth is not yet $3, $4, $5 million, you need to grow your money at a rate higher than what your house grows. You don't get any extra depreciation. You get depreciation off the interest. Whoop-de-doo. That's nothing. Don't get fooled into that whole lie by mortgage brokers. But it's pretty insignificant when you compare it with getting depreciation by investing in real estate. The cost segregation's getting even more out with the bonus depreciation to play some of the games, but the taxes that we've talked about in a previous masterclass here. General rule, and I think for most of our investors who come to the masterclass here in their 40s and 50s, you've already bought your house, and that's totally cool. Some of you have kids in their 20s and 30s. One of the rules of thumb I'll say is don't buy your home until your net worth is at least 2 to 3 times that of your home, even when using financing. A lot of us live in high price areas, California, Hawaii, even places in Texas are getting up there. If you're thinking Texas is $500,000 home, multiply it by 2 to 3, and you shouldn't be buying that home until you are net worth 1 million to 1.5 million. Or if you live in California with that starter home of $1 million, until your net worth is $2 to 3 million. Now you're probably thinking that's absurd. Where do I live? You'll rent. I still like to rent. The way I figure is a house in Hawaii would probably be about $1 million to $2 million and a down payment on that, because you max out on these jumbo loans at a certain point. I'm going to need to bring $500,000, maybe even $1 million down payment to the table that I could be putting into syndication deals and other investments. A lot of us live on the other side of the paradigm, right? These jumbo loans max out at a certain point. So we're going to have to bring so much money to the table. And that even makes this argument even stronger, putting it into other investments. Because at the end of the day is you got to look at every single dollar you have and what is your return on equity. Part of this, I get it. It's tough. Not everybody can have an amazing spouse like mine's. And I say that because hopefully she's listening, which she doesn't listen to any of these things I do like this. She's not super interested in this stuff. But at least I thank the universe that she is understanding enough to understand this little module right here, that in the long run, renting will be advantageous for us because I can take that money and invest it at some inflection point. For most people, when they get past $3-4 million, they can start to do things that aren't the most money smart things to do and buy a house to live in. But that's with you and you guys' marriages, and you guys need to figure that out. Of course, come to a retreat one year and talk to people in the same world, in the same space, and you can get more personal and help people deal with many problems. These are problems to have, I think. It ultimately comes down to this concept of return on equity, which also applies to buying a house to live in and buying a rental property. Keep in mind, buying a house to live in, your home, when you think of this concept, but also keep in mind of a lot of us might have already bought rental properties. And this is the number one mistake that most amateur landlords make. They buy a property, pay down the mortgage, and then try to pay it off over time. Now, it's not specifically that strategy is wrong, but it's more of the timing of it in terms of where is your personal net worth in the grand scheme of things. On the left side, you have return on equity. Return on equity is different than return on investment. Return on investment is the metrics that are put into place or you calculate on the entry point of your investment. And just simply put, it's how much money you make divided by your initial investment. When you're first going into an investment, your return on investment and your return on equity should be pretty much the same because time has not come by and your equity has not changed. But over time, as the property appreciates, as inflation has happened, as your tenants are paying down your mortgage, all these are good things and naturally happen over time, but your amount of deployable equity starts to go up. So that means if you're following along in terms of math, the numerator, how much money you're making from your investment, is generally staying the same. It might go up with inflation, but on your denominator is getting bigger and bigger, which is creating this percent return on equity dynamic to go down over the years. Investments are all different, but generally they follow the same curve where at some point you're dipping into single digits. So a classic example of this, and I don't want to offend anybody if this is you, I just want to make you aware of the facts so you can make changes. I mean, I live here in Hawaii. There's a lot of amateur landlords that own $1 million homes that have paid them off over time. $1 million home out here in Hawaii will typically rent for $3,000, maybe $4,000 a month. But let's just say it's $4,000 to give them the benefit of the doubt. But at least 1/4 of that
will go too expensive. Some would argue 50%, but let's just be conservative here and put it into the landlord's favor. So that $4,000 rent equates to $3,000 of profit at the end of the day. They don't have any debt service, so that's $3,000 is basically their profit. So $3,000 times 12 is $36,000 a year is their income. Now divide that by the denominator on the return on equity, which is $1 million, comes out to 3.6%. That's pathetic. That is a pathetic investment. Let's be honest. I'd rather have my money in T-bills for the amount of legal liability, things breaking, and headache in owning a rental property. Now, sure, when they initially loaded into that investment, the return on initial investment on that house, because they probably took out a loan and the property was a lot cheaper in price. Probably when they bought the property 30, 40 years ago, the price of the property was less than half. Let's just call it $400,000. I don't know what it is, but I'm just taking a guess. Might be even less. $400,000 house, then maybe they put down $100,000 back then. That's a lot of money back then for a down payment. They probably bought it for a lot less, put a lot down. The $100,000 was their initial investment. So at that time, they probably rented it for maybe $2,000 a month, and they made 20 grand a year. So that's on the numerator, and on the denominator, you had that bigger number because the initial investment was so low. They made 20 grand divided by $100,000 was their down payment. So that's 20% right there. Again, probably a lot more, right? And that's how these deals typically start. They start pretty high, but over time, as the property appreciates and the deployable equity increases, this number of return on equity, deployable equity, which is really how you measure an investment over time. So what do you do with this information? At some point, you leverage or sell the asset and you go into more and more deals. And you keep doing this. And this is how you grow your net worth over time. And that's the tricky part. When do you do it? You certainly do it before you're getting a 3.6% return on equity. It depends on where you are at as an investor. And where you are an investor is all what your network is. And that's why people join our community to get access to better deal flow. Retail investors, normal people struggle to find anything that beats the 10% threshold. In our world, people typically find things between the 10 to 20% range. For professional investors or family office investors, they're able to find amazing deals. But unless your net worth is $50 million, $100 million or greater, and you're incredibly networked and connected, you're not going to access that threshold. But that's why people join our group, so they can build their network over time, potentially getting there in a couple of generations. This is not a get rich quick scheme. This is a slowly grow your portfolio, but also grow your social capital, getting your kids involved into a group like ours. I'm big on people bringing their kids or the son-in-law to our events so they can start to intermingle with some of our younger folks in their 30s and 40s, growing those relationships and see where that goes into the future. Not necessarily to do deals with each other, because we're not that type of group. We're all just passive investors here. But the family values grow within the generation too. Ideally, my vision is when I'm not here on the earth, the group continues to evolve in that fashion. For those of you who are engineers, we have a lot of engineers in the group or had to go through physics class. You're probably seeing the concept of it's area under the curve, right? In the default normal mistake path, the area under the curve is not very much. If you're able to prune the portfolio and re-leverage into new deals by either selling, refinancing, buying more assets, you're able to increase this area on the curve temporarily. And then you just have to keep playing this game. When does this game end? This is obviously just looking at one investment of dozens and dozens of deals you probably should be getting into. It's a game of doing this just enough to get to your personal end game. And this is why it's important to interact with other investors, because a lot of people in our community try and shoot for about $4 to $5 million net worth as a baseline of, all right, when I get to that level or a certain age, I could sunset on my investing. At that point, you could theoretically just pay down your properties or not invest anymore, and you're good. My goal for everybody is to get to that point as quickly and as safely as possible so that you can live the life of financial freedom as long as you can. It's going to require you to get off the beaten path, which is why we try to provide people with the community and network to get there together. At the end of the day, we're only given so much time. And that's why there's urgency to get to that path sooner than later. One of the rules that I follow today personally is I only take financial advice from people who are financially free themselves. When I started to interact in a lot of these accredited investor circles, I was surrounded by people 20, 30 years older than myself. Strategically, that was exactly who I was trying to seek out. I was in my late 20s, early 30s when I was in this world as a pupil. I think people like me and they like somebody who's involved in the world. I had 11 rentals by 2000. I think I was about 30 years old at that point. And people like to help me, which goes into relationship building. People like people they like and they want to help them. Part of it too is strategically on my side. I wanted to get around people who are my pedigree. If I kept on investing the way I did and became 40, 50 years old, I wanted to find those people. Right? I wanted to learn their mistakes, their best practices. I wasn't going to go seek the advice of a trust fund kid who just was born with $20 million dollars and now had 10. Like that joke people say that I don't think is a very good joke. If you want to make a lot of money, start with a lot of money. That's why not a lot of people in our community are trust fund kids or go to the country club. That's just not our pedigree. I certainly wanted to find people who are further along on my trajectory. So I tried to find engineers, doctors who were in their 50s that had $4 or $5 million net worth at least and pick their brain. That was actually where I found not only the investing thing, but the accredited investor banking, the infinite banking, enhanced mode, and a lot of these tax strategies that they themselves were utilizing. Certainly not your normal financial planners and real estate agents. Real estate agents, they're just salesmen. Most real estate agents play in the residential world, which is very different than the commercial world that we like to invest in because they're more institutional investments and a lot less competitive, right? People buying little single family homes is everybody out there in the world. It's like amateur hour. Or the commercial world, you have a lot less competition. Mortgage brokers are salesmen to get you a loan from the big banks or lending agencies out there. They're not investors. I think this stems from CPAs, right? Why would you want to take advice from a bean counter who hasn't figured out these tactics or started to invest in real estate themselves to getting them on the fast path out of working a day job? A lot of these CPAs are very much rule followers. They may have some understanding of how the tax code works, but maybe not the best practices that the wealthy have. Not to knock CPAs too much, but I think there's a minority of CPAs out there that get this type of stuff. Some people will say, I want a CPA that has a lot of gray hairs, a lot of experience. In reality, that's like the worst people to go to because they're stuck in their ways. And more importantly, their client list is very mature. They don't need to do things the hard way, right? They want to do things the easy way. I've always tried to find CPAs who are on the younger side that are willing to try different things. This is actually how I do it with my attorneys, right? People who are on the cutting edge, really into research and doing things, finding that next best practice because the world changes so much. Land conservation easements, oil and gas deals. Some of these things move so quickly that most CPAs or attorneys they're just not able to keep up with it, especially if they have a thriving practice. I don't want to overspeak my bounds, but doctors potentially the same thing. Sure, you become more experienced over time, but you're not expected to read every single new medical journal and article that comes out if you have a thriving practice. At the end of the day, like, why take advice from somebody who still has a day job that wasn't able to figure this out? I think what's cool about this world is if you implement alternative investing, obviously at your dosage level that's appropriate for you, these tax strategies, that's why the alternative investments are so cool because they unlock these passive losses for you to play these alternative investment strategies.
some of the past clients we've seen come through the family office group, they're able to cut their tax bill by at least 20%. And then the infinite banking too. When they combine these three strategies, which I call the trifecta, you're able to get to the financial goals that you want to get to $4 or $5 million net worth in about a third of the time, where it may not take a decade to get to where you want to be if you start today. Whereas most people, it takes them 30, 40 years if they even get there, if they even have the income to do that. And certainly don't listen to the people in the cubicle lab. This is probably the big reason why I finally quit my day job, because I just couldn't stand the silly financial advice like the old heads would give to me. Like, why would I want to listen to an engineer who's been at that job for 60 years, who wasn't able to get himself out financially? I mean, at the end of the day, net worth don't lie. Net worth is your assets minus your liabilities. I don't want to come across as rude, but numbers don't lie. How much money you have, assuming you create it yourself, speaks to the level of sophistication you may have. Essentially, that's the score of the game. Another mistake that I made early on, right out of college, and I lost a lot of money doing this. Thankfully, it was in the early part of my career and set me on this trajectory of investing in hard assets where you have the influence to value add the asset. But I did a lot of swing trading. I was in my early 20s. I caught on to watching Fast Money on CNBC, the Jim Cramer shows. It appealed to me because there was a lot of numbers, fast, and it was sexy. And maybe I aspired to everybody was dressed up in suits, a lot more white collar than I think a lot of the investments that we look at today, which are a lot more blue collar. Who's buying a 200 unit apartment complex in Texas or more rural part of the nation, right? It's not super sexy, but this stuff appealed to me at the time. And this is right around the 2008, 2009 downfall, which was horrible for me from a money standpoint. Successful people say failure is typically where people rise from the ashes to make changes and eventually move into the right path. From an asset class standpoint, stocks are very volatile. The good thing about them is they're liquid, where you can trade in and out of them. Real estate, once you're in, you're stuck. If you're somebody who makes a gazillion fantasy football trades every week, or more on the emotional side where you buy, sell, this, I guess, disadvantage of real estate can probably be good for you. You stay the course. But I personally don't have any stock market assets. I probably should. I'm more involved on the operator side of the real estate portfolio and acquisitions. Maybe I'm not a good person to personally follow, right? I'm just sharing my story. I'm not giving any advice here. I'm just not a fan of the stocks world. The biggest reason I just can never really get on board the way I saw it, it's not the price of the stock is not really dictated by the performance of the company. It is in a way, but there's a big thing in there called the expectations of Wall Street. It's funneled through the expectations of Wall Street. So you can do really good on your financials, but if the expectations of Wall Street was higher, the stock price goes down. Or if somebody says something stupid from the C-level suite or something controversial happens, the stock goes down. From those two things, I was like, I don't have control over that, but I can't really predict those two things. I can't predict what the expectations of Wall Streets are, and I don't know what it is. The Wall Street doesn't even know what it is. Real estate or buying businesses, we have direct control over renovating a unit and then the tenant paying $100, $200 more in rent. That goes directly to the bottom line. That increases our net operating income, which increases the value of our building. We talked about that previously in a previous masterclass where we went through some situations where, say we have 20 parking spaces at $100 that we're now charging, we increase the income, how that increases the bottom line of the asset. There's direct impact into the force appreciation, the force appreciating that asset, increasing the value where we take fate in our own hands, as opposed to the stock market where you don't have control. And then don't get me started with the mutual funds and the REIT world where you have so many layers of fees. That's why we like to invest directly in private placements and syndications with the sponsor or be the operator ourselves, where we cut out all those middlemen and financial planners, etc. And then you get caught up in a lot of these emotional fallacies, like the sunk cost fallacy is an example. People going to a movie. Movies are pretty expensive these days. You sit through a little bit of it and it's not a very good movie, but people would rather just stick it out. With real estate, you're stuck in it to the end with the lack of liquidity, but with stocks, you got the ability to leave. But what if the movie turns around, or like a basketball game? I don't know if you guys remember when Tracy McGrady, when he was on the Rockets, scored like 23 points in 37 seconds. I will admit, I was watching that game and I went and took a shower because I wanted to get ready to go out with my friends that night. I missed one of the most iconic moments in NBA history where he did that. A little sad of that. Still think about that today, but I would have missed out on a great experience. Or in the investing world, you miss out on returns. So what typically happens, people will follow the herd and do exactly what everybody else does. And when you do this, you typically get slaughtered like everybody else, and you emotionally get out when you probably should stay the course and things go back up. But you're in it when things are riding the high and the frothiness of the market, and you buy at the peaks. Now, I'll just go over the advantages of real estate. I think there's a big difference between me. I used to buy a single family home turnkey rental or buying a house to live in. That's not the real estate we're talking about here. That's buy, hope, and pray strategy. What I'm talking about is value adding the asset. If you're investing in a development, you're not going to have the cash flow in the investment. You got to wait to the end. When you're talking value add deals, at least how we try to do it, when we're trying to pick up stabilized properties, you've got the cash flow yield there, you got the equity build up, and you've also got the forced appreciation value add there, which you can't do that with bonds. Cash savings don't have that. Publicly traded stocks, in theory, the CEOs, they're getting paid handsomely for this, but they're trying to increase the value of the businesses, right? Doing things every day that make it better, more profitable. From a real estate point of view, it's the only hard asset. Everything else is a soft asset. Now, when we get more into the private equity mergers and acquisitions mode, we may be picking up, say, engineering firms as an example. That is a soft asset. There's hard assets in that, such as the furniture, stuff like that. But it really is a soft asset in terms of the Rolodex, the intellectual property. But that's why people like real estate. And from that comes the tax advantages, right? You can depreciate those hard assets, such as the real estate, the equipment, where you can't really do that off of any other investments. Bonds has some tax advantages, but the returns from bonds is pretty much a fraction that of everything else. I just always want to point things from a transparent standpoint. I think that's why people like us. There's always like pros and cons. With real estate, you don't have the liquidity, right? You're not able to come in and out of deals. Once you're in, we're all stuck with each other. That's my young kid. She's 3. We get in a car and she always complains, I want out. I got to go to the bathroom. I'm like, you're making that up because we just took you. And second, we're stuck. You're not getting out until we get to where we're going. Like how it is with these real estate deals, right? That's why you diversify over time. The idea I picked up from other people is you try and space out your acquisitions when you go into deals. Maybe you put 100 grand every quarter. Ideally, they're all on different timelines. And normally these deals typically last a couple years to 5, 6 years. All things being equal, if you're going into deals routinely, at some point they should free up and create that liquidity flow for you. You can start to build a pipeline for yourself. All these have their pros and cons. I have made a living in one of them and it has worked for me. Different asset classes are somewhat counter-cyclical to each other. Where I'm trying to get to personally is there's a nice mix for everybody. I don't know what that mix is. And this is where you have to self-educate with smart individuals and find the best asset allocation mix for yourself. I think what we try to do here is focus on real estate and private equity because that is most what retail investors lack in comparison with more professional investors, family office investors. They will typically have a much higher concentration of those types of assets than your average investor out there. Now, continuing on the list of, mistakes that I've made, the 401ks, 403bs, TSBs, IRAs, or we'll refer to all these as qualified retirement plans or QRPs for short. what we're all taught is to put money into these 401ks so that we have it for later. I think, again, just like the Dave Ramsey stuff, where most people, this strategy really applies because most people don't have very much money and they need to save because they're bad savers. You listening may not fit in that category, right? Especially if your net worth is above $1 million and you're a good saver. There's a different set of strategies that apply when I'm saying to consider. The retirement funds, putting money into QRPs may or may not be for you for these variety of reasons, which these are very counterpoints to what we're all taught. So if you have to go back and rewind this section and then maybe come back and listen to it later on. But number one, you have a higher tax when you're increasing your income and you'll be in a higher tax bracket in the future. Here on the right side, I have the tax brackets in 2022. Generally, they go up and down with the pace of inflation, but they're generally the same graduated income based off your income system exists, where the more you make, the more you're going to get taxed on that graduated income step. The more you make, the higher the taxes you will pay, essentially. I think there's a misperception out there by people saying that when you're older, you'll make less money, you'll be in a lower tax bracket. That applies to most people, but not you. I think from all of us standpoint, what we're trying to do is grow our asset column so that asset column grows way more than what we're making at our day jobs or ordinary income to a point where well before we retire, the asset column is making so much in income that it's actually going to create more overall income for us than what we're making today. That's the whole freaking point of this. So we can create this perpetual income stream from not working and trading time for money. If you're into that and you think that you're going to get to a point that's going to happen, you actually will be in a higher tax bracket when you start to take money out of retirement funds. And you're probably thinking, man, was I duped into doing this? Which is actually like we find some of our older investors in their 60s who maxed out their 401ks and they have several $1 million in their 401k, but they are getting killed by taking that money out because their income is so high at that stage in life. And when I say it's high, it's relative to where they were in their working years. They might have been in these 20% ranges with lower income in their working years. And in their older years where they're taking money out, they're in these higher tax brackets. So if you're following along, what do you do about that? You try and leak money, these key monies out now while your income is lower. Now, number two, taxes will generally increase to pay for government entitlement programs. I think this is the general trend. I'm not going to go too far off the deep end here politically because we try to be a non-political organization. I specifically say, hey guys, when you come to the retreat, please don't talk about politics. That's the best way to eliminate new connections. To me, politics, it's going to be based off your fundamentals. That's not going to change. So why would we even talk about that? Let's talk about things that I think are up to debate that we are open-minded about. But even myself think that the world that we live in is becoming more of a socialist state, at least go to that trend. Some of you who live in the socialist state of California probably see where that is going. We'll probably all agree that taxes are generally increasing to pay for these government entitlement programs. So if you believe that, take money out of your QRPs now and pay it at a lower tax rate today. Now, obviously, we don't know this. I'm just bringing up these ideas for you to consider to make the right decision for you. Number three, a lot of these QRPs, there's some type of trigger where you exit at a certain age. But most of us, if you do play your cards, you're going to be wanting to retire, maybe access this money well before you get to old age. And they keep changing the old age because people tend to live more. But if you want access to this money before that age, get it out of there now and bite the bullet. Now, this is where it gets to be more of a personal type of situation. If you haven't booked your onboarding call with us, we can talk about your situation. If you're age 58, 62, we may say you maybe just stick it out a little bit longer. But if all your money is in these QRPs, then we got to get it going, right? So we may have to come up with a plan to leak it out. And then we start to look at where you're at in terms of the tax brackets based off of this chart. Obviously, these numbers tend to change over the years. If you're making $200,000 a year in terms of AGI, maybe you leak out $100,000 out of your QRP, pay taxes and penalties on it. So your AGI at least doesn't explode over this $340,000 mark, or this red line amount where the tax brackets go from 24 to 32%. This is a pretty big gap. That's why this guy right here is a little alarmed. Number 4, supposedly your money grows tax-free, but with real estate, it does not. So one of the big fallacies I think people will say, or at least my parents used on me, was put your money in your 401k so it grows tax-free. They are right. But if you're investing in real estate that gets you the tax benefits today through the losses, the depreciation, it's going tax-free anyway. So it's a wash. There are certain investments that you put into your qualified retirement plans. And what some people will do is they'll take the money from their 401ks or IRAs and they will move it over to a self-directed IRA or a solo 401k for their business owner. And so they can have the same advantages of these retirement plans, but be able to self-direct into things like real estate or private equity and or even stocks, bonds, mutual funds, right? That is an option too. And if you guys are looking for a referral to these types of people, you can submit to our team at thewealthelevator.com/vendor or email team@thewealthelevator.com. We can connect you with the folks we're working with at the moment. Vendors do change over time. Sometimes they get mature and they get to a point where they just don't do cutting edge stuff. Or we've had it in the past where a certain professional services firm that we've worked with sell their firm to private equity, and then the value goes down for customers or clients, and that's where we stop working with them. I think the big thing is if you're investing in real estate or other assets that give you these losses, you don't want to invest in them through a QRP. Because say you invested in a syndication private placement as an equity investor, you're going to get a K1 and some great losses with it, especially if it's in a real estate deal. At that point, you get the losses, but it doesn't flow to you personally because it's locked up in your qualified retirement plan money. This is one of the biggest things. We want the passive losses to flow to us personally so we can use it today to mitigate our taxes today, right? Because the idea of time value of money, if I can save 20% in my tax bill today, I can invest that into a deal and grow that over time. If I don't get the passive losses from a deal today because it's stuck in my retirement account, I am not able to take the advantages and have it compound over time. So 5 reasons to ponder. The big con that people always bring up is, what about the 10% penalty? It sounds really bad. The way I would look at it is if you have to pay a one-time penalty of 10%, but you recoup that, and if you're investing in things that get you a higher return, what's your crossover point? When you look at it, if you're going from a 5% investment to a 10% investment, you're going to recoup that in 2 years and it's all gravy. That's just one part of it, but also consider all the other intangibles and come up with the best decision. Now, for some extremely high income earners who make over $500,000 a year, it may make sense for them to utilize a qualified retirement plan, specifically a solo 401k or a self-directed IRA. I think that it comes down to the dosage amount and prioritizing using investments outside of these qualified retirement plans first. This comes down to your own personal situation. We're by no means giving anybody financial advice here. What I like to do is get on a personal call and we talk through these 5 points here and then have you have a working knowledge for you to make a best decision for yourself. But then at least send you off into a working direction. But this is what's cool about the community aspect is you go off and you find other people who are maybe in the same threshold as yourself and possibly people who've already done what you've done, taken out their entire retirement account and put it to a QRP or taking it to cash and invest cash and simplify their life. That's what I've done. I've personally got all my money out of the retirement accounts back in 2014, 2013. That was what I used to go buy all these rental properties that greatly impacted my life positively and allowed me to grow my net worth at that critical time. You'll meet people like that. Maybe they can provide counterpoints or ideas. And this is where you have to pull this together. This is your responsibility. We trying to educate you on the building blocks of this, at least kind of paint this more of a neutral point, right? Where as opposed to we're all just brainwashed. And I was there myself. Invest in the 401k, get the company match, but then max it out. Some people out there in the alternative investment universe have realized that they're putting their money in their IRAs or 401ks, their so-called tax deferred accounts, which we all know that it may not be the best way. And specifically, number 5 here, if you're investing in real estate, you're typically getting losses to offset your gains anyway. Essentially, you're going to have to pay taxes on this, right? Because all you're doing is deferring your taxes in these types of programs. But what the government is doing in a way is the government's in huge amount of debt, and it's essentially a blank check for them to harvest whatever you got in the future, right? Like right now, the tax brackets are as such, they could just jack it up in the future. Or for all we know, they could create some BS law where they go and target people's 401ks and just put some ridiculous surcharge tax on there. I'm not saying that's going to happen, but it could. They need money and may look for things like this. Some people are like, I'll be damned if I give the government a blank check to harvest whatever the revenue I have from my hard earned retirement plans. I'm going to get my money out now. But we don't know, right? This is the whole argument between, I'm sure a lot of you guys are familiar. Oh, should I put my money in a Roth IRA or should I put it in a regular IRA? Nobody knows. I would probably say diversification because you don't know. You put a little bit some and a little bit in the other might be the way to go to play that uncertainty. But there are risks in both paths. Nevertheless, hopefully what we've done here is we've dispelled the whole the 401k is where it's at and make people realize that it's not all it's made out to be. Like I said earlier, there is one exception to the rule where if you make a lot of money, $500,000 or more, and you are less than 55 years old, it may make sense. This is where it gets really personal. We're not going to get to that level here, but it's a rare occasion. The other exception would be qualified retirement accounts, self-directed IRAs, solo 401ks. They're good for non-tax advantage things or real estate because you get the losses from it. If you're investing in things outside of real estate, like private equity, maybe you join a project that buys plumbing companies or digital marketing agencies, great professional services businesses with no hard assets, give you no losses because there's no depreciation of a hard asset. This might be a good place to put those holdings in. We're getting a little bit more advanced here. Some people invest in life settlements. Another example of a non-hard asset that don't give you any losses, tend to put those types of things in these qualified retirement plan because you're not getting the losses from it. Therefore, one of the big advantages or disadvantages of it is negated. You're not getting the losses to flow to you. Since there is no losses, that negative kind of gets nullified in a way. I'm going to give you a framework to think about this. This is what I call the bucket theory, where the cash flow bucket today is that red bucket. And then number 2 is the orange bucket. Number 3 is that teal bucket. But this is my theory on the way to do things where you fill up the first bucket, your cash flow today bucket. For most of the people in our community, people are trying to shoot for $15,000 to $50,000 of passive cash flow a month to pay for their affluent lifestyles. Certainly when you get above $15,000 to $25,000 a month, that's a healthy zone for a family at that point. Obviously, when you age and your kids leave you, your needs become less. But hey, that's where you start to find more expensive wines and you go more extravagant vacations. You start to fly first class all the time. That's why we put a big range there. The idea is there's a big range for everybody here, but you want to try and fill your cash flow today bucket that you use up first. And one of the big ways of storing that liquidity is through an infinite banking or accredited investor banking plan. For more information about that in the e-course, go to thewealthelevator.com/bank. If you're new, we have a 2-hour-long webinar that should be a good quick primer for you on that whole strategy. But great way to sort of asset protect that chunk of money and have it grow. There are very few things that are risk-free in this world, but that's probably where you're going to get the best security in terms of a liquid holding. Keeping with the theme of mistakes, the mistake that we're all taught is to fill up your legacy bucket first. Invest in your 401k so you have the money later, which comes from a good place. but it's obviously opposite what I'm trying to teach people here, right? The problem is most people never get to fill up their today bucket because that they never get to fill up that completing the number two bucket. What I'm saying here is fill up the bucket sequentially. Number one, fill it up, then you start to fill up number two. I think people try and fill up one and two concurrently. And because they're never concentrated and they're investing in the wrong things and they're paying a lot of taxes, they just never are able to get very far. And by filling up bucket number two first, you don't get the passive losses to flow to you personally. So you get killed by taxes, which is also a big driver why you never fill up that bucket number one unless you make a phenomenal salary, own your own business, or extreme saver. At this point, once you have your lifestyle paid for with a safety factor, then you start to fill up self-directed IRAs, Roths, solo 401ks, defined benefit plans. That money is considered legacy, meaning you are not going to be using it personally. It's more for your kids or the legacy. The one exception, as I mentioned a couple slides ago, were extremely high income earners that are on the younger side. And then if you want to do a HSA in here, I think the HSA somewhat is exception to the rule, but I think if you're understanding the themes here, you're not filling this bucket up unless you've come to Hawaii with us and had the conversation. There's another legacy bucket beyond this for people who make boatloads of money. This is when you get to $5 million, $10 million net worth, where you start to put your money into maybe a nonprofit type of arrangement, other tax reasons and liability reasons for doing that. But this is just showing the sequential flow of how you fill up these buckets over time. Lessons I've learned along the way: normal people focus on debt and interest rate. I can tell who are some of the less sophisticated investors because the first thing they talk about is how low their interest rate is on their home. I've got like a 2.5% mortgage. Like, that's only one half of the equation. How much lazy debt equity do you have in there not doing anything is the bigger picture, the holistic picture. Then they focus on debt, right? Everybody focuses on the United States is trillions of dollars in debt. But what is the debt service of it? What's the debt service coverage ratio? And what is the percentage of general GDP on that, right? There's a bigger picture on it. Sophisticated investors focus on cash flow, which is the safety of their investment, or debt service coverage ratio on the particular investment, and the overall impact to their net worth. Again, going back to that mistake I see most landlords making where they have great cash flow on their investment of that $1 million paid off rental property, great cash flow, but their net worth isn't growing diddly squat. Sophisticated investors don't really pay off properties until they hit a certain inflection point. They know the best use for their money is to grow and grow more assets perpetually. And that's up to you guys, whether you want to get up to $5 million and then shut off the engines, or get to 10 million, or have your family start to grow a more formal family office, which is why they join our family office group to grow from there. Maybe they take less risk, but they're still in that growth mode. If you're not growing your net worth over time, you're going to lose it. The next generation messes it up for you. This is why they always say 90% of wealth leaves family in 2 to 3 generations. But it also applies to personal development. If you and your spouse aren't growing together, you're probably just separating apart at some point. If you're not moving forward, you're moving backwards, that whole premise. And the other thing is to focus on return on equity, monitoring that important metric, as we shown on the previous slide on that chart. Refinancing or selling to maximize the return on equity while optimizing the debt service coverage ratio and cash flow. If you want to maximize return on equity, you're going to be taking on more risk. But if you notice I use the word optimizing because it's different for where your risk tolerance is. And this is where it comes down to your net worth, right? Where you are at your journey. If you're younger, under $3-4 million net worth, you've probably got to take on more risks to get to where you need to be. Me personally, I've maybe gotten above that hurdle. I'm nowhere near where I want to be, but I may be more conservative on how I do things in the future. Of course, I think you never know what's happening on somebody's portfolio unless you know the big picture. I personally use the dumbbell theory, where if you think of a dumbbell, it's lopsided on both sides and there's really nothing in the middle. The average weight or the center of mass is in the middle, but you can't go by that. the dumbbell, meaning like I may have some more aggressive investments on the side, but it's counteracted with a lot more conservative investments on the complete opposite end of the spectrum, like life insurance, infinite banking, those types of strategies. I don't have stocks. I don't have traditional investments like that. I'll make alpha by going into private equity and real estate, but I'll have security and be able to sleep at night with my life insurance on the other side. If you go by the average center of gravity, I'm weighted in the middle. So that's from the outside. My situation is perplexing, but I have a method to my madness. And I think people somewhat, if they get into our group, at least they can speak the language as opposed to I just follow what Vanguard said to do for my age and just go with this cookie cutter asset allocation mix. There is no normal out there, is what I'm saying. The best way is to pull best practices. Hopefully you build some good relationships with cool people who are aligned on your trajectory and have a little fun along the way doing this. Possible funding sources for investing in new deals. When we do the in-person seminars or the retreats, we'll have we'll break people up and we'll actually help people like identify where their lazy equity is. But at the end of the day, it's up to you to decide where you're pulling funds from or not. Maybe you're exactly where you want to be. I always say, if you're not to $3, $4, $5 million yet, you're not there yet. You may be incredibly wealthy compared to your peer group, but there's always a next shelf. You always want to be content and happy with what you have and be appreciative. But the way I look at it is that you always have to be growing for the next step. I've been lucky enough with the podcast and the influence and brand that I've created in the community. It allows myself to interact with higher net worth people. We buy apartments from these types of people, these family offices, these incredibly wealthy people, 100, $200 million net worth above. And then so I hit these stratospheres and meet these people and I start to see what are the strategies that they're doing and what's on the next level. And this is what helped me create the Wealth Elevator book. And I'll continue to pull best practices forward. And when we do the retreats, what the plan is to tease out a specific strategy that somebody who has $25 million might employ. So not only is it fun to see those strategies, but you may not be ready for it. But where is the mindset? What is the strategy that you can emulate if you're $1.5 million net worth that this person is going to? Another example, I fell into this fallacy myself. When I was in my 20s and probably my 30s, I wanted to leave my day job. That was my number one goal. Part of that, I realized as an intermediate goal was I needed cash flow. So I started to invest in the turnkey rentals, the buy, hope, and pray strategy where there's no value add. You're just hoping that the value goes up, and that's not a good strategy. But I was rewarded by monthly cash flow. And what I realized, yeah, sure, that helped me quit my day job because that was the pain point at the moment. But that was a very nearsighted goal that I see a lot of new people coming into our community with. You may want cash flow today or on a monthly basis, quarterly basis, but that's not what wealthy people do. Certainly when you get above $5, $10 million, because you have other investments, you have a nest egg, you may even be working your day job or still working your business at that point. So you have cash flow to put food on the table. Those people are more situated with the viewpoint of picking investments that are better for the longer term, more safer, and not necessarily like they give up cash flow for better returns in the future or security. So that's a good example of if I didn't have the perspective of somebody who was on that next level beyond and the next level beyond, we would just be working on what is perspective of today. And the perspective today, whether you're still investing in traditional investments on that step number one, or you're already with rental properties going off into the future, without that perspective, you can't begin to make the steps in the right direction. And then we kind of work on this workshop planner in the workshops. Of course, so many different permutations and commutations. Another quick thing, 529 plans, definitely not what the accredited, sophisticated investor does. This is just no different than a 401k QRP plan out there. Just another example of what traditional cafeteria options people are stuck with. But this is just some of the mistakes or what normal people are talking out there. I think what we try to do is pave the quick path to where we want to be. It's not as simple as a band-aid. This is a holistic strategy. That's why we say join our community, get more involved. The strategies change, right? You need a dynamic type of plan moving forward. But with that, we are end of the module here. What we wanted to do with some of these maybe myths out there is neutralize it to a point where you can make the best decision for you. I think ultimately what it does come down is to community. Unless you have people in your five circle that are doing this type of stuff, thinking for themselves, it's very hard. In this online masterclass format, I've tried to make this the most scalable way possible for you to digest this information. And we'll see you guys in the next module.
Doing due diligence on deals.
It's a laundry list of due diligence items on syndications and private placements. This is, of course, not any tax legal advice here. But just a little bit context on myself. I own and lead a syndicating group, the Huido Pipeline Club. We have over 105 members in our paid mastermind group, well over 900 investors that have invested with us in the past. We've acquired $2.1 billion in real estate, which I think is an important number. That's probably tip number one right there. I would be wary of working with anybody under $1 billion of assets under ownership, especially under 500 million. And we've raised over $200 million of equity within our group, 10,000 rental units, 65 plus projects, and I guess more importantly, $45 million of distributions back to our passive investors. A little quick background on my story. I call this the linear path where we're all taught to go to school, study hard. Both my parents, doctorates and master's degree. And that was what I was blindly led to do. Maybe because I was good at math and science when I was a kid. I went down the engineering track, got a couple of engineering degrees, and started to work for the man in 2007 as a construction supervisor for BNSF Railway. Eventually headed more into the office to do more design permitting and other construction projects from there. The second half of my short stint of a decade working as an engineer, I was a city engineer, then I was an airfield engineer, kind of moving from private to public sector for quality of life. What I was really more passionate about was my real estate investing on the side. But yes, it can start as a side gig and then move off to something more. A couple years after college, I saved up to buy a Class A rental in Seattle, Washington. And that was where I got this taste of cash flow and alternative investments. And I realized the huge difference between alternative investing and the 401k, traditional investments, buying a house to live in and paying down debt versus I think what a lot of us have come to realize is a better path forward. So I went and bought more rental properties. Eventually, I came to a point in 2015 when I had 11 of these turnkey single family home rentals that I think a lot of investors get to. Mines were in Birmingham, Atlanta, Indianapolis. And I realized it wasn't quite scalable after that point, especially for accredited investors to expand their portfolio past the $1 million, $2 million net worth. And so that's the group that I work with today. People who have gone in several rental properties and moved beyond that starter level path. Personally, I started to join a lot of masterminds, started investing in apartments. And from a numbers perspective, this is how my income and expenses looked in my early 20s. For those of you guys who would like this diagram, you can go build your own. It's called a Sankey diagram. You can just Google it, but it's a great way to communicate this to your spouse. I know a lot of our investors, it's primarily, if you're listening on this webinar, you're probably the lead in the financial portion of your family for this stuff, but it's really hard to tell the story of where money is coming from and where it's going. And with this diagram, you can see the changes that I went through my first several years of buying all these little rental properties, increasing the amount of income and the savings. Eventually, it came to a point where I was an accredited investor and had this realization that rental properties just weren't going to get me there. This is cool when I was in my 20s and could just run around as a bachelor and do whatever I wanted. But when you start to have families and you start to have a second person you have to run decisions by, things get a little bit more difficult. Started to get involved in more syndications and private placements, started to add that to the portfolio. Eventually quit my engineering job full-time 2018 and went full-time into real estate syndication myself. Eventually, this was I would say a few years ago. What I attempted to do here was put all my individual deals on the chart here. where I graphed it arbitrarily from class A to class C, from heavy reposition down to yield plays. As true engineer form, you try to create each circle in somewhat proportionate to the amount of the holdings there.
But I've just lost track of it all. But that's, I think, the vision for investors is to get involved in dozens and dozens of deals. So you're diversified over 4 to 6 year time horizon. So in case a 2022, 2023 correction happens, the majority of the fleet is still around.
We work with people and help educate and create the community for people to incubate and get started in this world. Because that was the world that I came through, even after owning rental properties for a long time.
I started to invest in real estate syndications probably around 2015 and 16 after I was doing a lot of rental properties. I knew about rental properties looking at due diligence on that. But when you're looking at syndication deals, unfortunately, it's very much like looking at a black box from the outside, right? You don't know. A lot of times you're not going to go visit and walk units and stuff like that, especially as a passive investor. So what I put together here are some things to spot check from the outside, at least things to now be in comparing different deals together. And there's different ways you can deploy, either with a cash flow focus here on the left side or equity growth focus on the right side, where you're just trying to go after deals that like bigger pops. Because what we've seen when taxes triple or quadruple in some areas and insurance triples too, and interest rates go up and your debt service goes up, what you thought you had cash flow disappears. So at the end of the day, it's all a equity appreciation game anyway.
What's my focus here? Is it more equity growth or is it more cash flow growth? Or is it both? The answer is somewhere in the middle for everybody here.
Some people have different thoughts on how they do this. Some of the younger guys are like, oh, let me just go for it, right? Then I can go for more cash flow focus later on. But again, we're not talking about one deal. We're not talking about 5 deals. We're talking about 12, 24, 36 deals.
But I think this does give a high level until at least you're aware of things. Because that's the whole thing is in the beginning, you don't know what you don't know. And we were all there at one time. And then you start to become aware of these types of things. Now you know where to look. You know what to ask ChatGPT, for example. But if you don't know what the questions are because you're not aware, it's really hard to move forward. And what I tell a lot of people going through our e-course, or you read a lot of books, we also have a podcast, is even if you're aware of it, what really helps is getting around a community of other like-minded, purely passive accredited investors and start to jive with this type of stuff. But for now, we're in prerequisite stage, right? This is the intro class.
I've got 8 different things to look at when you look at a deal.
First thing here, when you're first getting a deal from an operator or sponsor, general partner, a lot of these words are interchangeable.
The first thing is, what kind of a deal is this? Is this a debt or equity deal? So a debt deal is basically, I'm going to lend this person money and get a preferred rate of return or interest rate back on it.
And it's very similar to a hard money loan. Unfortunately, it's also ordinary income. But if you're investing through your self-directed IRA or solo 401k, you're insulated from that. The other side of the equation is an equity deal where it is a little bit more of a risk, but you do get the upside.
I was looking at this other deal lately. It was a movie deal. So you invest money, not quite with Marvel movies, because you can't get involved in those types of deals. Those are institutionally funded. But think shitty movies, like Lifetime movies. Like a lot of that's funded by individual investors. They can be very lucrative, some of these things, but most of them, when it's like a Lifetime movie, it's a lower risk but lower return type of investment. But the way they structured that deal for investors, it was just a straight return. So I was like, nah, I'll pass, because if I'm going to go into something I'm not comfortable with, investing in movies, even if it is known to be as a safer type of asset class within that asset class, I want the upside. So I was like, nah, I'm fine. I want common equity as opposed to debt in that circumstance. Sometimes you can invest as preferred equity, which is a hybrid between the common equity and the debt. In case things go bad, you're a little bit higher in the capital stack. So you're protected, but you don't have the upside. So before you even look at a deal, what asset class it's at, even outside of real estate, you ask yourself, is this a debt or equity deal? At least know what you're going into.
The next thing is whether it's debt or equity. Is this a fund? So you have 2 types of deals primarily. a fund or a single asset LLC or identified pool of assets. A good example of a single asset LLC would be, hey, we're going to buy this 200-unit apartment complex in Dallas, Texas. The address is 123 Main Street. That's the deal. So investors are able to look at the deal. Yeah, I like this location. I like the sponsor. Yeah, I like it. That's where my money is going. Where on the other end of the spectrum, a blind pool fund, you don't know where your money is going. You're really betting on the operator, or in this case, the jockey in the horse versus the jockey analogy.
Typically, funds are put out to more retail investors. And when I say retail investors are guys under $20 million net worth, that's all of us. We're investing in these deals that it trickles down from family offices, pass on it. The big institutional professional investors pass on these types of deals. Investment bankers pass on private equity deals, and it comes to us. Maybe not quite like going to Zillow or LoopNet, but there's a pecking order, right? And this is why families work so hard to pool their money together to get to 10 million, to 20 million, to 50 million. So you can keep ascending this ladder of better deal flow. So with retail investors, which is unfortunately us, they have a lot of funds put out there. Blind pool is another word for this, where they put a lot of different deals into a fund, and it's the sales pitch is it's diversified, but you don't know what you're really investing in at the end of the day. I would say for most investors, it's probably good, right? Especially if you're not in couple dozen deals at that point, it's instant diversification. But a lot of times, I've got a fund, it's hard. You need to always be putting your money into stuff. If not, it's just sitting around doing nothing, and it drags on your fund returns at the end of the day. And a lot of times there's not as much transparency in what's happening because there's just so many deals, whether it's a house flipper fund flipping 12 deals, and this is kind of notorious where like one deal goes down and they rob Paul to pay Peter and nobody knows, and even the person running the deal doesn't even know, or a big fund that owns 15 apartment deals.
Topic here, what is a pro forma?
When you look at a deal, you're always going to get like a pro forma as an LP. What's in it for me? If I invest $100,000, was it $5,000 my first year, $6,000 my second? That's from an LP's perspective. What I'm drilling into more is the pro forma in terms of what is the asset running at we call it on the deal level. So what is the income looking like? What is the expenses? And then you break down the expenses to landscaping, taxes, insurance. This is where I think a lot of more sophisticated investors who have landlord experience are like, yeah, I understand this. I may not understand how it works on a 150 unit, 400 unit level, but I have a rental property. I understand I have to pay these things, and I can somewhat fact check or say, is this being a little bit out there, or is this somewhat reasonable?
When you get a pitch deck, you're going to be given this pro forma or projected returns. Nothing in this world is guaranteed. If you want a guarantee, that's what the T-bills are for, the closest thing to a zero risk type of coupon. But a pro forma, the way I see it, it's like French for toilet paper. It's not really worth much, right? You take the pro forma, but what are the assumptions and kind of stress test some of those. But just for starting real high level here, what is the assumed vacancy rate? What are the operating expenses? And now for beginning investors in your first 1 or 2 years investing in this stuff may make no sense to you. And you're going to just have to be okay with that when you're first starting out. And this is where sometimes people will tell new investors, just bet on a good operator because you don't know anything other than that. But my whole thing as an engineer, and I don't think the numbers are that difficult. It's just people get intimidated by this type of stuff. How do you get over this barrier? You need to start learning the glossary terms, right? Like when I started to salsa dance, I don't know like all the movements. I don't know how to dance, but I'm going to learn the terms first. So these are some of the terms I think would be good to just look up on the internet and understand. You may not understand how it really works in a deal, but understand at least what these things are.
Some of the big things that you look at is like vacancy rate. I like to look at deals that is assuming that it's not going to be running at more than 90% occupied. To me, 92% occupied is full. You're not going to get much more full than that. If you're running that thing at 94, 95% and up, your rents are too damn low. Bump your rents. And then you're always going to have industry standard is 2 to 3% of economic vacancy. So that means if you have an apartment building of 100 units, 3 of those people are usually not going to pay your rent. That's just normal. And that's in better properties too. That's class B and A. In class C properties, like we've had it as high as 20%. People just don't pay, but that's just how it is. And I think a lot of us, we live in this banana republic world where, especially here in Hawaii, where everything is so expensive. That's not how the majority of America lives in Alabama, Texas. But when you're looking at these deals, what are they assuming the full occupancy is running at? And then are they also assuming that they're going to have 3% of vacancy once you get to stabilization 2 to 3 years down the road? Now, if I'm saying a word that you don't understand, just stop me. There's no dumb question unless you ask it 3 times. But I think it's like anything else, like especially like a lot of the estate planning stuff. Until you hear this, then it doesn't get sunk in your head. But let's like dive into what these words mean. So when you see it on a deck 4 or 5 times, you're like, okay, now I see comparisons. I'm seeing trends here, what people are running these assets at. Like operating expenses. Some investors, it's like does everybody know the 50% rule here on rental properties? You make $1,000 in rent. Normally 50% of it, $500 goes to expenses, taxes, insurance. So I think that's a good general rule. If you don't know any of this stuff, just apply that. It's a good starting point. Most investors don't dig into each of the line items, vacancy, or like landscaping. But property taxes is a big one because a lot of the properties we'll invest in are places where it's getting better. But there's a huge train slack in terms of property taxes, like Texas have doubled, tripled, because the property values have come up so much over the last 5 to 10 years, and it just takes a while for that train slack to hit. So one of the general rule of thumbs in terms of underwriting is you want to assume that the taxes are going to go up 50%. So that might be a good thing to spot check or a good question to ask. Hey, what are the property taxes on it now? What are you assuming is going to go up in year 1, year 2? That would be a good question to ask. And if you guys have questions, ask it. I'll tell you if it's a bad question, and we'll talk about why. Because sometimes there's bad questions, right? Sometimes people look at things myopically, and they lose sight of the bigger whole of the picture here. Another general rule of thumb is expenses, which include all those line items, $4,000 to $5,000 per unit per year is a good general rule of thumb that you run Class B assets at these days. Your 1,000 square feet apartments. Yeah, which now have tripled. So you might want to see that coming up with a pace of inflation. So 5,000 per unit. And this is, yeah, so pro forma means nothing. That's French for toilet paper, right? So that's what we do when we analyze this. And this doesn't get shared with passive investors. The trailing 12 financials get pulled into the spreadsheet, and then the last 2 years too. So we know what this thing is buying at. And this is why we like these asset class, right? Because you see what it's running at. So if I'm going to buy your business, I want to see your profit and loss statement. I want to see your runway rate. I've started to invest in angel deals, and it's dumb because it's like there's no income and it's not there yet, no run rate, right? But there might never be, most likely not. Like 90% of the time, you're just burning up your money doing that type of stuff. But your returns can be amazing. But with this stuff, you have the run rate that you can see the last 12 months where you're like, all right, this is where it was. And then a lot of the things that we're doing is real basic. You're just cosmetic renovations to bump the rents. All right, let me go look at my income. If I bump my rents up $50, and there you can be like, all right, here's the new income and here's the new net operating income derived off of that. But we and everybody else has to put a pro forma together to derive what the returns are. But again, that's where it's your guys' job to understand, all right, are you being conservative with all these things here? Which most people don't understand. But I think it's good to acknowledge it, that it's here, because it's classic. Like most investors are like, oh, I saw the numbers, it looked pretty good. What numbers did you look at? The one that said for 100 grand, this is what you get? That's not the numbers. The numbers is the pro forma in terms of what the P&L is.
Of course, we do have a buy and hold analyzer for single family homes that you guys can reach out to us and get for free. And you can see how these numbers work on a more smaller deal, like a small rental property. And that can also help further the education process too. What we find today is, I would say half of our investors have never owned rental properties, which is fine. But the other half who owned rental properties before have a good working knowledge on how rental properties work. And they can really use that experience to extrapolate out to a 400 unit apartment complex.
But as far as like asset class, we're going to be looking at more of a manufacturing deal. It just highlights different asset classes out there, right? Real estate, that's the common thread here, right? We all like real estate, but real estate, you need good interest rates. And what I realized from higher net worth investors, they have things other than real estate. They own businesses. If not, they're maybe not the operator of their own business, but they own portions of private equity and other companies. But sticking to multifamily here,
which is what we specialize. These are some of the industry terms to understand what you're investing in. A garden style suburban is pretty typical. I think what we'll see within our ecosystem here. You could also have high rises, mid rises, and mixed use. Typically, the high rises are class A or institutionally traded, which is why you'll see in people that trade in under 50, $100 million assets, the garden, the suburban type of investments. But this also fits in the narrative of you may not want to be investing in the core business area because your numbers aren't going to be as strong there as in the suburbs. Here's another ways of saying what I'm going to be showing in the next coming slides, but this is taken straight from institutional investment portfolio management. To me, what I try to do is take these types of esoteric terms and bring it down to like regular people like us. They'll describe investments or locations or assets as class B and C or core plus value add in terms of what the business plan is. But I'm going to explain it in a little bit more down to earth. When you talk about a deal, all right, what kind of property are we working with here? So property classes. So we rank these in terms of A, B, and C and D. There's not really any type of numerical designation for each of these. But for the most part, like how old the property is pretty much determines if it's class A, B, C, etc. So your class A is going to be your new high-end type of assets. I would say today built 1990s and later. Class B is your older stuff. These are like 1980s, 1990s assets. Class C is 1950s to 1980s. So the older it gets, the lower the grade gets. At some point, once the asset is 50 years old in the commercial world, these things get bulldozed and made new. One great example of this, of course, a different asset class of hotel investments in Las Vegas, Circus. What a crappy hotel. Sorry if that's where you had a lot of good fun memories as a kid, but it's crappy, right? So that would be a good example of a class C type of hotel. At some point in the next decade or two, or who knows, maybe they already have plans of it. They're either going to renovate it or they're going to bulldoze the thing and build it brand new. But that's an example of what we do on the apartment side, right? We take an older asset and revamp it new, but we also do new developments too.
There was a question that somebody submitted, oh, what's good now? These days, right now, there's a lot of extra supply hitting the market in a lot of markets because prior to 2023, when the interest rates started to go up, everybody and their mother was taking advantage of this free money. So everybody built stuff. So like how people are born in 9 months, developments are born in 2 to 3 years. So a lot of that tail end of that wave is hitting right now, which is nice for people in the market because that's going to go away after next year. And there's going to be a big lull right there. But right now, your new stuff, which is your class A stuff, is being added on the market. And the losers are this value add and this lower end stuff, the class B and C stuff. Imagine like your new stuff goes on the market at $2,500 per month, right? Your slightly older stuff that would have gone for $1,800 to $2,200 a month rent, it's being competed because put yourself in the shoes of a young millennial. I'm just going to go for the really pretty stuff that has like a bar in the lobby for $2,500. I'm just going to stretch and go from $2,200 and pay a little bit more because I'm really bad with my money anyway, and that's what young people do. Right now, you're having a crunch on that more value stuff temporarily. There's this train slack effect. So right now, if we're going to do value add projects, it's going to be more of this core plus stuff. So this is going to be like stronger areas, less tertiary markets. So stronger areas are like the big secondary markets. We don't invest in California, Hawaii for obvious reasons, but like your Dallases, your bigger metropolitan areas, less tertiary markets like those, like Wichita Falls and those types of markets. And then also that also means your nicer stuff. So Class A, but built 2020. So not brand spanking new, but not 1980s Class B. So that's just, maybe that'll be the trend for the next few years. And then it'll change, I'm sure, as things change all the time.
On the second thing is the neighborhood class. So I think this is a lot more important what the property class is, because you don't really have too much control over the location and neighborhood. And it's also determined on a class A, B, C criteria. I think most of the people living here tend to live in class A neighborhoods. Why? We got money, right? We got some disposable income. We like to live in nice areas. Class B it's an okay part of town. You probably don't want to be there at nighttime. Class C you probably don't want to be there during the daytime or the nighttime. Class D is just bad area. And then Class F or war zone is pretty much the same thing. This is a lot harder to nail down. Never listen to a broker, never listen to a syndicator. They're always going to sandbag you and lower the grade on one level. But I think this is why we tell investors, we'll come with us on a field trip, walk a couple properties, and then we'll give you some data points. And you'll have some working knowledge of, yeah, that time I went with you to Fort Worth. We walked that class B minus location. Wasn't too bad, but now I know what a B minus is in the future. This is what you generally want to be looking for. These are the location classes. Ideally, you want to be in this red circle right here. You never want to be in the best area, because in the best areas, you're always going to be paying a premium, right? And we're investors. We're not necessarily living in these investments, but we want to find the best value, right? As far as the property class now, you're okay taking a Class C property because you're going to do some value add to bump it up. And part of that value add could be as little as $5,000, $10,000 or renovations per unit. So that's known as lipstick on a pig. Light value add, 5 to 10 grand per unit. Everybody should be writing that down. That is just going to minorly get you from a C plus to a B minus type of assets. This is where there's a bit of a cat and mouse game between syndicators and investors that like, oh, we're going to do all this rehab and it's going to be turning it into a Class B to Class A property. I don't know. That ain't going to happen in my opinion. That's like believing the Easter Bunny is real. Maybe if you're doing like 20, 30 grand per unit, but at some point it makes more sense to just build the thing from scratch. The reason why we like this lower middle class workforce housing in the Class B and the C sector is because in a recession, what happens? The A's come back to the B's, come back to the C's, and the majority of the population is living in Class C housing out there. I like this narrative because the lower middle class is growing. It's that middle class is shrinking. I think that's a lot of us here that's holding on to that cliff. And that's why we're trying to invest, so we don't become like the shrinking middle class. But generally speaking out there, the majority of the population curve is in that C class area. And that's why we like to invest in that area. In 2020, we started to build brand new developments it's considered Class A, but it's not luxury at all. It's very much for lower middle class folks, or for some of us sending our kids to college for the first time. You might put your kid in something like that, like a decent newer build, $1,400, $1,600 a month rent. Unless you spoil your kids and send them to the Amelie where there's like a bar in the lobby and you're into that type of stuff. But I think that's the type of still Class A workforce housing type of apartments that we'll build from scratch. But this is some of the stuff that we've done in the past where this was a Class C property. You see the yellow gross appliances. We changed those out and just repaint and change out the hardware on the faucet and the cabinets are repainted. And something like this might just cost $3 grand, $5 grand to do, and then you bump the rents up couple $100 across the board. Just some fundamentals before we get diving more in. We tend to buy in red states because of landlord-friendly laws. We try to stay away from short-term rental properties because I see it as discretionary spending in a recession. People don't go and do as much vacations. When I first started to invest my first 11 rental properties, I did this buy, hope, and pray model. where I just bought something that cash flowed and hoped that it would go up. Where when you get involved in syndications and private placements, there's typically a value add type of business plan. I spending 10 grand per unit to bump the rents up $150, right? So you're, in a way, you're taking fate in your own hands there. Here's what we've done in the past. We always very focus of the project is to rehab units and push those average in-place rents over time.
This one was actually the one that we had 80% collections on. So that was why we opted to sell this one as soon as possible. It's a scary place to be. I didn't want to be there. But as far as you're sizing up a deal, you're looking at the pro forma. The tangibles are like, all right, do I like the location? Right? Am I a believer in this location? In most cases, when you're looking at a pitch deck and you're looking at like the 6-7 pages of Dallas, Texas, most times I throw that thing away. It's just a waste of time. It's just filler to me. To me, you as an investor should already know what are like the more favorable places that everybody's investing at that point. But that's the big one, investing in a better location. The next thing is the year built, because the year built will determine if it's a core plus or where it falls in the pecking order of asset classes out there. As far as this stuff goes, pretty similar most markets, square footage. These are just, again, like the statistics on the assets.
When you're looking at a deal, these are some of the tangibles that you want to be looking at: the location, year built, square footage. I would also look at the rent per square footage, like a personal thing. I just want to know where it's at. Most properties today, Class C to Class B, are in about $1 to $1.50 a square foot for rent.
Some investors, they like individual HVAC units because then it's easier to predict when those things are going to go out, as opposed to that chiller broke, right? And it's, damn it, they cost like hundreds of thousands of dollars, and it's hard to model when that thing breaks. Which more modern, built 1980s and after, they tend to have individual HVACs. Maybe, I don't know for that reason. I don't know why, but it is, where the older properties have those awful chiller systems that just break at the wrong time.
So that kind of tells you what kind of asset it is right off the bat. But as you can see, that was just a personal thing of mine, right?
You know, I think a lot of times, like, this is where you put a lot of trust in your deal sponsor in doing the due diligence on what are the deferred maintenance items to be fixed. The big ones are the roof, the plumbing, the electrical. A lot of it is like electrical, for example, it needs to be copper, can't be aluminum. That's like the old way. The bank will mandate that the electrical system be more modern, right? If not, you don't get a loan. You don't really got to worry about that type of stuff. And this is what's nice when you have a bank involved. They're also doing a lot more heavier institutional due diligence on this, and they don't give a loan on something that doesn't fly. But the roof is another big item. You see a lot of deal sponsors doing this stupid thing where they take a ladder and they go up there and they take pretty pictures like they're on the roof, but they don't know what they're looking at. When we do diligence, we don't know what we're looking at. We get a professional third-party inspection company to itemize everything. Or like when you guys do an inspection on your guys' houses when you buy a new something, but like way more in detail and actually hold some weight. They give us like a full due diligence report, and they also give us estimates on pricing and contractors from there too. Some people say it's like you're just like outsourcing that whole thing out. So yeah, they're the experts, and this is what the institutions do too.
Like, you as an investor are going to build your own nuances and learn your own way. But this is where you need to mix it up with other purely passive investors. And what I found over time is like you develop really good relationships with other people and you get different viewpoints. The other thing, it's sometimes it's nice to see the units upgraded already and see that the rents have already been bumped. We sent our team out to Georgia the other week to go look at a deal. Specifically, we wanted to see the 6 units that were freshly renovated and were they hitting the pro forma rents. That's verification of the business plan. But other things to know, is it Section 8 or is it just straight pay with the rents? These other types of nuances that I think for now, I think just good to be aware of. But as you can imagine, there is hundreds of questions you could ask. And we actually do have in my e-course like a full 100 question list and a full due diligence checklist. But we tell everybody, hey, just use this as a guideline. And you never want to be the person who asks the sponsor 10 questions, because you're already going to be identified as a real pain and inexperienced investor at that point. Fundamentals, again, this is a big term, CapEx, capital expenditures. Like, what's the business plan here? Luckily, in real estate, it's pretty basic, right? We know that there is a customer out there for a box to live in, but are they changing out the flooring? Are they putting new washers and dryers into all the units? This is a big thing to vet. The next thing, and now we're getting into some of these terms where what to look for as an investor, as gotchas. There will be vacancy and there will be turnover. So to see your operator perform out a financial where they're assuming that they're going to be 95% occupied and everybody's paying is not a realistic rosy picture. So these are the things that you'll see over the time, and I personally key in on, right? Because it speaks to the level of conservativeness, the underwriting.
You're not going to get rich by just paying down the mortgage and waiting for appreciation to happen. You got to force appreciate the rents. Just like a business, you have to do things to make more revenue, cut expenses to improve the net operating income or beta.
But here's an example of that forced appreciation numbers work. That's what's nice about commercial real estate. It's all based off of numbers. It's not like residential real estate where it's based off comparable sales and emotion, essentially. These are very typical things you'll see in projects, like say the property management just wasn't aggressive with bumping the rents up. So that they actually get on it and they bump the rents up $45 across the board to a 100-unit apartment complex, creating $4,500 a month in extra revenue, or 54 grand a year. Now, the evaluation of commercial assets is the net operating income, which is the NOI is what we call it, which is the income minus expenses. So in this case, we bumped it up by 54,000, and you divide it by the prevailing cap rate, typically between 5 to 7% these days. So at a 5 cap, you just created $1 million of value right there. Another example, say you save $40 per unit by billing back utilities to the tenants. That's 600 grand there. Some of these cases, you can rent out reserve parking at like $20 or $20 for just merely 20 spaces. That's like a $300 bump in value. So the operators, part of their business plan, maybe not only to bump rents on individual units, but to do these types of things throughout the hold. And then, of course, the age-old just rehabbing units. This is the good old-fashioned way of doing it. Examples of rehabs right here. What I like about this is it's nothing spectacular. This isn't rocket science. I always say I'm just a dumb real estate investor here. This is not venture capital. We're not trying to recreate the wheel.
In these Class C and B properties, really you're only limited to maybe building back the utilities to the tenants or doing your cosmetic upgrades so somebody pays another $150 more a month. The Class A stuff has a little bit more ability to charge them extra stuff. A lot of us haven't lived in apartments in the last 10 years, but it's crazy. Like you pay your $1,275 for rent, but then you got this add-on charge. As soon as you know you're paying $1,500. On the pro forma that you get from your syndicator, a lot of that's captured in other income. It seems really like obscure, and it can mean like vending machine revenue. It can mean maybe they're building covered parking in Texas is a big thing to prevent the hail from hitting the cars. So they might charge somebody extra $50 or $100, or they might build storage sheds. That's other income. It's a huge part of your higher A class, or even 1990 properties and bigger. It could be maybe 10 to 20% of somebody's rent. But I think for the lower end properties, the name of the game is just rehabbing units, bumping the rent. But that's how you create this incredible bump in value, by doing this over time through the slow flip method. And that's what people pay for. And if you're one of these people who really likes the whole, we're improving the community, that's what these pictures are for. Like it's improving the community, making it better. People pay more in rent.
Switching gears a little bit, deal structure. Now, what this all is held together with is a private placement memorandum.
The private placement memorandum. So I consider that like a packet, a legal document packet. So like we were talking earlier about trust, you have that thing where in case you come in incapacitated, your will, your trust, your documents, whenever you sign one of these deals as a passive investor, you should have your PPM, your subscription documents, and there includes, there's like an application, technically an application where you're saying like, hey, I'm an investor. This is how I'm qualified. I'm not some bozo. Let me into the deal, please. So all this is what's known as most people just call it the PPM for short, private placement memorandum. It's usually like 100 something plus pages.
Investors pulling their money together essentially triggers securities law, SEC. So once you do that, the operator, sponsor, general partner, whatever you want to call them, they have to go through the proper SEC channels and create this big PPM document. For us, like we usually pay 20 grand, 30 grand for it for each one of these things. But this kind of sanctions that capital is coming in one place. And to me, what it does, two things. It protects passive investors, that the general partners have fiduciary responsibility to investors. And it also protects the general partner, because say a deal was projected out to get 100% return in 5 years and the return is 80%. Nothing to stop passive investors for suing for the remaining 20%, which is incredibly messed up. But hey, that's the litigious society that we live in today.
What I personally do is I just go Control F and I look up the word FEE, fee, and I just make sure that the fee structure aligns with what my understanding of the deal is. And then I also look up like how the GP LP splits are. And then also if there's a waterfall, that's how I find it. Now, there's a whole bunch of things that I've learned throughout the years, like when things go wrong, voting rights to kick somebody out. It should be written pretty neutrally. Not always the case, but I'm not giving any legal advice here, but certainly not worth anybody paying any money to get it reviewed. It is what it is. They're structured different ways. When we go into a deal, like this last deal, had a really confusing org structure, and that's what this is, right? This is a classic one. You have the asset here. It's owned by an LLC, and then everybody's got ownership of the LLC, right? This is why you can't 1031 into this stuff, because if you're selling off your rental property, it's real estate. Here, you're buying business interest, not a like kind of exchange. You'll have some kind of structure here. I've seen it extremely confusing where you have a secondary lender, preferred equity, but to me, graphically, it really helps to understand, for me, what we're getting into. But this probably goes well beyond what passive investors will do. What we want is, when we go into a deal as a group, we like to see, all right, is there a preferred equity lender in there? And how are our terms split with them? Because the preferred equity could be a two-face. They could be predatory at the end of the day. You don't know. But unless you go through problems, you don't learn about this type of stuff. But this is stuff that you can see where the family office is. This is second nature to them. And it's, in a way, it's getting second nature to us. We know different parties involved. Sometimes it can be a good thing, right? Because if a preferred equity partner is coming in, they're the institutional pros vetting this deal too. And it's good to be alongside the same deal. Maybe in a different part of the capital stack, but the same deal, same asset. But at the end of the day, the pro forma where we're talking about earlier, we're like, what's in it for me, 100 grand investor? It goes through all these splits and fees, takes into account. And that's, at the end of the day, maybe that's what my view of the world is. We're gonna get into a deal together. It's not gonna be all of our net worth. It shouldn't be. It shouldn't be more than 5-10% of your net worth. And we're gonna see if this goes well. If it doesn't, we don't have to work with each other again.
Of course, I always say the people I work with, it goes beyond this paperwork, right? It's more about working with honest people who have ethics and relationships. And that's the trouble, I think, going beyond this due diligence talk here today. It's really hard to find, when you invest in as many deals, like 20, 30 deals, and you don't have a community around you, it's going to be really hard not to step on a landmine here or there. And that's why, again, I said at the top, try to stick with operators above $1 billion of assets under management. And that's brings up this whole idea of the counterparty risks. I will identify two types of risks in deals. First is like the deal, right? Is this deal going to work? Is this business plan is vetted? Are they using conservative numbers? The other part of the risk is the counterparty risk. Is somebody going to steal my money? I've run into this on a handful of occasions, right? And that's why I put a lot of emphasis on the people that you work with. This is unfortunately, unless you start working with people or somebody who's invested with somebody in the past, it's really hard to determine who's legit in this industry, unfortunately. I think that just develops over time.
All these deals, they're only as good as like the people that you are working with. FTX was a good example of this that turned out to be a big Ponzi scheme. Sometimes there's like just people just stealing money, and it happens out there. That's why it's good to be plugged into a network and at least know who are the bad players out there. And if you're uncomfortable with this, then I totally get it. You could invest in more institutional firms, guys who have $4 or $5 billion of assets under ownership or better, but you're not going to get the returns from those guys. You're not going to be doubling your money in 5 years. You're going to be doubling your money in 10. For people who aren't worth $10 million yet, you got to take on some risk. But that's been my whole thing is I date around a lot and I work with a lot of people, and sometimes I get burned, especially in the beginning. But once you figure out who are the trustworthy people out there, you tend to stick it together. But that's why you have all these contracts, and then you have to get lawyers involved. And so some general tips if a syndication is legit. First, you learn and you understand the numbers that we talked about earlier. You try to underwrite the deal if you can, or vet some of the assumptions. You try and work with good people or stick with others. I call this proxy investing. Somebody says, hey, I got a good oil and gas deal. I'm like, let me know how it goes. But that's how I learn, right? Through you, right? Did you get your arm blown off or running through the landmine field? But if everybody collectively is doing this, gathering data points, that's a lot better than me going it on my own.
But when I first started to do this, my little secret was I would get to know the syndications attorneys and I would know who was legit in the business. Over time, you figure out who performs. I talk a lot about my first deal as a passive investor in 2012. I invested with these guys and they were just shysters and they just stole the money. I've made the mistake a few times more, but I think the more and more you grow your network, the less risk and chance you have stepping in these landmines. But I say that not to discourage people, but I think it just puts emphasis on building your network of other passive investors, and you just have to diversify over time. Let's get into back to things that you can control. Now that I've scared everybody, I want to try and empower everybody with some things you can actually look at. So again, you're looking at a deal and you're like, all right, what's the rent projections that the operator is showing me here? Looks like they're saying that the rents are going to go up 5% every year. Here's even in 2000 when things were going pretty well, Dallas was at 4%. So this is called the rent escalator in the underwriting sheet or the financial due diligence part. Normally what you want to see is anywhere from 2 to 3% rent escalators per year, and which is mainly to account for inflation. But anything higher than that, I would scratch your head a little bit. Not saying it's a deal killer, but I'm just making people aware of this type of stuff. A lot of times the operator sponsor will not openly come out and tell you this, of course. Why? Because they're trying to sell you the deal. But you can probably tease it out if you're able to interpolate these numbers on the grant potential income line up here. You can tease it out what it is. If you want to interpolate this, just ask ChatGPT, put this number in and put this number in and say interpolate this. But for those of you who's a millennial or older, you actually know how to interpolate this, which is you take this number minus this one, and you take that number divided by this and you get a percentage. And you're trying to see if it's, again, between 2 to 3%. Anything higher might be a bit of a head scratcher right there. All right. If anybody's sleeping right now, this is the most important thing ever. This is called the reversion cap rate. I call this cap rate gate. It's one little cell on the spreadsheet, but if you really wanted to fudge your numbers, you just change this one cell on the spreadsheet. And what this is, it's basically saying like, all right, we think that we're going to sell this deal 3 years, 5 years from now in this type of market, right? This is what the reversion cap rate will be, or the exit cap rate will be at the time and when we sell.
Detach this, like people talk about, oh, what's the cap rate of the building, which could be 4%, 5%, 6%. This is nothing really to do with that. This is just what is the assets for this particular asset class in this market selling for at this time or in the future, which is your reversion cap rate, also known as exit cap rate. So if you're buying a Class B, let me use something I know. Phoenix Class B, I think at one time it was selling for a 5.5, 5 cap rate, low fives. If you assume that thing, the market you sell for in the future is going to be at the same or lower, you're assuming that the market's going to get stronger, which is not very good in terms of being conservative. What you want to be doing is increasing that prevailing cap rate a little bit higher, 0.5% maybe. So this is a funny meme, right? You're buying it at a 4 cap rate, and then if the market is 5%, you're effed. And that's why the pro forma, we were talking about the pro forma earlier, that's all this stuff. Oh, it should be this in 5 years, right?
The thing is, nobody knows what the reversion cap rate will be come, 2029, right? A good rule of thumb is to increase the reversion cap rate to assume that you're selling it into a softer market. Counterintuitive, but on the next slide, when we play around with the numbers, you'll see. But the property value is the net operating income divided by the cap rate. If the market gets softer, it might trade at a 6.5 cap as opposed to a 6.25 cap. As this meme says, if you're buying something at a 4% cap rate and the market corrects at a 5%, you're screwed if you didn't account for it in your underwriting. More times than not, and this is just part of the game, folks. You have to understand this. It's like you go to a used car lot, especially, and the guy's like, all right, it's $15,000. And you just laugh because there's room for negotiation. Just like an operator puts out a deal at 95% return in 5 years. All right, what numbers did you kind of mess around to get to that number? And this is, again, the biggest one here. But here's an example, and you can see how much it fudges the numbers. Say today we bought this asset at a 5.25 prevailing cap rate. And this has nothing to do with what the asset is running at. That's a totally different topic that confuses a lot of people. That's also called the cap rate of the asset. This is just the prevailing cap rate of the asset and what they're selling at. So say you bought something at a 5.25, the market corrects and it's 6.25 tomorrow. If you assume that if you were a good Boy Scout, which nobody does this these days, and assume that the cap rate increased 6.25, and your return was 100% return in 5 years. But if you would assume you only were a little bit conservative and it was 0.25%, then your projected return that you showed investors was 144. But then you were screwed because you didn't account for that. So this probably reversed the other way. I think I'm kind of explaining this a little bit confusing, but basically you see the spread in the numbers, like 40-something% by underwriting it one way versus the other. And this is why what's on that PDF, it means nothing at the end of the day. This is where we try and teach investors like, hey, these are some basic stuff to spot check so you don't get hit by this bus right here.
That's probably the most important thing. If you're super lazy, that's all you need to know. That's like me and soccer. I don't know anything about soccer, but if something happens, I just say offsides, right? This is the same thing. If you want to look cool and you want to catch 80% of the bad deals not to invest in, it's this right here.
Moving on to this is sensitivity analysis. So you can see if the exit cap rates here change, you can see how these numbers really start to change here. Again, if you use a really aggressive reversion cap rate, like the projections can move 40% one way or the other.
Every time you fudge the numbers 1/4 of a point to the wrong way, you lose like 10 to 20% in terms of returns. So this is like where it really frustrates me because people will be like, oh, this deal is only 85% return in 5 years. So yeah, because we used the right numbers, or we tried to. But the other guy, they're comparing the 114% return deal is using BS reversion cap rates. And in reality, if you normalized it, it'd be a lot less projected returns. And that's why the pro forma means nothing. What I'm saying is everybody is dicking around with these numbers. Everybody's doing it. We're doing it. These are all guesses what the reversion cap rate is going to be in the future. So what you have to do is take that with a grain of salt. And what is the reversion cap rate in relation to prevailing cap rate today? All right, that's not conservative enough. Let me just downgrade your projected returns off of that. At least let me compare apples to apples. This is where they have to give you accurate numbers, but this is a cat and mouse game because I can give you the prevailing cap rate and the reversion cap rate, but there might be other things in the underwriting that might be changing some of the numbers around. So you have to be very careful how you ask your questions. So what I would ask is, what did you guys assume the exit cap rate or reversion cap rate to be? And then this is where, yeah, you could if you're lazy, you could ask them, what is the prevailing cap rate for this class? But it's always going to be within a range, and they're always going to be giving the lower end or the higher end that helps them. So this is where it's nice to have a group up together and be like, oh, what is Class B in West Fort Worth? What's the prevailing cap rate for that? And then add on a 0.5% on top of that. And that's a good reversion cap rate to use.
Some typical lending terms. Now, there's a little red there because there's definitely blood in the streets on this, and that's the important part. But here, the crossed out portion is if when I gave this presentation 3-4 years ago, what people were getting. The new one is today, so a little bit higher interest rates. The big one is the loan to values are a lot lower. And this is why I think you're not getting as many deals done today. This is why we stopped. Our last transaction was June of 2022. We haven't been very active because I can't make deals work when I have to bring 20% more to the table because the loan to values that banks are given is a lot lower. But the other thing to look at as an investor, if none of this makes any sense to you, is just to be aware of the term length. So this is different from the amortization. Amortization is typically the same on all deals, 25, 30 years, like your home mortgage. Commercial real estate, the transactions are a lot quicker. The loan terms are a lot shorter. You can't get away from this. Anywhere from 1 to a 15-year term is normal. So anything less than 5-year term might be a bit of a head scratcher, and that may not be for you as an investor. So we've seen this. And if you bought a property in 2021 at the peak of the market and the market corrected 30%, which it did, which is why it's such a great time to buy new assets at this point. But if you're in those 2021 vintage deals, you're screwed because now your $100 million asset is only worth 70 and your loan is due, right? You don't have enough runway to time you to get out of that trough in the market. So that's why we put the designation there, 5 years or less. If you had 5 years or more, you could probably value add the asset, get out of it, and or the market corrects back up to get you back to par level. But anything less than 5 years is something to be aware of.
This is the big thing that caught everybody these last couple of years. In terms of lending, it's not the interest rate. Everybody focuses on interest rate. When you are doing value add, interest rate really doesn't mean too much. Like, to use an extreme example, when you're flipping a house, you don't care what you're paying for your interest rate. You're going to flip the house, value add it, and make a boatload of money if you can do it in a decent amount of time. So same thing here. The interest rate doesn't really matter. What's going to kill you is this thing right here, the loan term. So in residential real estate, everything is 30-year term, but in commercial real estate, everything is on a sped up timeline. Loans are anywhere from 1 year to 15 years. The longer the term, the more expensive it is. So a lot of the projects that you'll see are value add projects that are supposed to take less than 5 years. So the right tool for the job is a bridge note that is 1 to 3 years in length. But if you want to be conservative, you try and go for 5. In the beginning, we would do a lot of 8 to 12-year notes. And I still think that's overkill. But that takes out of the equation of, oh shit, interest rates went up 40-year high, quickest time in history. And then now our loan is due. Our timer is up. Even though you've done a good job with the value add, your timer's up. So I would say that's written in blood. I would say that is the thing to be on the lookout. No eyes wide open going in. Now, I'm not saying if it's 1 to 3 year loan terms, not saying it's a bad deal, right? That's how you make a killing. That's how you double your money in 2 or 3 years and you look like a genius, but you're somewhat exposed too in that.
But other than that, like, all right, I'm just a passive investor. I don't have access to CoStar or Yardi, which is what we have access to and what we use to vet new deals as a general partner, or if we're going to invest in a deal as a fund-to-fund manager, we have access to CoStar and Yardi. But the problem is it's like $10,000 to $30,000 based on how many subscriptions you have. But these are great data houses. Of course, you have to take it with a grain of salt, but this gives what people's debt service coverage ratio is month to month on people's properties. And I can see what operators, what deals they have and how it's running and what their rents are.
We do a lot of spying on people and seeing what properties they own, because you can hyperlink to whoever owns this and what's in their portfolio. And then you can also see what their properties are operating at. what their debt service coverage ratios are. It's not the most accurate, but I mean, it's pretty amazing that they have all this information.
But as a passive investor, you're not going to have access to this type of information. So the next best thing for free best sources is City Data, Neighborhood Scout. These are a little bit of a composites. If you want to dig into raw data, that's where you look at crime maps, median household income, etc. that I've pulled here. And then, yeah, other things to look out for when you're doing due diligence on a geographic area is the population growth. Here are some general rules on that. We have some different rules for cities and more for neighborhoods here, but I just wanted to really highlight as we close out here some of the mistakes. Number one, I think LPs focus on the LP split way too much, or the preferred rate of return. These are the waterfall structures. And we do these retreats in Hawaii, and I always hear my guys talking about this. I'm like, guys, who cares? Vet the deal. If the deal is going to fly and it's going to work, it's going to be good. If it doesn't matter if you had 99% of the deal as an LP, right? Vet the deal. Who cares what the splits are? I know why people do this, because they don't understand the deal or all the stuff that we talked about today. They don't know reversion cap rate, and they focus in on something that they can understand and what the iceberg that's sticking on top of the ocean. But this is what a lot of these really bad internet forums out there where it's led by passive investors and they just don't know what they're talking about. And they're talking about splits all day long. Understand what kind of an operator somebody is. There's a spectrum of operators. There's institutional operators that have done billions of deals, $5-10 billion of assets under ownership. Here, you're going to have higher fees, higher splits. So these split schemes aren't going to be very good for you, but they're going to be reliable, right? You might double your money in 10 years. But for some of my investors above a few $1 million net worth, this may be the place they want to invest, more for reliability. Also, the minimums on these guys' investments might be $500,000, $2 million, $3 million. A little bit too rich for some people's blood. Where I started as a passive investor is dumpster diving through operators on the opposite end. The fake it till you make it people. The people who give really good splits and have low fees because they're just a newbie. And it's dangerous working in that world as an investor. There's a nice little sweet spot in the middle. Like I said, several $1 billion of assets under ownership, pretty good splits, tend to be lower fees than the big guys. More importantly, good reliability. They've done this before. So I would look at it from that perspective first. Am I working with an institutional operator, or am I working with a fake it till you make it operator who's still working his IT job on the side? We were there at one time too, as a passive investor. Just be aware of that. And then we talked about the reversing cap rates, check comps on occupancy and economic vacancy. A normal number that you want to see for occupancy is about 92% as considered full. And then you add on top of that 3% of economic vacancy at least. So your economic vacancy is usually going to be 10, 12%. And this is where you're not going to be an underwriting specialist. That's not within the scope of a passive investor. But I think you need to understand some of these nuances here to, again, build that bridge so you can intelligently talk to other investors out there. Here's some lessons learned that we've learned in our past investing, but it's more important to build a mastermind out there. We have it within our network of investors. This is going to help you get beyond multifamily. I think a lot of people start off with multifamily and then you branch out to self-storage, ATM machines, senior living, and then get out of it like buying businesses, buying CPA firms. You get into venture capital at that point. This guy is going crazy on the buffet line. This is a bit of a mistake. I think investors, you find this world of alternative investments. Like you're going to Las Vegas buffet. You're like, give me this. I want this. I want the Chinese food. I want the pizza. And you're like gobbling up everything. What I would say is just stick with one thing, get into at least 4 or 5 deals in multifamily first, something that you understand. A lot of us have lived in apartments or had rental properties. Start there before you start to branch out into more exotic things, and make sure you have 5, 6 other purely passive accredited investor buddies that you drink beers with and are very close with. Because this is all a game of you're getting out of this traditional investments into alternative investments. And with alternative investments, you tend to get better returns. You tend to beat alpha is the term. But I would say you need a network, and this is what we provide in our community. like to have these different conversations of how do we create our entire portfolio of all these individual deals. I would say for most people, $3 to $4 million net worth, so that you have your core capital, what's labeled here, satisfied, and then you can shoot for the moon or just retire and just relax and enjoy your life after that point. And that's what we teach is the intuitive investments, the tax strategies. And outside part of that is the infinite banking here. And there's a little bit of a diagram on that. But basically, you want to do your infinite banking, accredited investor banking policy, run your investments through that. And then it just is it doesn't move the needle as much as taxes and the deals, but it's just that third strategy that people will implement in this world. But unless like you're in a community of other high net worth people, where do you hear about this stuff? And that's been my passion. I came into this world in 2015 and I just was a sponge and like distilled all these best practices all in one place. My job continues to be like, what are the people $10 million, $50 million doing, right? And a great place to look for that is Tiger 21 is an organization for that. I think you need to have $30 million net worth to get into that or deployable assets. But straight from their data sheet right here, this is what their members have, most of which is real estate and private equity and less of what you would think of the traditional investments. Now, I don't know what they're holding, how they're holding it in cash or QRPs, but this is how their portfolio is broken down. And you can see how their portfolio is vastly different than the broke guy and the guy who in the cubicle next to you. Check out my new book. It just released this past week. It kind of distills all this information down in 200 very beefy pages. Also check out my podcast too, where podcast tends to ramble, a lot more fun there. But I think the book is pretty concise, capturing all this type of stuff. But yeah, if you guys want to book a call with me, we can go through deployment plans because there's such an order that you deploy funds out of. And it can be very complex based on where your tax situation is. But we can open up for questions.
You know this much about a topic that you started in 2015. So it's something that is obvious that you've really dedicated a fair amount of time to. And it seems like your life passion. Well done, sir.
Yeah, it changed my life, right? We find a lot of people that they might have a net worth of $1.5 million and they're paying a lot in taxes. These are the hard workers of society, right? That pay most of the taxes in reality. But some of these cases, maybe they can do real estate professional status. Their spouse can stay at home with the kids. That's just instant quality of life changer. And they net more money after taxes with extra passive losses from their investments.
So the whole point of today's talk was somewhat scare you guys a little bit and maybe use a little fear to motivate you to do that. And you might be like, all right, this is too scary. I'm not going to do this. But there's this echelon of like returns out here. When your net worth is 40, 50, 100 million, you get really good deals and you're able to cherry pick those deals. None of us are there yet, but you certainly can't grow your net worth to 8 figures and get your irrevocable trust, build a dynasty for your family unless you get past this level here. We all know this, right? Like we have to somewhat live in this world and we have to take risks over this. But with risks, you're never going to catch everything, but how can you best mitigate it on the front end by doing certain checks like a reversion cap rate? That's what I'm preaching here. If you're not cool with that, on the other hand, you don't need to be cool with that. You can just follow what other people do. That's what a lot of second generation people do. And that's what I've noticed. I think as a first generation millionaire, I think a lot of us have this idea where we're just going to do everything. We're going to learn everything. We're going to run the deal. But that's not what second generation kids do. They rely on their network. And I'm slowly realizing this. Okay, so this is the last slide. This kind of ties into what we were talking about earlier. If you're relatively younger in your 30s and 40s and you're already at that $3 million threshold, the irrevocable trust, get that thing tomorrow. If you're older and you've crested past that $5 million net worth, then get that too. I'm just throwing that out there, not giving any legal advice. But part of that has to do with this concept of core capital here. So I'll explain this. Core capital this is age on this axis. As you start to get older, you need less money, right? A lot of us here have younger kids. You guys are in this stage where you probably need $4, $5, $6 million net worth to be able to put in a cruise control and not do anything. But as you get older, especially as kids leave, they're not a nuisance anymore. You can take them off the books. probably only need maybe $2 or $3 million or even less, right? So that's this concept right here. So the idea is that's all you need. This dark blue corresponds to this dark blue, which is lifestyle spending. So lifestyle spending is like your basic needs. It's said in different ways to mean the same thing, right? This is how much money we need to survive and some beer money on the side. But at some point, we don't need it, and it becomes more of this gray money right here, right? This is the legacy money. I think I might differ. I'm sure I'll change my mind, but I'm like, I only got one daughter, and I'm like, even if I had two kids, I'd be like, hey, give them 1.5, 2 mil each. Any more, you're just gonna mess them up, right? I went to private school. I know what's up. So I would probably call this light gray, but I think half of you guys might call this dark core capital, right? It's needed. But at least we're talking about these concepts, right, in this way. So the idea is lock down your lifestyle spending first, your core capital first. And that's probably, again, let's just call it what it is, maybe 3 to 5 mil net worth. Once you have that, lock it up, and everything else, all the gray stuff that should go to this, gets put in your irrevocable and put up in the cloud and gone away out of your estate. But you're not going to do that investing in like traditional investments or not being your own business owner, right? Some of you guys own businesses. You have the ability to get there. But if you're just working for the man making $300,000 a year or less, ain't going to happen. You need to take more risk. But for most of people in our community, that's not the need. We don't need private jets. That's one blueprint I'm showing here. But what's nice, once you have your core capital set, everything else is off the table litigators too when you're doing this. That's what's so nice. It's like so freeing in a way that you're set. You're in cruise control, that whole concept. I changed the terms a little bit to align, but it solves the question of like, all right, yeah, how much do you need and what's the concept? And then it's also the concept of what's the real goal? People who have read the book, the Bill Perkins book, Die with Zero. Yeah, that's a recommended book. It starts to talk about this idea of maximizing your experiences. So, okay, so this is esoteric. So you have like money, right? We're all trying to get money, right? Money is very important when you don't have it. I think a lot of us, time is more valuable than money. In a strange way, you can change like money for time. Like I pay for the Whole Foods delivery thing. Whenever I get $40 worth of groceries, I have them deliver. I don't waste my time going to the grocery store, especially when you have young kids. I just pay. I don't care. Just pay. I'm paying for time. But there becomes a point where when you're older, you're sicker, and then you bring in health, right? You can't use money to pay for time at that point. But what is in the book, Die with Zero, the whole point is it's not necessarily time. Because you can have a lot of time and you can live an uneventful life, or experiences that is the thing. And this is where I argue you need freaking money to exchange for experiences. And at the end of the day, experiences to me is the point system. Now you might disagree with me, but experiences is what I think is a score at the end of the day. Throughout this, yeah, we're all here playing this game, trying to get passive cash flow. But the real game is exchanging your money for experiences while you're optimizing your finances. That's the optimization question. Maximize experiences, optimize financing. Well, we all know that you're getting older and you could die at any moment, which is why you need a trust, and your core capital goes less and less. So it makes sense to like, all right, when I get older, I just need to trade these suckers in, this money in for experiences. This is in super fine print here. Most of you are trying to go, and this is myself too, are trying to go for 99% confidence that you will have enough to last and understand the trade-off for limited time to achieve that. What that means is we're scarcity minded. We're like squirrels putting nuts away in the tree, and we're just running around. We have a shit ton of nuts in the tree, more than enough for a winter in Hawaii. And this is like the case for the people in FUM, right? I think more times than not, they're still like working their asses off, even though their net worth is 3 to 7 million net worth, and just makes absolutely no sense. But that's the case. It makes sense, right? Because if you spent your whole life trying to save money, make money, you start to associate your sense of value on that. So that makes sense to me. But if you look at it like this diagram, it's stupid. But with that, thank you all for coming.
Going through this whole transition myself, it was really hard to do it without meeting other purely passive accredited investors out there. So that's why we've created the network, which you guys can join.
This is the 10th module, Masterclass series, where I'm kind of taking you guys from the money mindsets of traditional finances to alternative investments. And no, so we'll start out here with a diagram of the debtor and saver mentalities. I think most of the folks here, if you're watching these webinars, certainly made it to the 12th module here. You're probably not in the category that I call in my new book, The Wealth Elevator. We talk about people being in the basement level.
Most of us are at least on that first floor of the wealth elevator, where I started myself as an engineer back in 2007 after graduating college. Had a good salary, was a pretty good saver. At the time, I was able to save $20,000-$30,000 per year pretty easily. Obviously, I expanded on that as I got more and more rental properties, but I was still on this kind of saver track here in the middle. What we want to get everybody to is this wealth creator world where you're also implementing infinite banking or accredited investor banking. In the members portal, of course, you guys can check out that e-course on that particular topic, but using money to grow your portfolio, paying your loan back to yourself, your cash value increases over time. And this is how you get on the path of wealth creation. Been teaching this for quite a while. Started the podcast back in 2016. This is a fun flowchart I put back there because people are like, I'm fascinated about this stuff. Where do I get started? The first thing I've always started with is not everybody can do this, right? If you're in the basement level of the wealth elevator, you need to focus on personal finances. You need to get a higher income. You need to save money. Maybe as simple as personal finances, keeping a budget. And for some people who, if you follow some of these tracks here, if your household income isn't very good, under $40,000, $50,000, you're going to need to be taking a more active approach, whether starting your own business, flipping houses, although that's pretty risky in my opinion, and very highly competitive by everybody and their mother in that world. For the most part, if you are able to make a decent salary, $100,000 a year, and save a little bit of that, you can get on this first floor of the wealth elevator and start implementing these strategies. And we talk about three things in our world, which is alternative investments, tax strategies, and the infinite banking. The big one that I focus in a lot is deals, which is the alternative investments. Alternative investments is a term for everything that's not traditional. So traditional investments is pretty much everything that the stock market, certified financial planners sell, or what people call marketable securities. I've always stayed away from traditional investments. I've always done things on my own, bought my own real estate, or directly invested into an asset through a syndication. The reason why I like these types of investments and off of the traditional investment path is that I'm cutting out all the middlemen taking all my fees. Because very early on, I realized with my first buy and hold rental property, I was making 20 to 30% plus per year. When you break down the cash flow, the tax savings, the equity growth in a leveraged form, and the tenant was paying down my mortgage too. You can't forget that income stream. Now, some of that is in accrual basis, right? But nevertheless, my net worth was growing, and I was looked over to my 401k, and I was like, why would anybody want to do that? Go up and down in a roller coaster at supposedly 6 to 8%. The next question that came up is, why is there such a stark contrast between traditional investments and alternative investments? And then I realized, and I met so many cool accredited investors all speaking the same way, saying that's the middleman taking your cut. So a lot of those traditional investments are what we call below this line here. And to set this chart up, you got your lower risk investments on the left side, your higher risk on the right side. And generally what people understand those projected targeted returns to be. So a lot of these investments are going to be under your 8 to 10% threshold. And this may or may not include hidden fees or expenses. So it could be worse than this, but we wanted to just stack everything up relatively to each other here. So you've got your bonds, your money market accounts, online savings accounts would be categorized here in the left. And then you've got your REITs. So REITs invest in real estate, probably invest in the same things that we invest in. But when you're investing through an institutionalized traditional investment, again, heavy fees, and they may or may not be doing any value add too. doing physical renovation. A lot of times we'll sell to folks like REITs, right? The REIT owners like these sort of really clean assets where there's nothing really wrong with it. So they can just sit on it and just be a very passive portfolio for them, which there's a fine line between a project that has some hair on it, and that's where you create the value. Obviously, we don't like to go through things that are less than 90% occupied or in disarray. There is something to be said about putting in value, force appreciating an asset. And when we get into the PE world, I think you guys will see exactly what I'm saying, where you're going into a business, you're changing processes, you're adding new revenues, maybe add a bolt-on, cutting expenses, morphing the business, increasing the value of any business in the PE space. 401ks, the reason why we position this here and stocks is because traditionally, at least from a personal finance point of view, it's predominantly stocks as opposed to bonds. And these are probably account for like target index mutual funds, those types, which if you don't know anything about investing, I suppose they're great for you. I think suffice to say, if you're listening to this webinar, you guys are ones that take a little bit control over your finances. That's what I'm so motivated to get people into this world is if you just educate yourself a little bit, don't get intimidated by all this. Wall Street wants you to just be intimidated and just give them all your money for obvious reasons, right? The fees, and so that they can take their cut. But if you have a little bit of aptitude towards this, you have some interests, get involved in this stuff, join our community, and it can lead to a lot more. Obviously, it's worked for me, so I'm very passionate about it, but I've seen how it's worked for a lot of people in the past. As a joke here, lending money to friends and family, that's a bad investment all the way around. Low return, high risk, that's what you want to stay away from. There's this concept called beating alpha. So alpha is maybe thinking of like beating normal, if you think about it. I would call the waterline, as we said it here, around just under double digits. Not to say that these are bad returns based on what you're investing in. The problem is the 401ks and stocks, the relatively high risk stuff, and you should be compensated with higher return, but you're governed by the fees and expenses in those types of products. Now, when you get into the alternative investing space, you start to get into this upper echelon of returns that some people think is a scam money. Who gets 20%, 30% returns in their money? Who doubles their money in a year? I think a lot of us have seen recent history, the crypto world, alternative coin space. I don't invest in those types of things. I'm not a huge believer, and it's very speculative in my opinion. I would probably put it in the category of venture capital. We'll get more into that here in the next slide. This is where the active investors, this is where the family office hangs out. The very wealthy people who have direct access and insider information into where the best deals are out there. In the stock world, you can't have insider trading. It's illegal. Now, some of the politicians, I think, have it and people get upset by it. There's been a lot of laws put into place to prevent insider trading. I think that generally nobody has it other than the upper 0.1 of the 0.1% politicians, etc. For the average guy, if you think you have some type of inside track, please let me know. I would like to know. What's cool about when you get outside into alternative investments, like buying a rental property or an apartment, you have an inside track on that particular asset and you can buy it with insider trading information. And no different when you buy a PE deal, a particular business, right? You may know of some particular trade win or windfall that may be coming that business's way. For example, you could be going into an apartment deal, which has a pending insurance windfall coming. You can reassign the rights to an insurance claim that may or may hit at $5 million or whatnot. That could be something that is very well known, totally legal to know. If it happens, great, but it's your decision to invest in a deal like that. But this is the world that opened up to me, especially when I started to meet other accredited investors. And that's why people join our family office, Ohana Group, the FOOM, to get around other high net worth accredited investors who are passive. And we have it on our checklist that you want to have at least a dozen accredited investors in your inner circle community. If you don't have that, you need to start getting that. Without that, you were just like where I was back in 2014, 2015. Sure, I had 11 rentals back at that point, but I did it all myself. So I think people are surprised that I'm quite the introvert. I stick to myself. I get very passionate about helping people implement this stuff. And people tell me all this all the time when they come to the retreat. It's a lonely world being an accredited investor interested in this type of stuff. You can't really talk about this stuff to your friends because it seems like you're showing off or something like that. And you value your privacy too. So getting around other accredited investors is very difficult. There's meetups for real estate, but most of those people are non-accredited investors with no money trying to flip or wholesale houses or trying to get your money when you step into the mousetrap there. So it makes it very difficult for accredited investors to interact. And that's the name of the game. So you can get above this line. And I just threw a plethora of different investments out there that are more in the alternative investing space and above this line of varying levels of risk. Now, again, this is not scientific. These are just generalities. There's another concept out there called the Sharpe ratio. The Sharpe ratio says if you are somehow magically able to mathematically calculate the amount of risk a deal has in relation to the amount of potential reward, you want to have it follow a certain line, like this line, but maybe more out here. Obviously, when you do this, it disqualifies certain deals like lending money to family and friends. You would never do that, especially if you apply the Sharpe ratio concept to it. But this idea of where you want to be a mature investor, there are some investments that are high risk, but definitely worth the reward. And it's up to an investor to decide and ascertain this on their own. So this may feel like very uncomfortable to new investors, but over time you learn by doing and you learn by a community too. Just to point some of these out, maybe we'll start on this high risk side and work our way backwards. You've got venture capital startups. These are very high risk, high return. I would probably call this even higher than the 30%. Some of these can, double. We're not talking about percent per year return. We're talking about multiples per year, 2x, 3x multiples. But I just put it here in relation. These are investing in things that don't have any existing revenue yet. Angel investing, certainly. Land investing can be the same way. Very speculative, though. You could have to sit on that land making nothing for years on end. Development and flipping is high up there. This is where we broke down multifamily value add can mean very, very different things, right? You can go in with a bridge note and a much more aggressive quick plan, be in and out in 2 to 3 years or less. Or you can go into a deal where you're taking agency financing, 5 to 10 year loans and be in it for quite a while, more than 5 years. And the risk does too. Non-performing notes down here for those people who like to trade the paper on investments. You can get some nice returns there. It's other younger brother, the performing notes. And the difference between performing and non-performing notes, the non-performing, the person who is paying off the note isn't paying. So they're AWOL. We don't know what's really going on. That's why the risk is a little bit higher and the reward is higher, obviously. Now, working our way back here, you got your single family home rentals, your turnkey rentals, you got your second lien private money notes where your positions, where the equity line is very similar to some people like to invest in preferred equity, similar returns, slightly higher than 10%. You could find a particular deal where their distress level is a little bit higher. They're running a little bit dry on money. So normally maybe you could get 10, 12% in a note. But because you know the owner or we know the owner, you could negotiate a slightly better deal. We're looking to put together a note fund maybe in the future to take advantage of this. Some high net worth folks out there, and this is when I start to hang out with all these high net worth accredited investors and qualified investors beyond that, and this is where I get all the information for writing what's on that penthouse level or beyond the rooftop of the wealth elevator floor construct. For those of you guys who've read my book, there's a table in there, a little diagram of all these floors. And I've got in the mind of these higher net worth investors out there. And some of these guys, they don't invest in the deals per se. They just sit back and they wait. and they'll deploy $500,000, $2 million in a deal. When the deal gets to distress level, they come in as rescue capital, and they may put in $1 million and get 15, 20% annual returns on that. But on top of that, they might get 5% as a quick fee, quick money right away. I've seen guys come in even as high as 10% a month. Some people think that's highway robbery, but if a deal needs it and long-term prospects make sense, it is not out of the ordinary. So that's where somebody who's well connected as an operator can really take advantage of other people and package that up for other investors in one of these distressed rescue funds out there. But not all of them are like. I think that's hard for investors to evaluate. That's just example of what's out there and what higher net worth people are doing. A lot of these investments are really more set up for the people on the second floor, third floor, and the penthouse level of the wealth elevator. Obviously, when you go above the penthouse level, your net worth is more in the $25 to $100 million range or greater. And then, of course, the first lien private money lending, which I think this is what people start off with when they go to the local real estate club. There's a house flipper out there that needs some money. So you lend money to them on their house flip. Unfortunately, you, the investor, don't get the upside. You take on all the risk. The house flipper partakes in the upside of that deal. And normally about 10%, 12% is the normal. And a warning here for some of you folks who are getting like 13, 14, 15% or more on a house flip, really scratch your head because you're likely working with a newbie house flipper. The only reason why they would be paying that much is because they're desperate for cash and they can't attract anybody else based on their track record. So not all deals are equal. I just put that there because maybe a fraction of our community comes in through the private money lender world from the house flipping space. But again, this is residential properties, very highly competitive, a lot more risk than most of these here are in the commercial world, more institutional, higher quality assets at the end of the day. One thing you're trying to do here for a lot of people is get off the beaten path, move from these things we're very familiar with in the traditional investment world and step people up slowly into things that make more comfortable. An analogy I like to use is sushi. For those people who don't eat sushi very much or maybe tried it recently as an adult, normally your buddy who has sushi has you try the California roll, right? No raw fish, it's imitation crab, there's a vegetable in there, you just soak it in soy sauce and you're good to go, right? When I started, and I just started with a turnkey rental property, and then you move up to the shrimp tempura roll, and then at some point your buddy sneaks you in with the spicy tuna, which is actually raw fish. So then you're moving up on the scale of more exotic sushi. And this is where maybe this is similar to when I started to get involved in syndication private placements in 2015, when I was scaling out and selling off all my rental properties. And maybe the uni is investing in venture capital and private equity, which in recent history, my secret is like I have my inner circle of other general partners and other investors on my level. And we talk just like how you guys should, right? You guys should be having a cohort of people around you. You talk and you also get good deals, good relationships. This is what I do on my side personally. What are you guys investing in? As a group, we transform ourselves. Real estate was really good from 2010 to 2022, 23. We had a recent correction. Interest rates are still relatively high, and they're predicted to be high in the near term and midterm future. This is what's opened up private equity deals as a better solution. And things change, right? I think depending on when you're watching this webinar, things may change. For example, we're going to get a little bit into infinite banking versus taking money from your home through a HELOC. If you would have came to us a few years ago, the HELOC would have been the huge way of doing that because interest rates were low. You could get a HELOC at a 5% rate. Now today it's way, way higher, and the infinite banking rate at 5% or so is lower. So that's the option that is on the pedestal now, where again, 3 years ago, the infinite banking was the secondary option. This is where we're not giving any financial advice here. You guys have to make your own decisions, but at least be aware of what's out there in the galaxy and not just be like most people who are stuck below this line in traditional investments, because that's exactly what Wall Street wants you to do. If this is all new to you, don't be ashamed. I went and learned those dozen types of investments. It took me, again, from 2010 to 2025, still learning. So it took me over a decade to see this a section at a time. So let's break this down more on my personal story here. I went on this as a more steady, stepwise fashion. People do funny things late into the night on their spreadsheets and PowerPoint. This is from my personal private files. I don't know when I took the screenshot. It must have been from like prior to 2020, but I attempted to put all my real estate holdings on a diagram based off of Class A properties here, Class C, and then more of the yield plays, which is the opposite of heavy reposition developments. And this is the way I was mind mapping to myself and just checking myself that at least my real estate holdings were more scattered in a way, or at least where I wanted it to be. Like, for example, I think if I wanted to invest in a deal, it would probably be more of a B plus class property that had a good amount of value to add. So I guess I'd be clustering around here. Obviously, there's a whole bunch of stuff here. There's a whole bunch of stuff here. So it was not that case, but maybe the weighted average would have been where I intended it to be. No deal is going to fit your buy box the way you want, and you have to diversify. You can't just get into 1, 2, 3 deals. You got to look at it more like 20, 30 plus deals to adequately get that weighted average where you want. This took a long time to acquire these types of projects, and maybe it might take a guy, even if they're well connected and conscientious about it and joined our group and got plugged in with a network and got a lot of deal flow, maybe they would do a deal every quarter, assuming that they have the funds to do that. It would take you a long time to get all these circles here. And going back to that really confusing chart of all those investments, now that I thoroughly confused you, I wanted to try and rein you back in and simplify it a little bit. So when you look at a deal, it usually follows in one of these 5 categories on this investment spectrum. Again, the risk and growth is more on the right side here, high risk, higher return, and the security is more on the left side. So on the right side here, high risk, high return, venture capital, angel investing, things that don't really have any profit yet or even any income. WeWork was essentially venture capital. They raised a whole bunch of money and they just spent it like drunken sailors, hoping that the company would go. What we like to invest in are things that produce income and have positive cash flow, positive EBITDA. Apartments that we take over, we look at the last 2 years of financials and we evaluate it. We make certain projections on things that we can improve, like renovating the units, which is obviously not rocket science. And we make an assumption of what the income will be. And most times in real estate deals, we're not decreasing the amount of expenses, but increasing it because we're adding to the services which tenants pay more for. But that can be very much predicted and modeled out. So those are these 2 categories right here. In the real estate equity investing, there's a whole bunch of different deals, right? This kind of square, you can have higher risk real estate deals where you're in and out in a year. You have lower risk where you have agency financing and it's maybe a 5 to 10 year play. But just putting this in terms of, I guess, planets. You have venture capital planet, you have PE planet, you have real estate planet. Planets are huge, but when you zoom on out, this is how you'd arrange the planets together. Debt investing, I think this is where it blends with real estate. And this is where you can lend money on an asset and you're positioned higher in the capital stack. So your security, in case the asset's value goes down, is a lot more secure. However, we know with less risk, you typically have less return. And if you're looking for something that's almost risk-free, nothing here is risk-free, obviously. That said, it doesn't have very much return. Life insurance is usually like 5% returns on that. Obviously, other reasons why you do it. T-bills would probably put in here. Bonds would probably be put in here. This is a way of looking at your portfolio, and essentially you have to come up with your own portfolio allocation mix. One thing that I personally do, again, I'm not a certified financial planner, guys. I'm just telling you what I personally do. I take a barbell approach. So a barbell, if you're thinking about in the gym, and the two ends are very big, in the middle is very small. I take an approach of where I'm going into alternative investments. I would say alternative investments are more on the riskier side, but I do think that it has outside return potential. So I personally believe it's a good risk adjusted return. And I have a lot on the no risk side. So that's how I do it. And the skinny portion of the barbell in the middle, I don't have any Wall Street traditional investments. And you may think that's crazy, but when you get around our world of accredited investors, that's not crazy. A lot of them don't have any of those traditional investments either. Now, I certainly think that when your net worth goes over $5 million, certainly when you pass the age of 60 and you got to think about your mortality, I do think having a certified financial planner on your team makes a lot of sense. And I am in the process of talking to other folks in the industry, seeking out the best ones. But you really want a good one, right? Not the one that works for one of the bigger financial firms, because those are just run-of-the-mill financial planners, right? But for folks who are not yet to that scale, you want one that works with more higher net worth people. So again, breaking this down and just giving people sort of an ideal, something to start with, right? This is not a suggestion of actually going out and buying these particular investments, guys. Use your common sense here. But I just wanted to show people how one would go about. The analogy here is like building on your Lego sets, you're building your blocks. It's very different than going into your 401k Vanguard portal and just clicking a bunch of buttons. This is you're working in terms of bigger chunks, and bigger chunks for you at this time when you're starting out. But this is where when you have a portfolio of dozens and dozens of these types of projects, it starts to become very granular and emulate a lot like a traditional 401k portfolio where it's just percentages at the end of the day. These types of private placements and syndications, you're going in more directly into the investment. Therefore, the general partner sponsor of it doesn't want a gazillion investors. That would just be too costly in terms of administrative costs and other headaches. So there's a certain balance. In most deals you see out there, usually the minimums are $50,000 to $100,000 per investor into that deal. Anything less, I would really caution even investing in the deal. At one time when we first got it started, we would take guys in at $30,000 a piece. Within our industry, we all talk that those are the worst investors to bring in because they just don't have the money. There's another reason why we stopped working with non-accredited investors. And it's the folks that don't really bat an eye too much at $50,000. Those are the real investors out there that can repeat invest. And that's where more institutional firms, where the investor splits aren't as good. A lot of this is covered in the syndication e-course. Some of the GP LP economics gets skewed more in the GP's favor, and the fee structure gets more skewed in the GP's favor as a firm gets more and more mature. So there's sort of a spectrum of operators, right? You can go to the guy who just did a weekend boot camp and just got started, like how we were back in 2015. And you can maybe get 85-15 splits. 85 goes to LP, 15 goes to GP. You can get in with maybe $30,000 minimums, but good luck, right? That was where I made a lot of initial mistakes as an LP and a GP, working with just unproven people. And then on the other side of the spectrum, you have more institutional managers who they don't want to work with anybody who's bringing in a check size of less than $1 million or $500,000. And the fee structure is more skewed in their direction because they have a big firm and team to pay their salaries with. So there's a spectrum, and I've always said you got to try and find something that's in that sweet spot in the middle, which I think that's what we are, right? Like we try to have this ohana of investors where we get to know people here. We make ourselves accessible, although it is getting tougher and tougher these days. We're getting over 900, 1,000 live investors, done over $2 billion of deals. Certainly it's becoming a bigger thing. Obviously expanded the team to help out with this because the first several years it was just me doing everything. And obviously now I got to focus more on the deal flow side and the acquisition side. But I think the education part of this is very important. That's why I still get involved. And this brings me a lot of joy to help people get started in this world because it was difficult for me to step out of single family homes into this space because who talks about it, this stuff? So back to the slide here, the idea is you start to layer your investments together and build your portfolio over time. Unfortunately, if you're buying in the beginning, you're not going to have a very diversified portfolio, and some of it is timing. Folks that got started in 2021, 2022, bought at the peak of the market, it's tough for those people. After that, the market corrected, so maybe now is a much better time. But I think after a while, you want to spread your portfolio over 4 to 7 years so that we know that a market correction is going to come every 5 to a dozen years. We just don't know when that's going to be. So the only other way to mitigate that is to diversify and to be able to absorb those ups and downs. So this gets into what do we do now? So you got to ask the question, where is your laziest equity at? Because I think a lot of people, like in particular, they may have rental properties or home equity that's not making very much money in there. And the idea is to get that money working, especially if you're under $2 to $3 million net worth. If your net worth is $5-10 million, sure, you can buy your house cash. You can buy gold that barely appreciates and just stick it under the mattress. You can do whatever you want. But where I'm coming from is when your net worth is less than $2 to $3 million, you need to still grow your money, and you need to do this prudently. And so going back to that case of some people have this idea of paying off their rental properties, which makes sense if your net worth is high. But if you're in the growth stages, this is more of the conceptual plan that you need to be doing. As I mentioned earlier, when I broke down the returns I got from my little rental property when I first got started around 2010, I was making pretty good returns every single year. But as the property appreciates and you pay down your mortgage, you have a higher equity position. So it's not really return on investment, as I point out here, but it's return on equity is the big thing here. Return on equity. So the way it works is as the years go by, your return on equity goes down. Now, at some point, you have to refinance, sell, or do a HELOC to extract that equity and get it redeployed. Now, I'm not a huge fan of 1031 exchanges unless you're making a capital gain of over several $1 million or some more advanced strategies like that. You can reach out. We can refer you to folks who do that. What I would urge you if you're in this situation is go check out my masterclass on mitigating tax gains. It takes you through, I think, maybe 7 different methods just to unlock, and we can have a conversation after you go through that masterclass. Once you get the money out, you re-leverage it into the next deal or multiple deals, and then you reset the C curve over and over again. Now, if you're like most landlords out there, you ride that curve all the way down 10 years, 20 years, where you're barely making any money. Now, a case in point in this, if you're in California and Hawaii and you have a rental property all paid off, that's probably $1 million that's locked up in that asset. And if you're renting it out, you might rent it out for $4 or $5 grand per month. But we all know like half of that goes to expenses, taxes, insurance. Hopefully your tenant doesn't drive you crazy, especially if you're in a blue state. But you may only make $2 grand per month on that $5,000 rent check. I'll call it $3,000. So that's if your equity position is $1 million and only making 30 grand, 40 grand, that's less than 5% return on equity. If you remember back to that old chart that we just went through, that's a horrible rate of return. It's an alternative investment, technically, not technically, but it is an alternative investment, but the returns are horrible because the debt structure isn't optimized. It's like you're on a sailboat, the winds are going well to your back, but you don't have the damn sails up. It's silly, but this is what a lot of amateur landlords do. They don't take this into account. So here's to give you a framework of some options out there to get you started. Now, based on when you're watching this webinar, some of these options could be flip-flopped, but traditionally the HELOC is the first way of tapping equity into your current rental properties or your home because it's temporary and there's no fees in it. The problem is you can't get all the equity in the house, but it'll get you going. I think that's the big part is just start to investing, getting going, and then you start to unlock the network of other people and you get more and more comfortable. Eventually you do a refinance on the house. And this is where I ask people, the rental properties, I think once people get into this world, they're sold on it as I did, and you start selling off the rental properties. There's some good websites out there to sell the properties with the tenant still in place. They attract a lot of unsophisticated turnkey investors. I won't say what it is on this channel. You guys can reach out and we can connect you over to those people. But great way to get rid of your turnkey rentals or rentals with existing tenants in place. Another way is to just do a cash out refinance on your home. And this is a way of tapping even more equity in that house, because the HELOC normally you won't be able to get at the last 20% of equity in the home. But this is where also sometimes I ask people on onboarding calls, do you want to live in that house or you want to keep the rentals long term? This may be the motivation to downsize or move just to unlock that money. Similarly to like another way that people get assets to invest is through 401ks. I know another guy helps people change jobs just so they can lock that 401k, because the way 401ks work with most employers out there is you can't really touch the money and self-direct it into a solo 401k or a self-directed IRA until you've left the employment of the employer. They're similar concept, but two different sources of money. The other one here, and I just want to put in people's head, I know it's not practical for a lot of people and it will cause your spouse to divorce you. But the reason why I got to where I'm at was in my 20s, I was able to not live anywhere and just rent. And I was able to plow away $50,000, $100,000 a year to down payments or investments every single year. And that's what set me up to my 30s and now today. If you do the math, especially if you live in an area where the rent to value ratios are under 1%, it makes sense to rent, especially if you're buying a house that's more than $500,000, $600,000. The reason being, real quick, is that the down payments on those properties are so huge. You have to do the math on if you would have taken that huge down payment and put it into investments. Of course, a lot of different investments, varying levels of risk and reward. You have to do the math on your own and assess the risk. Another way, like I said, deploying retirement funds. But the reason why the equity in houses are always first, especially for a HELOC and cash out refinances, that's not a taxable event. When you sell the asset, it is a taxable event. But like you said, there's ways other than the 1031 exchange to get the money, defer your taxes on those sales. That's what I did in 2016 or 17. I sold off 7 of my rentals that year, and I had a $250,000 capital gain that year. But because I was investing in syndications that year and prior, I had built up several $100,000s of passive losses that I was able to use to offset that. And that's what people call in our world the lazy 1031 exchange. And that once you've deployed funds in your retirement or HELOC, that's where you start to, in a way, look through the look for coins in the couch and look for other assets that you may have that earn less than 5%, then 10%, then 12%, you keep marching up. So that's what we did. That's actually how I got my wife to start investing. She had a condo. We sold it. I talked her into renting, which we still do today. She was able to invest it in a deal. And I think we doubled money on that one in 3 years. And I guess the rest is history. We're still together to today. Never can count on the future, but we're still today, and it's been working out. So sometimes when I just put it more on paper in a different form, make a plan, put the years up on the top, and then these different sources of funds. Everybody's situation is a little bit different. I find this kind of fun, right? It's like a little puzzle where you say, we're not saying where the money is going to go, but we know that where it's going to come from. That's why I call it a deployment plan. And you can make a plan based on your situation and where the money is coming from first. So the first place is always going to be your heart, sweat, and tears, your annual savings. Again, most of the people in our community save at least $50,000 to $100,000 a year, some much more. So that's where you deploy from first. And then cash savings. And then this is where you start to tap the home equity or the retirement funds, which we call qualified retirement plans in various orders, right? Everybody's situation is a little bit different based on your taxes. If you're in a higher tax bracket, you may do the home equity first because these will be taxable events by taking money out of your retirement account. And vice versa. If you're under $380,000, $400,000 adjusted gross income, you're in a relatively lower tax bracket. So this might be a better way of going first before touching home equities. Every situation is a little bit different. And then you also layer on top of that, plowing money away through an infinite banking policy and kind of making money in two places and playing that loop there, which we'll show a table of that here in a bit. But you can have various different forms of this. Every situation is different. If you haven't jumped on an onboarding call with myself, we certainly can have a discussion and I can give some input. I don't know your entire pictures, but we can chat, and I think this is fun. I'm not giving any financial advice, but just different ideas. What I like to do is I just like to fill people's heads up with ideas, but what really brings it alive is when they talk to other folks in our community, join the mastermind group, and then you hear their kind of kooky ideas too. And then now you're able to also have conversations on what exactly you should be doing. Some general ideas here. It's not about getting into 1, 2, 3 syndication deals and make great returns. That's really not going to move the needle, guys. Like, this stuff isn't magic. This is not a get rich quick scheme. If you put $100,000 into a deal and it makes you on average 10, 20%, or even 30%, is that going to change your life? No. What this is a holistic strategy of deploying gradually over time. Slowly, you get slightly better returns, and then some of these deals will have better tax benefits, like the real estate. That's what in turn lowers your taxes over time. And then you flow it through infinite banking. And it's this combination of these three things working in conjunction. I think people get enthralled by these higher returns, but unless you put a larger chunk into it, you're not going to really see the impacts right away. Now, if you want to gamble and put 100 grand in some altcoin where you could make 5x, 20x, yeah, that'll change your picture. But I don't play that game. At least I've never in the past where I do that quite of an asymmetric type of play. What do they say, like on angel deals, angel investors, they might invest in 20 deals, but they lose money on most of them. Maybe only one of those are winners, but boy, is it a winner, like a PayPal or something like that. Although, of course, if you even had access to the deal, that's the big thing. That's on the scale of angel investing in venture capital, if you go back to that earlier slide that we were discussing earlier. What I think is the key is maybe not getting these higher returns in individual deals, but it's more of a game of stop doing the things that are hurting your average rate of return. So look through your portfolio and what are the things that are making pretty much nothing, under 5%. And that's typically home equity or maybe just cash just sitting there. It's the idea of why am I not getting physically fit and why am I keep gaining weight? I work out so hard. I do these wind sprints up the hill. But when you look at it, it's what are the things, it's not the exercising, it's just the simple things. So you go to eat Jack in a Box late in the evening. You do these things that are hurting you. And that's the same concept here. So sophisticated investors always monitor their return on equity as opposed to just feeling good about the initial return on investment. If that doesn't make sense, go back to that earlier slide where we talked about the return on equity slide. And remember, return on equity is your profit divided by the total deployable funds in that particular asset. So take that into account when you're taking a look at your primary residence or your existing rental properties. Now, this is a Sankey diagram. There's a website, if you Google it, that you can make one on your own. I think it's a great way of communicating this to your spouse. In most cases, there's one spouse who leads the interaction with the finances. The other might be interested, doesn't have a huge amount of interest in it. Obviously, you want to keep them involved and communicate what's going on. So this diagram is a great way of visualizing what's going on out there. Back in, when did I graduate? 2007. I had a decent income. I was a good saver back then, and I was able to save my money. But it wasn't until I started to pile on investments out there and then started to get into the syndication deals, phased out of the rental properties. But all the time, the savings went up. And at this point, it became like a third paycheck a month for me. And this is the idea. Look how long this takes, right? This is not a get rich quick scheme. It's slowly over time. The other big concept in this, and this is super common sense, but I just wanted to point it out that at the end of the day, this is about personal finances. The more that you can push into investments, the more you can augment your month-to-month savings and your cash flow. This is a breakdown of people's total spending per year based on their income and income growth. Most people think of what they get paid at their day job or their business. That income was obviously growing based on the investments. The more you make, the more you're able to save. So you can look at this two ways. It's all about the pizza here. This wedge is what they call it. The more money you make, the more you can spend and invest that difference. There's a concept out there saying, what do you focus in on, the income or the expenses? There's arguments both ways. I'll discuss the differences, but most people will agree that you have more impact on the income. Get out there and play some offense. Get a promotion at your job. Get more salary. Invest more so you can get more income from investments. Create a side gig. Propel your business. Invest in yourself to get more revenue. What I'm saying is increase your top line income as opposed to worrying about cutting expenses, not having your $6 latte. I think something can be said for cutting costs, but I think generally speaking, most people will agree that improving your top line is going to do more to your bottom line than worrying about being a miser and saving. And this flies in the face of traditional personal finance, by the way. If you guys have read The Millionaire Next Door, I got news for you. The millionaire next door doesn't have enough money. Realistically, you're going to need to get to that level of $4 to $5 million by the time you get into your 60s to have enough. Inflation is going to eat that so-called millionaire next door with the Camry. They eat their shorts. That's just not enough. And the way you do that is with getting off the traditional investment path in the beginning and going to these alternatives. And I'm now unlocking the tax strategies and then also throwing under the infinite banking. So one more concept here, this concept of the freedom number, or what we call the passive cash flow number. Think of it more like a velocity concept of like how much passive cash flow your income, your portfolio is generating on a month-to-month basis to be able to freely spend that with your personal expenses. Some people call this the critical mass number, or the where you hit zero gravity. You think of a spaceship that blasts off into the atmosphere and breaks the atmosphere and goes zero gravity at that point. When your investments make more money than you can spend, and then it just keeps compounding on each other. Good problem to have, or just the simply FU money concept. So it's not a net worth target, it's a monthly number. And for a lot of you folks, just to throw a number out there, it's usually between $15,000 to $50,000 per month. And we backdoor it into the net worth number because that's a lot easier to calculate for folks, especially getting started, who haven't turned their portfolio into a cash flow portfolio yet, is $4 to $5 million net worth using the 4% extraction rule. Obviously, a lot of different factors out there, like your age, how many kids you have, what age range are they in? If you have adult kids who are already financially on their own, maybe not financially independent themselves, but financially on their own, you may only need 3. And obviously your lifestyle. Some of you guys have expensive tastes. Some of you guys still live pretty frugally, and that's just become part of your identity. One little tidbit there, as far as like creating trust for your kids, most people will say that the magic number when kids become adults and have become their self for the rest of their life is usually about 35. So that's the age of when people will transfer funds to the kids at that age. No, obviously you're hoping that they're not a crackhead at that time. I've seen it a lot of times where people who are already past that stage in life get a whole windfall of money, and they don't go out and buy the Lamborghini or do something stupid with the money. They are who they are at that point. Obviously, I hang out with a little bit more financially conscientious people. So the idea is to diversify. You could have more of a cash flow focus or equity focus portfolio. So 2 different data points here, just to sample. You never want to have more than 5 to 10% of your net worth into any one asset or deal. That's certainly not diversification. It's harder in the beginning, right? When your net worth is lower. You want to have a startup phase with just test driving 10 to 20% of your net worth is normally what I see our investors start off with in the first 2 to 5 years. And make sure you try to spread that out over 4 to 7 years. Obviously, that's not going to be possible in the beginning. But again, that's what's going to make things a little bit more safer for you in the long run, because a market correction is going to happen in every asset class. Stocks, real estate, everything has a market cycle where things go up and down. And then obviously you want to have many deals. several dozen. And if you think about it, it might be daunting, but the idea is a deal a quarter for a year, over 5 years, that's 20 right there, and you're on your way. So like I said, you can have more of an equity growth focus mode or a cash flow focus mode. Two ways of getting to generally the same place. I think most people who are age of 55, 60, I guess that we would define that as younger, under the age of 60, may opt to do more equity growth focus mode. People who are already in retirement stage of life may pick the cash flow focus mode off the bat. You're going to be diversifying into many deals across the spectrum. If you remember back to my chart earlier of all my scatter chart of all my investments, they aren't always predicated on one area. Just like that other 5-block chart with venture capital, PE, real estate, debt investing, you're not going to just pick one of those squares. You're going to diversify over a spectrum. And this is where you have an infinite amount of commutations. And this is why there is no normal out there, guys. But you want to figure out what your passive cash flow number is, whether that's $15,000 per month or $50,000 per month. You want to stick a flag in the sand and say that this is what I'm trying to shoot for. This is what I need. I will be the first one to tell you that you will likely be wrong in your prediction. And this is the concept of, I want you to start walking on the moving escalator first before you really start to land the plane on what the heck that number is. The reason why I'm saying this is a lot of you guys come to the retreats. We'll do some personal finance exercises. What is my burn rate? Do I really spend $10,000 per month, or is it more like $25,000 per month, or vice versa? If you haven't yet even have $5,000 of passive cash flow coming in, you're like this little guy right here just sitting there and thinking, yeah, I'd like to have $15,000 per month. So I don't really believe that you're a really good predictor of what you really need until you start to walk on this moving escalator. Another thing, I think unless you have $500,000 of your net worth into alternatives, I don't know if you even have a big enough cash flow income source to be able to adequately predict what your passive cash flow number is. Some people are just brand new to this world. Maybe you have never owned rental properties. So the name of the game is just getting the first one and getting moving. And this is where hopefully we've tried to unlock a lot of these concepts for you in this masterclass series. But really, you need some community around you, right? You need other people on this journey to go up with you. Maybe not necessarily carry you, because we're all in this journey on our own. But if you surround yourself with a community, I think it makes it a lot easier. Certainly makes it a lot more fun. What I would say is get moving, get $5,000 of passive cash flow first, then come back and reevaluate this passive cash flow number. Most times what, at least from our community, is you guys will overshoot your target. You know, you may say that I need $25,000 of passive cash flow a month, but when you get going and you start to get $5,000, $10,000 of passive cash flow in your portfolio, and you start to feel what that is, that's the huge thing. You got to feel real life what that is. Then you may realize that $15,000 is more than enough. And therefore, you could have retired 2 years ago, like how we've had with some individuals in our mastermind group. And now they're trying to figure out what to do with themselves. What's the next journey after trading time for money? I think more times than not, a lot of us are, I don't want to say scarcely minded. We are more conservative in nature. So that's the reason why we overshoot this number. We see this concept. We do hot seats in our mastermind group where somebody will come in and divulge their financial picture. And a lot of times the group will look at it and it'll be like, man, you've ran 32 miles in a 27 long marathon. Dude, you could have stopped a while ago. And that's where it's a little sad in a way. Like my whole idea is like people set a number and then they get to the number and then they relax and chill. We've coined the concept of T-bill and chill, where you just put your money in T-bills and life insurance, something really simple and almost risk-free, certainly low return, but you have enough, right? You've hit that critical mass point and you de-risk your portfolio at that point. So said in a different way, get to at least a 20 to 50% of your goal number, and you're going to start to see that goal starts to move on you, more than likely come closer to you. I think most people overshoot it. And again, I think most people in our community, $15,000 to $20,000 of passive cash flow a month I think a net worth of $4 to $5 million can get that for you. So you certainly don't need to get past 8 figures. If you get there by the time you're 55, I don't see why you can't get to well beyond $10 million net worth by the time you get to your golden years at the end, right? It's just compounding interest at that point. So going back to my story is a little bit different. I've turned myself more into an entrepreneur, helping people along this path. Taking us back maybe a couple decades ago, I was the supervisor here on the left. These are some of my guys. And it was cold back then in the morning briefings. But a lot of this was stressful, traveled a lot. Luckily, I didn't have a family at that time. You have the toxic people culture in any Fortune 50 company. But I walked this path of going from step to step. Got some turnkey rentals, stopped doing that in 2015, got into syndications and private placements. I probably should have gotten off the beaten path and just retired a while ago, but I'm in too deep. And I essentially, the way I look at it is like helping you folks along this journey is my passion in a way. We have a lot of people who join our mastermind group and we move some things around and allows them to create that lifestyle that they want to quit their job. But then now they stay in the group because they like the community and it's, about social relationships at that point and also searching for the next passion. There's a concept called ikigai out there, which is the combination of 4 things: to find something what you love, what the world needs, what you can be paid for, and what you are good at. At this point, if doing pottery is what you love and what you're good at, fine. That's called a hobby, by the way. But if that's what you're good at, then that's great. But I think most people search for this, what is their ikigai out there? And that's what, for me, is I enjoy connecting with new investors, helping them along their journey, and then cultivating the community. When we have the retreats here in Hawaii or wherever we do them, it is a magical weekend for sure, and goes well beyond just talking about finances. I think too often people are stuck in this rat race. This is the final slide here, pulling it all together. The idea is you trade time for money, you throw the free cash flow from that after your monthly spend, you put it into an infinite banking, accredited investor banking policy, you flow it through some real estate, alternative investments, as he mentioned, a myriad of earlier in the presentation. Some of the investments cash out or they have cash flow from the investments. And this is in the growth years, you put it back and you pay back the loan and then you do it again. And you're making money in 2 places, the purple and the green. The infinite banking policy, the life insurance policy is growing, and the purple investments, obviously, they're heading in the right direction too. At some point, when you hit that critical mass point, you pay back your loans and then you go on a nonstop vacation. And that is the big high level picture on how this all plays together. This is a screenshot of my book here. There's a diagram for the floors of the wealth elevator. Most of you folks, I'd say, on the 2nd and 3rd floor of the wealth elevator as accredited investors. But the idea is we talk about strategies of what people are doing on the penthouse level. These are the secrets and tips that I'm uncovering from my network that I bring back to you guys. And some cool stuff out there that not a lot of people talk about. But the key of getting there is, unless you get off the beaten path, to me, I don't see there's a way of getting there because the returns aren't there, because Wall Street is taking your returns where you take on all the risk and you're going to be killed by taxes. Unfortunately, people are always stuck in the basement level, which is not even shown here, and the 1st floor, which frustrates me. And that was why my parents did it. They did it the traditional way. Thank goodness I never listened to what they did financially, but it made me test different things out there. And I discovered this alternative investing, alternative finance path, and uncovered this wealth elevator myself. And now, as the metaphor suggests, we try and send the elevator back down. So especially if you're somebody who's already on the 3rd floor and you want some community around you, join us. We want to try and make it where people help out each other within the group. And at the end of the day, send the elevator back down for other people. If you haven't yet, check out my book, The Wealth Elevator, found on Amazon. If you guys have already got a copy, thank you for purchasing it. If you want to share it with a friend, we can send you a secret link at thewealthelevator.com/secret share, where you can give a free copy to your friends and also get the MP3 PDF version. If you guys have any friends who think might be interested in it, you can also connect them and get this masterclass version or the audiobook. I think both kind of resonate with different groups of people. I think the masterclass that you guys went through was a little bit more granular than the book, whereas the book might be good for newer people, right? Because it's a little bit quicker to digest than, shoot, it's been like maybe 12 hours of these webinars. But if you got a friend, connect us via email and we'll get you a free copy of the book for sending people our way. And that way you also have a study buddy to go through the syndication e-course, which I think is the next step after you've completed this masterclass series. Go into the syndication e-course. Usually takes people 8 to 10 hours to go through. And then of course the infinite banking e-course. And if you haven't had a onboarding call with myself, book a call with myself. If you want a life insurance policy illustration, or you want to evaluate your old life insurance policy to see if it's up to AIB infinite banking standards of today, let us know. But anyway, we can help. Shoot us an email at team@thewealthelevator.com. And thank you all for listening in. The introduction to infinite banking. I'm going to try and keep this presentation brief and under an hour for sure, and some Q&A at the end. Some of you guys are more experienced with infinite banking and looking to implement maybe the new accredited investor banking. Some of you guys are brand new. We're going to start off with a refresher. Of course, everything here needs to be personalized to your personal situation, which also includes the actual configuration of the policies. You can get a life insurance policy from pretty much all the major companies out there, but the devil's in the details how you configure this stuff. I'm not giving any financial advice. I'm not a certified financial planner, nor am I licensed to do these policies. I'm just telling it from how I do it. If you guys need a referral to the folks that do it for our community members, please let us know, team@thewealthelevator.com, or with any vendor that you guys need, thewealthelevator.com/vendor is the URL. What I've discovered just through my own journey and what I talk about in the book, The Wealth Elevator, is 3 major parts of this, which is investing in alternative investments. That includes real estate, private equity, rental properties, and then the tax strategies. And then the third part is the infinite banking, where you're making money in a couple of places. And the question that comes up, what do people do with their short-term or mid-term savings when they're letting it build up to get to a substantial amount, $50,000, $100,000 to put into a larger deal or go buy a real estate asset? This is what I've discovered talking to so many accredited investors as a best practice, what a lot of people are doing in that intermediate time. And then also long-term in the future, like when you're out of the growth mode and wanted to put your money more into savings mode, but still generate a return. Right now, the problem with putting your money in 401ks and IRAs is the liquidity there. And on the other side, you've got your money in the bank where you hardly get any interest and you're getting beat by inflation. You have to have your money working, either in investments or something that's beating in the pace of inflation. Essentially, the idea is you're double dipping and you're making money in a couple of places. And in a way, you're replacing the bank, which is making money off of your money. I think we all generally understand that the bank takes in deposits and then they go and invest the money. A lot of times they'll invest in apartment buildings or real estate or other investments out there, or they'll lend it out to local business owners and operators, and they'll make a higher return, and their business is making money off of the spread, and they make a great yield off of that. So by implementing infinite banking strategy, you're essentially getting rid of the middleman and becoming your own bank. Also, part of that is getting part of that yield back. What it's based off of is a whole life policy. Life insurance, you've got 2 kinds of policies out there. You have the whole life and term life. No, not a certified financial planner. Term life, I think, is something everybody should have, where if you passed away, at least to pay for funeral expenses and close up loose ends. Now, I think most of us in our community who are accredited investors, you probably want to have maybe a 7-figure, high 6-figure type of policy that gets cashed out to give to your kids, your family upon your passing. Some people say, I'll be dead, so it doesn't really matter. But to leave this earth and leave your loved ones behind, money to help things, maybe not the grieving process, but helps them carry on the life, at least
make up for the fact that you're not making income, which is what these policies are based off, your earning potential. On the other side of it is the whole life policies, which is what these infinite banking, accredited investor banking policies are based off of. Both kind of do the same thing, right? There's like a payout scheme upon your passing. And again, a lot of this talk is a little morbid, but this is what you're basically doing is using these life insurance policies as a hard asset. And that hard asset is a life insurance contract that has a cash value policy. The nice thing is when you start to fatten up these whole life policies, you get the benefits of the term life policy too. So of course, talk to your own insurance provider on what threshold makes sense that you get rid of the term life so you don't have to pay for two things that are doing the same thing. But by implementing this strategy, this is the secondary benefit of doing this. This is the big reasons why people are doing this. And when I first started to learn about this strategy, if you're somebody who gets bogged in the details, it can get a little confusing. But we'll start here on the upper left-hand corner. One of the benefits of using the whole life policies is it's a very stable policy where the premiums are guaranteed to remain the same, right? Doesn't matter if your ages changes in your health, which is again why it's important to get this stuff sooner rather than later. We have some folks over the last several years dragging their feet on this, just like the trusts and stuff, living trust, people tend to delay it, but your health ain't getting any better. The sooner you do this, the better, if anything, just your age. But also that's what separates the whole life policies from there's other policies out there that are called IULs, Index Universal Life, which are fixed onto what's happening in the stock market or the economy. So the whole life is based primarily off of your health index and not really tied to what's happening in the stock market. You could configure these policies with a component that goes up and down with the stock market. Again, we can connect you with the agent if you want to do that. But just to keep things simple for today, we're just going to keep it all with using the whole life as the base to take the economy out of the equation here. Investments, they go up and down with the economy. They're market dependent as it is. To do it with the whole life takes that factor out of the equation. Upper right-hand corner, additional dividends. You can use dividends that you get from the policies to offset your future premiums in case you run low on liquidity in the future. It can be used to pay that so your policy doesn't cave in. And also put in additional money to buy up that additional insurance, or what we'll call paid up additions. And we'll define these terms a little bit later when we go into more detail. What this does is increases the cash value of the policy. Continue on in the circle, tax-free loans and withdrawals. So this is kind of the reason why we do this, especially in the growth years, right? When you're under a few $1 million net worth and you're trying to grow your money in multiple places, invest in alternative investments. The idea is you put your money into an whole life policy and you take a loan from yourself and then put that money to work in an investment or a rental property. You can also use the cash value to do whatever you want, right? Remodel your kitchen, buy some jet skis. I wouldn't necessarily do that if you're not to the end game level of net worth, 4 to 5 million. But hey, that's you, right? The money is there to do what you want. And then the cool thing is while you have an outstanding loan out, your entire cash value continues to grow in the policy. The analogy, if you want to think about it like a home equity line of credit, you own your house. And then if you want to draw the value out of it, you can take a line of credit from it through a HELOC, home equity line of credit. And then you can use that for whatever you want, right? But then the house, the underlying asset continues to grow and you get that upside. Same thing here, just to easily digest it. Think of this as no different than a home equity line of credit to your house. Where in this case, instead of the house, the underlying asset is a life insurance contract that has a cash value. And when you take loans from it, it's like a HELOC. Additional benefit, as we said earlier, again, this is the secondary benefit. I don't want to have this come across as the big thing. You also do get a death benefit. And as long as your premiums are paid, your beneficiaries will receive the full life insurance benefit minus any outstanding loans. That's a big concern with people, right? People are like, I'm taking loans from this policy and I don't know when I'm going to die. And probably when I die, my pants are going to be down and I'm going to be caught.
Nobody wants to die with their pants down. That's probably the worst position to ever be. But more than likely, if you don't know when you're going to pass away, you're probably going to have some outstanding loans on your policy because you're likely still in the growth stages. But no big deal, right? Whenever that unfortunate day happens, you minus any outstanding loans, and then the cash value goes to you tax-free. You can also talk to your agent about adding on a long-term care rider onto that too. And then the last thing here, you get the guaranteed cash value growth. And this is the one part of the double dipping strategy. So when you fund these policies, the cash value grows tax deferred. And then again, the premiums can be used for whatever you want. The way I've done it in the past is I use it to take a loan out from my own policy and use it to invest in investments. That's when you're in the growth years. When you get to more retirement age, you can just use it to pay it all off and have all your cash value there to pass it down to the next generation. Or you can simply withdraw on it very slowly and use it as retirement income. You can use it as education funds in lieu of a 529 plan with a lot less restrictions there. You can use it to pay off your mortgage. Depends on where the interest rates are. Right now, interest rates are pretty high, and you're probably going to be paid a lower rate with your infinite banking policy. So it would make sense if you're just looking at it from a numbers perspective to pay off your high rate mortgage and just pay the interest on your infinite banking. Of course, every situation is different and these things move in flux, right? As interest rates go up and down, certain plays become more advantageous. And this is part of the whole alternative finance world out there where it's just not a one set thing. It is very much, it depends strategy. And you'll see a lot of what we're talking about today is a lot of just the basics of people take these, they use these policies and these strategies. They do some pretty cool stuff with these policies. You can also use it to establish an emergency fund. The cool thing about these policies is when it's in there, it's sort of asset protected depending on which state you're in. Very similar to 401k, very hard to get at from creditors and litigators. Personally, I'm a business owner, so it's a great place to store your payroll for your team and reserves, places that kind of store the cash you need in a rainy day. But you definitely don't want to put it in the bank where banks fail, at least the lower tier ones. And you get a pretty horrible rate of return in there. Here you get much a better return. And it actually, a life insurance company with a AAA rated firm is a lot more stable when you look at bank failure rates. I will address this right now. We said the word whole life insurance. And if you've followed Dave Ramsey or you're doing some Googling on whole life, there is a lot of people out there that will say whole life insurance is a scam, right? You should just buy term life and invest the difference. And this is a dissidence that I was like very confused in 2015, 16. I started to meet a lot of accredited investors and started to learn about these alternative investment strategies. And I was like, then why the heck are these very affluent people using these very large whole life insurance policies? And it didn't really occur to me that the whole thing was how these policies were configured. There's no difference between a whole life insurance policy that's configured with majority insurance versus how we like to do it with just 10% insurance. And then the other 90% is the paid up additions. That's the secret sauce. Most people, when you're talking in YouTube land or articles or tweets, you never get past the surface with this stuff and they just demonize whole life policies. So what I would say is whole life policies, yes, generally they're incredibly high fees, but the fees come from that insurance portion of it. And most times when people create these policies, it's with the majority of the policy that you put in as the insurance portion. Again, where the premiums and the commissions come from. Now, when you crunch that all the way down to the minority share or like even 10%, you can see how that drastically reduces the fees. And you can also see why a lot of these agents don't like to configure the policies like this. And then now you get to in this kind of gray area where you're like, I want an infinite banking policy. There's a lot of shades of gray in there, right? There's a lot of people that do so-called infinite banking policies where the mix is 50% insurance and 50% paid up additions. And still, that may be 5 times as much commissions as the way that we like to configure it. I'm taking a quote from Dave Ramsey here. He says, working for these big mutual companies out there, they screw people every day. And they actually, the business model is they'll get like the young guy from college or high school to go out and call their old friends and sell them these small few $1,000 term life or whole life policies. And the whole life policies are, again, not how we're configuring it, right? The ones that these guys are doing are the ones with the high insurance component with the high commissions. The opposite of what we're trying to do with the bare minimum insurance and the ability to take loans from it, which a lot of those mutual companies do not give you that ability to do that, or it makes it a lot difficult with the fees in there. Maybe you can remember when you graduated college, your long lost classmate gives you a call, wants to have lunch, and sells you on some life insurance policy. Yes, it's still whole life insurance, but it's all to do with the dosage of how much of it is insurance versus paid up additions. And when you configure it with very little insurance and 80, 90% paid up additions, that's where you crunch down the commissions and you keep more of it. But now you're configuring it how the big guys do it. Bank of America employ these types of strategies where they'll buy life insurance policies on their key employee. The Walmart does it with their key employees, Walt Disney, the Rockefellers, Rothschilds. A lot of these strategies are emulated by big family offices and companies. Again, using the same whole life insurance, but it's all predicated on the dosage. This comes down to working with the right agent who understands this and is willing to forego those commissions. But that's where I think our group is a little more sophisticated. We'll get into a policy illustration here a little bit to make you aware, or maybe if you have a policy currently, you could probably compare it pretty easily, or just submit it over to our team and then they can do a quick run for you. For some people, it makes sense to just scrap the policy. That's what actually I did with my spouse's one. But sometimes you can do like a 1031 exchange. You can exchange it and roll it into a properly designed policy. Maybe the word isn't improperly designed or badly designed, but it's what you're looking for. And when you are an investor and you're going to take the money out as a loan to invest in another place, so you can make money in two places, which is the policy generating a nice little return, and then your money is out working in a project, a syndication, a rental property, what have you, or even back in stocks. That's the idea where you're making money in two places. So for those of you guys who've heard the term infinite banking, at this point, it's a widely used term for the general use of whole life insurance. But again, it can be configured in different ways. This has been around, I believe, since the 1980s. Normally what happens are like the big family offices will use a strategy like this and they'll get it indoctrinated. And then it comes out to the more ultra high net worth, wealthy people out there. But even in the 1980s, 1990s, people have been doing this infinite banking here on the left side. And again, the real difference is the premium split. Whereas in this case, even if they do say, oh, it's infinite banking, it's just using a 50-50 premium split. What we like to do is crunch the premiums down even more to even 5 times as less to get the insurance portion just to 10%. So like a 90-10 or 10-90, depending how you're saying it. What this does is it stretches your dollar as much as possible, and it allows you to max overfund it even more. So again, I mentioned this earlier. If you're confused by this whole thing, don't feel bad. It is a little confusing. The best thing is to get around other investors who are actually doing these types of strategies. That's been my whole thing about investing and learning about these strategies. Like when I was first learning about this, I was like, this is confusing. But then I was like, then why are you guys all doing this? I don't get it. What works for a lot of people is they think of it like a house. But instead of a physical house, think of the house as a whole life insurance contract, which when you're talking big companies with very strong balance sheets that have been around, been paying since 100+ years, pretty stable companies to pay out the premiums. You think of it that as the hard asset. And when you're paying into the policy, you think of it like you're paying down your house mortgage, just like putting in your base premiums. That's like your mortgage payments every month. And that obviously you're building up equity that way too. But you can also do what's called paid up additions, PUAs, and that's paying extra payments to your mortgage. Again, what people will like to do is the insurance portion is maybe just a tenth of it, but the majority of it is these paid up additions. The idea is you're making these massive contributions to your life insurance contract to boost up the cash value portion. Just maybe in a matter of a week or two, you can take the money back out through a loan, just like you would a HELOC on the house. And the money can go elsewhere to do what you want, ideally investing. The house is still yours, right? The life insurance contract is still yours. And that continues to grow along with where else you put the money. These are the two terms to key in on. There is one gotcha. There are limits on how much you can put into paid up additions. And this kind of is dictated by when you configure your policy up front, you got to come up with a plan with your agent. A lot of this is dictated by how much is your net worth, what is your net every year, your net meaning how much you make minus how much you save, right? You want to right size a policy for yourself so that you don't fall behind. Yet you want to create the way I call it bucket. You want to have a big bucket so that you can grow into comfortably. This is where by having a too small of a bucket, you limit to just how much you can fatten up your policy or do these paid up additions on your policy. The other thing here is I don't think I mentioned it yet, but these policies have great tax advantages towards it. When I finally understood this, I was like, oh, now I understand why the wealthy do this strategy. But basically, the way the IRS sees life insurance is when the money comes out of it, it's seen as tax-free. At one time, people abused this. They would put $1 into the policy as insurance and $1,000 as the paid up additions. And it got to be a point where the IRS was like, wait a minute, guys, this is getting ridiculous. And they were like, all right, we got to put limits. So they started to create this MEC limit. And at this point, it's dictated by your age, gender, death benefit, but it's basically how much total funds you can contribute each year without the policy being considered a modified endowment contract. And at that point, you've crossed that threshold where it is tax. Luckily for all of us, these limits are pretty generous generally. You got to give it to those financial hackers out there. It's the real estate professional status. I don't know exactly when this was, maybe 10, 20 years ago, but it was a little loophole where a bunch of doctors would just buy one measly little rental property. And then now they would be like a real estate professional and then use all these real estate losses to lower their incredibly high doctor salary. And this is, again, where the IRS is like, all right, we see what y'all are doing here. We don't like it. You're abusing the system, which is why today you see all these kind of rules with the 750 hours and you have to have active participation in your portfolio. So they tried to close up these loopholes. Same thing here, right? People just got a little egregious without having any type of MEC limit there. So that's why this came into place. But this is where you work with an agent and you stay within bounds on these policies. But still, it's even as configured today, it's still a pretty good place to store some capital and do this double dipping effect. So the big part of this whole strategy is to take the money that you get from your cash value, take a loan from it and get on the offense and invest into real estate deals, stocks, bonds, mutual funds, private equity, your own businesses. And you can also take it for your own personal expenses too, if you want. This is just merely, you can see this is a tool that you can use in multiple ways. Whatever you have out as a loan, ultimately, if you pass away, it gets recollateralized and minused out of your cash value at the end. So that's actually a pretty simple process. I've got a few of these policies, but what I'll do, and a lot of this is in our Infinite Banking e-course. If you guys aren't a member, you can get access to this at thewealthelevator.com/club. If you can't find the e-course, it's in the e-course section, or just shoot our team an email at team@thewealthelevator.com and we can point you in the right direction. Going into these topics a lot more in detail in this e-course. And one of the sections is the easy ways to make this process as simple as possible. Now, some of the carriers out there simply just pick up the phone. The maximum over the phone loan that you can draw from yourself is $25,000, and you can get that done in 4 to 5 minutes. When you're signing for more than that, you typically have to sign a PDF document, and then it takes maybe a week for the money to drop into your account. But it's pretty quick liquidity to get money from there. And all the carriers have their apps these days and online portals. Works pretty simple where you can get the liquidity pretty quickly. To bring this all together, you contribute maybe 100 grand into one of these policies. Step one, Obviously, you have to work with a licensed insurance professional. If you guys need a referral, just go to thewealthelevator.com/vendor and then put your name into the form there. Step 2, you establish this policy. You have to go through some underwriting, a medical review. It's not that difficult. Most times, a nurse comes out to your house, does a little medical questionnaire. You have to obviously answer it truthfully. But most times, these policies, it's not really dictated too much on your health because we're not looking for the high death payouts. We're looking more for a liquidity mechanism. But yeah, certainly if you're a smoker or you're at high risk, may make this strategy a little bit less advantageous, but it's just better to go through the process and see if it makes sense for you. Once you start to fund the policy, now you have a cash value. In the beginning are when all the fees hit you. But by the 3rd to 6th year, the fees are a lot less negligible at that point as you start to hit this crossover point. And that crossover point is a way to, as an astute consumer, compare different policies from different carriers and then from different agents. Again, you don't know what the agent is charging you in terms of commissions and fees. At the end of the day, a lot of these things are commodity products, pretty much just a realtor, right? Do they want to charge you 3% or do you want to charge you 2%? At the end of the day, it's pretty much the same product. And I know the agents will probably disagree with me on that, but that's how a lot of the financial product world works. You take a loan from your policy, put it into a project, buy some stocks, buy some real estate. This is the name of the game when you are in the growth years. You leverage your cash value policy, and now your money is growing in 2 places, in your life insurance and also in that investment. You start to generate income from some of your investments in the long term. Maybe some deals go full cycle. And then when the money comes back to you, you put it back into your policy and maybe rinse, wash, repeat. But also life happens, right? And this is the way that people use these policies all different ways. Some people will leave 10, 20 grand of cash value in their policy for unexpected expenses to come up. I think this is a superior place to put liquidity as opposed to your under 1% bank account. And when the money is growing in here, it's growing tax-free. Where when the money is growing in your bank account, it's considered ordinary income. So again, this is tax advantage. And then the idea is continue on the bend into step 5 and 6, and you have your cash value grow over time, just like a house grows in value. You continue to use it as a bucket. And then the strategy kind of changes when you start to hit end game, $4 to $5 million net worth. And you're getting to a point where you don't need to necessarily invest. You don't need to grow. And one idea, theoretical idea, is you start to pay off your policy and pay off all your loans and just have 100% or a big portion of it as cash value. And at this point, you have this pool of money. If an opportunity comes up, you can just put it down, take a loan from yourself and put it right into the investment. But you have the capacity for it to be there. Obviously, it's asset protected when it's in the policy. You know, there's a lot of other strategies, but from a legacy transfer standpoint, there's all these cool ideas that people come up with in our community where, you know, the money's in there and you may assign the rights to your kids. What some people do who are a little bit older is they'll buy a policy on their kids, but still own it themselves. That's how they get around the whole, they're too old to acquire their own life insurance policy on themselves. Or if a lot of these policies is dictated on how much money you make, because again, that's how the death payout is dictated. What's your potential earning potential? The question is, does it make more sense to write a policy on our children who have a lower premium or ourselves because we are closer to that payout on the death benefit? Obviously, the children are going to have a longer life expectancy and are going to be in a better health rating. But the problem with that is they're going to be limited to the amount of the policy size that they're going to get. Because again, this is based off of their earning potential. And especially if they're 18, 21 years or under and they have no job, you're only going to be able to qualify for a pretty paltry sized life insurance policy, right? Like most of the people, accredited investors doing this strategy, you're dumping in $50,000 to $100,000 a year. And you're going to need to substantiate an adult salary to get that type of policy. I think it really works well if your kids are starting their jobs, and a lot of you guys have raised great kids who have professional 6-figure salaries. I think that's an ideal strategy to use them as the insured person. And you can even own it. You don't have to give it to them yet. And then now you can see where we're getting into these strategies of passing down the legacy, passing down the resources in this mechanism. For those people older than the age of 60, this is something really to look into to get on your adult children as opposed to yourself. A lot of these strategies are what family offices do. People with $100+ million, they'll do a strategy called PPLI, which works in the same way. You'll have the patriarch of the family buy a life insurance policy on the youngest person in their downline, and that person will be the insured head. Of course, they diversify, right? And then part of that too is if you have two working spouses, most people will do is they'll insure the female, because females typically, they live longer and the actuary tables are a little bit better from that perspective. But you also got to think of from a pragmatic standpoint. What if you don't pass away? What if your spouse passes away? Then you don't get any money, right? So to diversify that makes sense to spread it out as opposed to just put it on the female's side. So this is, again, where you talk with your agent and you find the best configuration. I think it makes sense to try and even it out, maybe put a little bit more on the female side because very slightly cost effective that way. But it's all based off of what the earning potential of the person. But yeah, as you can see, it's a tool that can use many different ways, especially when you get halfway through this procedure, you're seeing how it becomes a big part of your financial toolkit. The problem is just, again, going back to trust. Everybody who has kids here needs to have trust. You should have got it a long time ago. This is no different. Once you have it, you're glad you have it, but it's something where it's like you perpetually procrastinate on is what we notice. But again, this is a commodity product. And the way to compare policies, you could ask your agent, hey, the policy you did for me, was it a 80-20 split? Was it a 50-50 split? How much was insurance to paid up additions? Some of these agents don't even understand that question. What I've realized, it's a very technical type of product to sell, which is why finding people has been extremely hard to do it for our more sophisticated group. What you want to ask for is the illustration, or when you're getting a new policy too, you look at the illustration, which is this kind of computerized spit out of a bunch of numbers here. But the thing to key in on is the break-even point, which is highlighted in green here. At the end of the day, the policy is growing. You're paying fees in the beginning, but that's how you measure at what point, how many years does it take to when you recoup that and get back to even. This is how you can compare how much more advantageous one policy is to another. Some policies that are less configured properly with maybe a 50-50 split, the break-even point would have been maybe in year 7 or 8. Usually in these policies, when you're trying to configure it with the lowest amount of fees possible, usually around year 3, 4, 5 is when you're seeing that break-even point happen. But for those of you guys who like to shop, this is the way to do it. The problem is most agents out there, even if they are doing infinite banking style policies, it's confusing and most people don't know what to look for. This policy, by the way, is a 45-year-old male, non-tobacco smoking, where they're putting in $50,000 a year, which is our standard client out there, I would say, in their mid-40s. And then as you can see in this policy, it's like a 10 pay, right? So they're putting in money for 10 years here, $50,000 every single year. And out of that, the base premium is $4,500 a year. So again, like that's where the 10% is coming from. And then the other 90% is the paid up additions. So I believe that's the delta between the 50,000 and the base policy here. So as you can see, 90% of it is the paid up additions. So again, going back to that house analogy, this is like your annual mortgage payments. And this is the rest of it that you're putting in, about $45,000 a year that you're putting in as the sort of your extra payments to principal, which kind of goes straight to the cash value portion. So some people here are interested in the new accredited investor banking policy configurations. Now, these are a newer thing that we're doing for some clients. If it makes sense, for those people with a little bit more liquidity up front, maybe you're selling off an asset, you're selling off a home or cashing out a business, and you have $250,000 of at least a liquidity at the start, it might make sense to just flash fund the policy all in the first year or two. as opposed to doing it over a 6, 7, 8 year, or in this case, a 10-year pay. When you do it like that, you can flash fund it and then you can get to work quicker, right? You can take loans from it quicker. But it depends on your own situation. This requires you to plan ahead in the future. So it gets a little fun, right? How you configure these policies. This is where it's important to work with an experienced agent who also does these policies on their own too. A common question that comes up, are all the companies the same? Again, we'll try and work with the big carriers that are the AAA rated, been around for over 100 years, been paying the premiums. For the most part, everybody's using the top 3 or so, but it depends on some carriers are a little bit more flexible than others. I have 3 different policies with 3 different carriers. One policy, I have to make my paid up additions every 3rd year. Another one, it's like 1 out of 5. So it gets a little confusing, and I've probably made it more confusing than it needs to be for myself since I have so many. And I think that's where you need to find an agent who is non-captive. So they're not just selling XYZ insurance company's policy. They can go to what's really best for you and your situation. If your income is high one year, low the other, and your liquidity is going to be going up and down, it makes sense to go with a carrier that has a little bit more flexibility in how you feed these policies. Some people think that they're being savvy shoppers and they're finding smaller insurance companies that might have slightly better dividend rates. Instead of 4.5%, it's like 5.2%, and they think they're super smart. But I'll caution against that because some of these smaller life insurance companies are definitely not as stable as the big ones that have been around for such a long time. Like the other year, I saw somebody using a life insurance company out of Puerto Rico. It might be better terms up front, but look, this is something that I want to just sleep at night, right? To me personally, I want this to be the most stable thing in my portfolio. And then the other things I do are obviously more risky and higher return. But I just don't want to screw around with the stuff on this side. So generally, I would say just stick with the big guys. If a dividend is a little bit higher, one carry or the other, I'd just still go with the more reputable company there. But again, the agents will apply their sets of fee structures on it, and then obviously configure it differently with different amounts of insurance premium percentages, as we mentioned before. So that's really where the differential from your guys' side comes from as consumers to really shop this stuff out. One thing I wanted to do was just talk about the accelerated death rider benefit. This is discussed in the book Die with Zero by Bill Perkins. He was on the podcast a couple of years ago. And one of the technical things he talked about in that book was the end of life care, going to an assisted living or a SNF. Money just goes out the window. And he mentioned that it might be a good idea to insure against that risk at the end. And a lot of times these policies, you can have this be an add-on to your policy. Again, not the purpose of the whole life policy or this infinite banking or accredited investor banking setup, but something to think about. And if you still want to have term life insurance as additional add-on, that's fine. But again, this is, I think, where you have that individual conversation with your life insurance agent. When you're doing the underwriting process, it's pretty quick. I've seen people get these policies done in a month and then taking a loan and then loading it into an investment or getting access to it right away. There is some income documentation when you're applying for over a $10 million policy. So some folks, they want to put in $250,000 or more a year on them and their spouse. That's usually the threshold where you're getting a policy over $10 million. And that may require additional documentation. But generally, if you're doing something that's $50,000, $100,000 a year for 6 to 10 years, it's usually pretty light on that side. The hardest thing is just scheduling your medical review. I don't know if you need to have a blood review. I think that's where you have to talk with the agent. But I think the biggest thing there, get it done as sooner. Your health isn't getting much better. A lot of it is dictated on your age. So if you're kicking it around, I would say get started with the process and get moving with it. People take the strategy and they take it a lot of really cool places, things that I haven't really thought of. One of those, some of the people in the family office groups have found a way to triple dip it, where instead of what I was alluding to earlier was you're double dipping, right? And the double dipping is you're making money in the policy, but also your investments. But what some people have done is taken the money, put it into investments, and then getting a loan from that and then put it into the next set of investments. So you're triple dipping. And again, you're probably like, what? And that's what I was like at one time. I was like, what are these people doing? And then you introduce a little bit more risk. But if you're investing in stable assets, or in this case, I'm not super familiar with security-backed line of credits myself. I probably would only feel comfortable doing it on T-bills, for example, right? Where you can get usually 100% leverage on your T-bills because it's such a low volatility investment. And I would probably use that just for myself. That's just where my comfort zone is with paper assets. But then to get a loan from that and put it into real estate, for example. But yeah, this is the start, right? Once you start to build this policy and you get down the road and you can become sizable, multiple six figures, a lot of these strategies really open up. Some other use cases out there, upper left-hand corner, I think we talked about this, but just to sum it up, people will fund like a 6-year policy where they put $250,000 per year. They'll every year take the money out and maybe fund a deal or two, 50, 100 grand in a couple of deals. And they'll capitalize on the long-term arbitration of the rate, right? They're maybe making or paying 5% on their infinite banking policy, but making 10 to 20% accrual base at the end of the deal. The deal may not be cash flowing that much, but from our accrual base, it eventually catches up with them. Of course, investors will need to evaluate their own risk tolerance for this, but that's the concept of the growth years. When you're under a few $1 million net worth, you've got to have your money working for you. And part of that is using leverage. A lot of people will use 529 plans, which I'm not a huge fan of because you're captive to the traditional sets of options out there. And the second problem is you have to use the money on educational things. Whereas when you use an infinite banking plan as your partial 529 plan, you can use the money for whatever you want. Home remodel, kids education, investment, or you can keep the money and hoard the money in your policy. You can do whatever you want with it. The ideal place for midterm liquidity and possibly even short-term liquidity. I haven't seen anybody who's paid off their monthly expenses by funding it through an IBC every single month, like how some people do that sweep strategy kind of thing with the HELOC. Certainly, if you have a $20,000 expense that comes up infrequently once or twice a year, that's where you call a loan from your infinite banking, and in a week, you got the money in your bank account and you're off and rolling. Bottom left, endgame investors with higher net worth simply just want to fund their daily expenses out of it or have the money grow at that point. When the policy gets so big, the way you get it big is by starting today, right? Or start yesterday was the best time to plant a tree. If you get $2 million of cash value here at 5%, and mind you, that's tax-free, right? Because it's not a modified endowment contract, it's life insurance. That would be 100 grand that you live off of tax-free right there. And that can be your retirement plan. And again, when the money's in there, it's off the table of litigators. It's very good asset protection. And new investors, right? Like new investors getting started. I think this is a great place to just get things ready, start to load the gun, get ready just to set this stuff up. Now you can do an accredited investor policy, what we call AIB for short, and flash fund it all in the beginning. Or you can do like the illustration called for a 10-pay, a 10-year policy, or way I personally did my policies was like a 6-7 year policy load period. That's usually a little bit more faster. However you want to do it, this is where everybody needs to decide what's best for them. And that's dictated on how much liquidity you have up front, really. But at least when the money's loaded into this thing, you're making money tax-free at around 5%. So it beats the money market out there and it's asset protected. And I think new investors who look to access home equity, which right now, the HELOC rates are really high, right? So even more now than ever, taking loans from your life insurance policy is more than likely going to be lower than that of a HELOC. And of course, this may change over time as interest rates start to come back down. But for those people who are uncomfortable with these types of new alternative investing, alternative finance strategies, they feel uneasy about the monthly interest occurring in their HELOCs or their mortgages. Whereas the cool thing with these infinite banking policies, it's not like you have to make payments to it. There's no payment schedule. The interest accrues, but as long as you fund the policy with enough that it doesn't hit a negative amount, you don't have to worry about the policy kind of caving in on each other. I might be explaining that the wrong way. Again, you have to talk to your agent about and understand this concept. But it's a pretty simple concept. I think once you grasp onto it, it's certainly important to know. But when you configure the policy with such a low amount of insurance, it actually makes it pretty simple to hit your base premiums, right? And when, now you're seeing like the huge difference between a normally configured IBC policy at 50% premiums and a non-IBC policy at 100% premiums. You may have to be paying 5 to 10 times as much money just to keep that money alive every year. Again, get a little technical here, things for people to be aware of. But as anything, you got to learn how to drive a car. You got to know where the seatbelts are. You start to understand these things pretty quickly once you get one of these policies. But the benefits are great. And I think for a lot of you guys watching this webinar, you guys are attuned to some of these alternative investing strategies, but you likely have friends or family who they'll never buy a rental property. They'll never invest in syndications or private placements. The trickiest thing that they'll do is do like an age-based index fund. I think for those people, especially people who've paid off their mortgages, to transfer their net worth into one of these very stable policies that, again, is asset protected and tax advantage might be a great idea. Again, not giving any financial advice here, right? But I think once you understand how this tool is used, multiple use cases for this and combinations. Again, this is not financial advice, folks. But if I was starting it today, and just to throw a dart at the dartboard, if your net worth is $1 million and you net $60,000, $80,000 per year, which I think most of folks listening are at that level. And what that means is that's what you save. And I've always said it doesn't matter what your income is. People in our group, they make $500,000, $1 million a year. Some only make $200,000 a year. All I really care about is what you net at the end of the day. And that comes down to basic personal finance, keeping a freaking budget and not spending more than you make. And the net is really the important thing. A lot of you guys, like myself, have been very, at least I'm speaking for myself, I've been pretty neurotic about saving my money over the last decade. And I have to learn to loosen up a little bit. And for what I tell folks like myself is, if you can save $50,000, $100,000 a year, you're doing really good. And I'd say enjoy and smell the flowers a little bit. But that's where in this kind of base example, if you're able to save $60,000 to $80,000, maybe take a third of that or half of that, and then use that as your 5 to 7 year commitment. Or in that, we talked about the 10-year pay, contribute that amount every year for that 10 years or so. So that might mean, just for starters, $30,000 to $50,000 a year. Maybe more if you have a big load of money, couple hundred grand lying around, either in an IRA or any other non-retirement account. If you got like $1 million of just lying around, or you got it inherited, maybe you bump that $30,000 to $50,000 up to 100 grand a year, right? Just to account for that. Of course, if you have a bigger amount, that's where you do that accredited investor banking. On the next slide, I'll get into that. But you do a 90-10 policy where you minimize the fees and you max load the cash value policy. And then you just let that run. And then more than likely at that point, maybe you're getting paid more. Maybe some of your investments are panning out. And then you layer on top of that a second policy. And that's why I have so many policies, because I started small. I started smaller than what I thought I should have. And then I put another policy on top, and I got another policy on top of that. So that's how you build into this strategy. I think some people, they get maybe a little bit intimidated on, I have to do a $250,000 policy per year right away. No, you just do something and get started with it, right? The idea is creating the tool, and then over the years, you start to learn how to utilize the tool. And especially when you start to get around other accredited investors also doing the strategy and utilizing it in different ways. Now, for the accredited investor banking method here, this is again for those people who have a little bit higher net worth and certainly have a little bit more of liquidity at the moment. And the reason being is accredited investor banking is a way of flash funding the beginning part of the policy. Get money working faster as opposed to just doing 50 grand every year for 10 years. In these policies, you fund the first year, and then in theory, you may be able to do one every year and layer it that way. But that's just how the use cases between the AIB case and the traditional IBC case is done in those two methods. We go into this a lot more in detail in the Infinite Banking e-course, which you guys can find at the wealthelevator.com/club. And then once you get your login there, you should have access to the e-course portal. All these sections are broken up so it's easily digestible. And then there's some screen shares of how do I take a loan? If it's your first time, go through the curriculum. And then there's more, we get into a lot more advanced case uses for those of you guys who do originate policies, the cool tips user guide section in there too. But again, I don't have a license in this. I just use this personally myself. A lot of folks in our community do this. So I thought I'd share the strategy. If you're not a part of our community, you can go to thewealthelevator.com/bank, BANK. Or you can also go to accreditedinvestorbanking.com and you'll get redirected. There, you'll have to put in your email address to get access to the full e-course. But once you guys are ready or you want to take a look at your older policies and see if it makes sense, if it's properly configured, just reach out, team@thewealthelevator.com. Remember, this is one of the parts of the trifecta I keep talking about. I certainly think for high income earners, the tax strategy is really the low-hanging fruit for folks. Of course, you got to invest in things like real estate that get you a lot of passive losses to implement those strategies. We have the syndication e-course where, you learn how to do diligence and look at deals to pick the good ones. But the cool thing is infinite banking, you're literally making money in two places in the investments and the cash value policy. And this is one of those things that just separates you against your peer group that is just doing the traditional thing out there. It's not a get rich quick scheme. It takes a while, but I certainly think it is a lot more efficient way of getting there. It is certainly a little bit off the beaten path, which is why we say get more closer to our community. We have the mastermind group for people to join. I would certainly say that if you're investing more than $250,000, having a community around you to help learn these strategies and also look at deals together makes a lot of sense. To answer your question, what is the going rate on a policy loan today? It ranges, let's just call it like 4 to 6% there.
Thank you. Your point is that the rate today in a policy loan is obviously better than anything you can get from a HELOC or other areas. So might as well leverage that.
If we were back to 2020, 2021 days, I think the HELOCs might have been around 3%? It's usually like prime plus 1 or 2. So then it would have made more sense to pull the lazy debt equity from the HELOC. But yeah, certainly today, if you're just going by the numbers, the money is better to be here. Now we get into some of these more advanced strategies for like people buying like $1 million, $2 million plus homes. I still rent these days, but I was looking into it and I was like, what the heck are people doing? Because you can't get a mortgage for larger than 600, 700 grand. And I don't want to pay cash for it. Right. And what I've learned is like wealthy people, most of them are just trust fund kids, right? They don't really care. They don't really understand the usage of debt. But if you wanted to apply debt, it would make sense, especially in today's environment, to pay cash for it, but then take the loan on your infinite banking at that 4 or 5%, as opposed to getting a mortgage for 7, 8% these days. Or actually, for that big of a loan, it's probably like 9, 10, 11%. So a huge differential there.
And then there's the whole aspect of simple interest versus the way they compound the interest in a mortgage. And it's all back end loaded. So you're way better off with using the money from the policy loan as well.
But in this case, it's both simple interest, right? HELOC is simple interest. Just to compare apples to apples, right? The HELOC versus the infinite banking loan, both simple interest.
This is great. Thank you.
So it's a tool, right? Like I think the thing that is difficult in the beginning is starting it, because who has liquidity? No one ever has liquidity. That's everybody. Best time to start was yesterday, right? And you see how it rolls over the years. And if you're just doing $50,000 a year and you do that for 7 years, in theory, you'll have $350,000, $400,000, maybe even more, because it's growing and compounding in there for you. But then you have that nice little slush fund to do what you want with it. And then plus 10 years onto that, who knows how big that thing is.
And a death benefit for your heirs.
Yeah, but who cares about them, right? It's asset protected. That's the biggest thing. Think for yourself, man. But to that point, this is where some people, they like these types of strategies where they can assign it to their kids to do exactly what you're talking about, but they don't have to give it to them. But it's in a controlled substance mode. Whereas, hey, son, here's this policy. Here's how you use it. You take loans from yourself, but you got to pay yourself back, or you pay this moderate or low interest back to yourself. In a way, is a governor to reckless spending and buying Jaguars or Ferraris or Corvettes if you just give money away. Like, some people have certain thing resonates with certain people or kids. Some people have said great success with giving them the reins to a policy like this. And then it teaches them in real life, hey, here's how you use debt. Here's how you pay it off. And then here's how you take this debt, you put it to something else. And yeah, there's a little risk involved in that, but it's in a controlled environment.
A really large credit card with a very large limit, but really low interest rates compared to a credit card.
Yeah. Yeah. All right. Thanks everybody for jumping on. If you guys need to run any policies, let us know. Talk to you later.